Hello, CA Foundation champs. Are you all ready to test your limits? Ma'am, what are you trying to tell? Yes, I am coming up with question paper marathon where we will be discussing keeping ICAI suggested answers of all past previous attempts. So, what are the question papers going to be covered starting from the recent latest attempt, that is May 2026 until June 2024, which was all the attempts being tested as per the new scheme of CA Foundation. Now, this is the ultimate chance to turn your fears into fire and your doubts towards dominance. What can you expect from this marathon? I personally would go through whatever examiner's comment has been provided for the respective attempt, and we will literally discuss each and every question with a supportive answer, or there can also be alternative way to reach out the same. So each question will be analyzed, interpreted, and what can be the perspectives can also be understood here. This is definitely going to be a game changing tool in your preparation. Let's make the most productive session. Make sure you also pass on this to other co learners so that we can grow together. Let's rock it, guys. All the very best. Hello champs, hope you are doing amazing. In this video, let's discuss May 2026 CA Foundation Paper 1 Accounting Question Paper along with ICAI suggested answers. In the discussion, I will also highlight the common mistakes committed by students and some important points to take care while you are approaching a particular question. So with this objective, let's begin the productive session, guys. Question 1, as we all know, is a compulsory question which will have three subparts, where the first part being true or false. You will be rewarded 2 marks for each statement, wherein you have to answer whether the given statement is true or false along with the relevant reasons why it is true or false. So let's continue the discussion. First statement: cost of inventories should comprise all cost of purchase. The given statement here is false because cost of inventories will not only include cost of purchase, it also includes cost of conversion and other costs which are directly related in bringing the inventory to the present location and condition. Since in this statement it only provides cost of purchase, it will be false. Next statement. According to the decision in the case of Garner versus Murray, the loss due to insolvency of a partner has to be borne by the solvent partners in their profit sharing ratio. The given statement again is false because as per the decision of Garner versus Murray rule, the loss due to insolvency shall be borne by the solvent partners in their capital ratio and not in their profit sharing ratio. Next statement. Amount spent on demolition of an old building which was necessary for the construction of a new factory building on the same site is revenue expenditure. Again, the given statement is false because any expenditure made in order to acquire or construct a new category which turns out to be an asset will be part of your capital expenditure. Since it is considered as revenue, hence it is false. Next statement. As per Section 39 of the Companies Act 2013, in case of issue of shares, the application money must be at least 25% of the issue price of shares. As per Section 39 of the Companies Act, first of all, the given statement is false. As per this section, the issue of shares, that application money shall be at least 5% of nominal value of shares, and here it is mentioned 25% and that too on the issue price, hence it is false. Next statement. Adjustments in the form of additional information shall be adjusted in the final accounts of a non-profit organization only in one place. Again, the given statement is false. Adjustments or additional information is just indicative that those are not considered when any data of financial accounts are presented to us. So, even in the course of non-profit organization, it will not have only appearance in one place, it will have two treatments, hence the given statement is false. Next, cash book is a subsidiary book as well as a principal book. Yes, the given statement is true. Cash book part of a subsidiary book wherein the original entries will be reflected, where all cash transactions can be observed, from which the ledger accounts will be prepared. Since the same could be used as a reference where you can find the cash account balance and trial balance, hence it will be also called as principal book. Hence the given statement is true. Now let's look at what is the answer and the reasons given as per the institute. First statement, as we discussed, it is false. Reason being, it should comprise all cost of purchase, cost of conversion, and also other costs. So these three things need to be mentioned. Second statement was, as per the decision of Garner versus Murray, the loss due to insolvency has to be borne in the capital ratio and not profit sharing ratio. Third statement was, the amount spent on demolition of an old building which is necessary for the construction of a new factory building is a capital expenditure. They had mentioned it as a revenue, hence it was false. Next statement, as per section 39, application money must be at least 5% of the nominal value of shares. It is not 25% of issue price of shares. And the next statement, additional information means that information which has been identified just before the preparation of final accounts. So as non-profit organization follows double entry system, there shall be two effects for each of the additional information. Since they had already mentioned one, hence it was false. And the next statement was, cash book is a subsidiary book as well as principal book. Yes, it was true. Cash transactions are straight away recorded in the cash book, on the basis of which ledgers will be prepared. So therefore, it becomes a subsidiary book. Since cash balances are directly taken from the trial balance, it will also be treated as principal book. Hence, it is both subsidiary as well as principal book. I hope this segment was easier. Moving on to the next part of question 1. Define accounting policies in brief. Name the major characteristics which should be considered for the purpose of selection and application of accounting policies. Also state the conditions in which a change in accounting policy should be made. Again, a straightforward theory question. When it comes to theoretical concepts, this also becomes one of the potential areas, since we have also seen in the past accounting policies being tested. So first, how do we define accounting policies? In simple words, accounting policies is nothing but specific accounting principles and methods of applying those principles. So you can write the specific accounting principles and methods of applying those principles. Now, where is this incorporated? This should be adopted by the enterprise for what? In the preparation and presentation of financial statements. So this is just a simple meaning where we can mention for accounting policies. And these policies are based on several accounting concepts, conventions, and then principles. So this could be a concise definition or meaning for accounting policies. Then they've asked some characteristics. So there are three important characteristics in order to go ahead with compliance of accounting policies: that there should be no compromise in the areas of prudence, then materiality and substance over form. We can inference provide some details on this. See, the major characteristics that should be considered while selecting and applying accounting policies are prudence, then substance over form, and then materiality. As we know, there is no single list of accounting policies, that you need to follow a certain list given in order to convey that accounting policies has been systematically incorporated in the preparation and presentation of financial statements. So enterprises operate in diverse and complex environmental situations. So they will have to adopt various policies depending upon what suits to their nature of doing business. So then there was one of the component of the question which told that when can a change in accounting policies to be made? There are three areas where it would be permitted to change accounting policies. One would be it is required by some statutes, or it would ensure compliance with accounting standards. This can be written in 2 points. And third one is change would result in a better and appropriate presentation of financial statements. That is, change would result in more appropriate presentation of financial statements. So these are the points which you can easily quote when we are able to answer about accounting policies. I hope this was comfortable to all of you. Next question. The following are some of the transactions of modern stores during the month of March as per their waste book. You are required to make out their returns outward book. So here they're asking us to prepare a returns outward book. In short, in other words, it means a purchase return books. So list of transactions are given. On 8th March, returned items to Manoj Stationery Mart. 12 dozen pencils at 50 per dozen, 12 dozens at 150. So we'll multiply 12 into 50 and then 12 into 150. The total subject to trade discount at 4%. Then on 15th March, returned items which were bought on cash to Raj Stationery. So this item will not be entered in the returns book since the transaction involves cash. So this will not be observed here. Then returned computer to Vidhi Computers, which was purchased for 28,000 for office use on credit, even though it was made on credit since it is of asset. So this will again not be entered in this particular book. Then 21st March, returned items to Rajat copiers, 8 packets A4 paper at 100, and then 6 packets A3 paper at 125, subject to trade discount at 6%. Only these two transactions will be present. So we will have to prepare a purchase return book in the books of modern stores. The format will be date, particulars, details and amount. We will enter the name of the supplier, Manoj Stationery Mart, 12 dozen pencils at 50 and 12 dozen pencils at pens at 150 per dozen. So this subject to trade discount at 4%. So this will be the net amount. And then on one transaction with Rajat copiers. So that was 8 packets A4 paper at 100 per packet and 6 packets A3 paper at 125, subject to trade discount at 6%. So this will be the total of returns outward book. This was again a pretty simple one. You just have to bifurcate which transactions will enter. After we complete this, we need to give a note about those two transactions which was not entered in this particular book. See, returns of cash purchases and returns of computer are not recorded in the return outward book. So this completes the question. Once you provide the note by for what we are not recording this, since one was for cash transaction and one more was asset which was still on credit, these two will not be recorded in the returns outward book. I hope this question was easy to go through. Moving on to question number 2. Part A. On 1st April 2023, Subban Limited purchased certain machinery for 60 lakh. On 1st October 25, a part of the said machinery purchased on 1st April 2023 for 4 lakh, having become obsolete, was auctioned for 2 lakh 25,000. On the same day, a fresh machinery was acquired at a cost of 7 lakh 50 and installation charges of 40,000 were incurred in erecting it on the same day. So if we have to consider cost of this machinery, it will be 7 lakh 90,000 because we need to also consider installation charges as part of cost. Yes, the company has adopted the method of providing depreciation at 10% per annum on the written down value. All right. You are required to prepare machinery account, provision for depreciation account and machinery disposal account in the books of Suman Limited for the period from 1st April 23 to 31st March 26. So this is from the data given. They are asking us to prepare all the books, calculating depreciation to the nearest multiple of a rupee. So this area, machinery account, provision for depreciation and machinery disposal. First, a concept behind, understand this carefully. Whenever the question is asking us to prepare provision for depreciation account, it is understood that machinery will be reflecting at cost itself because all the depreciation on the respective assets will be accumulated and it will be recorded in a separate account called as provision for depreciation. In this course, any sale or any machinery which has been auctioned or which is going out of the business will be presented in a separate account called as machinery disposal account. So let's understand how to present and solve all of these. So meanwhile, I'll just open a separate document so that it helps easier for us also to refer and help you also to analyze the values which is coming there. So this was 2A. Just, oh, yeah, I hope this is visible. So first, on 1st April here, we have machinery account, provision for depreciation and machinery disposal. So first, let's understand the entries one by one, how it will be reflected in machinery and accordingly the depreciation and the provision for depreciation. Alright. So first, on 1st April 2023, Suman Limited purchased certain machinery. So the entry for this will be machinery account debit to bank. So on 1st April 2023, you can observe this entry as to bank at 60 lakh. Now, as I mentioned earlier, no machinery will be shown at net of depreciation in the asset account itself because we have a separate account for it. So depreciation will be recorded there. So on this, there should be depreciation charge. They have mentioned at 10% on WDV method. So on 70 lakh, on 60 lakh, we have 10%. So entry for that will be depreciation account debit to provision for depreciation. Now here we would have opened provision for depreciation. So on 31st March 24, you can observe the entry by depreciation. 10% on 6 lakh will 60 lakh will be 6 lakh. All right. So after we do this, no other entries in the respective year, we will close the ledger. So as on 31st March 24, by balance carried down 60 lakh. The same will be taken to the next year on 1st April 24 to balance brought down 60 lakh. I hope till here everyone comfortable. So likewise on the same note, provision for depreciation, we have recorded the current year depreciation, no other transactions. So we will also close this to balance carried down 6 lakh on 1st April 2024 by balance brought down 6 lakh. Clear. Next, the transaction is happening next on 1st October 25. So we are in the year 1st April 24 until 31st March 25. Till here, no other transactions. So when it comes to asset, you will carry at the same value 60 lakh and then on 1st April 25, to balance brought down 60 lakh. Likewise, depreciation is also to be considered. So our depreciation after subject to first year was 6 lakh. The asset is now standing at 54 lakh. It is on written down value. So the current year depreciation will be 5 lakh 40,000. Again, the same entry by depreciation account debit to provision for depreciation. You can observe that entry here. 31st March 25 by depreciation 5 lakh 40,000. So this accumulates. So total balance which is getting closed will be at 11 lakh 40 as on 31st March 25. So 2 years, all of you comfortable. Moving on to the next year. As on 1st April 25, we will bring down the balances. That was 60 lakh in the asset account and in the provision for depreciation, it will be 11 lakh 40 by balance brought down. Yes. On 1st October 2025, a part of the machinery purchased for 4 lakh having become obsolete was auctioned for 2 lakh 25. Now there is an asset, a part of the asset which is getting auctioned for 2 lakh 25. So when this happens, we will route these transactions to a separate account called machinery disposal. Now for our benefit, they have also given us the cost. This was costed at 4 lakh, which is now getting sold at 2 lakh 25. So first we will take that value from the asset account. Now the asset is going out, that is it is getting auctioned. What will be the entry? Now remember, we understood that this is getting routed through a separate account called machinery disposal. So the entry will be machinery disposal account debit to machinery. So this is on 1st October, my machinery disposal at 4 lakh. Clear? Now, after we do this, there is again a machinery purchase on the same date. So, what will be the entry? Machinery account debit to bank, that is on 1st October. See here, on 1st October to bank, the value will be 7 lakh 90. We already understood that with the discussion because it also includes our installation charges. Done. So, after doing this, that's it in the asset account. So, we can close the asset account at the balance 63 lakh 90,000. So, this is in the asset account. Coming to provision for depreciation. Now, there was an asset representing 4 lakh. With respect to that, there is a depreciation which has already been accumulated. We need to take that back from the total accumulated depreciation balance. How to do this? First, we will have to make a separate working in order to understand how much is the depreciation being accumulated with respect to this 4 lakh asset. So here we'll do the working. See here, original cost of the asset is 4 lakh. That was since 1st April 2023. So the sale is happening as on 1st October 25. Till then, we can charge the normal depreciation. See, let's depreciation at 10%, that is for first year 40,000. And then now the written down value will be 4 lakh minus 43 lakh 60,000. So on that, it will be 36,000. This is as on 31st March 25. So the asset is still in the business until 30th September because the auction is happening on 1st October. Now here we have charged depreciation for 2 years. So what is the WDV of the asset? 4 lakh minus first year 40,000 minus second year 36,000. So the WDV of the asset is 3 lakh 24,000. On this, the asset is still present in the business for 6 months. So at 10% into 6 by 12, that will be 16,200. So here all of you can just understand how this has been getting 3 lakh 24,000 at 10% for 6 months. So this will be the total depreciation. Now, don't you think this would have been accumulated in the provision for depreciation account? So we will have to take this back. I will just show you the entry, how it has been made. First, let's complete the working here. So after we deduct the depreciation, this will be the book value. The auction price is 2 lakh 25. So there is the loss on sale. So this was with respect to 4 lakh assets. Now coming to provision for depreciation account. See, this depreciation which has been accumulated should now be reversed back in the provision for depreciation account. So this will be transferred to machinery disposal. We understood how we are getting 92,200. So the entry for this will be provision for depreciation account debit to machinery disposal. So that has been recorded here. Now we have made the entries from the asset account as well as in the depreciation account. So this will be entered in machinery for disposal account. So first of all, from asset account, it was by machinery disposal. So in the machinery disposal to machinery at 4 lakh, and in provision for depreciation to machinery disposal. So by provision for depreciation 92,200. Now, since the asset at cost and the respective depreciation is present in the machinery disposal, we will complete the sale entry in this ledger itself. So, how much are we getting from the auction? 2 lakh 25. So, that will be bank account debit to machinery disposal, which we will enter as buyback. Remember, this is happening all on 1st October. So, then there was loss on sale. So, that will again be recorded here. So, the complete entry will be bank account debit, profit and loss account debit, which is your loss on sale, to machinery disposal. So by profit and loss account, loss on machinery 82,800. All these we have understood in the working. Now we have completed the treatment for the asset which was representing for 4 lakh in the provision for depreciation. Remember, there is still other assets present for which you have to record the depreciation. And also, in addition to that, there was new asset bought which was present in the business for 6 months. There should be depreciation on the same. So for this also, we can understand with the working. So we are here finding the remaining value of the asset. 60 lakh was the total assets. So in that 60 lakh, 4 lakh asset was getting auctioned. So how to calculate the remaining value? See here, book value as on 1st April was 60 lakh minus 4 lakh. So that becomes to 56 lakh. On this 10% depreciation, so that will be 5 lakh 60,000. And on the remaining book value, again the depreciation for 24-25, you're left with 45 lakh 36,000. This is the remaining asset which will again be charged at 10% for the current year. So that will be 4 lakh 53,600. And then on the new machine which was worth 7 lakh 90,000 is present in the business for 6 months. So that we will charge 39,500. So the total depreciation for the current year will be 4,93,100. What will be the entry for this? Depreciation account debit to provision for depreciation. So we can observe this in provision for depreciation as by depreciation 4,93,100. If you are wondering what is this separate 16,200 was, remember the asset which got auctioned was still present in the business for 6 months. So we are recording the depreciation for that 6 months as on 1st October. That is the entry. So as on 31st March, this will be the closing one. And after considering all of these, we will have two balance carried down. So accordingly, your machinery account, provision for depreciation, and then machinery disposal gets closed off. Here, most common mistakes committed by students would be they will not take the cost, sometimes they will take the written down value. So be careful here. And also, when it comes to provision for depreciation, make sure we are taking out the total depreciation which has been charged to the provision for depreciation till date. That is, till the asset is getting sold or auctioned. So the thing is completely taken out, reversed, and routed through machinery disposal. I hope the concept was clear and easily understood to all of you. Moving on to the next question. The accountant of Angad Traders was unable to agree the trial balance as on 31st March and transfer the difference to suspense account. On examination of the books, you observe that the accountant had committed the following errors. So they've given us the list of errors. Let's observe the requirement. You are required to pass the necessary accounting entries in the books of Angad Traders to rectify the aforesaid errors. So they're asking us to pass the rectification entry. So let's understand the transactions one by one. First, goods of the value 15,000 returned by Mr. Arora were entered in the sales day book and posted therefrom to the credit of his account. So this was sales return, but they have entered it into the sales day book. It was posted to the credit of his account. See, generally when we do a sales return account debit to respective party's account will be the entry. Now when it comes to credit, that is being considered properly. But the error here is they have routed this through sales day book. So what will be the rectification entry? Sales has been credited, that should not have been done. So when we have to rectify, we will debit it. Sales account debit. Sales return is not debited, so we will debit now. Sales return account debit. 2. Party's account was done correctly, so will not disturb that. We will route this to a suspense account. So what will be the rectifying entry? Sales account debit, sales return account debit to suspense account. See here, we can observe sales return or return inward account debit, sales account to suspense account. With respect to 15,000, 15,000, and to suspense 30,000 will be the impact. Next transaction. An amount of 3,000 entered in the sales return book has been posted to the debit of Mr. Rade, who returned the goods. This amount is entered in the sales return book has been posted to the debit who returned the book. So when sales return happens, it is sales return account debit to party's account again. So here what happened here is they have debited, they've posted it to the party's account directly. So it should not have been debited. So what do we do now? We will reverse it back and route it through which account? Suspense account. So the rectifying entry will here be suspense account debit to Mr. Rade. Now when it comes to Mr. Rade, 3,000 was the amount. Since they've posted it wrongly on the debit side, first cancellation for that 3,000 and then the correct rectifying posting should happen with the exact amount 3,000. Hence, total 6,000 will be reflected here. Clear? Yes. Next transaction, wages of 4,600 paid to workmen for making furniture on 31st March had been charged to wages account. So this is a capital expenditure treated as revenue expenditure. So what will be the rectifying entry? This should have been debited to furniture. So we will debit furniture account. Since it was debited to wages, we will cancel it out. So the rectifying entry here will be furniture account debit to wages account with 4,600. Yes. Next, a check of 12,000 received from Janak Enterprises has been dishonored and was passed to the debit of allowances account. So first of all, when check was received from Janak Enterprises, the entry would have been bank account to Janak Enterprises. When this was dishonored, we will just again reverse that Janak Enterprises to bank. This was passed to the debit of allowances account. So instead of debiting Janak Enterprises, they have debited allowances. So how will we rectify this? First, we will cancel out. So the rectifying entry will be to debit Janak Enterprises to allowances account. So at 12,000. See, Janak Enterprises account debit to allowances account. Right. Next, goods amounting to 1,600 had been returned by a customer, JV Corporation, and were taken into inventory. But no entry in respect thereof was made into the books. So there is error of omission. We need to pass the entry. So this has been returned by a customer. So it will be a sales return. So the entry will be sales return or return inward account debit to JV Corporation account. Return inward or sales return to JV Corporation at 1,600. Yes. Next, a second-hand motor car purchased for 30,000 on 1st October was debited to car maintenance account. Angad Traders charges depreciation on written down value of vehicles. So first of all, it is a capital expenditure again treated as revenue. So the entry, rectifying entry will be motor car account debit to car maintenance. This was at 30,000. So since this is an asset, depreciation should also be charged. So what will be the depreciation entry? Depreciation account debit to motor car account. 15%, remember this is purchased on 1st October. So depreciation for 6 months will be considered. See, first entry will be motor car to car maintenance and then depreciation to motor car. So if we have to observe 30,000 at 10% for 6 months will be 2,250. So 30,000 at 15%, sorry, 30,000 into 15% into 6 by 12. This will be 2,250. I hope this is clear. Next, on 31st March 2026, old furniture sold for 16,000 has been entered in the sales book, the total of which had been posted to sales account. Now, this was an asset sale, but they have treated it as goods sold. So, what will be the rectifying entry? Sales account debit, because sales was credited to furniture, which is the actual asset being sold at 16,000. Next, amount of 8,880 due from Hemal, which had been written off as bad debt in a previous year, was unexpectedly recovered and had been posted to the personal account of Hetal. Now, this was as good as bad debt recovered. So, whenever there is a recovery of bad debt, we credit it to a separate account called as bad debts recovered. So, what they done? It has been posted to the account of Hetal. So, instead of crediting bad debts recovered, they have credited Hetal's account. So, what will be the rectifying entry? Hetal's account debit to bad debts recovered account at 8,880. Got it? Yes. Next, total of discount allowed column in the cash book for the month of March amounting to 2,500 was not posted. So again, the entry is not made. So what will be the entry? Discount allowed account debit 2. We will route it through a suspense. So this will be the rectifying entry 2,500. Next, a sum of 3,500 paid towards mediclaim insurance of the proprietor had been charged off to employee benefit expenses account. This is a personal expense, so we will debit drawings. The wrong debit made to employee benefit expenses will be rectified by crediting it. So what will be the rectifying entry? Drawings account debit to employee benefit expenses account at 3,500. I hope this is clear. This completes our question number 2, both parts. Moving on to the third question. X and Y are partners in an LLP, namely Alpha LLP, sharing profits and losses in the ratio of 2:1. The balance sheet of the LLP firm as at 31st March was as follows. So they're giving us the balance sheet. Just analyzing, there are a list of assets given and then capital accounts. There is profit and loss account. Be careful about this. Bank overdraft, trade payables and outstanding liability. Additional information on 1st April 2026, they agree to admit Z as a partner for 1/5 share in future profits and losses. Z would introduce 60,000 as his capital and would also bring in his share of goodwill of 18,000 in cash. It was agreed that the goodwill account would not appear in the books of the firm. Okay. The new profit sharing ratio is also given 8:4:3. It was decided to revalue the assets, land and building, plant and machinery, and inventories. Trade payables amounting to 1,200 were considered as no longer payable. That means there was a trade payable. It is amounting to 1,200. There is a reduction in liability. Provision for doubtful debts is to be created at 5%. Y has settled the outstanding liability in full by paying 1,500 from his own bank account. The necessary entry for the same was not made in the books. Okay. The capital accounts of the partner would be readjusted on the basis of the new profit sharing arrangement, and any excess or deficiency would be transferred to their current accounts. All right. You are required to prepare revaluation account, partners capital, and then balance sheet after admission of Z. So first of all, when there is revaluation treatments so much given, it is better to complete off the revaluation account, then partners capital, and then balance sheet. So likewise, we will open all the account, revaluation, capital and balance sheet. So any entry which has simultaneous treatments can be rectified altogether. So first, revaluation account, observe all of you. It was decided to revalue the assets, land and building 1,75,000, existing balance is 140, so there is increase. So in the revaluation credit side, buy land and building 35,000, plant and machinery is 50, and in the existing balance sheet 60, so there is a downward to plant and machinery at 10,000, done. Then inventory is 25, existing is 28, again there is a decrease to inventories 3,000. Then trade payables amounting to 1,200 were considered as no longer. So this is reduction in the liability on the credit side of revaluation 1,200. Provision for doubtful debts is to be created at 5%. So 44,000 into 5% on the debit side to provision for doubtful debts. Then Y had settled the outstanding liability in full by paying 1,500 from his own bank account. Now, first of all, what was the outstanding liability balance? 1,800. Here they are telling it is paid in full by paying 1,500. That means there is a 300 benefit. So this again should be treated in revaluation account by outstanding liability 300. Make sure this is not missed. Okay. So these were the impacts of assets and liabilities rising due to admission. So once all this is entered, we will close the revaluation, find out the profit or loss. In this case, there is profit. This will be distributed to old partners in their old profit sharing ratio, that is 2:1. So after doing this, we will present the details in the partners capital. So first, buy balance brought down 1,80,000. So we will bring down the balances first. Then as I highlighted while going through the question, in this case, there is profit and loss account. This also has to be apportioned to old partners in their old profit sharing ratio. So what will be the entry by profit and loss account? The balance is 24, 2:1 distribution. Okay. Then after doing all of these, we had revaluation. We can either approach the transfer to partners capital. So the entry is revaluation to partners capital. So in partners capital, it will be by revaluation account. So these entries are done. Now addressing the admission of a new partner. First, the new partner is bringing capital. So what will be the entry? Bank account debit to Z's capital. So buy bank for the capital introduction. Next, he is also bringing his share of goodwill 18,000 in cash. First of all, this goodwill should be apportioned to old partners. And this should be done in which ratio? Sacrificing ratio. First, we need to make a working note to calculate sacrificing ratio. So what is the way to calculate sacrificing ratio? Old ratio minus new ratio. So what is the old ratio? 2:1. So old ratio is 2/3 and new ratio is given to us in the question as 8:4:3. So you can either calculate, refer to this table, or roughly I will also calculate here for x. 2/3 minus 8/15. So we need to take LCM 15. So 3 5s are 15, then 5 2s are 10, minus 8. So it will be 2/15. And for y, 1/3 minus 4/15. So again LCM is 15. 3 5s are 15, minus 4, 1/15. So again the sacrificing ratio will be 2:1. So the goodwill 18,000 will be apportioned in the proportion of 2:1. So what will be the entry for it? First, he is bringing it in cash. So buy bank 18,000. Who is bringing? Z. So buy bank goodwill, we will credit it to Z, and this will be given to the old partners. So what will be the entry? Z's capital account debit to X capital to Y's capital. So we can observe that to Y's capital to X capital and to Y's capital. Now the amount of goodwill was 18 into 2/3, 12 and 6 in Z's column. So likewise, this apportioned to the old partners by sets capital in X and Y's column. I hope this is clear. Now there was one entry with respect to outstanding liability. This was settled by whom? Y. So what will be the entry? Outstanding liability account debit to Y's capital. He is settling it at 1,500. So by outstanding liability in Y's column. All the entries with respect to admission is done. There is one treatment which talks about capital adjustment, what does it say? The capital accounts of the partners would be readjusted on the basis of the new profit sharing arrangement, and any excess or deficiency would be transferred to their current account. So this can be done in two ways. Either you can calculate it in the partner's capital account itself, or you can also do this as a working note. Since we have prepared a partner's capital, we can first find out what should be the total capital of the firm, keeping new partner's capital as base, and then apportioning that in the new profit sharing ratio, then compare the difference. So anyway, this will be the balance carried down. See, what I'm trying to tell here is, what is the new partner's capital? 60,000. 60,000. And what is his profit sharing proportion? 1/5. So I will take the reciprocal of it. So this will be 3 lakh. Now this 3 lakh should be apportioned in new profit sharing ratio. So if I have to calculate how much for X, 3 lakh into 8 by 15, 1,60,000. And for Y, 3 lakh into 4 by 15, this will be 8 lakh. Sorry, this is 80,000. And accordingly, the balance which is available, that will be for Z. This is nothing but their balance carried down. So once we enter this, observe here, two balance carried down, 1,60,000, 80 and 60. We can identify the difference. Now this difference they are asking us to route it through partner's current account. See, after totaling from the given data, there is a balance appearing on the debit side. So we will write it as 2Y's current account and then by X's current account. This will be presented in our balance sheet. First of all, in the balance sheet, we will take the revalued amount. See, land and building at 175, plant and machinery at 50, inventories at 25. Then trade receivables was 44,000. There is a provision which was created. So net will be 41,800, and then bank existing balance was 18,000. Then with the existing balance, the partner is bringing 60,000 as capital and then additional 18,000 as goodwill. So total of all this will be 96. And then we had X current account. So this X current account is nothing but coming on the asset side as 17,800 balance, and then capital account balance we anyway found out as 160, 80 and 60,000. Wise current account, that will also be reflected in the balance sheet on the liability side. Then after doing that, trade payables 24,200 was existing, in that 1,200 was reduced, so the remaining is 23,000. Bank overdraft as it is 60, outstanding liabilities was anyway settled by Y. So after you calculate, incorporate all of these, the balance sheet total will be 4,05,600. The points where students need to take care here is, one, with the treatment of outstanding liability with respect to the benefit you are getting, since it is settled at 1,500 where it was existing at 1,800. That is one treatment. And then with respect to this outstanding liabilities, it should also be entered in the partner's capital. And likewise, you can make this capital adjustment calculation either in capital account itself or make another working. See here, they have made a working to find out the capital balance. This been entered as balance carried down and then found out the difference for current accounts. I hope this is clear. Right. Next question. Kanchan runs a business of hosiery goods. She does not maintain proper books of accounts. She only maintains a record of her bank transactions. She is able to provide you with the following data of her assets and liabilities. So, assets, liabilities, opening, closing balances are given to us. Details of her bank transactions during the year were as under. Okay. Then additional information, no cash transaction took place during the year. Goods are sold at 20% profit on sales. Cost of goods sold was 3,60,000. Expenses paid include annual fire insurance premium for business stock of 7,500, which was paid on 1st Jan 2026. The insurance policy is effective from the date of payment. Okay. So then discount allowed to trade debtors and discount received is given. You are required to prepare a trading profit and loss of Kanchan and then balance sheet. So this is a question from single entry or accounts from incomplete records. Keeping the details, we will first open the respective accounts, trading, profit and loss account, and then balance sheet. One point to observe here is we need not prepare the opening balance sheet since opening capital balance is given to us. So with the available set of data, we will first incorporate and also understand what working note should be prepared. First, we will open the trading P&L and then balance sheet. So in the question, we have opening stock. So two inventories, we can write 58 and then closing stock is also given to us 68,000. So we'll first make that entry to opening stock and then buy closing stock. Done. Then we will need purchases and then sales. We will open the information one by one. Furniture and fittings, they have given us the opening and closing balance. Whenever such things are analyzed, it is always better to maintain the ledger because there could be some hidden information which we can find out. So we'll open the furniture and fittings account. So anyway, there is closing balance sheet. We can record the closing 47,500. See here, furniture and fittings account, we'll first open to balance brought down 58 and by balance carried on 47,500. So far, whatever information is available, only that we are entering. Then, trade debtors. Trade debtors, we can observe that closing balance is not there. That is required for us to close the balance sheet. So, we'll also prepare debtors ledger. So, debtors account to balance brought down 34,850. Done. Then trade creditors likewise 36,500, 34,775. So here we can enter the creditors 34,775 balance easily. Then inventories. So we will also prepare one trade creditors account in order to find any purchase details. Then we have inventories that is already entered. 68,000 can be entered in the closing balance sheet. Yes. Then bank account. See here closing balance is again not available. So we will prepare a bank account ledger as well. To balance brought down 28,850 entered here. Then details of a bank transactions are being mentioned. Collections from trade debtors. So what will be the entry? Bank account debit to trade debtors account. We have both the accounts open. So one in bank account, two debtors, 4,34,500 and in debtors account by bank 4,34,500. Done. Next, one life insurance policy of Kanchan had matured during the year and the amount was retained in the business. So if it is mentioned that it is retained in the business is nothing but additional capital. So first we will make the entry for the amount being received. Bank account debit to capital. So that will be the entry. What is the next treatment? This will be added to your opening capital balance that will be reflected in the balance sheet. See, we already had capital balance given 1,43,200. Here we are adding the additional capital which is 15,000. Clear. Next, sale of furniture and fittings. Remember we had made furniture and fittings ledger. So we will record this entry there. They've clearly given that book value of this machine, the book value of this furniture getting sold is 20 and the sale value is at 16,000. So in furniture and fittings, what will be the entry? Bank account debit, profit and loss account debit. There is loss on sale to furniture and fittings. So we will record this. By bank, we are getting 16,000. This entry should also be made in the bank account. See here, to sale of furniture, 16,000. Then, buy loss on furniture, which is 4,000. Clear with this? Yes. Then, paid to trade creditors for purchases, 3,70,000. So, what will be the entry? Creditors account debit to bank. So, buy creditors, 3,70,000. Expenses paid 69,250. So expenses to bank, this will also be entered. Since this is current year, this will also be reflected in my P&L. So two expenses. The value here is 69,250. There are certain adjustments to be done. So we will understand that. Yeah, there is one adjustment for this. So we will understand that there. Then we have purchase of new furniture and fittings. So we have made one furniture and fittings account. So what will be the entry? To bank 18,000. Then Kanchan's personal drawings per month 2,000 is given. So we need for whole year that will be 24,000. It will be reflected in the balance sheet less drawings 24,000. Since this is made, we will analyze this done through cash. So what will be the entry? Drawings account debit to bank. So buy drawings 24,000. For the furniture purchase, buy furniture 18,000. So these were the data entered so far. Then goods are sold at 20% profit on sales. Cost of goods sold was 3,60,000. So can we use these details to find out our sales? Yes. Cost of goods sold is given to us as 3,60,000. So keeping this as a base, we can find out our sales value. So that means we need to arrive at the selling price. If they tell that 20% is the profit margin on sales, don't you think 3,60,000 is representing 80 proportion of it? So I want this for the 100%. So how do I do it? 3,60,000, if there is 20% profit, is representing 80%. So what is the value for 100%? So how do I present this? 3,60,000 into 100 divided by 80. So this will help me find out my sales. So that will be 4,50,000. See here in the question, they've told that no cash transactions took place during the year. Now we have opened the debtors account. So here we'll also understand that the sales are all made on credit. So two sales, 4,50,000. Clear with this? Yes. Then expenses paid include annual fire insurance premium for business stocks of 7,500, which was paid on 1st January. The insurance policy is effective from the date of payment. See here, we'll understand the calculation for expense here. How much was the expenses given? 69,250. Now this fire insurance premium is paid for one whole year. So this was done on 1st of January. So what do we do? This is treated as a prepaid expense. So we will reduce this fire insurance premium 7,500 in the total expenses paid. Since we also had insurance premium, fire insurance premium is 7,500. We need to record only the current year expense. For how many months this is being prepaid? This will be for 9 months. So we have Jan, Feb and March. Only for 3 months it will be recorded in the current year. That is 1st Jan to 31st March. That is only 1,875. This will only be considered as the current year expense. Now understand these transactions carefully. Expenses paid included annual fire insurance premium. That is why first we are deducting here. I hope this is clear. And then in that insurance premium, we are only considering how much belongs to the current year. That was only for 3 months, Jan, Feb and March. So this will be reflected in the profit and loss account. To expenses 61,750, to insurance premium only 1,875. I hope this is understood. Next, discount allowed to trade debtors and discount received from trade creditors. Now, discount allowed to trade debtors, the entry will be discount allowed account debit to debtors. So, this will be recorded in the debtors account by discount allowed 2350. This will also be shown in our profit and loss account to discount allowed 2350. Then, discount received from trade creditors on the credit side of P&L by discount received 1725. If you had done a creditors account, this entry will also be recorded there. After doing this, we had some accounts open, left open. So we will have to close these bank transactions all entered. So at the end, we get the closing balance 13,100. This will be reflected in the balance sheet. Then there was prepaid expenses. Do not miss to record this as well. Then we had furniture and fittings, all entered transactions. So the difference will be depreciation. There was no rate or any information given. So this is the balancing figure 8,500, where and all this will be reflected in the profit and loss account. Since closing balance was already given, we already recorded that in the balance sheet. So to depreciation on furniture and fittings 8,500. And then there was the loss. This will also be recorded at 4,000. So after this, we have some missing figures to be entered. See, if we had done creditors account. Okay, first let me explain you about the sales. 3,60,000 was cost of sales. Then there was margin. We found out sales. This 4,50,000 is sales. On that 20% is my gross profit. So that will be 90,000. That is how we can record the gross profit here. Gross profit carried down 90,000. So this we have already understood as 4,50,000. See, this purchases, we don't have explicit details given, but can we find out? Yes, we can make a rough creditors account, enter the opening balance and closing balance. Let me just show it to you here. If this is a creditor's account, since your working is not given, by balance brought down, creditors opening balance is 36,500 and then to balance carried down 34,775. There were transactions like paid to trade creditors for purchase. The entry will be creditors account debit to bank. So to bank 3,70,000. Then we had discount received. So the entry will be trade creditors account debit to discount received to discount received. This will be 1725. So if we just calculate 3,70,1725 plus 34,775 minus 36,500, 3,70,000 will be the balancing figure, which is nothing but your purchases. This will be the balancing figure. So this 3,70,000 is reflected in the trading account. Two purchases 3,70,000. I hope this is clear. So after we do this, we get gross profit, then gross profit carried down, gross profit brought down. We have already incorporated all of the expenses and income. Then we arrive at net profit. This will be added to capital and accordingly your balance sheet gets closed. 1,82,225. This we found out from the debtors account itself. So that's why working note reference is given. I hope this is clear and easily understood. Next question. Question number 4. Donna, Jenny and Tony are partners of DJT Corporation sharing profits and losses in the ratio of 3:2:1. On 31st March, their balance sheet was as under. So they've given us the details of capital accounts. Anything additional? Yeah. Joint life policy is given. These are the points to observe while we are going through the question. Yes, Tony died on 31st May 2025. Okay. As per partnership deed, the following arrangements were to be put into effect. Now, whenever they are framing a death question, we should just be careful about the way of dates they are giving us to calculate, especially when it comes to goodwill and then profit, share of profit calculation. Keeping this in mind, let's read the question. The remaining partners share profits and losses in the ratio of 3:2. That means this will be their new ratio. Since they are not giving any further details, we'll also assume this to be their future gain ratio. Then the partners are allowed interest at 10% on their capitals, but no interest to be charged on drawings. Okay. Upon the death of a partner, goodwill of the firm be valued at 3 years purchase of the average net profits after charging interest on capital for the 4 years to 31st March preceding the death of a partner. Remember, the death happened on 31st May and they are asking us for the purpose of goodwill to calculate profits for the previous 4 years for the year ending 31st March. Alright. So, preceding the death of a partner will be as on 31st March 2025. Then, goodwill to be credited to deceased partner's capital account with her share of goodwill without using a goodwill account. That is, we have to route it through partner's capital. Profits till the date of death to be ascertained on the basis of average profits of previous 4 years. Now for profits also they have given us average profits for previous 4 years. Anyway, we will make the calculation of average profits for goodwill. We can use that as a reference. Additional information. The profit or loss before charging interest on capital were as follows. Okay, they're giving us past 4 years data. Average capital during the preceding 4 years to 31st March preceding the death of a partner may be assumed at 3,50,000. Now this is again an easier part since they have directly given on an average basis for 4 years. Then upon the death of Tony, her capital account is to be credited with her share of profits. Interest on capital calculated till the date of death. So date of death is 31st of May. All this to be done till 31st of May. After the death, 2 lakh was received from insurance company against joint life policy. Now remember, when joint life policy was appearing in the balance sheet, that means it was treated as an asset. So we have received 2 lakh, asset was existing it at 60. So this excess 1 lakh 40 which have to be apportioned between all partners in their old profit sharing ratio. We'll understand that calculation. Then fixed assets were revalued. So they are giving us the list of asset revaluation. Amount payable to executor of Tony was paid immediately. That means we are settling it immediately. You are required to prepare revaluation account and then partners capital after giving effect to the above transaction. So first part revaluation will be relatively easier. So first we will understand revaluation account. So point completely gives us the details of revalued, that is point number 5. So we can refer that. Land and building is valued at 3 lakh. So what is the balance sheet land and building value? It is 2 lakh 60. So increase on revaluation credit side by land and building 40,000. Clear? Then plant and machinery is depreciated by 15%. So value of plant and machinery is 1 lakh 15 on that 15%. So two plant and machinery. Then we have furniture and fixtures, which is again depreciated by 10%. The value of furniture and fixtures here is 80,000. Two furniture and fixtures 8,000. Then we have inventory, which was valued at 45,000. Inventory is 35, so there is increase by inventory on the credit side. Then we have trade receivables are all considered good and no provision is required. So if you just observe in the balance sheet, there was provision. So if the question is confirming that no provision is required, that means this needs to be reduced. So this will be recorded in the revaluation account. So by provision for doubtful debts 4,500, since we are reversing this. Done. Next, these were all the points covering revaluation of assets and liabilities. So this was the first part of the question. We have incorporated this. Then we can close the revaluation account. Total is 54,500 and then there is profit in this case which will be apportioned to all partners in their old profit sharing ratio, including the deceased partner. Then they are asking us partners capital account after giving effect to above transaction. Remember, this is happening on which date? This is happening on 31st May. Don't forget that, because we will have to record the impact, especially your interest on capital and the share of profit, to only deceased partner here. So there were three partners, Donna, Jenny and Tony. So first we will bring down their balances by balance brought down 1 lakh 60, 1 lakh 80 and 1 lakh 20. Then we have general reserve. This should also be distributed to all partners in their old profit sharing ratio by general reserve. What was the old profit sharing ratio? 3 is to 2 is to 1. So this 1 lakh 44 is being distributed to them in their respective profit sharing ratio. Then here comes the important calculation. Before that, we also found out revaluation profit. Let's close that as well. So by revaluation profit, we have transferred the respective share. Clear. Now, after doing all of these, only point pending is for goodwill. Find out the respective partner share and then credit interest on capital. Okay, the question is clearly telling that interest on capital to be credited. So what will be the entry? Interest on capital account debit to partners capital. So what is the partners capital balance? 1 lakh 20. The rate of interest is given at 10%. So 1 lakh 20 into 10% for how many months? April and May. So 2 by 12. So this will be 2000. So by interest on capital 2000. I hope till here all of you clear. Then let's move to goodwill now first. So we have to first find out the average profit. 1 lakh 46,600 plus 1 lakh 88,000. There is a loss in between 69,200 and then 1 lakh 52,200. So 4 lakh 17,600 divided by 4. 1 lakh 4,400 is my average profit. See here 1 lakh 4,400. Now remember, the question is clearly emphasizing that these profits are before charging interest on capital. We have to take out the interest on capital. They've given us the average capital for 4 years. So we can use that as a base. 3,50,000 at 10%. So that will be 35,000. So after we deduct that, we will have 69,400. This is nothing but adjusted average profit. We want goodwill. What is the number of years of purchase? It was 3 years. So 69,400 into 3. So that will be 2,80,200. So this is firm's goodwill. We want the partner share. So what is the proportion of Tony? It is 1 by 6. So 2,08,200 into 1 by 6. This is 2,08,200 into 1 by 6, that is 34,700. Now what will be the journal entry for this? See, first of all, this is the share of goodwill. This will be apportioned to the existing partners in their gain ratio. So the entry for this will be gaining partners capital account debit to deceased partners capital. So Donna's capital account debit, Jenny's capital account debit to Tony's capital account. So the amount is 34,700 in the proportion of 3 is to 2. So into 3 by 5, this will be 20,820 and 2 by 5, 13,880. This will be presented in the capital account. Donna's, Jenny's to Tony's capital. See here, to Tony's capital in Donna's and Jenny's column, and then by Donna and Jenny in Tony's capital account. You can also show this separately as well. So this was the point for goodwill. Then we have share of profit. With respect to profits, see profit till the date of death on the basis of average profits of previous years. So we have anyway calculated average profits. How much was average profit? 1,04,400. Remember, this is average profit for the whole year. We just want it for 2 months, that is April and May. So 1,04,400 into 2 by 12, that will be 17,400. This is the profit from which we have to deduct interest on capital since we are providing it separately. How much is the interest on capital? First of all, understand most of the students miss out here itself. This is the total firm's profit representing for 2 months. So here we should also consider the total capital and then take the interest on the same. See, what is the capital balances using question and reference? 1,60,000 plus 1,88,000 plus 1,20,000. This is 4,68,000. Rate of interest is given at 10%. We need it only for 2 months. So that is 7,800. Do not miss out on this. This is where most of the students go wrong. Please be careful here. And then after we take out capital, we arrive at the adjusted profit 9,600. Again, remember this is the firm's profit. We only want what is the share representing to the deceased partner. 9,600, 1 by 6, that will be 1,600. What will be the entry for this? Since we are doing it in between the year, we will route it through a temporary account called profit and loss suspense account. So the entry will be profit and loss suspense account debit to deceased partner's capital. So this will be reflected in the capital account as by P&L suspense. 1,600, we have made the working how we have got this. So this is the consideration. Then there was one joint life policy. After the death, the partnership firm is receiving 2 lakh. So first of all, there are two ways of treating this. Since this was recorded as an asset, we can easily route it through revaluation account, showing this as an increase in the asset. So that will automatically have an impact in your revaluation account. If not, since this excess belongs to the partners, we will distribute it to all partners in their old ratio. Now, how much is the extra balance they've got? 60,000 was already reflected. 2 lakh they're receiving. 1 lakh 40 is excess. What is their profit sharing ratio? 3 is to 2 is to 1. So 1 lakh 40,000 into 3 by 6, 70. First of all, let me tell you the journal entry. When they receive it, bank account debit to joint life policy account will be the entry. This joint life policy should be distributed to all the partners. So joint life policy to all partners capital. By joint life policy, 1,40,000 into 3 by 6 and then 1,40,000 into 2 by 6, that will be 46,667 and 1,40,000 into 1 by 6, 23,333. This will be the impact from joint life policy. Now, after doing all of these, the question has clearly told that amount payable to Tony was paid immediately. So first we will find out how much is the amount due. That will be paid immediately means you will reflect through bank account. All of these total, then that will be 2,10,508. Then for the other two partners, we will have balance carried on. This will be written as two bank, two balance carried on. This will be reflected in the balance sheet. In bank balance, if it was asked, we will also show this as a reduction, whatever was paid. So these were the respective working notes. As mentioned, see, for joint life policy, we can also consider it in the revaluation account. If you take it in the revaluation account, what happens? This is increase in the asset by joint life policy 1 lakh 40. This again you need not reflect in the partner's capital because the impact of 1 lakh 40 would have already been resulted here in the amount you're transferring to revaluation. So I hope both alternate ways of doing is clearly understood to all of you. Just practice this once well before, especially points of goodwill calculation when it comes to profits, average profits, and the interest part. And then when we are calculating the share of profit to the deceased partner. Clear? Yes. This was next. Moving on to the next question. The following is the trial balance as on 31st March of Mr. Suresh, a retail trader of books. So they have given us the list of items. Then value of stock in trade at the close was 1 lakh 55. Provision for doubtful debts is given. Depreciation is given on furniture and delivery van computers. Audit fees for the half year ended amounting to 15,000 is outstanding. Term loan from bank was obtained on 1st May. Interest is at 10%. Fire took place in the godown on 27th March and destroyed stock worth 40,000. The insurance company has admitted a claim of 50% for the said loss on 31st March. You are required to prepare the trading and profit and loss account of Mr. Suresh for the year ended 31st March and balance sheet as at that date. So this is a final accounts question. First, we will open all the formats: trading, profit and loss, and then balance sheet. So as and when we run through the item, it becomes easier to analyze. So first, we need opening stock. So there is opening stock available, stock on 1,425, 1 lakh 25. So two opening stock 1 lakh 25,000. Then we have purchases visible. So purchases 8 lakh 60. So let me make an entry 860. Then let's go one by one. Carriage inward is a direct expense, so appears in trading account. Two carriage inward 18,000. Then carriage outward indirect in profit and loss. So two carriage outward 22,000. Then we have returns inward. Return inward means sales return. So there should be buy sales. We will first make returns inward entry 55,000. Purchases return salaries 1 lakh. Indirect expense, so two salaries 1 lakh. Then rent 30,000. Indirect again nothing mentioned, so 30,000. Interest on term loan 51,000. Remember there was details given for loan. Term loan from bank was obtained on 1st May. Year ending is on 31st March 26. Interest is payable at 10% per annum. So first of all, what is the amount of term loan? Term loan from bank is 6 lakh. So considering the rate of interest, 6 lakh at 10% for how many months? The loan is borrowed on 1st May. So this will be for 11 months. It should be 55,000. How much is given here? Interest on term loan is given as 51,000. That means 4,000 is still outstanding. So we will record that. 2 interest on loan 51. Outstanding 4,000. How do we show the working? 6 lakh at 10% for 11 months. That will be 55. We've already paid 51. So 4,000 will be outstanding. What is the one more treatment for this? This is your liability. So in balance sheet under term loan, add outstanding. You can also show this as an addition or show it separately as well. Then printing and stationery, indirect expense. So to printing and stationery 10,000. Sales promotion, again same thing, indirect 12,000. Then interest received, since we are covering on the same page, we are running through the same item. P&L by interest received 9. Sales given, so in trading account buy sales 13 lakh 50. Returns outward means purchase return, so less return outward 48,000. Discount received P&L credit side 30,000. Capital account as on 1st April. This is your opening capital balance in the balance sheet 6 lakh 29,000. Term loan from bank, we will also make this entry as a liability 6 lakh. Sundry creditors 1 lakh 80 in the balance sheet liabilities. Yes. Then we have general expenses. in profit and loss account to general expense 20, discount allowed P&L to discount allowed debit side. Then audit fees up to 30th September is given 50. There was also an adjustment which told that half year is outstanding. So what is the current year expense? 15,000 plus 15, 30,000. So to audit fee, add outstanding 15 and 15, 30. This is again one more a liability. So audit fees outstanding 15,000. Clear. Then term loan from bank was obtained. Sorry. So here electricity charges, we will record this in P&L. Two electricity charges 14. Delivery van an asset. So recorded in the balance sheet 4,50,000 in the inner column. Remember there was depreciation given at 15%. So on 4,50,000 at 15% is 67,500. This will also appear in the P&L. So they are just showing this as one working. 67,500 here for delivery van. Then we have furniture and fixtures 1,50,000 in the inner column. On 1,50,000 at 15% again. So this will be 7,000 22,500 plus 22,500. Then we have computers 1,20,000 at 40%. So this will be 48,000. So total depreciation will be 1,38,000. So accordingly, this will be reflected in the balance sheet computer minus depreciation. Then cash at bank 1,40,000. So 1,40,000 in the balance sheet. Cash in hand 65,000. 65. Drawings in the balance sheet minus capital less drawings 1,20,000. Then insurance premium is given 7,000. P&L debit side. Sundry debtors 3,50,000 in the balance sheet. Sundry debtors in the inner column. Investments again an asset in the balance sheet. Asset side 90. So this was your details from the trial balance. Then we move to additional information. Value of stock in trade, that is your closing stock. So in the trading account, buy closing stock 1,55,000. The same will appear in the balance sheet. Stock in trade 1,55,000. Then provision for doubtful debts is maintained at 2.5% of sundry debtors. So debtors was 3,50,000 on that 2.5%, which will be 8,750. The same will appear in the P&L account to provision for doubtful debts 8,750. Then depreciation done, dual treatments done, audit fees also done, term loan is also done. Then a fire took place in the godown on 27 March and destroyed stock worth 40,000. The insurance company has admitted a claim of 50% for the said loss. So what will be the treatment? First, when this happened, the entry would be loss by fire account debit to purchases. So when we are crediting purchases, the balance from purchases should come down. So less loss by fire 40,000. Since this is loss by fire debited, so this will be reflected in your P&L as to loss by fire 20. Now in the question they've told insurance company has admitted a claim of 50%. That means they've admitted means it is receivable. So we'll record the 50% of the loss as receivable. That means an asset. So total loss is 20. How much you are expecting? 10,000. So sorry, the total loss is 40. How much we are expecting? 50%. So insurance claim receivable is 20,000. So let me give you a complete entry how this will be worked out. First, loss by fire account debit 40,000 to purchases 40,000. This would have been the entry if there was no insurance claim received. Now since this is claim that 50% is receivable, so insurance claim receivable account debit, that is 20,000 to loss by fire 20. So now what happened? Your loss by fire came down by 20,000. Henceforth, in P&L, you can observe this at 20,000. And since that balance will be shown as a receivable 20,000. I hope this is clearly understood. Now this completes recording of all the transactions. So first step is to close your trading account. Find out gross profit. That will be 5,35,000. Buy gross profit bought down. Then after considering all of these, net profit 85,250 will be added to your capital balance, and accordingly you can close the balance sheet at 13,93,250. I hope this is clear. Few transactions were pretty simple. Most students where they can find it difficult would be the treatments connected to this. Be careful with respect to that, and rest all was pretty simpler. You have to just go through with the wordings given, and outstanding treatments will have dual impacts. Clear with this? Yes. So this was our question number 4. Yeah. Moving to the next question. Attempt any one of the two parts, that is either 1 or 2. See, always if you observe, question 5 will always have an internal choice. So in this first part, you can either opt 1 or 2. So first part, profit and loss account of Prabhat showed a net profit of 15 lakh. So after considering the closing inventory of 9,37,500 on 31st March, on scrutiny it was observed as under. Purchases for the year included 37,500 paid for new electrical fittings for the Goda. Goods valued at 1 lakh were given away as free samples for which no entry had been passed in the books. Invoices for goods amounting to 6 lakh 25 had been entered on 27 March, but the goods were not included in the stock. In March, goods were sold and delivered were taken in the sales for April 2026. Goods costing 1,87,500 were sent on sale or return basis in March at a margin of 33.33% on cost. Though approval was given, these were recorded in the sales for March. You are required to ascertain the value on 31st March and the adjusted net profit for the year ended on that date. Now here they have given us the profit balance and then also the value of closing stock. Then asking us to find out the revised adjusted net profit and the value of inventory on 31st of March. So in order to consider this adjustment, we will prepare a profit and loss adjustment account. So first we will bring down the given profit, which is 15 lakh. That is by net profit brought down. We can write it as by net profit 15 lakh. Done. Now, side by side, we also need to find out the closing inventory, which is given as 937,500, considering the impact of transactions. So, for that also, we will make a separate statement. So, first taking this as a base, which is given 9,37,500. Then, purchases for the year included 37,500 paid for new electrical fittings for the Goda. Now, what happened? Purchases, first of all, is your expense. So, that has also included those paid for electric fittings, which should not have been the part of that purchases. So, this should be impacted in the profit and loss account. So, in profit and loss account, electric fittings will appear, will impact in your P&L. Whereas purchases should be reduced since they should not be part of the purchase expense. Here we are just preparing P&L adjustment, so we will consider the trading impact on the reversal side. So purchases should have been reduced. That means expenses reduced. It is nothing but as good as increase in your income. So that's why we are routing this on the credit side as buy electric fittings 37,500. I hope this is understood. Next, goods valued at 1 lakh were given away as free samples for which no entry had been passed in the books of the accounts. So what is the entry fee reflect this? Advertisement account debit to purchases. So again, there is no trading account. We are crediting purchases. So buy samples 1 lakh. I hope why this is appearing on the credit side with respect to the impact we are discussing. And then in the P&L, advertisement will appear on the debit side. So thus we will reflect as 2 advertisement samples 1 lakh. Next, invoices for goods amounting to 6,25,000 had been entered on 27th March, but the goods were not included in stock. First of all, this has been entered on 27th March means while you're counting, this has not been included. So don't you think when it comes to closing stock, this also should be recorded? So first we will record that 6,25,000, add purchases which is not included in stock 6,25,000. Now what happens in the P&L account? this has been entered, but the goods were not included in stock, means we will also have to impact this to our closing stock. Imagine in trading account, this should be aggregated to the closing stock. So that's why on the credit side, buy stock purchases not included 6,25,000. I hope this is clear. Then in March, goods of 5 lakhs sold and delivered were taken in the sales for April 2026. Now we are closing down the details as on 31st March, but what they have done is this was taken for the April. If it was doing for April, we had to reverse this. Since no entry has been reflected in March, we will record that 5 lakhs sold. That means this is part of your revenue. So we will include this. This were taken for April 2026 as buy sales goods for 5 lakh. And then next would be goods costing 1,87,500 were sent on sale or return basis in March at a margin of profit of 33.33% on cost. Though approval was given in April, these were recorded in the sales for March 2026. First of all, we are finding out the value as on 31st March. Status of this goods is still not a concluded sale. It is still sent on approval. So we have to result the implications created due to the assumption made as sales. First, what happens in profit and loss? We have sent this goods on approval. This gets added back to your stock. But when it comes to stock, we will treat it at cost price. Remember that carefully. What is the cost price? 1,87,500. So we will first make the entry buy stock of goods sent on approval at 1,87,500. Now, since this was recorded as sales in the month of March, we need to reverse the impact. So what we will do? To sales. Remember, when this was recorded, this would have been taken at selling price. So they have given us cost price and they've also given us 33.33% as a percentage on cost. Don't you think we can find out the selling price? Yes. 1,87,500 plus 33.33% will be 2,49,000 and odd. So we can round it off to 2,50,000. So this will be taken back reverse. So that's why we are debiting to sales. So this is also part of your stock. This was not record. This was considered as sales of March, which is not your sales. If you were taken it as sales, you would have reduced. Since this is not a sale, we will add back. So goods lying with customers on approval basis at cost. Remember, this is your stock. So we will take cost here 1,87,500. Now after considering all the impact, we will find out the adjusted profit taking total of the credit side. We get 26 lakh as the adjusted net profit, and in the stock statement 17 lakh 50 will be a revised closing stock. I hope all of you understood this calculation. Next, on 31st March, the bank account of Sagar, according to the bank column of the cash book, revealed a debit balance of 37 lakh 25,000. So this is a favorable balance, that is bank column of the cash book revealing a debit balance. On examination of the cash book and bank statement, you find that. So first let's observe the requirement. You're required to make appropriate adjustments in the cash book to arrive at the correct balance and to prepare a statement reconciling the adjusted balance in the cash book with the balance shown in the bank statement. That means here we need to prepare what? Adjusted cash book, find out the revised cash book balance and then take it to BRS. So when the question is on adjusted cash book, first approach is to bifurcate the transaction which comes in cash book and which in BRS so that it becomes easier. Why do we do this? Because those entries which is already considered in cash book will again not be appeared in BRS. Okay. So first statement. Checks amounting to 3 lakh which were issued to trade payables and entered in the cash book before 31st March were not presented for payment until that date. So this is due to a timing difference. It will have no impact in the cash book. So this will go to BRS. Then checks amounting to 12 lakh 20 had been recorded in the cash book as having been paid into the bank, out of which checks amounting to 9 lakh 75 had only collected by the bank. Again, this is resulting due to timing difference. There will be no effect in the cash book. So this will appear directly in BRS. Then a term deposit matured on 13th March and proceeds amounting to 2,82,500 were credited to bank and entered in the bank statement but not recorded in the cash book. So if we are aware, we would also make this entry in the cash book. So this will appear in cash book. Then inspection fee of 15,000 debited by the bank had not been accounted for in the books of accounts. Books of accounts mean cash book. So we will make the entry in cash book. Payment of 33,000 made to a creditor had been wrongly entered as 30,000 in the cash book. Again, error in the cash book will be rectified in the cash book. Trade association subscription 5,000 was paid directly from the bank as per mandate, yet to be accounted for by Sagar. That means no entry in the cash book. We will make the entry. A bill payable of 2,50,000 had been paid by the bank but was not entered in the cash book. So we will make an entry in the cash book. Bill of exchange for 1,40,000 had been discounted with the bank at a cost of 2,000 but no entry had been made. So again, no entry. So we'll make the entry in the cash book. So first in the adjusted cash book, we will open the account as two balance brought down. Observe here, two balance brought down 37,25,000. Now we have made the bifurcation. So let's analyze the entries one by one. Term deposit matured and proceeds 2 lakh were credited to bank. That means our bank balance should increase. So what will be the entry? Bank account debit to term deposit. So to term deposit 2,82,500. Next, inspection fee. Again a charge. So inspection fee to bank by inspection fee 15,000. So here they have given dates. You can also mention the respective dates. For some entries, there are no dates. So it is always better to consider this on the year end, 31st March. Okay. Then payment of 33,000 made to a creditor had been wrongly entered as 30,000 in the cash book. The actual payment was 33. You have made a short payment. So we will consider the extra payment. So on the credit side, by creditor 3,000. Clear? Then trade association subscription 5,000 was paid. Again an expense. So by trade association subscription 5,000. Then bill payable had been paid by the bank but was not entered in the cash book. What will be the entry? Bills payable account debit to bank. So we'll enter this as by bills payable 2,50,000. Then bill of exchange had been discounted at a cost of 2,000 but no entry has been made in the books. So first let me tell you the entry. For this discounted, what will be the entry? Bank account debit, discounting charges account debit to bills receivable. This will be the entry, right? So what will be the amount? They are telling that bill of exchange was 1,40,000. So you are discounting it with 2,000. So you are receiving 1,38,000. We have to reflect this in the adjusted cash book. So how will we write this? Two bills receivable. Remember, when there is compound entry, we take the corresponding amount. So two bills receivable 1,38,000. We have considered all of the entries. Considering all of the total, we get the revised balance as 38,72,500. This will be your balance starting for BRS. There were two transactions which were resulting due to timing difference. First, checks amounting to 3 lakh which were issued to trade payables entered in the cash book. So checks issued is nothing but payment made. So if this is your cash book and this is your passbook, when checks were issued, the balance is reduced, which is my base book, cash book. In order to match the balance, I will have to add. So check issued but not presented, 3 lakh. Then checks amounting to 12 lakh 20 had been recorded in the cash book as having been paid into the bank, out of which checks amounting to 9 lakh 75 only collected. So there is a difference, 12 lakh 20 minus 9 lakh 75, 2 lakh 45 resulting into difference. When checks was paid, you have an increased balance in the cash book for 12 lakh 20, but in passbook only up to 9 lakh 75. In order to match, I will have to bring down the balance of the difference, which is 2 lakh 45. So less checks paid but not collected, 2 lakh 45. So your balance as per passbook will be 39,27,500. I hope these steps are easy and clearly understood. Next. Next question. Summary of receipts and payments of Urban Healthcare Society for the year ended is given. So the list of receipts is given, payments is given, and then additional information. Subscription due, subscription received, stock, amount due, value of equipment. You are required to prepare income and expenditure account, and all the working should form part of the answer. So here they're just asking us income and expenditure, but there are a lot of important working notes involved in this. So first let's begin with the given set of details. Receipts, opening cash balance is given. Since there is no balance sheet to be prepared, this will have no relevance. Subscription income is given. 1 lakh 50. Subscription receipt is given. We need to find out subscription income. So 1 lakh 50, there are details of opening, subscription due and closing. Subscription received in advance, opening, closing is given. So we can find out 1 lakh 50,000, 4,500 does not belong to current year, so minus. 6,600 belongs to current year, so plus. Then 3,600 belongs to current year, so plus. Minus 2,100 does not belong to current year, so minus. So the subscription income will be 1 lakh 53,600. We can write this in the form of working note. See, this working can be written which one you will add and which one we will subtract. Since they have asked, it will form part of your answer. Make sure this is shown clearly. Yes. Next, there is donation 45,000 raised for meeting revenue expenditure. No other adjustment pertaining to that. So we will record this as income. By subscription is done, by donation 45,000. Then interest on investments at 9%, 27,000 is given. No other treatment with respect to this, so we will directly record interest on investment 27,000. Then health check up camp collections is given 37,500. Connected to this, if there is any expense, if there is any payments, we need to check. Yes, there is one health checkup camp expense 4,500. So this is income and expenditure. So we will net off this and show. So 37,500, that is receipts is more. So by profit, or you can just write by health checkup camp collections. So 37,500 minus expense 4,500, net we are showing here. Then coming to payments. Payments for medicine supply is given. Now with respect to this, we need to make an important observation. Stock of medicine is there. Amount due for medicine supply is there. You're making the payment of 90,000. Amount due, that means it is outstanding. So we will have to make a working note for this. First, 90,000 expense. Opening outstanding, we will reduce 45,000. Opening outstanding, that is 45,000. Then sorry, this is stock of medicine. Opening is 27,000. So this is 27,000 minus, and then closing 39,000 add. So what we did first was we found out what is the current year expense. Purchase payments is given, that is 90,000. Opening outstanding less because this does not belong to current year, and then closing outstanding add 39,000. That's what we did here. So this gave us the purchase expense. Now observe, there is stock, opening stock of medicine and closing stock of medicine also available. Now when this is the case, we can find out what is the medicine consumed for the current year, which should be recorded in income and expenditure. So using this opening and closing balance, we take opening stock plus purchases minus closing stock will give us the current year medicine consumed. So stock of medicine opening is 30. Purchases we already found out, that is 1,02,000. We will take that here. See, this is taken here, and then minus closing stock, which is 45,000. So what is the medicine consumed in the current year? 87,000. This will be reflected in the income and expenditure as to medicine consumed. Remember, this is one of the very important working note. Make sure you do not miss on any of the points. Then we have honorarium to doctor. So we will record that to honorarium 30,000. Miscellaneous expense 3,000. Then equipment purchased is given. Remember, this is the revenue natured account. So this will be reflected in the asset account in order to find out the depreciation impact. See, 63,000 is given. In the current year, we are also purchasing something for 45. So better we present this in the account, or you can also make such working. So how to calculate that? See, roughly to show, opening balance of equipment is 63,000. Then we are purchasing 45,000. Closing balance is 90. So the difference will be your depreciation. 45 minus 90, which is 18,000. That is what is being also shown here. This will be depreciation shown in the income and expenditure, depreciation on equipment 18. Then we have another asset, building. There's no other extra details given. So 1 lakh 50 minus 40, 1 lakh 44, we assume the difference is for depreciation. So building 6,000. Clear with this? So after considering all of these, then we have subscription taken, stock of medicines, honorarium. Yeah, there was one salary. So that will also consider here two salaries, 84,000. After we incorporate all of these, we can close the income and expenditure. Here there is a surplus of 30,600. The important calculation, important working in this question is your subscription account and then the payment for medicine, and then from that finding out what is the cost of medicine consumed, which will be recorded in the income and expenditure. I hope this is understood and clear to all of you. Next question. The balance sheet of Star Limited, unlisted company other than All India Financial Institution, Banking Company, NBFC, and Housing Finance as at 31st March is as under. Now, why do you think these requirements are given? This is with respect to the debenture redemption topics. So, let's understand first what is the requirement. At the AGM, it was resolved to give existing shareholder the option to purchase two rupees 10 shares at rupees 15 per share for every 5 shares held prior to the bonus distribution. This option was exercised by all shareholders. When they are mentioning existing, this easily means they are pointing out on issuing right shares. So after providing this, they are going for bonus issue to issue one bonus share for every 6 shares held. Then to repay the debentures at a premium of 10%. The debenture redemption reserve investments realized at par as per existing book value. Okay, so for this they are asking us to give necessary journal entries in the books of Star Limited. So let's understand this one by one. In the books of Star Limited, first we will make a right issue. In order to consider, first we need to find out what is the existing number of shares, 30,000. So 30,000 is the number of shares. Right ratio is given as option to purchase 2 rupees 10 shares for every 5 shares held. So this will be 2 by 5. 30,000 into 2 by 5, 12,000 is the number of right shares. And the share price face value is 10, which is being offered at 15 rupees. So what will be the journal entry? First, bank account debit to equity share application. That is for 12,000 shares at 15 rupees. First you are receiving. So 12,000 shares at 15 rupees. Then we will transfer this to share capital. Equity share application allotment, you can address it like this: to share capital to securities premium. 12,000 at 10 rupees for share capital and 12,000 at 5 rupees for securities premium. This completes our right shares. Then there is bonus issue. One bonus share for every 6 shares held. Now, there was existing 30,000 shares. From right shares, the number of shares has been increased to 42,000. So, the bonus ratio here is 1 share for every 6 shares held. That will be 7,000 shares. So, the requirement of amount will be 7,000 into 10, 70,000. So, we have only free reserves available, which is statement of profit and loss. Not to miss here, we also had a balance from securities premium due to issue of right shares. We'll also utilize that. So what will be the first entry under bonus issue? Securities premium account debit 60, which is directly coming from here, and then the remaining 10,000 from the existing profit and loss balance to bonus to shareholders. First we are making it due and then we are issuing the bonus shares. Bonus to shareholders account debit to equity share capital 70,000. So this is your right shares and bonus share entry. Next is for your redemption. Redemption is happening at 10% premium. So first we can make it due. What is the amount of debentures available? It is 70,000. 70,000, 10% premium on the same. So what will be the due entry? 10% debentures account debit, premium on redemption of debentures account debit, that is 7,000 to debenture holders. This will be the due entry. Now, with respect to this, there is debenture redemption reserve investment asset account also maintained. So they have told that it is realized at par value. Observe here. This is the asset valued at 10,500. So first we will realize money by selling this. So what will be the entry? Bank account debit to debenture redemption reserve investment. So here the entry is reflected here as per the suggested answer. You can also write it immediately after this due entry 10,500. After this, we need to provide for debenture holders. Remember, the total amount due to debenture holders will be 77,000. So here we will have balances presented in debenture redemption reserve. When the debentures are redeemed, we will transfer it back to general reserve. So the transfer entry will be debenture redemption reserve account debit to general reserve 7,000, 7,000. How to figure this out? If you observe, there was the detail of this given in the balance sheet. Then we had this premium which will be written off by the profit and loss balance. So statement of profit and loss account debit to premium on redemption 7,000. This is the another entry. At last, we need to make the payment to debenture holders. So debenture holders account debit to bank. I hope this was pretty simple to understand. Now for all of those how we calculated shares, we need to just show the working, how the right shares came and how the bonus shares was arrived at. Do not miss that you have to consider the bonus issue after right shares. So existing number of shares which was 30 and from the right shares 12. On that number of shares you will make bonus issue. I hope this is clear. Right. This completes your question number 5. Then moving on to the next question. Question 6. First, Orange Limited issued a prospectus inviting applications for 2,50,000 equity shares of rupees 10 each at a premium of rupees 2 per share payable as under. On application, you are receiving 2 rupees. On allotment, 4 rupees. This includes a premium of 2. And then on first and final call, 6 rupees per share. Applications were received for 7 lakh shares. That means there is a situation of oversubscription. Letters of regret were issued to the applicants for 30,000 shares and shares were allotted to the remaining applicants. Letters of regret means they are outrightly rejecting this. When they are rejecting, there will also be a refund. Then for the remaining number, that means remaining 6 lakh 30, they are going with pro rata allotment. Excess money received with application was adjusted towards sum due on allotment and the balance amount will be returned to the applicants. Okay. The first and final call was made. The amount was duly received except from Mr. Mohan belonging to category C who had applied for 5,000 equity shares. His shares were forfeited. Okay. The forfeited shares were reissued at a discount of rupees 1 as fully paid up. You are required to pass necessary journal entries for the above transactions, including bank transactions in the books of Orange Limited, and then show detailed working of amount received on application, amount adjusted, allocated to share allotment, and the amount refunded. So, a very good question for a good weightage of marks. So, as usual, first we will record the issue entry. First will be you're receiving application money. You're receiving applications for how many shares? 7 lakh shares. So what will be the entry? Bank account debit to equity share application. 7 lakh shares at rupees 2 per share. That is at 14 lakhs. Now this number has extra money which will be first provided to allotment, that is the next installment, and anything extra will be refunded. So first we know that 30,000 is outrightly rejected. So there will be refund going for this 30,000 at 2 rupees. This is one part. Second, we need to make a calculation to understand how much is given for allotment and how much extra is refunded. So for this, you can also refer the institute's working note which is given here below, or else I will just roughly make one here to understand it clearly. So this would also be simpler. Which one you are comfortable, you can follow that. So first, there are three set of category of shareholders given. Let's analyze that. Now, if you observe category A, 70,000 they applied for, they were also allotted 70,000. So here there is no extra application money we can configure. So this for calculation purpose we can ignore. So we have category B and category C. So first we will ascertain what is the excess application money. So first observe category B. Number of shares applied is 2 lakh. Number of shares allotted is 1 lakh. That means 1 lakh number of shares has got excess application money. So 1 lakh shares at 2 rupees per share. Excess application money received for category B is 2 lakh. I hope this is clear. Then coming to category C, number of shares applied is 4 lakh, whereas number of shares allotted is 80,000. That means there is 3 lakh 20,000 applications extra, with respect to which I've received 2 rupees per share extra application. So 3 lakh 20 at 2 rupees will be 6 lakh 40,000. Now the question has clearly told excess money received was adjusted towards sum due on allotment. So next we will see allotment money due. Coming to category B, number of shares allotted is 1 lakh. So allotment money, remember here it also includes premium. So what is the total allotment money due? 4 rupees for 1 lakh shares. So allotment money due is 4 lakh. Coming to category C, 80,000 shares at 4 rupees. Allotment money due is 3 lakh 20,000. I hope this is clear. Now when it comes to adjustment, excess application money I can fully provide for allotment money. See here, still 2 lakh will be remaining. Allotment money wise, still 2 lakh would be remaining. Yes. Then when it comes to category C, I have enough balance. So I've provided that extra remaining is 3 lakh 20. This is not for allotment money. Allotment money for category C is turning nil because completely provided. Extra balance 3 lakh 20,000 should be refunded because the question provides that. See, excess and the balance amount is returned to the applicants. This is the simple working. Now, keeping this, we will understand what is the journal entry. First, what is the entry we have understood? We have received the application money. Now, the next entry would be to transfer the application money to share capital, allotment, and then refund. So, what is the next entry? Equity share application account debit to equity share capital with respect to the number of shares allotted, how much shares they are allotting in total. See, first of all, 2,50,000 for what they have received the application, and they are completely allotting for how much shares they are allotting it for 6 lakh and 70,000 shares. So now if we observe, allotment application money is 2 rupees. So 2,50,000 for which number of shares were applied for, we will transfer the application money with respect to these number of shares. So 2,50,000 at 2 rupees. This is transferred to share capital. Then to equity share allotment. Now we will refer the working. See here, from this working, how much we are able to provide from the excess application. First, if you observe, we are able to give 2 lakh from this balance. We are able to give 2 lakh and then 3 lakh 20,000. So how much is total? 5 lakh 20,000 is being taken to equity share allotment. I hope this is understood. What we did, what was the excess money which is being provided to allotment is being taken. And then we also had to make some refund. First, 30,000 was outrightly rejected. So 30,000 at 2 rupees, that will be 60,000. Here we have the calculation 3 lakh 20,000. 3 lakh 20 plus 60 is how much? 3 lakh 80,000. So this has been refunded. So this is again an important entry where you can easily ascertain the balance. As I told, you can either understand this table or refer to working note given by the ICAI as well. After this normal treatment, but we have to be careful of the amount. Next would be allotment entry due. So what will be the entry? Equity share allotment account debit to equity share capital to securities premium. How many shares? 2,50,000 shares. You are receiving 4 rupees per share. So 2,50,000 into 4. 2,50,000 into 2 for share capital and 2,50,000 into 2 for securities premium. Remember, this is a due entry. Next, receipt entry. Bank account debit to equity share allotment. Remember, for equity share allotment, how much is due? 10 lakh. But out of this 10 lakh, we've already received 5 lakh 20. How much is remaining? 4 lakh 80. Only that much you will receive here. I hope this is clear. Next, we'll be making call money due. Equity share first and final call to equity share capital. 2,50,000 shares at rupees 6 per share. So that is being considered here. Then the question says that first and final call was made, amount was duly received except from Mohan who had applied for 5,000 equity shares. His shares were forfeited. Now, first of all, when they are giving us such information, first be clear that we want shares in the allotted proportion and not applied. Here, they have given us the applied data, but we need to find out in terms of how much shares was allotted to him. So, how do we find out? See, they are clearly emphasizing that this was from category C. So, can we find out the ratio which is present here? Number of shares applied is 4 lakh and number of shares allotted is 80,000. So, if I have to find out the divisible number, 4 lakh and 80,000. So, this will be taking us to a ratio of 5 is to 1. That means if I have to get allotment of one share, I would have applied it for 5 shares. So if they've given it for 5,000 shares, can I find out how much is this shares allotted? Yes. So how do I find it? 5,000 shares is for application. I want how much is it for 1. So if I do 5,000 into 1 by 5, that is 1,000 shares. So this is nothing but the number of shares which did not receive the call money. So what will be the entry now? Bank account debit, calls in arrears account debit to equity share first and final call. For calls in arrears, 1,000 shares was due. You're not receiving 6 rupees, so 1,000 into 6. And then on the balance, 2,49,000 at 6 rupees, you get 14,94,000. This will be the call money received entry. Then these shares were forfeited. So what will be the forfeiture entry? Equity share capital account debit to share forfeiture account to calls in arrears. This 1,000 shares was taken at 10 rupees, so 1,000 into 10. Calls in arrears at 6 and the balance go to share forfeiture. This shares which was forfeited was reissued at rupees 1 as discount. So what will be the entry? Bank account debit, share forfeiture account debit to share capital. Bank account at 1,000 rupees 9, share forfeiture 1 rupee as discount and then 1,000 into 10. So after doing all of these, you have a balance in share forfeiture will have to be transferred to capital reserve. So share forfeiture, we had 4,000 used for discount 1,000. So how much is remaining? 3,000 will be transferred to capital reserve. This was your journal entry. You can arrive at the value by making this working, and then for the number of shares allotted, because the question clearly tells that you have to show detailed working. So that's why we have done that, and the shares allotted. For to find out the amount to be transferred to capital reserve, you can also make this calculation. What they have done is amount received on reissue, amount already received before forfeiture. That is, remember, 4 rupees you already had received from application allotment. That was with you. And the nominal value of shares which has been collected. So the balance extra profit is nothing but transferred to capital reserve. I hope this question was understood to all of you. Then, next question, last one. What is the trial balance? Even if the trial balance agrees, some errors may remain. Do you agree? Explain. So this is again a straightforward theory question. You can write down few points about trial balance, what it says. Preparation of trial balance is the third phase in the accounting process. In the accounting process, when you start from recording, this becomes the third phase. After posting, a statement is prepared to show separately the debit and credit balance, such as known as trial balance. You can also incorporate some points that it contains various ledgers, and this is prepared to provide that it is arithmetically accurate. So it forms the basis for preparing the financial statements. These are certain points. And then if it tallies means it that the accounts are arithmetically accurate, but there could be certain errors present. After mentioning this, you can touch upon the points which acts as the limitations of trial balance. That is, when do trial balance tally even if there are some errors? Examples like transaction has not at all been entered in the journal. When there's no entry, you'll also have no impact on debit and credit sides. Wrong amount has been written in both the columns. Instead of writing 1000, we have written 10,000. Still, the trial balance will tally. Then a wrong account has been mentioned in the journal. Instead of debiting Mr. Ram, we have debited Mr. Krishna. The account will still get tallied. The entry has not at all been posted in the ledger. So the impact of those transactions cannot be observed. Entries posted twice in the ledger. Again, error of principle, that is treating revenue as capital expenditure. And at last, compensating error, that is two errors which is compensating to each other. These are all the points which may result in some errors even though the trial balance would tally. Now, this was completely your May 2026 paper, guys. If you just analyze, few questions were exactly similar to what we find in the ICAI study material. Just a matter of good practice was only required. Few questions definitely was time taking, but it was still a manageable paper. I hope this video was helpful to your preparation to just analyze how the questions are being framed in the recent times. You are doing your best, guys. Continue. Remember that don't count the hours, make the hours count. Give your best shot. All the very best for your preparation. Take care. Hello, champs. Hope you are doing amazing. In this video, let's make a wonderful discussion of January 2026 ICAI CA Foundation exam paper along with its suggested answers. So, in this session, what we will observe is the questions which have been framed, concepts covered, how it needs to be solved and presented. For your benefit, I've also went through the examiner's comment, which definitely becomes a game changer for you to inculcate so that what mistakes have been committed by Jan 2026 aspirants need not be done by you again. And this also gives you that perspective how the evaluators will consider or would think and the student's mindset in that exam environment. So after this complete session, what is your job is to completely practice once. That only gives you the time for what you have invested in seeing this video, guys. So let's begin this session with the same spirit. So, as you are aware with respect to the question paper pattern, question number one will always be compulsory. This is common in any of the level of CA exams. And out of the remaining five questions, you need to attend four, where one would be available to you as choice. Each question will be of 20 marks. That is, I hope all of you are aware. And observe these minute things which most of the students would miss. They have clearly emphasized in the paper itself. What does it tell? Wherever necessary, suitable assumptions should be made and disclosed by way of a note forming part of the answer. Most important thing, working notes should form part of your answer. So these are all minute stuff which most of the students tend to ignore or miss out, because ultimately here they are not expecting a neat presentation. They're just expecting what would be the base or what would be the calculation to arrive so and so value. So these all becomes part of your main answer. So let's begin with question number one. As we know, the first part would be true or false, which is the most favorite and the most easiest scoring part. So let's observe the questions what has been asked in Jan 2026 exams. So each question will be of 2 marks, wherein 1 mark for your answering whether it is true or false, and then the another mark will be for the reasoning which you provide. So first question, money spent to reduce working expenses is revenue expenditure. So the solution for this will be false. Simple reason being, any expenditure which helps in reducing working expenses will not be in revenue nature, because it definitely brings down the amount of spend which the business has to make. So this will be a capital expenditure. So your answer would be false, and the reason is what I mentioned. I will also show you what is given as per the ICAI suggested answer. Next, transactions regarding the purchase of fixed assets on credit are recorded in the purchase book. Remember, purchase is one of the subsidiary book. This is with respect to purchase of an asset, and if it is done on credit, it will not appear in the purchases book, because only goods purchased on credit will be written in purchases book. This will be entered in journal proper. So your answer would be false for this. Second, so this was false and this is false. Third, a present financial obligation of an uncertain amount which can be measured reliably by using a substantial degree of estimation is termed as a liability. This is clearly pointing out to the definition of liability. Along with liability, there was one more thing, which was provision. Whenever you come across the word that is of estimation, just understand one thing, guys, because the liability definition and provision definition is quite similar. You observe the similar wordings being framed there. So how do you distinguish? First, logical understanding is required. Meanwhile, to identify, provision is something which we do on an estimation basis, because there we cannot be accurate. It differs from business to businesses. For example, provision for doubtful debts as such. So therefore, this is not a liability definition. The statement given is false, and this is for provision. So the answer for this also is false. Next, nominal accounts are kept under single entry system. So this is coming from a chapter where accounts from incomplete records, chapter number 9, where you understood the different types of maintaining books of accounts. There, nominal accounts are kept under single entry system is not at all a correct statement. The answer for this will be false. Under single entry system, we will just find cash account or any some personal accounts, and there would not be any nominal accounts maintained. Next, winding up of LLP may be initiated by tribunal if the LLP has failed to submit the statement of accounts and solvency or the LLP annual returns for more than 3 consecutive financial years with the registrar. See, most of the students will ignore such theoretical points, but you observe these importance. 2 marks weightage is given, and definitely this is not a lesser marks at all. This is coming from your introduction to partnership and LLP accounts. That is unit number 1 of your partnership. In that particular unit, there is a clear provision mentioned about the maintenance, or that is submission of statement of accounts and solvency. And the number of term mentioned there is for 5 consecutive financial years and not 3. Hence, the answer for this will also be false. Next, as per section 52, a company may utilize the securities premium account to write off its preliminary expenses. Section 52 of the Companies Act gives us the 5 specific uses of securities premium, and one amongst those is to write off its preliminary expenses. Hence, the given statement is true. So these were the discussion of your true or false. Let's observe what is the ICAI's answer for this. See, first one, that is money spent to reduce working expenses was revenue. This is false, because this is in capital nature, and the reason would have generated long-term benefits. Then purchase of fixed assets is again false, because that will not be recorded in the purchases book. Then again, it is not a provision, and it will be, sorry, it is not a liability, but it is termed as a provision. Next statement is again false, wherein generally, as I mentioned, cash book and personal accounts will be maintained. Nominal will not be maintained under single entry. It will be just maintained under the double entry system of accounting. The next point was about presentation, submission of statement of accounts and solvency for the LLP along with annual returns, and it was for 5 consecutive financial years. Hence, the given statement was again false. The next statement was true because preliminary expenses, to write off preliminary expenses, securities premium account balance can be utilized. So I hope this was all comfortable. Now, in this case, there was an examiner's comment wherein the students definitely didn't have the ability to give the proper reasoning. Some students were clear in presenting whether the solution was true or false, but they failed to provide proper reasoning, the logic behind why the given statement was true or false. Here, this also presents as one of the important aspect that you should have a proper clarity on the concepts which you interpret, especially in points like this one, wherein you find the similar wordings being mentioned, and most of the students tend to commit this mistake as considering this as true. I hope you're understanding the direction in how you need to prepare to approach these true or false. Because as I mentioned in the beginning, this is a sweet spot, guys, where you can easily score 12 marks provided such conceptual clarity with respect to the statements given should be very, very precise. Done? Yes. Let's move to the B part of first question. What are accounting standards? Briefly explain the main advantage of setting accounting standards and their limitations. Just to break down what is being asked, you're just asked the definition of accounting standard, and then they're asking you the advantages and limitations, advantages and disadvantages of accounting standard. So this is the simple requirement. This is asked for 4 marks. Let's directly jump into what points need to be clearly mentioned. See, guys, this is the expected answer. We cannot expect the students to reproduce the same thing which is given in the material. So just observe the usage of keywords. If you utilize that in your answer, your job would be done. Simple question. They're asking you the definition or meaning of accounting standards and then advantages as well as limitations. So let's observe what is given. Accounting standards are written policy documents. Why am I highlighting? These are all must used words in your answer. Issued by the expert accounting body or the government or other regulatory body covering the aspects of four things: recognition, measurement, presentation, and disclosure of what? Accounting transactions and events which is presented in your financial statements. So this is the simple meaning of accounting standards. It is just written policy documents. You have to mention issued by whom and this is regulated for what. That's it. Clear? So use four keywords. It is recognition, measurement, disclosure, and presentation. And this is with respect to accounting transactions and events in the financial statements. So this was about accounting standards. There was other two parts, that is to explain about advantages and then limitations. Advantage. The main advantage of setting accounting standards is that the adoption and application to ensure why are we supposed to look at the work structure of accounting standard is to ensure that there is uniformity, comparability, and qualitative improvement for what? In the preparation and presentation of financial statements. So this is the main of your advantage. That is how we begin. Apart from that, there are other few points. These standards will reduce to a reasonable extent or eliminate together. What would they eliminate? They will eliminate some confusions with respect to the application or treatment of certain items. See, confusing variations in the accounting treatments used to prepare financial statements. Next, there are certain areas where important information are not statutorily required, means it is not required as per law. But due to compliance of accounting standards, it informs the users a clear picture about what is being requisitely followed. So, this standard may call for disclosure beyond those required by law. Then, the application of accounting standard would, to a limited extent, helps in a greater comparison. Now, if I have to compare financial statements of X company along with Y company, there should be a common accounting standard which becomes applicable. If the bases are not same, definitely it is not comparable in nature. So that is why this becomes easier. And if there is financial statements which need to be considered of a country, different companies operating in different countries, this is also considered in this particular aspect. So these are some advantages of accounting standards. Then there are two limitations. There is difficulties in making choices between different treatments because some accounting standards can prescribe different accounting treatments. It becomes difficult for an accountant to make a clear judgment. Then accounting standards cannot override the statute. That means accounting standard cannot go beyond what the law prescribes. Law is the ultimate authority. So accounting standards cannot override the statute. So this was all about accounting standards, advantages and limitations. Next. Next question is about journal entries. Mr. Vijay has entered into the following transactions during the month of December 2025. You are required to journalize the same in his books of accounts. So they're asking us for journal entries. So this is integrated with your GST transactions. So let's understand this precisely. First, purchased goods from Ramsons for 20,000 at a trade discount of 10% plus CGST and SGST at 9% each. 10,000 was paid immediately and the balance is payable after 2 months. So first of all, normal purchase entry. So this is goods purchased on credit. So the entry would be purchases account debit to Ramson. But there are some additional adjustments. There is GST levied on such purchase transaction. So if I also consider GST, it again is the nature of my expenses. So I will debit. So the entry for this will be purchases account debit, input CGST, input SGST to Ramson. There is some part which is also paid. So when some amount is going, so we will use either bank or cash. Understand one common thing here, guys. Whenever you come across the payment or whenever you are receiving, make sure we use both cash or bank, even if the question is telling us received or paid in cash. Because as we certainly know, in the practical world, there are more usage of banking channels rather than cash. Because the government itself has regulated this to eliminate or to reduce cash transaction to minimal. So that is why it is always logical to use either bank or cash. Now let's understand how the amounts have been arrived. The transaction amount was for 20,000 and there is a 10% trade discount. So on 20,000, if I apply 10%, there will be 18,000. So 20,000 minus 2,000, that is 10% on 20,000. On this, I will charge GST. Make sure let's not commit this mistakes and not apply it on 20,000. So the rate of GST was 9%. So on 18,000, if I apply 9%, it is 1,620 each for CGST as well as SGST. And then to Ramson's, to bank. Remember the question clearly emphasized 10,000 was paid. So we will take all the total of debit side and then pay 10,000. The residual will be credited to Ramson's. I hope this was clear. And then give the narration being goods purchased from Branson's CGST SGST payable at 9% each. Now in this, what was the examiner's comment in the entire question? Examiner have clearly commented telling that students missed writing input CGST. That is, they've just written CGST SGST, but they are clearly specific that you need to mention whether it is input or output. So make sure you don't miss out on this point. This was first transaction. Next, goods costing 10,000 were withdrawn for personal use. This, if I have to write as a normal journal entry, the entry would have been drawings account debit to purchases. Since goods are not present in the business, whatever GST paid on those goods purchased should also be reversed. So your entry will be drawings account debit to purchases to input CGST and to input SGST. The drawings amount here is 10,000. So we will write this for purchases and charge GST along 10,000 to purchases, to input CGST, to input SGST at the GST amount. The total will debited to drawings. Being goods withdrawn for personal use and input CGST, SGST debited at the same time of purchases reversed. Here the word which you clearly have to use is reversed. Next entry. Purchased machinery for 52,500 including IGST at 5% by issuing a check to the supplier. This transaction is simple, guys, but one simple calculation which students would generally miss out is, since we are observing that the first two transaction was GST separately applied on the transaction amount. But what is the different from this point here is, here whatever the transaction amount you are observing 50 to 500 is already including GST. But we need a breakup. First we need to find out the gross value and then GST amount on that gross value. This is nothing but the total. So how to calculate this? 50 to 500, if you observe, is representing 100 rupees plus 5% on this. So this is 105. Yes, I want the value for 100 because I want the gross value. How to find this out? 50 to 500 into 100 divided by 105. So this will be 50 to 500 into 100 divided by 105, which is nothing but 50,000. This is 50,000. And the GST rate which is given is 5%. So 50,000 into 5%, if you observe, this is again 2,500. So what will be the entry? This is machinery purchase. So on purchases, there will be input GST. So here it is IGST. So the entry would be machinery account debit, input IGST account debit. 2. This was by issuing a check to the supplier. So to bank. See, machinery account debit to input IGST to bank. Whatever we found out, how we got that 50,000, you should present this as a working note. See, the machinery is purchased for 50 to 500. This was representing 105. So we need how much it is for 100. So that will be 50,000. This need to be presented as a working note. I hope the transaction is simpler to all of you. Next entry. Goods costing 3,000 before trade discount of 10% were issued to Vinod. Such goods were purchased by paying CGST and SGST at 9% each. So let's understand the transaction first. Goods is costing is given. This was before trade discount. This was returned to Vinod. So when we are returning, that means this is a purchase return. So what will be the normal journal entry? This will be Vinod's account debit to purchase return. Since there was GST which was paid on the purchases, the same would also be reversed. So Vinod to purchase returns to input CGST and input SGST. So 3,000 was before trade discount. Let's observe how this is written. See, Vinod account debit to purchase return. The purchase return amount was for 3,000, but there was a 10% discount. So the transaction amount will be 3,000 minus 300, which is 2,700. Again, GST will be considered on this amount 2,700 and 243 after applying what was the GST rate. GST rate was 9% each, so on 2,700, 9% each. So total 3,186 will be debited to Vinod. So I hope the question was comfortable. This GST integrated question is one of the important tested frequently by the institute because this is a very trending topic and conceptual understanding is what is required why we need to debit and the respective amounts calculations. I hope the question number 1 was comfortably understood to all of you guys. Moving on to the next one. Question 2. Mr. A's trial balance as on 31st March did not agree and he wrote off the difference to the profit and loss account for that year. Observe one thing, as in when you read the question, this was the data given as on the year end, and they are also mentioning that it did not agree, so the balance was written off to P&L. Next year, he engaged the services of an accountant who, after a close scrutiny of the books of the for the year, observed the following errors. So your favorite question that is coming from rectification of errors. Observe the weightage, guys. This is asked for 12 marks. It is a very interesting question and it is a similar one which is given in your institute study material as well. So before we go ahead, I will just inform you about what was the examiner's comment in this question. First of all, most of the students have conceptually failed in observing this point that this error was found out in the next year, where he observed the close scrutiny of the books in order to find out the difference. When the books were closed, that is, this is the stage where the errors are identified after preparation of after preparation of final accounts. Understand one thing, guys, we cannot again disturb profit and loss account when there is nominal accounts are involved. So here we bring in a separate account named profit and loss adjustment account, wherein the nominal accounts will be utilized and the rest will be normally operated through suspense account. As per the examiner's comment, most students have missed writing profit and loss adjustment account. So that itself completely communicates to the examiner that you are not paying attention with respect to the requirement of the question, or you might not be aware about this point conceptually. I hope these points need not be repeated from you guys. Whenever you observe it is of next year, automatically this point should strike that when there is nominal accounts covered, we will not use the respective nominal account and make use of profit and loss adjustment account. So let's run through the transaction one by one. Goods worth 5,000 were dispatched to a customer before the close of the year, but no invoice was made. So when there is no invoice made, then there will be no entry. So there is an error of omission. This was dispatched to a customer. So this is normally sale entry. What would be the entry? Customer account debit to sales. Remember one thing I explained you just before, sales is a nominal account. So we will use another account called as profit and loss adjustment account. So your entry will be customer's account debit to profit and loss adjustment 5,000. See, customer account debit to profit and loss adjustment 5,000. Being rectification from non-preparation of invoice. So you can write the narration in a simpler communication of what you're doing with the entire transaction. Next, 3,000 due to Mr. X was omitted to be taken to the trial balance. Understand one thing, they're only giving from the part of X. Due to Mr. X means Mr. X will be your creditor. So when there is creditor, his account will be credited. So there is nothing given with respect to the debit part. So we will route this through a suspense account. So your entry will be suspense account debit to Mr. X. Mr. X is the creditor, therefore we are crediting. The amount is 3,000 and 3,000. Next, wages of 5,000 paid for erection of machinery were debited to wages account. Now observe one thing, guys. This is a revenue expenditure, but this is a capital expenditure because this is paid for erection of machinery, but they have treated it as a revenue expenditure. First, the wrong treatment needs to be rectified, I mean to say removed or eliminated, and then the correct impact needs to be provided. So what will be the rectification part here? So wages is being debited. It should not have been debited. So this is again a nominal account. Machinery account needs to be debited with respect to such amount. So the entry would be machinery account debit to profit and loss adjustment with respect to 5,000. I hope this entry is understood. There is one more point. We have still not gone through the entire question, but as per ICAI suggested answers, in order to help you understand how it is being presented, observe one point lastly. There is one consideration given for depreciation on machinery. So again, we are discussing about the machinery itself. If this wages amount was part of the machinery, don't you think we were also charging depreciation on the same? So that impact should also be taken. The amount is 5,000. 10% on that of charging depreciation will be 4,500. So this complete entry is being integrated. So your complete adjustment entry will be machinery account debit to profit and loss adjustment, which is 4,500, 4,500. I hope this is comfortably understood. And this depreciation part is also mentioned in the narration. See, there is also an alternate way of writing this. First, you can simply write machinery account debit to profit and loss adjustment and then charging depreciation on the machinery. So then the entry would be depreciation account debit to machinery account. Again, depreciation is a nominal account. So that will be P&L adjustment to machinery. Here also the presentation would differ. See, if you just write machinery to P&L adjustment, amount you would debit would be 5,000. And then when you charge depreciation, there would be 500. So net the impact will still be 4,500. Therefore here the IC has presented one single answer. I've given you the two perspectives of how to solve this. Clear? Next. Purchase of goods from Mr. R for 20,000 was omitted to be recorded. Again, there is error of omission. So the entry would here be purchases account debit to Mr. R. Remember, purchase is a nominal account. So the entry here will be P&L adjustment to Mr. R. 20,000. Clear, all of you? Next. Cash payment of 5,000 to Mr. C was posted to the credit of his account. Cash payment of 5,000 to Mr. C. So what should have been the entry? C's account debit to cash. So here what they are telling is it was posted to the credit of his account. Observe one important thing carefully. There is error only with respect to one part of the account, which is Mr. C. C's account should have been debited, but his account has been credited. Sorry, yeah, his account has been credited. How do we rectify this? We need to first cancel the credit which is taken off 5,000 and then post it on the debit side. Remember one thing, guys, whenever we are cancelling first, there is one effect, and then for the correct debit, there is one more effect. So the total amount which we need to consider here will be 10,000. I hope you understood how this has been arrived. So here the error is only with respect to Mr. C's. So the entry will be Mr. C's account, which should have been debited, we are debiting to suspense because there was no error with respect to the cash payment. As I mentioned, the amount here will be 10,000. How is this 10,000 coming? As I repeatedly telling, C's account is credited, but his account should have been debited. 5,000 is the amount. So 5,000 on the credit side will get cancelled. If I have to bring 5,000 more on the debit, there is 5,000 also cancelled on the credit side. So the total amount needs to be considered would be 10,000. Clear? Yes. Next. Purchases of 15,390 was wrongly posted as 15,930. Now first let's understand the difference. 15,930 minus 15,390. So there is 540 rupees shown more. Now purchase will have debit balance. So they are showing more of a debit balance. It needs to be brought down. Remember, purchases is a nominal account. So we have to use profit and loss adjustment. This is again a single omission which is happening in the purchases book. So the entry will be routed through suspense account. So what will be the ultimate entry? Suspense account debit to profit and loss adjustment. How are we getting this? 15,930 minus 15,390. I hope this is clear. Next. Goods worth 16,000 were sent on sale or return basis to a customer and entered in the sales book. Understand one thing, when the goods are sent on sale or return basis, it is still not a completed sale, but they have entered it in the sales book. At the close of the year, the customer still had the option to return the goods. That means you cannot still conclude it as sale, because when the customer has the option, you cannot clearly conclude whether it was a sale or the goods are coming back to you. Gross profit margin was 25% on sales. Now understand one important thing here, guys. When the goods are not yet considered as sales, you cannot first of all consider it to be your sales. But they have recorded it as sales, that needs to be corrected. On top of it, when there is still an option to return the goods and the goods are not in your premises, understand one thing. How do we account this? Carefully observe the journal entry here. Let's also understand the logic behind this. The amount, transaction amount was 60,000 and there was a gross profit margin of 25% on it. Remember in inventory chapter, because the concept is covered in your inventory chapter, we will record the inventory at cost or net realizable value, whichever is lower. Because here we cannot record it at selling price. Simple logic here is we cannot expect or make profit from our own stock. So that happens only when the sale is generated. But when we are maintaining it in our books of accounts, we will record it at cost or net realizable value, whichever is lower. Now, since it was recorded as a sale, it is not actually sale. It should be present in your business. When the goods are taken in your business, which was shown as a sale, now rectified, that means your inventory balance will increase. Remember, inventories are your assets. When it increases, we will debit. So the entry here will be inventory account debit. Remember, as I told you, you cannot show this at selling price. So they have given us the profit margin. 16,000 was the selling price. if I have to find out the cost price, I will take out the gross margin inward. So on 16,000 is a selling price. If I take out 25%, I will get 12,000. I hope this is clear. And this 16,000, because I considered it as sales, the entry would have been customer account debit to sales or debtors account debit to sales. So I'm just reversing by crediting the customer. There was profit involved, so that will be routed through profit and loss adjustment 4,000. Observe the narration also, so you will have a proper clarity now. Being the customer account credited for the goods not yet purchased by him, because when it was considered as sale, we would have debited. So here we are crediting cost of the goods debited to inventory and profit debited to profit and loss adjustment account. I hope this is comfortably understood. Next, a return to a creditor 550 was entered in return inwards book. However, the creditor's account was correctly posted. A return to a creditor means this will be your purchases return. But what they have done is they have shown it in the sales returns book. So whatever entry is made in the sales return needs to be corrected, because they are clearly telling that creditor's account was correctly posted. So sales return will have a debit balance. So when we cancel this, it will be credited. Remember, here the sales return will be routed through which account? It will be routed through which account? Again, profit and loss adjustment. The creditor's account was correctly posted. So the entry will be debited through suspense account. Suspense account debit to profit and loss adjustment. Here again, if you observe the same treatment, the amount covered is here 550. 550 was debited. First I have to cancel that. So 550 there. Correct amount 550 needs to be credited. So the total amount which we need to take here is 1100. I hope this is clear. Later, most two important entries where the examiner have clearly emphasized that most of the students have missed this, and that is where they have failed to score the complete marks. Whenever we have such profit and loss adjustment and suspense account, and especially the transaction was pertaining to previous years, that is errors was related to previous year transactions, and you are rectifying it in the subsequent year, make sure the accounts opened needs to be closed and transferred to the proprietors or the business owner's capital account. So in this, we have made use of P&L adjustment, and we have also taken suspense account. These needs to be completely, the balance which is there in need to be completely transferred to capital account of the person. Here in this question, it is of Mr. A. So for this, it is always better to prepare this as a ledger which becomes part of your working note. So one, there is profit and loss adjustment, and the other there is suspense account. What entries are presented here? If you have understood the journal entries, we have debited P&L adjustment somewhere, credited some, and debited suspense, credited somewhere. All those entries will be presented here in the ledger. And ultimately, if you observe, the closing balance will be transferred to A's capital account, and in suspense account also the balancing figure will be transferred to A's capital. So this entry needs to be presented as your journal. That is when your complete entry is valued. A's capital account debit to profit and loss adjustment, because it is coming closing on the credit side. And then for suspense, it is on the debit side, suspense account debit to A's capital. How to fill these values? As I am telling you, whatever entries, what we understood, just observe based on that entries only, this ledger is being prepared. I hope this was completely understood. A very important question, guys. Good question for practice. Make sure all of these important points, especially not missing these two entries and this working note, becomes very, very crucial to score complete marks. I hope this is clear. Next question. Mehta and Company had the following balance appearing in its books of account as on 1st April 2024. So before we understand the complete story, let's read the requirement. You are required to prepare the plant and machinery account in the books of Mehta and Company for the year ended 31st March 2025. So they are giving us the detail from 1st April. Also show the working for profit of loss on sale and scrapping of the machines. Round off the figures to the nearest multiple of a rupee. So this is requirement of plant and machinery. Along with that, they are asking us few important working notes. Now let's read the complete question. Balance of plant and machinery as on 1st April 2024 is given to us. That is 1 crore 42 lakh and 50,000. Its accounts are made up to 31st March every year and depreciation is charged at 10% per annum. Under which method? These are all the important markings which you need to consider while you read the question itself, written under written down value method. On 1st September 2024, that is in the same current year, a new machine was acquired at a cost of 21 lakh 20,000 and a sum of 46,900 was incurred on the same day towards installation charges for erecting the said machine. So this becomes part of the cost of the machine. So both will be considered as the cost of the machine. On the same date, a machine which had costed 32 lakh 8500 on which date, observe, on 1st April 2022 was auctioned for 5 lakh 62 500. Read the statement carefully. On the same date means which date? 1st September 2024. A machinery which was worth 32,80,500 as on 1st April 2022 is being auctioned for 5 lakh 62,500. Another machine which had cost 32 lakh 77,500 on 1st April 2023, having become obsolete, was scrapped on 1st September 2024 and it realized nothing. So there is no amount realized from this part. Remember, on 1st April 2024, there are three events happening. First, new machine was purchased. The asset which was present from 1st April 2022 is getting auctioned, and then there is another machine which is also scrapped. For all of these, they are asking us the working to present it in the plant and machinery account as on 31st March 2025. I hope the question is comfortably understood. Now let's understand the working. First of all, in the books of Mehta and Company, Plant and Machinery, they have given us the balances on 1st April 2024. So asset will have a debit balance to balance brought down 1 crore 42 lakh 50,000. I will just highlight what all elements which we have been discussing so it becomes very clear for you to also follow up. Next, from 1st April 2024 till 1st September 2024, there is no any such transaction. So we will analyze the entries one by one and make the respective entries. On 1st April 2024, a new machine was acquired at a cost of 21 lakh 20 and a sum of 46,900 was also incurred, considering this as an installation charge. So the total cost 21 lakh 20,000 plus 46,900 needs to be considered as a cost of the machine. So what will be the journal entry for this? Machinery account debit to cash or bank with respect to the amount, that is 21 lakh 66,900, including the installation charge. So in the plant and machinery account, we will post this on the debit side. Observe, to bank 21 lakh 66,900, the same thing which you are also getting on your calculator. And this happened on which date? 1st September 2024. So that is also taken care. Clear till here? Next, there are assets which are getting auctioned and which is getting scrapped. We have to also consider depreciation till date and then record the auction and sale and also profit or loss on the sale. For this, we need to make a separate working note. So first of all, see, this is getting auctioned for 5 lakh 62 500 means what? You're getting money. So what will be the entry? Bank account debit to plant and machinery. So by bank, we will record this on 1st September 562 900. Before we consider the sale, there needs to be depreciation on this part of the machinery. So we will do the working note for the sale. See, calculation of loss on sale of machine. Cost as on 1st April 2022 is given. That was 32 lakh 80,500. Remember the method which was written down value method. This was from 1st April 2022. So we want the value as on 1st September 2024. So we will consider the depreciation of the respective year and find out the written down value as on this day. So from 1st April 2022, depreciation will be at 10%. So that will be 3 lakh 28,050. WDV as on 31st March 2023 will be 2950 to 450. Upon that, again at 10%. So WDV as on 31st March 2024 will be 26 lakh 57,205. Remember, the auction is happening as on 1st September. So till there, we have to consider depreciation. 10% depreciation on such amount for how many months? For 5 months. How are we getting 5 months? April, May, June, July and August. Because the auction is happening on 1st September itself. So therefore for 5 months. So that will be 1,10,717. After considering our value will be the written down value as on 1st September 2024 is 25 lakh 46,488. On this, we will compare with the sale proceeds, that is the auction amount, which is 5 lakh 62,500. Definitely, there is a loss. So that the loss amount is 19 lakh 83,988. So what will be the journal entry? The asset is going out of the business, so it will be credited. This is the loss. So profit and loss account debit to plant and machinery. So this 1983,990 will appear on your debit side, sorry, credit side. See, buy loss on sale. Remember, we are doing this from 1st April 24 to 31st March 25. So we have to also record the depreciation which happened from 1st April 24 until 30th August 2024. Clear with this? So that was for 5 months. We have already calculated this. That is 1,10,717. Properly note all of these points, guys, because most of the students tend to take the total depreciation calculated till now, that is starting from 1st April 2022. That would be a complete error from your part, because we are just presenting the ledger here from 1st April 2024 until 31st March 25. Clear with this? I hope what all points have been highlighted is clearly understood to all of you. Next, on the same date, there was another machine which is getting scrapped, for which you have to also again understand the working note. Calculation of loss. But for this, they have given the cost from 1st April 23. So the cost was 32 lakh 77,500, 10% on WDV basis. So 10% for that particular year will be 29,049,750. That is written down value as on 1st April 24. We have to calculate the depreciation for 5 months again before 1st of September. So depreciation at 10% for 5 months. So this will be 1,22,906. Remember, this will go to the plant and machinery account, and then this was completely scrapped, realized nothing. So whatever will be the WDV after depreciation will be completely lost, which is 28 lakh 26,844. So, how will this be presented? 26, 20, 28, 26, 844, which is your loss on scrapping the machine. On the same machine, depreciation will be there. So, by depreciation, which is 1,22,906. I hope till here all of you understood. Now, observe one important thing carefully. The total asset which was worth was 142.50. On that, there was part of the items which was auctioned, which was scrapped. Some machineries was also additionally purchased. So there are still some machinery, part of plant and machinery lying in the business, on which we need to charge depreciation for the whole year, because that is present in the business, correct? So that calculation should also be understood. See, balance of machinery account on 1st April 24. How do we calculate? First, take the total value of asset given, and then consider the WDV of machineries being sold, being scrapped. We can use these working notes and consider these values. See, one is 26 lakh 57,205, and then there is another WDV 29,049,550. So these two is being taken care here. This is not present in the business, so we have to reduce this. So total 56 lakh 6,955. The remaining machinery worth is 86,43,045. Remember one thing, guys, in the current year there was some asset purchased as well, but that was purchased in between the year. For this, there will be depreciation charge for the whole year at 10%. See, for 12 months, and for the remaining asset which was purchased in the current year, it was purchased on 1st September. So 1st September to March, September, October, November, December, Jan, Feb and March. So totally for 7 months we will charge depreciation. Total of these two will be 9,90,707. The entry here will be depreciation account debit to plant and machinery. So this will be reflected in your machinery account by depreciation. Clear with this? After we enter all of these transactions, there will be some closing balance left, which you will show this as balance carried down. I hope all points of how the values have been arrived is clear. As I mentioned in the beginning itself, you will not get this until you practice all this by yourself. Make sure you also solve this once and compare with the values which you are also getting or not. As I'm clearly telling, concepts is very important, guys. Students can commit common mistakes here with respect to calculating months and taking WDV values. So make sure you note all of these stuff. So this completes our two questions. Moving on to question number 3. Income and expenditure account of Global Sports Club for the year ended on 31st March 2025 is given as under. So observe one thing, they have given us the income and expenditure. So the requirement will be either to prepare your receipts and payments. So let's observe. See, they are asking us to prepare receipts and payments account and then balance sheet as of 31st March 2025. Whenever we are getting into such full-fledged questions, always open the account. Also, one important thing when there is not for profit organization question is you have to make a close observation whether the opening capital balance is given or not. If not, we have to also present the opening balance sheet. I hope all these concepts are clear to all of us. Yes. So they are giving us the detail of income and expenditure, and then this account has been prepared after the following adjustments. So opening balance is given and closing balance is given. Subscription outstanding, received in advance, outstanding salary, prepaid electricity expenses is given. Next, the club owned a sports ground valued at 2,40,000. The club had sports equipment on 1st April 2024, which is the opening balance, valued at 62,400. At the end of the year, after depreciation, the value of this equipment amounted to 64,800. Next, audit fee of 4,800 for the year 23-24 was paid during the current year. 23-24 is your previous year. Audit fee for 24-25 is as yet outstanding. That means there is a liability because the current year expense of audit fee is not yet complied. During 23-24, the club had raised a bank loan of 48,000. This is your liability. This loan was outstanding throughout the current year as well. On 1st April 2024, cash in hand amounted to 33,360. Why do you think all these values are given? Because there is no opening capital balance available in the entire question. So we need to also prepare the opening capital, opening balance sheet to find out the capital fund. So let's observe how the workings have been done. So the requirement of question in this is to prepare receipts and payments account and then balance sheet. As we run through the question, we also observe that there is no capital fund or opening capital balance given. So for that, we also have to prepare opening balance sheet. So first job of yours is to completely open all set of accounts as we have commonly followed in approaching an NPO question. Open all the respective accounts, that is first receipts and payments, and then receipts and payments, balance sheet. Along with that, one as a working note, your opening balance sheet as on 31st March 2024. So as we run through, we can simultaneously enter the values. So first, expenditure and income is given. Remember, it is receipts and payments, which is as good as your cash book. So it will have the opening balance and closing balance. If you observe, the opening balance of cash is given on 1st April 2024. The cash in hand amounted to 33,360. The same thing we will enter. See, balance brought down 33,360. This is also your asset which will appear in the opening balance sheet. So in the opening balance sheet, which is prepared as on 31st March 2024, cash in hand 33,360. I hope this is clear. Next, since we had to open the account, that's why I first covered that cash balance. Now, to upkeep of grounds, this is your payments. There was no such adjustment. So 24,000 will come on the payment side. To salary, we will again observe the receipts and payments, since we have to scroll down and just informing you or explaining you well before here. To salary, 1,14,000. See, for this salary there was an adjustment. There is an outstanding salary, opening balance and closing balance is there. First of all, this is your liability, so it will impact both opening balance sheet as well as closing balance sheet. And then the adjustments. So what is the adjustments? We need to record the the payments of salary. So this is opening outstanding, which will be added, and closing outstanding, which will be subtracted. See, salary here is 1,14,000, 9,600 add 10,800 subtract. See, by salary 1,14,000 add 9,600 less 10,800. So this is 1,12,800. As I mentioned, opening outstanding, closing outstanding appears in the respective balance sheets. See here, salaries outstanding 10,800, and then there is salaries outstanding 9,600. I hope this is clear. Next point. So this is done. To books and magazines, 12,000. So there was no specific such expenses. So this is again an expenditure. We will record it on the payment side. Books and magazines, 12,000. Then we have annual dinner expenses. So when we have such amounts, remember guys, in the income and expenditure, we will net off generally and show. But in receipts and payments account, receipts should be recorded separately, payments separately. So we will cross check whether, yeah, see here there is expenses and then contribution, which needs to be separately presented in the receipts and payments. So expenses will come on the payment side and contribution on the receipt side. 36 on the payment and 24 on the receipt side. See here, the contribution for annual dinner 26,000, 24,000, and by annual dinner expenses 36,000. I hope this point is clear. Next, then there is audit fees 6,000. For audit fees, there was some adjustment. What was the adjustment? See, audit fee of 4,800 for the year 23-24 was paid during the current year. In the receipts and payments account, we are not considered whether it is past, present or future expenses or income. We just considered about the inflow or outflow. So this was the expenses pertaining to the previous year, but it is paid in the current year. So that we will record in the receipts and payments account for 4,800. See here, in the receipts and payments account, by audit fees 4,800. That is what has been recorded. In the income and expenditure, they would show you the current year expense. Remember, the audit fee was for the current year is still outstanding. That means in the opening balance sheet, before it is paid in the current year, it was still outstanding. Yes or no? So that will be your liability. So observe, in the opening balance sheet, 4,800 was your liability. Current year expense is anyway outstanding. So that will again become my liability. See, audit fee outstanding, which is 6,000. I hope this point is clearly understood. Next, so this is a current year expense. This was not paid, means it is outstanding. That was what was shown in the closing balance sheet. Next, electricity expense 10,800. There was an adjustment wherein there was a prepaid electricity expense. So opening will be subtracted, closing will be added. So what is the value? 10,800 minus 0 plus 1,440. This is an expense, so you will find this on the payment side. See, by electricity expense 10,800, at prepaid 1,440. I hope this is clear. Next, then we have interest and bank charges 3,600. There was no particular specific adjustments for it. So interest and bank charges appear on the payment side 3,600. I hope this point is understood, all of you. Whatever is being marked, I hope everyone are comfortably understanding this. Next, there is depreciation on sports equipment. Remember one thing, guys, it is a receipts and payments account which is similar to cash book. This is a non-cash expense, but they are giving us some details about sports equipment. We will consider this as part of working note to prepare sports equipment ledger. Why and how do we come to know that we need to prepare? Observe one thing, guys. The club at sports equipment, which is valued at 62,400, this is the opening balance. But at the end of the year, that is the value of this equipment after depreciation is 64,800. The value is being increased. That means there would be some asset which would have been purchased. The value is not given. So how do we find that out? By preparing the sports equipment ledger. So we will present all of these details in the sports equipment ledger. So the depreciation is 7,200. Observe the working note, guys. Sports equipment. Okay, they've not prepared the working note. You can do one thing. You can present this in your ledger, sports equipment ledger. How do we get the values? Sports equipment will have the opening balance. See, let me show this how to do the sports equipment account. So to balance brought down, by balance carried down, there was depreciation. So by depreciation, that was 7,200. Opening balance is 62,400 and 64,800. 62,400, 64,800. So 7,200 plus 64,800. This is 72,000 minus 62,400. So this will be 9,600, which is nothing but written as to bank, showing purchase of additional sports equipment, which should appear on your payment side. So if you observe on the payment side, 9,600 will be your addition. See, buy sports equipment 9,600. Here the institute have directly written such values. You can also make sure you present it like this as well. If not, if you feel logically or conceptually comfortable, directly write it in your ledger. Clear? Next. Then with respect to sports equipment, since this was an asset, we can also enter the same in our opening and closing balance sheets. This is done, and then surplus. So this surplus will be taken to our closing balance sheet, 36,400, adding to your capital fund. See here, add surplus 36,400. Clear? Next. We have completed all the impacts on the expenditure side. Now moving on to income. Subscription 1,80,000. Subscription, as you're seeing in the NPO question, is a very important element. So make sure you do the working note properly. So they've given us the details of subscription outstanding and subscription received in advance. So we will make the working note. Subscription outstanding. Opening will be added, closing will be subtracted. Received in advance, opening will be subtracted and closing will be added. So we want the amount which is shown on the receipt side. See here, subscription account. Subscription as per income and expenditure is taken. Opening will be added, that is of outstanding, and closing advance will be added. So these two values are given, and accordingly the other two values are also considered. So subscription received during the year is 1,72,080. Outstanding subscription is in the nature of your income receivable, so that you will show it on the asset side in the balance sheet. Observe here, subscription outstanding, this is the opening balance, and subscription outstanding will be the closing balance. Subscription received in advance will be your liability. Opening balance is taken here, and then closing balance in the closing balance sheet. Clear with this? So likewise, we have entered sports equipment details also. Remember here, we'll take the closing balance in the closing balance sheet, and accordingly in the opening balance sheet, sports equipment 62,400 is taken. Sports ground details was given. So sports ground was valued at 2,40,000. So accordingly, the same values will also take it here. Sports ground 2,40,000. Sports ground 2,40,000. I hope you're all understanding the values which have been considered one by one. Then we have done with subscription. Entrance fee 6,000. So 6,000 is just given. So this will be your normal receipts, no other adjustments, because there was one sports equipment, one audit fee taken. We have to one enter with respect to bank loan. Rest all is being addressed. So entrance fee is your receipts. So two subscription entered, two entrance fee 6,000. Then we will have income from annual need. This is, there is a receipts of 35,450 and expenses. Remember, in receipts and payments, you have to show this separately. So on the receipt side 35,450 and on the payment side 18,000. Next, there is interest on investment at 11%. Cost of investment is 2,05,000. Purchases on 1st March 2024. Remember, this will have to appear on the asset side. Along with that, interest on investment 22,550. So on 2,05,000, 11% is again 22,550. There is no other adjustments provided for this. So we will enter accordingly this on the receipt side. So to interest on investments 2250, the receipts shown on the receipt side, and then payments 18,000. All of the entries has been made. Receipts and payments was given with the opening balance. We will find out the closing balance, which is 60,400, which will impact your closing balance sheet. So investments is 2,05,000. Bank loan was given in our adjustments 48,000, that will appear in the closing balance sheet. Remember, we opened the opening balance sheet to find out the balancing figure. So 4,81,960 after considering all of these items will be arrived at, that will be taken to our closing balance sheet at surplus, and then we consider all the calculations. Your total will be 5,89,640. I hope this is clear to all of you guys. I understand scrolling up and down would be confusing, but keep the question handy with you on the one side and then analyze the pointers of solutions which was explained. Clear? Next. This is next an admission question. Ram and Shyam are partners sharing profits and losses in the ratio of 3:2. The balance sheet of the firm as of 31st March 2025 stood as under. So they are giving us the requisite details. Due to financial difficulties, it was decided to admit Mohan as a partner in the firm from 1st April 2025 on the following terms. Mohan would be paid 40% share in the profits. The new profit sharing ratio after the admission would be 7:5:8. So this becomes our job pretty simpler. They have directly given the new profit sharing ratio. Mohan will bring 2 lakh towards capital in cash. Alright, then on admission, the goodwill of the firm will be valued at 2 years, purchase of 3 years, normal average profits of the firm. So, to calculate goodwill as per average profits method, Mohan will bring his share of goodwill in cash. The partners will neither withdraw their share of goodwill nor will the goodwill appear in the books of the accounts. So, the question is clearly emphasizing that Mohan will bring his share of goodwill in cash. So, there is capital brought in, there is goodwill brought in, and the partners will neither withdraw their share nor will the goodwill appear in the books of the accounts. That is what the precise point is. The profits for the previous 3 years were as follows: 40,000, which includes insurance claim of 80, 20,000, which includes voluntary retirement compensation of 2,20,000, and 1 lakh profit, which includes profit of 50,000 on sale of fixed assets. Then it was decided to revalue the assets, fixed assets, investments, and then there is inventory. Trade receivables 5,000 was considered as irrecoverable. That means this will be your bad debts, and a further 5% is to be provided for bad and doubtful debts. They are asking you to create provision. You are required to prepare revaluation account, partners capital account, and then balance sheet as on 1st April 2025 after the admission of Mohan. See, in the admission question, you have to first and foremost observe the treatment of goodwill. In this question, they are asking us to first value the goodwill. There is a requirement of finding out the first adjusted profit because they are given some treatment of abnormal items. So let's calculate the yearly profit. Here I am just showing you the working here itself so that you will understand better. 23, 24. Isn't visible. Yes. So 40,000 is the profit given, 20,000 loss, and then 1 lakh profit. Just showing you the treatment of abnormal items. First of all, insurance claim. This is again an abnormal item because we will not consider the value of insurance claim recurringly, that is every year, in our profit or loss figure. So this insurance claim, considering this to be received, you would have added. That means your profit would have gone up. Now we have to eliminate this effect. What do? We will reduce. So minus 80,000. Next, this includes voluntary retirement compensation. That means you have paid someone. Again, this is a huge amount which is abnormal in nature. That is, it will not appear recurringly every year. So it would have been reduced your profit balance. You need to eliminate this effect. So what do? We will add. So 2,20,000 add. Later, profit of 50,000 on sale of fixed assets. Again, when there is profit included, it would have been added. So we need to eliminate this effect. So we will subtract 50,000. So this gives me my adjusted profit or loss. Minus 40, 2 lakh, and then 50,000. So this is 3 years data. So if I consider minus 40 plus 2 lakh plus 50,000, 2 lakh 10,000. I am supposed to find out the average profit. So this is 2 lakh 10,000 divided by 3 years, 70,000. The number of years of purchase is given as 2. So 70,000 into 2. So your goodwill will be 1 lakh 40,000. Let's observe the ICAI is working. See here, 1 lakh 40,000 is the value of goodwill. So goodwill to be brought in by Mohan. They have given 40% would be his share. So on 1 lakh 40,000, 40% will be 56. That is his share of goodwill. And remember, this share of goodwill need to be apportioned amongst the old partners in which ratio? That will be in sacrificing ratio. So we have to find out the sacrificing ratio. How do we find out old ratio minus new ratio? The question is emphasizing about the new ratio details as well. So we can easily find that out. Yes, let's find out the sacrificing ratio in order to apportion the new partner's share of goodwill. So, old ratio of Ram and Sham as per the question is 3 is to 2. New profit sharing ratio is anyway given to us in the question. 7 is to 5 is to 8. So for Ram, old ratio minus new ratio will give me my sacrificing ratio. So 3 by 5 minus 7 by 20. So LCM between 5 and 20 will be 20 again. 5 fours are 20, 4 threes are 12, minus 7. So this will be 5 by 20. For Sham, 2 by 5 minus 5 by 20. 20 again, 5 fours are 4 twos are 8, minus 5. So this will be 3 by 20. Sacrificing share will be 5 by 20 and 3 by 20. Sacrificing ratio will be 5 is to 3. So the share of partners' goodwill. What was the share of partners' goodwill? 56,000. will be apportioned. Observe here. See, to Ram 56 into 5 by 8 and to Sham 56,000 into 3 by 8. I hope this working all of you understood. So here they have also given the calculation in the basis of proportion because Mohan was given 40% share in profits is what the question says. So you can also calculate it likewise. If not, you can easily do like the working which I showed. So this was with respect to the treatment of goodwill. Do it properly, guys. It will definitely have a good weightage. So how to start this question? First, prepare the revaluation account. So they've given the details of the value of fixed assets. Fixed assets is 8 lakh revised value in the balance sheet. The fixed asset was 6 lakh. So there is increase in fixed assets by fixed assets 2 lakh in the revaluation account. Investments is turning 0. So there is a loss to investments with respect to the value of 1 lakh. Then there is inventory 2 lakh 96. In the balance sheet, inventory value is 3 lakh 25. So there is a reduction minus 296, 29,000 on the debit side of revaluation. Then we have trade receivables 1 lakh 25. There was a point given. 5,000 was considered as irrecoverable. That means 5,000 is your bad debt. Write it on the debit side of revaluation. So the total trade receivable was 1 lakh 25. In that 5,000 is bad. So remaining is how much? 5%. So remaining is 1,20,000. 5% of this will be 4,750, which will be shown as your provision for bad and doubtful debts. So these were all the points on the asset side. There was nothing mentioned on the liability side. So the treatment of revaluation will be considered as per the values I mentioned. So two investments because it is turned out 0, two inventories, two bad debts, 5 to provision for doubtful debts. I hope you all understood how this has been arrived. So provision for bad and doubtful debts, how are we getting this? 1,25,000. Whether this is visible, not visible, just a minute. So 1,25,000 minus 5,000 will be 1,20,000. On 1,25,000 apply 5%, we get 6,000. Clear? So after we consider all the revaluation impacts, there is a profit on revaluation which will be transferred to old partners in their old profit sharing ratio. So that has been considered. Then we will open the capital account by balance brought down with the respective capital. By bank introduction of new partners capital account, he is bringing 2 lakh and then transfer of profit on revaluation by revaluation account 36,000, 24,000. Remember the question clearly told Mohan is bringing his share of goodwill but no partners are withdrawing their share. So what will be the entry? Bank account debit to again the respective partners capital. So this is what the treatment is done by the institute. There is also an alternate way of doing this. How can we do it? So bank account debit to Mohan's capital. So this will include your capital account plus share of goodwill. So 2 lakh was his capital, 56,000 was his goodwill. So we will take 2 lakh 56 here and then Mohan's capital account will be debited and the respective old partner's capital account will be credited. So Mohan's capital account debit to Ram's capital and to Sham's capital. This is also another way of doing this or else if you have understood by bank how it is being considered, this is also fair enough to present. So after considering all of these, we will enter the ledger totals and find out the respective closing balance in the balance sheet. Take the balances of capital account and take the revised, revalued figures here. Trade receivables was 1,25,000, 5,000 was bad, and 5% provision was created. That was 6,000. So your balance will come to 1,14,000. And then all other liabilities, write it as it is. Loans in advance, inventories, and then bank balance. Accordingly, you will have the total of balance sheet at 16,66,000. Question was pretty simpler, guys. We have to just be careful with respect to calculation of goodwill. What is the examiner's comment here is most of the students have failed to correctly calculate the sacrificing ratio because the question somehow confuses you giving this percentage. If you're clear conceptually, if you remember the working note I did, you can still solve using ratios. If you are fair enough to understand these points, yes, still clear. Now, just to interpret how are they taking 60 and 40 is, remember the old ratio was 3 is to 2. The considering the entire structure has 100%. So for that 3 out of 5th, just take 3 divided by 5. You'll still get 60%. That is how they are getting 60 and 40. And then 2 by 5, 40%. 40% was given as a share to Mohan, and that is how they are being calculating this. Clear? Yes. Likewise, if you want to know how this 35-25 came, 7 by 20, which is your total proportion, 35%, and then 5 by 20, which is 25%. I hope this is comfortably understood. Next question. A, B, and C are partners of ABC LLP, sharing profits and losses in the ratio of 3 is to 2 is to 1. The balance sheet of the firm as the 31st March 2025 stood as under. So they're giving us the respective assets and liabilities. On 1st April, A desired to retire from the firm and the remaining partners decided to carry on the business. So this is a retirement question. It was agreed to revalue the assets and liabilities on that date on the following basis. Goodwill of the entire firm is valued at 2,88,000. Now the goodwill is directly given and A share of the goodwill is adjusted in the accounts of B and C, who would share the profits equally in future. So there is a mention of new profit sharing ratio as well. So when there is retirement, the retiring partner will have to take his respective share of goodwill. So what will be the journal entry? Old partner's capital account debit to retiring partner's capital account. And this will be apportioned in which ratio? In the gain ratio. Moving on. Building is to be appreciated by 30%, plant and machinery depreciated by 20. So building appreciation will come on the credit side of revaluation, plant and machinery depreciation on the debit side. Inventories are to be written down to 80% again on the debit side. Trade receivables are considered good only up to 95% of the balance sheet figure, means that 5% you need to create as a provision, debit side entry, and the balance is to be provided for as doubtful. Old credit balance of trade payables was 16,000 are to be written back. So trade payables balance was 3,20,000. What they are telling here is old credit balance are to be written back. That means you are reducing the balance, giving back these trade payables. So this is nothing but a saving to us. So we will enter this on the credit side of revaluation. Observe here. See, by trade payables 16,000. All other values, if you calculate, you will be clear. That's why I'm just explaining you directly. Then the joint life policy of the partners is surrendered and a sum of 96,000 is realized therefrom. So joint life policy, if you observe, the balance sheet was given. They are not mentioning this on the asset side. So what does this indicate? This was not treated as an asset but as an expense. So if you are receiving any amount, the journal entry here would be bank account debit to all partners' capital in their old profit sharing ratio. 96,000 will be equally apportioned amongst all the partners. Next, the total capital of the reconstituted firm shall be the same as before the retirement of A. So what is the total capital? 9,60,000. They want to make sure that even after A retires, the same capital balance will remain. And individual capital of B and C shall be their profit sharing ratio and the same shall be brought in by them. So what does this mean? It shall be in their same profit sharing ratio, means as per the new profit sharing ratio. Remember, there was details of new profit sharing ratio given. Don't you think this becomes more simpler? 9,60,000 divided by 2. So 4,80,000 for B and 4,80,000 for C should be their closing capital balance. Yes or no? So this was easy for us to find out carefully here itself. Next, 75% of the amount due to A on his retirement shall be settled in cash and the balance shall be settled after 1 year. So that balance 25% will be shown as loan. You are required to drop the following accounts after giving effect to the above transactions. Revaluation account, partners capital, and then bank account. One of the important examiner's comment to observe here is the question is not at all asking to prepare the balance sheet. Since they have asked to prepare bank account, first of all, the students have not clearly presented the bank account. They are wrongly interpreting to write the balance sheet. Most of the students have given the balance sheet for this question, but the examiner's comment is clearly communicated telling that There was no requirement of the question at all with respect to preparing the balance sheet. So, reading the question carefully, being alert at this point is relatively important to save your time here, guys. Moving ahead. So, revaluation account, we roughly understood what values will appear. So revaluation account, one extra treatment what institute has done here is they have taken the joint life policy surrender value here itself. If this is confusing to you, you can just eliminate this value and find out the profit or loss on revaluation. Accordingly, take it to capital. They have also given the alternate treatment. See here. Alternatively, surrender of joint life can also be routed through partners capital. As I told you, the entry would be bank account debit to old partners capital account. So the alternative treatment, see, in such case there will be no surplus or deficit in the revaluation account. Bank account debit to A's capital, to B's capital, to C's capital. This can be your alternate entry. So if that is done, what they are telling is you will not have profit or loss on revaluation itself, because 96,000 is your value. 96,000 is also the profit on revaluation. So ultimately both sides it will match. By balance brought down, take the respective balances. In this question, there is revaluation. If we are not routing the joint life policy treatment through revaluation, this will not come. Next, there is a goodwill entry. Goodwill of the firm was valued at 2,88,000, I guess. 2,88,000. Remember, this should be apportioned in the gain ratio. Old ratio is given 3:2:1. New ratio is equal. So we need to find out the gain ratio. See here, gain ratio is nothing but new profit sharing ratio minus old ratio. New ratio is 1 by 2. Old ratio was given as 3:2:1. So 2 by 6, because we are calculating for B. Remember, most of the students will again commit mistakes here for taking for A. We are doing this calculation for B. LCM between 2 and 6 is 6. So 2 3s are 6, 3 minus 2. So this will be 1 by 6. Then for C, 1 by 2 minus 1 by 6. 6, 2 3s are minus 1. This will be 2 by 6. So the goodwill is given of the firm as 2,88,000. A share is 3 by 6. So 2,88,000 into 3 by 6 will be 1,44,000. This will be apportioned in the ratio of 1 by 6 into or 2 by 6, or in the ratio of 1 is to 2. That is 1 by 3 and 2 by 3. 48,000, 96,000 will be the amount. What will be the journal entry for this? So who are giving B's capital account debit, C's capital account debit to A's capital, who is the retiring partner. This will be the entry. So this will be presented in your capital account. See, to A's capital 4896, and by B's capital in A's column, by C's capital in A's column. There was one other important point about the maintenance of capital balance. We already found out that was 4,80,000 and 4,80,000. Which if we enter this, we can easily find out what would be the amount which is supposed to be brought in by the old partners. Before doing that, we will close A's account. The question clearly tells 75% is paid and then balance 25% is shown as loan. So how do we find out the amount outstanding to Mr. A? 4,80,000. In this question, they've taken 48. So we are taking this 48 also for you to understand with the same value, 6,72,000. So this is the total amount due. In this 75% is 5,04,000. So how are we getting this? 6,72,000 into 75%. So the balance will be shown as A's loan, which will appear in the balance sheet. But here in this question, they have not asked us the balance sheet. And after we write the balance carried out, you will have the difference balancing figure on the credit side. By bank, this will be your balancing figure. So that's why the question is asking us to prepare the bank account. So the opening balance, you can take it from the balance sheet, 1,60,000, and Remember the joint life policy treatment, the entry was bank account debit to respective partner's capital. So we can easily bring down the partner's capital credit of 96,000. And then here to B's capital to C's capital with respect to these capitals being introduced, 1 lakh 76 and 4 lakh. Then remember 75% was settled to Mr. A. So that value will come, then ultimately we will have the closing balance. The question just asked us the bank account, but as I clearly told, most of the students has committed the mistake. Rather than presenting bank account, or some have presented but they have not done it correctly, and most of the students have given the balance sheet even though there was no requirement about it in the question. Avoid or refrain from doing such mistakes, guys. I hope this question is also comfortably understood. Next. The following is the schedule of balances as on 31st March 2025 extracted from the books of Mr. Rade. So they've given all of the balances. Then during the year, Mr. Rade has distributed free samples costing 3,300 for publicity. Then a fire took place in the warehouse on 20th March and destroyed goods worth 6,000. The insurance company was admitted a claim of 4,500 on 31st March 2025. Create a provision for doubtful debts at 5% and provision for discount on trade receivables at 2.5%. Depreciation is to be provided on plant and machinery at 15% per annum and on furniture and fittings at 10% per annum. Bank overdraft is secured against hypothecation of stock. Bank overdraft outstanding on 31st March has been considered as 80% of real value of stock, deducting 20% as margin, and after adjusting the marginal value, 80% of the same has been allowed to draw as an overdraft. Prepare a trading and profit and loss for the year ended and then also balance sheet as on that date. In the entire question, this is the most important one where most of the students also feel tricky point here. Rest all you can easily do it. So this is a final accounts question. When you approach a final account question, open all the respective accounts, trading, profit and loss, and then balance sheet. So open the respective trading account, profit and loss, and then your balance sheet. Likewise, we will have respective working notes to be also considered. So let's understand this one by one. So keep the questions side by side so that will be helpful for you to compare with the answers easily. So here I will have to scroll down in order to look at the question. We will run through the trial balance data given. Advertisement expenses 13,400. Where will this come? In my profit and loss account. Bad debts, profit and loss 4,400. Bad debts recovered, profit and loss credit side. Other two is on the debit side. Cash at bank in the balance sheet. Bank overdraft, balance sheet. Assets, liabilities. Capital, balance sheet, liabilities. Carriage inwards, trading account. Carriage outwards, P&L. Cash in hand, again balance sheet, assets, drawings, balance sheet, capital, furniture and fittings, balance sheet, assets, interest paid on loan, your P&L, indirect expense, administrative expense, P&L, opening stock, trading account, plant and machinery, balance sheet, assets, prepaid rent, again, balance sheet, asset. Because this is given in the trial balance, the entry would have already been reflected. Then printing and stationery, P&L, expense, provision for discount on trade receivables. Remember, provision for doubtful debts, these two is already given to us. There is an adjustment which is also mentioned, so we have to be careful enough in order to considering the amounts. We need to find out how much after incorporating these adjustments. Then purchases, trading, rent, rates and taxes, P&L, salaries and allowance, again P&L. Salaries payable, this is already given in the trial balance, so this becomes your liability. Sales, trading, trade payables, again balance sheet, liabilities. Trade receivables, balance sheet, assets. Wages and salaries, wages and salaries is given, so we will take it to trading account. So this is the classification. Accordingly, we can find out the respective values. During the year, Mr. Radhe has distributed free samples costing 3,300 for publicity. What is the journal entry for this? Advertisement expense account debit to purchases. So what will be the impact we need to consider? Add advertisement expenses plus 3,300. There was some amount for advertisement. See 40,640, add 3,300 to it, and then also consider reduction of this amount in your purchases. So let's observe this treatment. See here, goods distributed as free samples, which is taken as a subtraction, and then in my advertisement expenses added. Clear with this? Yes. Next, a fire took place in the warehouse on 20th March and destroyed goods worth 6,000. The insurance company has admitted a claim of 4,500 on 31st March. First of all, the goods lost will be your loss. That needs to be recorded in your profit and loss. See, loss by fire. Understand one thing, 6,000 was the total goods lost by fire. In that, insurance company has accepted claim for 4,500. So your net loss will be 1,500. That is how this value has been arrived. Next, create a provision for doubtful debts at 5% and provision for discount on trade receivables at 2.5%. I told you there is already an existing provisions. We have to consider that as well and then find out the residual. So first of all, how much is my total debtors? Let's find out the value of total debtors first. Bad debts is given, bad debts recovered is given, advertisement expense. Oh, sorry, this is administrative. You have to take advertisement expense here. Trade receivables, 4,80,000. So they're asking us to present 5% as doubtful debts and 2.5% as discount. So there is a working note already given by the institute. Let's understand from that itself. So existing trade receivables is 4,80,000. So required is 4,80,000 into 5%. So 24,000. From the given details, 12,800 was already presented. Remember the concept. We will add the new provision and subtract the old provision. That is what is done. So 24,000 is required, but you have just maintained 12,500. How much extra required? 11,200, which will be taken to my profit and loss. Likewise, provision for discount on debtors. Remember that will be taken on the good debtors after providing for provision. So 4,80,000 minus 24,000. On this, I will have to create 4,56,000. So how am I getting this? 4,80,000 minus 24,000. So on this value, the required provision was how much? 2.5% into 2.5%, that is 11,400. See, this is 4,56,000 into 2.5%. This is 11,400. How much was already created? 5,500. So the remaining is 5,900 required, which will be written in my profit and loss. See, provision for doubtful debts and then provision for trade receivables 5,900. Rest all values I've already told where and all that will be placed. You can accordingly cross check. Next. So this is done. Depreciation is to be provided on plant and machinery at 15% and furniture 10%. Plant and machinery 80,000 into 15%, 41,000 into 10%. furniture and fittings 4100. Accordingly, this will also be shown in the balance sheet. Clear with this? Yes. Next point, depreciation is also done. Then there is bank overdraft, which is secured against hypothecation of stock. Bank, first of all, hypothecation of stock here means providing this as a collateral. Your bank overdraft, this is nothing but in the nature of a borrowing. So what is the collateral security? That is the stock of the business. So for providing this loan or credit facility, the bank is taking stock as the pledge. That is what this hypothecation means. Bank overdraft outstanding on 31st March has been considered as 80% of real value of stock, and after adjusting the marginal value, 80% of the same has been allowed to draw as an overdraft. First, observe one thing. In the entire question, did you anywhere observe the value of closing stock given to us? No, the closing stock was not at all mentioned. That means we need to first find that out. How can we find it? Because of this one particular adjustments. They are telling bank overdraft is based on what? See, it is being considered as 80% of real value of stock. So bank overdraft details is available to us. 80% is taken as the real value of stock. Upon that, and after adjusting the marginal value, 80% of the same has been allowed as an overdraft. So from the question, bank overdraft is 3,20,000. So how do we have to interpret this? Let closing stock be X, because that is what we require now. So the question is clearly telling that the bank overdraft is taken as 80% of the real value of stock, and upon that there is again 80% adjusted as the marginal value. So how do we present this? X into 80 by 100. This is the real value of stock. On top of it, there is still 80 by 100, which is taken as adjusting the marginal value. This is 3,20,000. Now I have to find out X. X will be equal to 3,20,000 into 100 into 100 divided by 80 into 80. I can cancel out the zeros. So this will be 3,20,000 into 100 divided by 64. So your closing stock will be 5 lakh. So where and all closing stock will come? In my trading account. See, observe the entry here. Buy closing stock 5 lakh, and then one more will appear in your balance sheet. Closing stock 5 lakh. I hope this is clear. Rest all points are easily manageable. So after you enter the values, you can find out the closing amount. So there is also an alternate way of given to calculate the closing stock. So accordingly, we can find it relatively. Understood, all of you? Yes. Next question. Attempt any one of the two subparts, that is either part 1 or 2. So there is an inbuilt choice given in question number 5. 5A, you can either take first one or the second one. But we need to understand this to solve. On 30th November, the bank statement of Rama and Sons showed a debit balance of 39,700 at bank. 39,700 at bank. On comparing it with the cash book, the following discrepancies were observed. So they have given us the list of transactions. You are required to ascertain the balance appearing in the cash book of Rama and Sons as on 30th November. First of all, this is a bank reconciliation question wherein they are giving us a debit balance at bank. So what does this mean? Generally, bank will have a credit balance. So this is bank overdraft. As per examiner's comment, most of the students have considered that, but they have reversed the impacts, that is, add less, where they've gone wrong with respect to the analysis what they have taken as their base book balance. So make sure before you proceed, know your starting points clearly. So that is when it becomes helpful for us to interpret it easily. Clear? So here they've given us the debit balance of 39,700. So this is your cash book and this is your passbook. Let's understand the entries one by one. 39,700 is the starting point. A check of 10,000 was issued to a supplier on 25th November, but it was not presented for payment till 3rd November. The balance is given for 30th November, so this transaction will have an impact. If the check has been issued, your cash book balance would have come down. What book you can adjust in this question? Passbook. So if we have to balance, I will have to reduce. But remember, this is an overdraft balance. What will I do? Reverse the effect. I will add. So 10,000 will be added. See here, 10,000 add. Clear? Next. A check of 3,000 was received from a customer and deposited on 28th November but was credited by the bank on 2nd December. We are doing this as on 30th November. So check received would have increased your cash book. There is no entry in the passbook. So because it was credited on 2nd December, if we have to bring the same book at the same level, we need to add. But I have to reverse the effect, so I will reduce. Minus 3,000. But not credited by the bank. Next. The bank had directly collected interest of 2,400 on behalf of the firm, which has not been recorded in the cash book. Cash book, passbook. The bank has collected interest means the balance is increased. Which book I can alter? Only passbook. So if I have to match, I will reduce. But here I have to reverse the effect, so I will add 2,400. Bank interest not entered. Clear? Next. Credit side of the bank column of cash book was overcast by 900. Credit side of bank column of cash book means they're talking about the payment side. This is overcast by 900 means your cash book is showing less because it is payment by 900. Which book I can alter? Passbook. I have to bring it down. Since this is overdraft balance, I will add 900. Credit side of the bank column overcast 900. Clear? Next, the customer had directly deposited 8,000 into the firm's bank account, but no entry was made in the cash book. There is a direct deposit. Direct deposit means your balance would have been increased. Passbook balance is increased. No entry in the cash book. I will have to reduce. Since this is overdraft balance, I will add 8,000 add. Check directly deposited 8,000. Next, a check of 2,000 deposited earlier was returned dishonored and debited in the bank statement only. A check of 2,000 deposited earlier was written dishonored means there is a debit in bank statement means the balance would have come down. So which if I have to match, I can alter only passbook. I will certainly add. Since this is an overdraft balance, I will reduce. See here, check dishonored and debited to bank 2,000. Next, as per standing instructions to bank, EMI of 20,000 was paid by the bank. The same was omitted to be accounted for in the cash book. So this is the payment done. So your passbook balance would have come down. If I have to match both the books, I will have to certainly add. Since this is overdraft balance, I will reduce 20,000. EMI paid by the bank 20,000. Comfortable? Yes. Next, amount of 5,000 was wrongly credited by the bank to the firm's account for which details are not available. Amount was wrongly credited by the bank to the firm's account. That means the balance would have been increased. There is no entry in the cash book. If I have to match, I will have to reduce. Since this is overdraft balance, I will add 5,000. See, amount wrongly credited 5,000. Next, the cashier had wrongly recorded a bank payment of 12,500 as 21,500 in the cash book. So what is the difference? 21,500 minus 12,500, 9,000. So this is a payment, bank payment in the cash book has been recorded. So the balance is down. If I have to match, I will have to certainly reduce. Since this is an overdraft balance, I will have to add by 9,000. Error in entry of payment 9,000. So how did I get this? 21, what was the value? 21,500 minus 12,500. I hope this point is clearly understood to all of you. And this was pretty simple as well. Students have committed mistakes in order to consider this as an overdraft balance, taking this as a normal credit balance. So after doing all addition subtraction, the balance of the BRS is coming positive. So since we started with overdraft itself, since it is coming positive, so you'll still have a overdraft balance, but as per which book? This will be as per cash book. Clear? Next, there was a choice in this subpart. So next question is on bills of exchange. T draws on J a bill of exchange for 1,80,000 on 1st April for 3 months. J accepts the bill and sends it to T, who gets it discounted from his banker for 1,72,800. T immediately remits 57,600 to J. On the due date, T, being unable to remit the amount due, accepts a bill for 2,52,000 for 3 months, which is discounted by J from his banker for 2,40,660. J sends 40,440 to T. Before the maturity, T becomes bankrupt and his estate is being paying 50 paisa in a rupee. That means 50%. Pass the necessary journal entries in the books of T. So they're just asking us in the books of T. So this is the concept testing of accommodation of a bill. If you have structurally understood, this becomes pretty simple for you to solve. So first of all, T is drawing a bill of exchange. So what will be the journal entry for this? Bills receivable account debit. This has been accepted by J. So the entry will be bills receivable account debit to J, 1,80,000. Bills receivable account debit to J, 1,80,000. Then this bill is being discounted with the bank for 1,72,800. When you receive the money, the entry would be bank account debit, discounting charges account debit to bills receivable. You're receiving 1,72,800. The value of the bill was 1,80,000. So the entry will be 1,72,800, 7,200, and then 1,80,000 to bills receivable. The bills receivable discounted with the bank at a charge of 7,200. The same thing is happening on 1st April. Remember, this is an accommodation of bill. So whatever amount is received should also be remitted to J. So when you're paying, the receiver account will be debited. So J's account debit to bank account to discounting charges account. So remember, you will also apportion the share of expenses. So the question is clearly specifying how much you're giving back to J. Immediately remits 57,600 to J. So let's understand this with a table. There is T and J. 1,80,000 is the bill amount, 7,200 is the discount, 172,800. If J gets 57,600, how much is liable for T? 172,800 minus 57,600. This is 1,15,200. Now we have to also apportion the discount in the ratio of benefit derived. How can I find it? See, 7,200 is the discount for 1,72,800. I want how much is it for 57,600. So this is not visible. Just a minute. So 57,600 into 7,200 divided by 1,72,800. 57,600 into 7,200 divided by 172,800. This will be 2,400. So what will be the journal entry? J account debit to bank account to discounting charges. 57,600 was given to us in the question. 2,400, how do we find this? So this is the working. To find this 2,400. So this becomes pretty simpler for you to consider. I will just mention it here. Next, so this is our running table. So this becomes easier for us to calculate. So if I've given 2,400 as a discount in 7,200, so remaining 4,800 goes for T. So if I have to find out the net balance, 4,800 plus 1,15,200, this will be 1,20,40 and 57,600 plus 2,400, 60,000 for J. Till here all of us clear? Then, next what happened? On the due date, that is from 1st April 2025, 3 months later plus 3 days of grace. That means April to May, June, July. 1st of July, 3 days of grace. So it will be 4th of July 2025. T being unable to remit the amount accepts a bill for 2,52,000 for 3 months. First of all, we will make the entry for this. Now, T is accepting the bill. That means there will be a bills payable drawn on him. So, what will be the journal entry? Remember, we are preparing journal entries in the books of T. So, as per the due date, see in the bill of exchange question, these points becomes very important. J account debit to bills payable for the value 2,52,000. Moving ahead, which is discounted by J from his banker for 2,40,660. Now J is getting it discounted. We are making the journal entries in the books of T. J sends 40,440 to T. This is only what we are concerned about. 2,40,660 is being received. 2,40,660 has been received, out of which 40,440 is being sent. 40,440 is being sent to whom? To T. That means balance 24660 minus 40,440 is lying with J. That is 2,220,000. Now what was the bill amount? 2,52,000. We are getting 2,40,660. What is the discount? 11,340. Remember, the expense should also be apportioned in the ratio of benefit derived. Yes. So what will be the value here? We need to consider 1,20,000 for 40,440. So how do we apportion this in the ratio of benefit derived? So if I have to find out the net balance as on this date, so it will be 1,20,000 plus 40,440. That is what is taken here. Observe 1,20,000 plus 40,440. This is representing 2,40,660. So divide by that, the total discounting charges is 11,340. So remember, T is receiving the amount. So the entry would be bank account debit, discounting charges account debit. Who is giving? J. So to J's account. And this also happening on the due date itself. I hope this entry is understood. Later, what is happening? Before the maturity, T becomes bankrupt and his estate is paying 50 paisa in a rupee. So T has become bankrupt. First of all, when there is bankruptcy erased, we have to first pass an entry of bill dishonor. Remember, he had accepted the bill, this one. He had accepted the bill. First, we will reverse this entry. So what will be the entry? Bills payable account debit to J. We have to consider this on the due date of the respective bill. So 4th July, we drew this bill. 3 months from that date. So 8, 9 and 10, 3 days of grace. So this will be 7th of October. So we will first reverse this. Then 50 paisa is realized from his estate. We have to find out how much is remaining from his estate. How much is available in his estate? See, 1,20,000 in 11,340. First, I will have to apportion the discount. In this calculation itself, we can find out 7,560 is going for J, means out of 11,340, 7,560, 3,780. So how much is the net balance? 1,20,000 plus 40,440 plus 3,780. 4,440 plus 3,780. This will be 1,64,220. 60 plus 2,220 plus 7,560. 267780. Bank to discounting charges 7,560. Oh, sorry. Here we have just taken the interchange amount because T received 7,560 for this one, and 11,340 minus 7560 is 3780 for J. I took the interchange amount there because that was given for T and this was for J. So net balance 1,20,000 plus 4440 plus 7560. This will be 1,68,000 for T. 60,000 plus 2,220 plus 3780. 2,64,000 for J. So net balance of T is 1,68,000. In this only 50% is realized. So what will be the entry? J's account debit 1,68,000 to bank 50% is realized and the remaining goes to deficiency account. If you have understood this calculation, the values could be pretty simpler. Make sure you practice this really well in order to understand the entries and be careful about the respective due dates. Anyway, after the completion of this video, I will share you this document itself wherein you will have all the working notes done respectively so that also be useful for you to follow. Clear? Yes. So this was choice questions which was there. One was for BRS and then there was bills of exchange. Next question. Sumitra is engaged in the business of trading in detergent. She does not maintain proper records. From the following details, you are required to compute the total of purchases and sales. So they have given the requisite details. We have to just compute the total purchase. Total purchase or total sales includes both your cash plus credit transaction. Remember that both cash purchase as well as credit purchases. See, opening balances are given of inventory, sundry creditors, debtors, closing balances are also given. Then the respective transaction with creditors and debtors given. Simple interpretation. You can just prepare the debtors and creditors account, find out their credit amount, and then there is anyway given of cash details, cash sales, cash purchases given. We can directly add and find out the respective amounts. See, the opening balance of inventory. Sundry creditors will open on the credit side by balance brought down. Sundry debtors on the debit side to balance brought down. And then closing balance to balance carried down by balance carried down. Cash paid to creditors, the entry will be creditors account debit to cash or bank. Cash received from debtors, bank account debit to debtors. All these entries will be mentioned. Discount received during the year. You can receive discount when you are actually paying. So this can be given to us from the creditors. A creditors account debit to discount received and discount allowed to debtors. So discount allowed to debtors. All these entries you can find it out here. Whatever we discussed in sundry creditors and then sundry debtors. Credit purchases you can find out as a balancing figure. So by purchases 2,90,000. To that we will add cash purchases 30,000. So accordingly we can find out our total purchases. Clear? Then we will have sundry debtors. Then we will have total sales, credit sales plus cash sales. Cash sales details are given to us in the question. Credit sales, we will find this as a balancing figure, 5,80,700. So accordingly, this details will come. Clear with this? Yes. So this was a simpler question, minimal time taking if you have got the concepts properly. And this question is framed from your single entry chapter, accounts from incomplete records, wherein we will understand the preparation of debtors and creditors account. Next question. Ajanta Limited issued 50,000 equity shares of 10 each payable as rupees 3 per share on application, 5 per share including 2 as premium on allotment and 4 per share on call. That means here the allotment money is 3 rupees. All these shares were subscribed. Money due on all shares was fully received except from X holding 1,000 shares who failed to pay the allotment and call money, and Y holding 2,000 shares who failed to pay the call money. All those 3,000 shares, that is 1,000 holded by Mr. X and 2,000 of Mr. Y, were forfeited. Out of forfeited shares, 2,500 shares, including whole of X's shares, were subsequently reissued to Z as fully paid up at a discount of rupees 2 per share. Pass the necessary journal entries in the books of Ajanta to record. Observe here carefully to record the forfeiture and reissue of the shares. Also prepare the extracts of the balance sheet and notes to the accounts. examiner's comment in this particular question is most of the students have written all the entries from application allotment, but the question is specifically asking you to record the entries on forfeiture and reissue. So the disadvantage for you guys would be you will lose lot of time if you start entries from the application, because the question requirement is just from forfeiture and reissue. Along with that, they have asked to prepare the extracts of balance sheet and notes, which most of the students have missed. This is the examiner's comment. So let's interpret this and solve as per what is the question required. So we have to first pass the forfeiture entry and then later reissue. For forfeiture, 1000 shares didn't pay allotment and call, and 2000 shares didn't pay the call money. So what will be the journal entry? Equity share capital account debit. Remember, there is premium involved. On 1000 shares, allotment money was also not received. So with respect to this number of shares, we will also eliminate premium. So the entry will be equity share capital account debit, securities premium account debit, to share allotment account, to share call account, to share forfeiture account. So this will be your journal entry. See, equity share capital, securities premium, to equity share allotment, to equity share call. Now, yes, how have we got these values? Share allotment was not paid for 1000 shares. So 1000 into 5 rupees allotment and premium money. 1000 at 2 rupees premium money which was not paid. Total number of shares were forfeited was 3000 into 10 rupees, which is the face value. And then equity share call was not paid for 2000 shares. The call money was somewhere around 6 rupees, I guess. Call money on allotment and 4 per share on call. Okay, so the total number of shares which was not paying call money was 2000 plus 1000. So total number of shares is 3000 into 4, and the balance will go to share forfeiture account. The entire details should be presented in the summary. The next entry would be of reissue. They are telling there is a discount of 2 rupees on reissue. So the entry would be bank account debit, share forfeiture account debit to share capital, entire 2500 shares. Out of 3000, 2500 shares have been reissued. So this is done at 8 rupees per share, 2500 into 10. So the balance will be done through share forfeiture. Last important entry here is there is only 2500 shares reissued, but 3000 shares which were forfeited. In this 2500, complete shares of X is being involved. So how do we find out the amount which is required to be transferred to capital reserve? We can prepare a working note. So here the ICAI has already given us the alternative. If the amounts have been transferred to calls and arrears, instead of what we have taken here, share allotment, share call, you can also use calls in arrears if the amount is being transferred. This is also accepted. See, in the working note, how to find out the amount to be transferred to capital reserve. Remember, you have to just first understand what amount is being received by the company. On 1000 shares, which was taken by X, 1000 shares, 3 rupees is already been considered. See, amount forfeited per share of X, 3 rupees of amount is already been lying down with the company. This is representing your application money. So that is 3000. How much was the reissue price? 2 rupees per share. So I will take that out, 2000. So how much is remaining? 1000. Likewise for shares allotted to Y. Remember here, number of shares which was taken from Y was 1500 because the entire 1000 was taken from X. 1500 here you should not include the premium amount. So we are only taking 6 rupees. How is that? 3 rupees on application and 3 rupees on allotment. So this is 6 rupees taken. 9000 is lying in share forfeiture. In this reissued only 2. So how much is remaining? 6000 will be remaining here. So the total amount which needs to be transferred to capital reserve will be 7,000. So this entry will be done. Share forfeiture account debit to capital reserve. This will be your journal entry. The question is also asking us to prepare the extracts of balance sheet and notes to accounts. So extract of balance sheet. Equity and liabilities, we'll have shareholder funds. Let's understand this in the working note. Total issued share capital is 50,000, out of which subscribed is 49,500. How are we getting? 3,000 was forfeited, 2,500 was reissued, so that 500 gap is already there. 500, and then we will add forfeited shares balance. Where are we getting this 3,000 from? Observe carefully, guys. Share forfeiture was credited by 15. Then there was a debit of 5,000. So if you literally observe 15,000 minus 5,000, 10,000 is remaining. But how much we transferred to capital reserve? Only 7,000. So there is still 3,000 which will be added to your capital balance. 3,000. Clear? Then there is reserves and surplus. Securities premium is allowed because you have collected premium amount on allotment for the remaining shares. Default was only with respect to 3,000 shares. In that also only 1,000 shareholders didn't pay the allotment money. So securities premium will come for that. Further details, share application for 50,000, share allotment is for 49,000 at 5 rupees including premium. Share call for 47,000 because total 3,000 shareholders didn't pay at 4 rupees, and then shares reissued 2,500 into 8. So this total is taken as your cash and cash equivalent, and the amount which has been transferred to capital reserve 7,000. Accordingly, you will take all of these details. See, total premium amount receivable in allotment, how much we are getting? 50,000 into 2, because this is the total number of shares. Amount reversed on forfeiture was 2,000. So the balance remaining is 98,000, which will go to balance sheet. That is how we are getting this 98. So all of these we will present here: shareholder fund, share capital, reserves and surplus, and then cash and cash equivalents. I hope this is comfortably clear to all of you with respect to concepts. So this was your question number 5. Then last question. The balance sheet of Dynamic Limited as of 31st March includes the following information. 10,000 equity shares fully paid up is given. 1 lakh 9% preference shares, 100 each, rupees 70 paid up is given. Then there is capital redemption reserve, securities premium reserve, general reserve, balance with banks. Under the terms of their issue, the preference shares are redeemable on 31st March at a premium of 5%. So there is a preference shares. This is to be redeemable. Observe one thing. For redemption of preference shares, those shares which are fully paid up can only be redeemed. In this case, 100 is the face value, out of which 70 is only paid up. So first of all, the balance need to be fully paid up. Observe here, preference shareholders having 4,000 shares failed to make the payment for the final call made under section 55, because section 55 is the regulating section for redemption of preference shares. Their shares are forfeited after giving proper notices. Fine. In order to finance the redemption, the company makes a right issue of 10 lakh equity shares of 10 each at rupees 11 per share. That means it is issued at premium. 2 being payable on application, 4 including premium on allotment. So here 1 rupee is the premium, so 3 plus 1, and the balance on 1st June. So how do we derive at the balance? If 2 is on application, 4 minus 11, so 5 rupees will be the balance on first call. The issue was fully subscribed and the allotment was made on 31st March 2025. The money due on allotment was received on 31st March 25. The preference shares were redeemed after fulfilling the necessary conditions of Section 55 of the Companies Act. You are required to pass the necessary journal entries with narration in the books of Dynamic Limited for the above. A very good question for practice, wherein it gives you a structure of the entire issue along with redemption of preference shares. So first, let's be very alert with respect to dates given here. The redemption is due on 31st March 25, and the company is also making a right issue. Observe one thing carefully. The balance, which is the balance out of this application and allotment, the remaining amount is taken on 1st June. They are asking us to pass the necessary journal entries. First of all, the money is required before 31st March 25 because the redemption is due as on that date. First, clearly understand this. So keeping this in mind, let's analyze the entries. So there were 4,000 shareholders who failed to make the final call. So that means remaining 96,000 is first having their due and then making the call. Clear? So we will have to pass the entry for this. First, we will make the entry due. What is the due entry? Share final call account debit to share capital. So 9% preference share final call to 9% preference share capital. Total number of shares was 1 lakh. 30 rupees was the call money. So accordingly, we'll get 30 lakh. In this 30 lakh, only 96,000 shareholders are paying. But before we pay, we will first show that as calls in arrears. So what will be the entry? Bank account debit for what amount we are receiving. So that is 96,000 shareholders into 30 rupees. That will be to 28 lakh 80,000. And then calls in arrears. This is 4,000 shareholders into 30 rupees, which is 1 lakh 20. 2. 9% preference share final call. Later, this shares were forfeited. So what will be the forfeiture entry? Share 9% preference share capital account debit to calls in arrears account and to share forfeiture. So the amount which has been transferred 1,20,000 with respect to 4,000 shares, 10 rupees was the face value. So that has been taken care here. Sorry, this is not 10 rupees. This is 100 rupees. So 4 lakh total capital to calls in arrears and then to shares forfeited. I hope these three entries are comfortably understood. So after this shares are forfeited, remember one thing, there is no point in again reissuing the forfeited preference shares because ultimately this need to be redeemed. So we will not reissue it. The amount lying in the share forfeiture will be transferred to capital reserve. So the next entry will be share forfeiture to capital reserve. How much ever was there in the balance will be transferred to capital reserve. Clear with this? Next, for considering this redemption, the company is going ahead in making the right issue. So they are giving the breakup of application allotment. So we will have to pass the issue of shares entries. So what is the first entry for receipt of application money? Bank account debit to equity share application 10,000 in 10 lakh shares into 2 rupees. Then equity share capital to equity share application to equity share capital. Again, the same transfer entry. Then equity share allotment to equity share capital to securities premium. There is 1 rupee premium. 10 lakh shares into 1 rupee. Then we will have bank account debit to share allotment account. So till here 31st March all entries have been done. Because remember 31st March is the due entry for redemption. What is the balance collected on 1st June? We are not bothered about it. Clear? Next. So now we will have to find out how much amount is required for redemption purpose. Remember 96,000 preference shareholders are there at rupees 100. So we will need how much? 9,96,000. See here, preference shares to be redeemed is 96,000 into 100, so 96 lakh. How much money I've collected from the issue of equity shares? 10 lakh shares. I've collected the application money. I've collected the allotment money. Here you will not include the premium. Be very, very careful here because remember section 52, only 5 purpose. Nowhere in section 52 it provides the point that you can utilize this balance for the purpose of redemption of preference shares. Clear with this? Yes. So 1 lakh into 2 plus 3. This is your application money and this is your allotment money. So that is 50 lakhs. Still balance. This balance required by creating capital redemption reserve. We can create capital redemption reserve only from the free reserve balance. The question is giving us the general reserve balance available. So first we will create the capital redemption reserve. What is the creation entry? General reserve account debit to capital redemption reserve. I hope all of you understood how we got this 46 lakh, from where this is coming. So later, now we have the all funds accumulated. We will now redeem the preference shares. First, we will make it due. So what is the due entry? 9% preference share capital account debit. There is a premium on redemption. So premium on redemption of preference shares account debit to preference shareholders. Due is for 96,000 shares. So 96,000 shares into 100. The premium is for 5%. So on 96 lakh at 5% will be 4 lakh 80,000. Then to preference shareholders. Then we will make the payment preference shareholders account debit to bank. At last, we have this premium which needs to be written off. There is pre-reserve balance given. So we can either write it off through general reserve or securities premium account. That is what is done here. General reserve account debit or securities premium to premium on redemption of preference shares. Now, if you observe this question, it is relatively easier, but there are literally a lot of entries need to be done. If you systematically understand, this becomes a very scoring question because this has been asked for 15 marks. Alternatively, the journal entries for forfeiture is also given, wherein, unlike you saw the previous question, if the amount is not transferred to calls and arrears, you can replace the respective accounts. Here, we have transferred the amount to calls and arrears, so we routed it through calls and arrears. You can also do it directly by taking call account as well. Clear? Yes. So the next part of the question is, what do you mean by principal books of account and what are the rules of posting journal entries into the ledger? Again, a simple theory question. Principal books of accounts, you have to write about your ledger, and what are the rules of posting journal entries into the ledger? Let's observe quick points. See, after recording the original transaction, recorded entries are classified and grouped by preparation of accounts. The books which contain all sets of account, which is in the nature of personal, real, nominal, is known as ledger. Ledger is also known as your principal books of accounts since it provides full information regarding all the transactions pertaining to any individual account. So this you have to just give a snippet of what does the significance of ledger is, because that is your principal books of account. And they have asked the rules regarding posting of journal entries in the ledger. Just observe, you will know the simple basic points. You need not by heart what is given here. See, separate account need to be opened for posting, and then you have to clearly make use of the words to and by. You can reiterate these points. To will appear on which side, it is written on the debit side, and by will be written on the credit side. And the concerned account debited in the journal should also be debited in the ledger, but reference should be of the respective credit account. Meaning, for example, if I write bank account debit, how will I present it in the ledger? That is what they are reflecting. So you will read it as bank account debited to or by. So that is what they are interpreting here. So this is all about the rules regarding posting of journal entries in the ledger. So roughly the entire overview of Jan 2026 exam paper was pretty lengthier. Why? Because they have framed question, majority questions for 10 marks, which will definitely be a time consuming one. But all are pretty simple provided you have that conceptual clarity, and the practice of speeding up writing should be very, very precise, because the adjustment entries, especially when it comes to partnership, was not much trickier. If you know few minute points, it was pretty manageable. It was a very good paper for practice. Make sure you also go through the entire video once and literally practice sitting for complete duration to practice the entire paper. That is when you realize where you are standing if such papers is again reflected or touched. Hope you enjoyed this session. Anyway, I will share you this entire document in the description. Kindly find it out because I have made certain workings in this. So I will attach this in the description. You can download it, guys. Give your best effort. Prepare really well for your respective attempt, guys. Until I see you in the next video, keep working hard and all the very best. Take care. Hello champs, hope you all are doing amazing. In this video, let's discuss September 2025 CA Foundation accounting question paper along with ICAI suggested answers. Meanwhile, I've also gone through the examiner's comment wherein I can advise you while we come across the respective questions on what was the expectation from the examiner and what was the mistakes committed by students. This will definitely help you in your presentation and preparation as well, guys. So let's begin the discussion with the strong committed mindset. Question number 1, part A will always be true or false, wherein you have to answer by quoting the statement as true or false along with the relevant reasons. So let's begin this. First one, the materiality depends only upon the amount of the item and not upon the size of the business, nature and level of information, level of the person making the decision. The given statement is clearly emphasizing that materiality concept is purely dependent upon the amount of the item. So this is not correct. So hence the given statement will be false. What will be our reasons? Here you have to use as a keyword which says that significant elements having the economic effect will impact the concept of materiality, because materiality is basically talking about what would be the relevant information for the purpose of disclosure in the financial statements. So, this keyword I will also emphasize while we discuss the respective answers. I will show you, so then you can come across the respective word. Next point, next one. While preparing the income and expenditure account as per accrual concept, the income and expenditure is considered in the period in which actual receipts and actual payments are made. First of all, income and expenditure is made on accrual basis. The given statement here is emphasizing on recording the transaction, that is receipts and payments on cash basis. So the given statement here is false. Income and expenditure, and exclusively accrual concept, talks about occurrence of transactions and events. Based on that, we will make the recording. Whereas what is presented here is as per the cash basis of accounting. Hence, the given statement is false. Next, profit sharing ratio and capital contribution ratio need not be same. Yes, as per partnership agreements, both ratios need not be same. So the given statement is true. Now, profit sharing ratio is purely dependent upon the mutual agreement between partners, whereas the capital contribution ratio, nothing will be specific because it purely attributable to the amount they invest in the form of capital. So, hence, the given statement is true. Depreciation is not provided in the financial year when the entity incurs loss. The given statement is false. You have to use a specific statement here. Depreciation is a charge against profit. What does charge against profit here means? It is nothing but you will record or you will provide for the item even if there is loss. So it is called charge against profit. There is one more specification called as appropriation of profit, wherein we provide for certain items only when there is profit. Depreciation will fall under the category of charge against profit. Hence, the given statement here is false. Next, the concept that helps in keeping business affairs free from the influence of the personal affairs of the owner is known as the matching concept. Whenever we come across the affairs talking between the business and the owner, it directly connects us to which concept? Business entity concepts. So, hence, the given statement here is false. So, here they are specifying that this is as per matching concept, hence, the given statement is false. Next, a company cannot issue equity shares at discount to general public. Yes, as per the Companies Act, that is to be more specific, as per section 53 of Companies Act 2013, you cannot issue shares at discount to the public. So the given statement here is true. So let's observe what is the relevant reasons and answers as per the suggested answer given. First statement, they are talking about materiality concept. So as per materiality principle, all the items observe here having significant economic effect on the business should be disclosed in the financial statement. This is the keyword which will observe your elements of what you have to quote in the answers. Next, false. Again, while preparing the income and expenditure as per accrual concept, the items of revenue pertaining to the current period are included and not the actual receipts and payments. So you will emphasize more about the items related to current period of account because that is what the accrual concept proposes as well. Next was about profit sharing ratio and capital contribution ratio. See, the profit sharing can be different from that of capital contributed, and it is not necessary that the partner contributing more capital should have a higher profit sharing ratio because it purely depends on the mutual agreement. Observe the last line. Profit sharing ratio is determined by mutual agreement among the partners. This line becomes important to utilize in your reasons. Next point, depreciation will not be provided in case of there is any loss. That was the statement. So as I explained while we were discussing, depreciation is a charge against profit and it is not an appropriation of profit. Therefore it has to be provided even in case of loss in a financial year. Next point, it was about the matching concept wherein they were discussing about the affairs between business and owners. So the concept that helps in keeping business affairs free from influence of the personal affairs is called business entity, and matching concept specifies that all expenses matched with the revenue is taken into consideration. So they're just explaining what is business entity concept all about and what does matching concept proposes. Last was issue of shares at discount. to the public is not allowed as per Companies Act. So the given statement was true as I specified there. According to section 53 of the Companies Act 2013, a company cannot issue shares at discount except in case of issue of sweat equity shares, that is issued to employees and directors. Thus, any issue of shares at discount shall be void. So these are the respective reasons given as per the suggested answer. As per the examiner's comment, the examiner are clearly pointed out that points where the students would give the reasons. They've quoted whether it is true or false rightly, but they have missed their marks in quoting the valid, relevant reasons with respect to the concept of materiality, and then the other points were still okay. So, as we have discussed, please make sure that you make use of the respective words as it is in order to not lose marks in reasons, because this is a sweet spot where you can secure 12 marks easily. I hope this was clear. Moving on to the next part of the question, explain the generally accepted valuation principles. So it is a straightforward questions asked for 4 marks. Generally accepted valuation principles, one of the important theoretical aspects. What are the 4 aspects where we use as the measurement of valuation principles? One is historical cost, current cost, realizable value, and the present value. For historical cost, just give few explanation. That means what is historical cost? It is nothing but acquisition cost or your purchase price. According to this, assets are recorded at an amount of cash or equivalents paid, because we purchase the assets. What is gone outflow, that will be recorded, and liabilities are recorded at the time of proceeds received in exchange for the obligation. So here they're specifying what does historical cost basically means. Next is current cost. Assets are carried out at the amount of cash and cash equivalents that would have to be paid. Observe the wordings, that would have to be paid, whereas here that is paid, directly given if the same or an equivalent asset was acquired currently. So usage of this word is important while we were explaining about current cost. Then liabilities are carried at the undiscounted amount that would be required to settle the obligation currently. If you are observing the wordings carefully, both is talking about, while with respect to assets, purchase of assets, and with respect to liabilities, settlement of liabilities. But in historical cost, it directly connects with paid or received, whereas under current cost, it just emphasizes on if it is paid at this point of time or if it is settled at this point of time, what should have been the current specific cost. Clear with this? Then realizable value. As per realizable value, assets are carried at the amount that could currently be obtained by selling the assets in the normal course of business, that is ordinarily disposable, and liabilities are carried at their settlement values. As on today, if I have to sell the asset, what is the value I'm supposed to fetch out of the sale amount? That is called as realizable value. Same with respect to liabilities. If I have to settle the liabilities as on the current date, what is the settlement value? Then present value. Present value is nothing but the current today's value by discounting the future prices. See, asset is carried at the present discounted value of the future net cash inflows that the item is expected to generate in the normal course of business. In simple words, what does that mean is, if I have to find out the present value of an asset, I will just estimate what is the cash flows I'm expecting out of the respective asset in the future period. So all those values will be taken in the present scenario, applying the respective discounting factor, that is called as present value. Same with respect to liabilities, it is carried based on the future net cash outflows. The difference here is, for asset it is net cash inflows, whereas for liabilities net cash outflows. Based on that, we will just figure out the respective values. If you in short learn this, it is just recording of assets and liabilities depending upon the cost consideration. So historical cost, current cost, realizable value, and present value. These were the 4 generally accepted measurement basis or valuation principles. Most of the students have not given the exact answer for the institute because they have directly misinterpreted the questions and they have not pointed out these 4 aspects clearly. This is what the examiners comment is. It is a simple topic. Make sure you relevantly know what are the points under the respective headings. This is where majority of the questions will lose marks in theoretical aspect. Clear with this? I hope this was comfortable. Yes. Next part of the first question, record the following transactions in the purchases book. This is a subsidiary book based question. So let's analyze this one by one. Before we run through this, there should be a format drawn. So the format here will be date, particulars, details, and then amount. So first element, first transaction as on 2nd December coming from Gupta and Co. So 100 plates at 150 per plate. We will write this in the description, and then 500 small bowls at 50 per bowl. Total this all, and on this total amount there is a trade discount of 10%. So if I have to calculate 100 plates into 150 rupees, 15,000, 500 bowls into 50 rupees, 25,000. So this totally will be 40,000 on that 10% discount. See, observe here. This totally will be 40,000 on the 10% discount, mean 4,000. The net amount from Gupta would be for 36,000. And there is one more element with respect to this. Packing charges are 2 rupees per plate and 1 rupees per bowl. So there were 100 plates. So 100 into 2, 100 into 2, and 500 bowls, 500 into 1. So this will be 500 and this will be 200. Packing charges would come to 700 rupees. So the total transaction amount from Gupta and Co will be 36,700. I hope this is clear. Next, 6th December, purchased a furniture for shop from plywood company on credit. First of all, will this transaction come in the purchases book? No, this transaction will not be entered in the purchases book because this is a purchase of an asset. We will record only those transactions which are in the form of inventory for the relevant business. So this is in the form of an asset, hence this will not be recorded in the purchases book. If not in purchases book, where will this be recorded? This will be recorded in a separate subsidiary book called as journal proper. I hope this is clear. Next, on 8th December, purchased on credit from Anjana and Co. 50 boxes of spoons at 200 per box. So we will write this in the description. 50 boxes into 200. Then there is 40 boxes into 250. So this total will be 20,000. Upon this, there is 8% of discount. See, this total will be 20,000. On this, there is 8% of trade discount. So the net amount here will be 18,400. Next, 15th December, purchase for cash from Steelhouse. Again, observe here, this is purchase for cash. Subsidiary book will record those transactions which are done on credit basis. So this transaction again will not be entered in the purchases book. So we will give a note, one for the furniture and this for the transaction happened through cash. Then purchased 1 dozen cookers at 750 each from Verma and Sons on credit. So 1 dozen will be 12 units into 750 rupees. So that is from Verma and Sons. So that will be entered. Miss Verma and Sons, 1 dozen cookers at 750. This is 9,000. How are we getting this? 12 into 750. So this will give us 9,000. Total of purchases book is 64,100. We didn't record two transactions. For that, we will give the respective note. Purchases in cash is recorded through cash book, and purchase of furniture being fixed asset will be recorded through journal, or this can also be called as journal proper. I hope the first question was comfortable and simpler for us to secure complete 20 marks. Yes or no? Yes. Moving on to the question number 2. The following are the details of machineries held by a firm. So they are giving 3 machineries and the respective purchases dates. Purchase value is also specified, useful life is given, and then there is scrap value also provided. The firm uses, very important observation to be done, sum of years digits method for charging depreciation and maintains a separate account for it. A separate account is maintained for what? For recording depreciation. On 1st April 2024, the M1 machine has become obsolete and has been sold for 1,34,000. On the same date, the estimated useful life remaining of machine 2 is reassessed at 3 years. See, this is happening on which date? 1st April 2024. Machine 2 was purchased on 1st April 2022. So then in this current year, there is a reassessment with respect to useful life with 10,000 as scrap value. There is also a revision in the scrap value as well. Okay. You are required to prepare the machinery account, provision for depreciation account, and machinery disposal account for the year ending 31st March 2024 and 2025. They're asking us to record these transactions in three ledgers for 2 years. First of all, by observing this itself maintains a separate account for it, we will have to be clear that they are not recording the depreciation in the asset account. That means where it will be recorded either accumulated depreciation account or provision for depreciation. The question is mentioning us to prepare provision for depreciation. So we will record all the depreciation entries there. First of all, observe carefully. The transaction is having impact with machine number 1 and machine number 2. Machine number 3 is being purchased in the current year itself because we are recording it on 31st March 2024, 31st March 2025. So there is an asset purchased in the respective year. So there is the details of transactions to be arrived as on 31st March 2024 for machine number 1 and machine number 2. So let's understand this with a working note. I hope all of you are aware of sum of years digits method. So here in this method, we will just take the depreciable value along with the number of years for which we are charging depreciation divided by total sum of years. So on the numerator, we will also have to take the current year as the relevant year for calculating depreciation. What am I trying to tell? You will understand while we observe the working. So here there is machinery account, and then there is provision for depreciation, then there is machinery disposal. See, they are asking us to present it as on 31st March 24 and 31st March 25. If you observe, machine number 1 was bought in 1st April 2022. So first we will have to find out the value of machinery as on 1st April 2023 because we have to close it on 31st March 24 and 25. I hope we are understanding in what way this has to be done. So for this, let's observe the working note. See, calculation of total sum of digits of machine 1 and 2. Okay, so machine number 1 was bought. Sorry for that. That was machine number 2. Machine number 1 was bought in 2020. So from 2020, we will have to find out what is the depreciable value. 11 lakh is the purchase value and scrap value for this would be 20 years. Useful life is 8 years. So keep this in mind. Now let's observe the working. Observe this column, all of you. Machine number 1 cost is 11 lakh. So I want the depreciation for the current year. So how many years have passed? 2020 was the year in which the asset was purchased. So 2020 to 2021, 21, 22, 22, 23. So this 3 years will help me find out the current year depreciable value. So 11 lakh 20,000 was the scrap value. So 11 lakh minus 20,000. If I remove the residual value, which was 20,000, which has to be taken out, depreciable amount will now be 10 lakh 80,000 multiplied by, as I told, we will also have to take in the numerator the year for which the depreciation should also be charged. So 3 years, there were totally 8 years of useful life. So 8, 7 and 6 will have to be taken on the numerator divided by total of some years. So here we can simply apply n into n plus 1 by 2. Useful life for this machinery was 8. 8 into 9 divided by 2. So this will be 36. That is how we are getting 36. I hope this calculation is understood. Yes, denominator we got 36. So let's solve this. 10 lakh 80,000 into 21 divided by 36. So that will be 6 lakh and 30,000. So 11 lakh is my cost. Total depreciation for 3 years is 6 lakh 30. So 11 lakh minus 6 lakh 30. The residual value, sorry, the WDV, the written down value for machine number 1 will be 4,70,000. Next, likewise for machine number 2. Machine number 2 was bought in the year. So let's reflect on the question. Machine 2 was bought in the year 1st April 2022. So we want to just calculate the depreciation for 1 year because we want it as on the year ending 31st March 23. The useful life for this is again 8 years. Scrap value is given as 40,000. So 9 lakh 40 minus 40,000. 9 lakh 40,000 minus 40 will be 9 lakh. We just want it for 1 year. So 8 divided by, hence the total is again 36. So that will be 2 lakhs. So here the WDV will be 7 lakh 40,000. So these are the values as on 31st March 2023 or 1st April 2023. Is this point clear? So this we can reflect it here in the machinery account. See, first of all, understand one thing. Depreciation is not shown in the machinery account. They are maintaining or accumulating it in a separate account called provision for depreciation. So we will record the entries accordingly. So in the machinery, it will be recorded at the original cost itself. Machine number 1 was bought for 11 lakh. So observe here, as on 1st April 2023 also, it will be brought down at the original cost itself. So machine number 1 value is 11 lakh at cost and machine number 2 is 9 lakh 40. As on the year end, it will again get closed at the same balances because there is an auction which is happening in the year 1st April 2024. So next 1st April 2024, you will bring down the balance, that is 20 lakh 40, and 1st April 2024, as we saw, this was getting auctioned. So when the machine number 1 was getting auctioned, the sale will not be reflected in the machinery account. They are also asking us to prepare a separate account called as machinery disposal. So every sale entries will be impacted in that particular account. So this amount will be transferred to a separate account called machinery disposal account. So the entry will be machinery disposal account debit to machinery at the original cost itself. Machine number 1 at 11 lakh. I hope till here all of you have understood. Moving on to provision for depreciation. Whatever we have calculated as the provision amount, we will reflect it here. See, first observe, provision for depreciation will have credit balance. So what will be the journal entry? Depreciation account debit to provision for depreciation. So since it has been carried forward in the beginning, so you will have the opening balances which you have already calculated. For machine number 1, it was 6 lakh 30. For machine number 2, it was 2 lakh. How are we getting this? Just before we came across, we have understood how this has been coming. So that is what is written here. Then in the current year, that is as on 31st March 2024, this we will also calculate the depreciation on the respective machinery. This is on the current year. So 1st April 2024, there were some impacts given. Machine 1 has become obsolete and has been sold for 1 lakh 34. See, before it is getting sold, that particular depreciation needs to be considered. Observe, for machine number 1, 10 lakh 80,000 was anyway after depreciable amount after considering the scrap value. We have already taken the depreciation for 3 years. That was 8th year, 7th year and 6th year. Now the asset is getting sold. We have to first record the depreciation. We are standing at which year? 5th year. So the total here will be by 36. So 5 by 36. The current year depreciation will be 1 lakh 50,000. So that is what will be recorded. Likewise for machine number 2, 9 lakh, how are we getting? I hope all of you are clear. So we had calculated depreciation for the 8th year because only 1 year had gone. Then this current year is now 7 by 36. So we will get 1,75,000 as the depreciation. In the current year, there is new machinery which is also bought, which is priced at 8 lakh 10. So this should also be recorded. Machine number 3, 8 lakh 10,000. So this is bought and the residual value is given for 5 years. So again, n into n plus 1 by 2. So 5 into 5 plus 1 by 2. So this will be 5 into 6 by 2, which is again 15. Clear with this? So 8 lakh 10 into 5 by 15. So that will be 2 lakh and 70,000. So here we have calculated the depreciation of machine number 2 for 23-24. For 24-25, I explained you about the machine number 3. For machine number 2, the machine is still present in the business. It is not getting auctioned. So there is a reassessment with respect to the residual value, and considering the impact, we have also have to take the revision in the useful life as well. So revised depreciation will be 5,55,000 into 3 by 6. Now, how did we get this 5,55,000? All of you consider the cost of machine number 2, which was 9,40,000 minus. We have calculated the depreciation. First till the first year was 2 lakh, and in the year 23-24 it was 1,75,000. The written down value is 5,65,000. 5,65,000. For this, there was a scrap value given of 10,000. So if we minus the revised value, what we are getting is 5,55,000, and they are revising the useful life to 3 years. So 3 into 3 plus 1 by 2, which means 3 into 3 plus 1 by 2. So this is 3 into 4 by 2. 4 threes are 12. 12 divided by 2 will again be 6. So that is how we are getting 3 by 6. And hence the depreciation for this particular year will be 2,77,500. I hope all of you understood what the working was. Now let's observe how this is getting reflected in the ledger. See, as on 31st March 24, for machine number 1, we found the depreciation to be 1,50,000, and for machine number 2, 1,75,000. I hope you are all understanding how are we getting this. See, 1,50,000 for machine number 1 and 1,75,000 for machine number 2. That is what is being entered here. Clear? And then after considering this, 8,30,000 plus 325 will be 11,55,000, which will be taken as balance carried down. For machine number 1, 6,30,000 plus 1,50,000. That is your total depreciation getting added, and for same machine number 2 as well. Clear with this? So this is for the year ended 31st March 2024. This machine number 1 is getting auctioned in the current year. So first of all, whenever there is an auction, remember in the machinery account, when the year of auction came, we literally transferred that particular assets balance to separate account called machinery disposal. So with respect to depreciation, whatever is belonging to that machine is still sitting in provision for depreciation. This also should be transferred to that particular account, which is machinery disposal. Now, which machine was getting auctioned? Machine number 1. What is the balance of machine number 1? 7,80,000. So this is not getting carried forward. So we will reverse the balance. What will be the entry? Provision for depreciation, which will have a credit balance. Now I have to take out, so I will debit. 2. Machinery disposal. So machinery disposal depreciation accumulated was 7,80,000. So we have been recorded that. I hope this is clear. So in this particular year, machine number 1 was still there as on 1st April 24. This is the balance brought down. So that is what is being written. In the ending year, if you observe, by depreciation account, machine number 2 was 2,77,500 and machine number 3, 2,70,000. How we got? We have already understood this calculation. 2,77,500 and 2,70,000. Clear with this? I hope till here all of you done. So then to machinery disposal. Then after considering this, we will only have the balancing figure in machine number 2 and machine number 3. How are we getting this? See here, machine number 2, 3,75,000 plus 2,77,000. 3,75,000 plus 2,77,500. This is 6,52,500. And likewise for machine number 3, only 2,70,000. This has been appeared here. Clear with this? So they are asking us for 2 years. We have been recording it for 2 years. Coming back to machinery account, we had discussed this till here. So in the current year, that is 1st April 2024, machine number 3 is purchased. What is the entry? Machinery account debit to bank account. So that is being reflected here to bank 8,10,000. So then we will find out the closing figure. There will not be machine number 1. So this is an error printing. So this is machine number 2 and this is machine number 3. Make a correction here. Machine number 2 will be standing at 9,40,000. Remember, this is original cost. So same 9,40,000 is carried forward. And machine number 3, 8,10,000. Clear with this? There is one more account which they have asked us, machinery disposal. Machinery disposal, first you have transferred as on 1st April in the machinery disposal to machinery account. This is only to machinery. There is no disposal again here separately. To machinery account 11 lakh. Clear with this? Then from depreciation, provision for depreciation, here we are transferred. So this is by provision for depreciation 7,80,000. Now there is an auction money which is worth, we are getting how much? 1,34,000. What is the entry? Bank account debit to machinery is now sitting in machinery disposal. So to machinery disposal. So whatever we are getting as 1,34,000. Understand, find the calculated book value. 11 lakh was the cost minus total depreciation before it was getting auctioned was 7,80,000. The value of machinery standing on this date is 3,20,000. but we are only getting 1,34,000. So that means the remaining is your loss. How much is our loss? 1,86,000. So how are we getting this? 3,20,000 minus 1,34,000. I hope this is clear to all of us. Understood? So as per the examiner's comment, this was one such question where most of the students was not able to do a proper calculation. Simple reason being, some of year's digit method, most of the students will just ignore or just observe looking at the formula, and they would not practice any such question. In your institute material also, there's no full-fledged question for this. They have given the calculation purpose of how to do the depreciation calculation under sum of years digits method. Here in this question, they have combined this with other concepts, as in to prepare machinery account at cost, provision for depreciation, and machinery disposal. That is where the conceptual clarity was required, and most of the students failed to present the requirement of the question. After discussing this, I hope each one of you watching this video understood this question properly. Yes or no? Right. So this completes our part A of question number 2. Then moving on to the next question. Pass the journal entries to record or rectify the following transactions in the books of Mr. Dutt. Suspense account may be used if required. Observe one important thing here. They are clearly specifying either record or rectify. So as and when you understand the transactions one by one, you will have to figure out whether it was not recorded, means you have to record. If there was any error, we will rectify. With this mechanism, we will have to solve this question. And observe, such questions is again asked for 12 marks. So let's discuss this one by one. Sale of goods to Mahesh at the list price of 1,80,000 less 10% trade discount. Out of the amount due, 50% is received, out of which two-thirds is received by check and the balance is received in cash. CGST and SGST applicable is 6% each. Remember, there is a sale of goods which is happening. So then there is integration of GST to be done. So what is the entry? Normal entry, before we understand the due amount which is being received. So we can pass two different entries for this, no worries, because it becomes simpler for you to interpret as well. So Mahesh account debit, two sales, two output CGST and two output SGST, since there is GST involved on sale. Remember, 1,80,000 is the list price. On there is trade discount of 10%. So 1,80,000 minus 10%, the transaction value is 1,62,000. On this, we will calculate the GST at 6% each. So if I have to take 6% of GST, 9,720, 9,720 will be the respective GST. Now, 9,720 plus 9,720, this was on 1,80,000 minus 10%. 9720, 9720. The total due amount was 1,81,440. Let me show this entry to you so that you will understand properly. So this is what the entry which we discussed. Mahesh account debit to sales to output CGST, output SGST. The same transaction is telling that 50% is received. In that 50%, two-thirds is received by check and the balance in cash. So what is the entry for this? Mahesh is still due by 50%. That means he is your creditor. Yes or no? Sorry, he is your debtor to receive. So we will just record the receipt entry for the partial amount. So the total amount due here is 1,81,450. First take out 50% of this. This will be 90,720. In this 90,720, two-thirds is received by check. So what is the entry? Bank account debit, cash account debit to Mahesh account with respect to the 50% amount being received. So this is 90,720 into two-thirds. And this is the remaining 90,720 minus 60,480. I hope this transaction was simple and clear. So next entry. One of the debtors, Mr. X, has agreed to pay his dues of 3,000 to Mr. C, who is a creditor of Mr. Dutt, with the same amount being due to him. So this, they are just routing over the transaction. One of the debtor, Mr. X, has agreed. When he's paying, his balance will come down. So X will be credited. C was your creditor, that if you are that who's preparing these entries, so C was your creditor. So creditor would have a credit balance. When we are settling the amount, his balance would also come down. So the entry will here be Mr. C's account debit to Mr. X account with the amount 3000, 3000. See, Mr. C to Mr. X. Relevant narration should also be observed. 3000 and 3000. Next, employees have been given inventory having selling price of 1 lakh, cost price was 75,000 on the eve of Deepavali as a gift. CGST and SGST applicable is 6% each. First of all, understand this transaction carefully. You as a company is giving away the inventories, your own inventories to your employees on the eve of Diwali. So this is as good as you have made the purchases which you are making for the purpose of consumption, not other than manufacturing or towards your business related transactions. So in this case, whatever GST paid on the same would also be reversed. So input CGST, input SGST will be appearing on the credit side. So since this was an inventory, you will have a Deepavali Eve account credited or some inventories account. So let's observe what ICAI has written here. See, miscellaneous expense account debit or Diwali gift account debit, two purchases, to input CGST and to input SGST. This was your own inventory. They have given us the selling price as well as the cost price. So we will record it at the cost price, which was 75,000. And then on that 75,000, I guess it was 6% GST. So 7,500 into 6%, 7,500 into 6% will be taken, and these were the respective GSTs. So the entry will be miscellaneous expense or Diwali gift, two purchases. The GST paid on this will be reversed. So input CGST and then input SGST. I hope this is clear. Next entry, sale of 2,500 made to Mr. Kamal Kumar has been debited to Mrs. Kamala Rani. Again, this is a error wherein we have to pass the rectifying entry. Sale of 2,500 to Kamal Kumar. The entry should have been Kamal Kumar account debit to sales. But now what has happened? So this is being debited to Kamala Rani. So this Kamala Rani's account needs to be cancelled. So what will be the entry? Kamal Kumar account debit to Kamala Rani, where we are passing the rectifying entry. See, Kamal Kumar to Kamala Rani, 2,500, 2,500. Next, a second-hand machinery was purchased and its overhauling charges paid are 15,000. The accountant debited the overall charges to repairs and maintenance account. Depreciation on machinery has been charged at 10%. First of all, the purchase of an asset. So any expenses related at the time of purchase will have to be added to the cost of the asset. But what has the accountant done? They have treated it as a revenue expenditure instead of capital expenditure. So we have to first reverse it. Overall charges has been debited to repair and maintenance account. That needs to be eliminated. So we will credit repairs and maintenance. On the same, there is depreciation also to be recorded. So that depreciation will be charged at 10% on 15,000. So what will be the journal entry for this? It will be machinery account debit because it was debited to repair and maintenance. See, this is again credited. Machinery account debit 13,500 because there is depreciation at 10% on this as well. So depreciation was anyway supposed to be debited at 10%. So that is 1,500. Repairs and maintenance, which was a wrong debit, now credited by reversing it at 15,000. See, which is wrongly debited to repairs and maintenance is now rectified. Is this understood? Yes. Next. A purchase of 151 from Mr. X was entered in purchase day book as rupees 15 and posted to X account as 51. Purchased amount was 151. Mr. X was entered in purchase day book as 15. So again there is a mismatch with respect to amount and posted to Mr. X account as 51. So entry was wrong and posting was done at 51. Understood what is the transaction all about? Purchase of 151 was entered in purchase day book as 15. So first of all, in the purchase day book, the amount needs to be corrected. So 151 was the transaction amount, but we have recorded it as 15. So the difference is 136. So how will I increase the purchase book balance? By debiting purchase account. Purchase account debit 136. I hope this is clear. Coming to Mr. X. X account will be anyway credited. This was posted as 51. Actual posting was supposed to be 151, but they've taken 51 out of it. That means 100 is a shortfall. Yes or no? So this 100 will also be taken care. And the balance with respect to what is reflecting will be routed through suspense account. Now, how this entry will be presented, observe here all of you. Purchases account debit 136. As I told, they have taken only 15. So difference between 151 and 15 to X 100 because X was anyway credited with 51. The balance to suspense account by 36. Clear with this? How this is being done? So being purchases of 151 from X wrongly posted as 15 and posted to X as 51 is now being rectified. Clear with this all of you? Yes. Next. R has been issued a credit note allowing rebate of 6,000 as goods supplied to him was found defective. CGST and SGST charged was 6% each. When you are issuing a credit note, that means you would have made a sale and there would be some defect about your product. That is when a business will generate a credit note to another party. So on this credit note, you are allowing a rebate. Rebate is nothing but which is equivalent to discount, which is your loss or an expense. So this account will get debited. Now there was CGST and SGST charged. At the time of sale, you would have credited this. This would be rectified. This would be reversed now. So we will debit the respective CGST and SGST account. So what will be the journal entry? And this will be routed through R's account. Observe here. Rebate account debit, output CGST, output SGST to R's account because this is being returned to R. That is the rebate which was being allowed to R. So rebate was 6,000. On that GST was 6%. So 360, 360 each. 6,000 into 6%. Clear with this all of you? Yes. Next. S was also given a credit note of 2,000 for making prompt payment for outstanding against goods sold to him. CGST and SGST charged on sale was 6%. So S was also given a credit note for making prompt payment. Means we have to record this transaction. So how will we record this transaction? Observe here all of you. Discount is allowed to S, that is discount allowed account debit to S because we are allowing for prompt making prompt payment means it is our loss. So debit all expenses or losses, discount allowed debit. Whom are we giving this to? S. So the amount is 2,000 and 2,000. Being credit given for making prompt payment for outstanding goods sold. So this is your narration. Next transaction, an accrual of telephone charges for 2538 has been completely omitted. That means there is an omission of error of omission which needs to be recorded. An accrual of telephone charges has been completely omitted. First of all, accrual means it is outstanding. So what will be your journal entry? Telephone charges is an expense. So telephone charges account debit. It is outstanding in the nature of liability to outstanding telephone charges 2,538. So this will be your journal entry. See, telephone expenses to outstanding expenses 2,538. Clear with this? Next. A check of 25,390 issued to Mr. C. Das shown under trade payables towards his dues has been wrongly debited to the purchases. A check of 25,390 is issued to Mr. Das. So when you are issuing the check, Mr. Das would have been receiving it. Actually, his account should have been debited. Towards his dues has been wrongly debited to purchases. So the wrong debit is done to purchase. So what will be the rectifying entry? Das account debit to purchases 25,390. This will be your rectified entry. See Das, Mr. C Das account debit to purchases. Being checked, issued, wrongly debited is now rectified. So this was all of your journal entries where you were either supposed to record or rectify. This was an interesting set of transactions which becomes very important for your practice. I hope you have understood each transactions which were discussed in detail. This completes your question number 2. Let's move to the next question. Question number 3. From the following particulars furnished by Mr. Y, prepare his trading and profit and loss account for the year ended on 31st March. Also prepare his balance sheet as on 31st March 2025. So they are giving us the list of details, and there is also a note, no fixed asset has been sold during the year. See, first of all, in this question, as in when you read prepare his trading account P&L, most of the students will confuse this as a final accounts question also. But remember, there is also a chapter called single entry or account from incomplete records, which will have again requirement for you to prepare either profit and loss, trading and balance sheet. But the difference between final accounts in this particular chapter is there would be some incomplete information wherein you will have to figure out, find the data and then take it to the respective financial statements. So this is a question coming from your account from incomplete records chapter. First and foremost, most of the students fail to observe this. And if you do not understand this is coming from this chapter, you will not certainly get an idea what all accounts need to be presented. First and foremost, there will be some information which will be missing and you will have to figure it out. To figure out, we will have to make respective working notes. We have understood in detail in that particular chapter. So let's understand the respective solution in one single hand. So there is opening balance is given and then there is closing balances provided. Always and always when you have such question, prepare creditors account and debtors account. These two are must. Sometimes there would also be cash book required. If there is any details provided with respect to that cash transactions, make sure you also make that as a working note. In this, we have observed creditors account where we are also observing debtors account. There is also another expenses outstanding, fixed assets, stock in hand, cash in hand, cash at bank. You need not prepare a separate account for this because this will anyway get placed in the respective financial statements. So there are other four items. It is always better to prepare ledger as a working note of these items. So we will open creditors account, take the opening balance, closing balance, likewise expenses outstanding, fixed assets account and then debtors account as well. So creditors opening balance will appear on the credit side 6,38,000 and the closing on the debit side 4,96,000. Let's observe this. See here creditors, to balance brought down and then to balance carried out. We're just entering the details what is given. Then we had expenses outstanding. Opening balance 24,000, 13,200, closing balance. Expenses outstanding means it will be your liability. So opening will have on the credit side, closing on the debit side. 24,000, 13,200. Expenses payable 24,000, 13,200. Clear with this? Yes. Then there was fixed assets which also includes the machinery 4,64,400, 481,600 opens on the debit side, closes on the credit side. 464,400 fixed assets account, 464,400 and 481,600. Clear with this? We are just entering the values and hence I have highlighted those. Then there is stock in hand. Opening balance will go to trading account, likewise closing stock and then in the closing balance sheet. So 3,21,600, 4,44,800. Now in the entire question, we should also have to analyze one thing, whether they have given any capital balances, opening capital balances for the purpose of our closing balance sheet. Let's quickly analyze that. If not given, it is also better to incorporate that in your working note. So the time consumes lesser. Okay, there is no opening capital balances in this question. So we'll also prepare one opening balance sheet. So fixed assets opening balance will go in that opening balance sheet. Opening outstanding under the liabilities and then creditors under the liabilities again. Stock in hand 3,21,600, 4,44,800 in the trading account. 3,21,600, 4,44,800 and we have been presenting closing balance sheet. See here 4,44,800 in the closing balance sheet. If there is opening balance sheet, we can also observe the opening balance, fixed assets, then there was sundry, debtors, creditors, expenses outstanding. All these was already discussed. Then there is Cash in hand 1,18,400 and 48,000. This will directly sit in the balance sheet. So closing balance sheet 1,18,000. Closing balance sheet was 48,000. Opening 1,18,400. See, closing 48. Opening 1,18,400. Then we have cash at bank opening 1,60,000 and closing 2,75,200. 2,75,200. This is the closing balance sheet 31st March 25 and opening balance sheet 1,60,000. I hope this is clear. So after we have entered all that, anyway, we have completed the opening balance sheet values. The difference amount, whatever we get, will be the opening capital balance, which is 10,70,800. Where will this come? We will take this balance to the closing balance sheet, 10,70,800. Whatever we have understood, I've just highlighted to just re-not visit again. Fixed assets closing was anywhere there, 4,81,600. That is also entered in our closing balance sheet. So sundry debtors closing was not given. Creditors 4,96,000 was given. This was all available already. So just highlighting the same since we have considered. Now, observing these details one by one. Cash and discount credited to debtors. So there is both involved, cash as well as discount. So the journal entry would be cash or bank account debit, discount allowed account debit to debtors. So here we have cash or bank, discount allowed, debit to debtors. So they have given one final amount, 25,60,000. We need a breakup. So we will just observe carefully. Is there any additional information given? Returns from debtors 58,000. So this is your sales return. What will be the journal entry? Sales returns account debit to debtors. So we have opened the debtors account. This will be placed there. By sales returns 58,000. See here in debtors account. Return inwards 58,000. So this was your sales return. We will also enter it in our trading account less sales return 58,000. Then bad debt 16,800. The journal entry for this again will be bad debts account debit to debtors. This is also your loss will appear also in your profit and loss. 16,800. Observe here in the profit and loss account to bad debt 16,800 and in debtors account by bad debt 16,800. Clear? Next. Gross sales, both cash and credit. So total sales is given 28,72,400. So in order to consider the debtors, I want credit sales. Here both sales are given. So we will directly take this in our trading account 28,72,400. There is no breakup yet available. Discount allowed by creditors. So what will be the journal entry? Discount allowed by creditors. Creditors account debit to discount received. So we have opened the creditors account. So this will be reflected in that account. Discount received is your gain and in P&L account. 28,000. See here in the profit and loss account, discount received 28. Creditors account, discount received 28. Clear with this? Yes. Next, we have returns to creditors. That means you're making a purchase return. What will be the entry? Creditors account debit to purchase returns. 16,000. First, this will be reflected in your trading account. Here they have taken 16. Let me explain how the other values are given in a while. Yes, there was a purchase return. So what will be the journal entry? Creditors account debit to purchase returns or returns to creditors. So that was 16,000 that has been entered here. Later, then we have capital introduced by check. Capital introduced by check is nothing but your additional capital introduced, 3,40,000. This will appear in the balance sheet, 3,40,000. See here, capital introduced 3 lakh 40. Clear with this? Next, we have collection from debtors deposited into bank after receiving cash. Remember, there was one transaction, combined amount was given 25 lakh 60,000. Now we have got the breakup. That is how much is collected from debtors. So 25 lakh is collected from debtors. How much will be the discount allowed amount? 60,000. So this will be entered in the debtors account. So by cash, by discount allowed. See, in the debtors account, by cash 25 lakh, discount allowed 60,000. I hope this is clear. Next, cash purchase. Now there is a breakup given. Cash purchases is given. If you observe till now, they have not given us the purchase value 41,200. So we will anyway take it in the trading account. 41,200 taken. Next, expenses paid by check. Sorry, expenses paid by cash. So this will appear in by profit and loss 3,82,800. So in the profit and loss account, two expenses. Okay, we had opened expenses outstanding account. Remember, that is your liability. So expenses paid will also have an entry here. When you are paying, there was outstanding balance. That is your creditor. So what will be the entry? Expenses payable account debit to bank. How much we have paid? 3,82,800. So after considering this, we will have a closing balance which is given to us in the question 13,200. So after writing off all of these values, remember to close the ledger, always have four items into consideration. Opening balance, closing balance. Then there will be some item which will be transferred to the current year profit and loss for the expenses, and then some amount which will be settled. So here there was some amount which is being paid to bank. So the difference which is going to the profit and loss account will be nothing but your balancing figure 3,72,000. This will be shown as your current year expenses. That is how we are getting 3,72,000 as per the expenses outstanding ledger calculation. That is why we observed that preparing ledger becomes important, because this all values will be generated there itself. Next. So then we have drawings by check 17,200. This will again be appearing in the balance sheet. See, less drawings 17,200. Then we have machinery acquired by check 1,27,200. There was one fixed assets ledger opened. When the machinery is acquired, what will be the journal entry? Fixed assets account debit to bank. So 127,200. I will enter this fixed assets to bank 127,200. There was opening balance given, there was closing balance available for fixed assets as well, and they have clearly mentioned in the question no fixed asset was sold in the current year. So there is a difference which will be nothing but depreciation on machinery, because this is an asset. So every year depreciation should anyway be charged. So the balancing figure will be depreciation 1,10,000, which will appear in the profit and loss account. Depreciation on fixed assets. Are you observing why preparing ledger accounts as working note becomes important? Because these are nothing but incomplete, unavailable information to us, wherein we are figuring it out by making the respective transactions entered. Clear with this? Next. Then we have cash deposited into bank 2 lakh. So we have neither preparing cash book or bank account. So this entry will have no relevance to enter. Cash withdrawn by bank likewise. Cash sales. Cash sales is given. Remember, they had given us the total sales 28,72,400. We have opened the debtors account. Credit sales was supposed to be taken there. Debtors account debit to sales. They have given us cash sales, so we can find out how much is the credit sales. 28,72,400 minus 1,84,000. This is my credit sales to 26,88,400, which will be entered in the debtors column. See, this two sales 26,88,400. Remember, in the question, debtors closing balance was not given to us. Now we have entered all the values, so we can find out the closing balance of debtors as a balancing figure 7,14,800, which will also appear in the closing balance sheet. Clear with this? Then we had payment to creditors by check. So what will be the entry? Creditors account debit to bank 24,10,800. So this will appear in the creditors account 24,10,800. Now here again opening balances was given, closing balance is given, all other details are entered in the creditor's account. If you remember, in the question they had not given the credit purchases value. So whatever we are going to get as a balancing figure is nothing but the credit purchases, 23 lakh 20,000. So this will be taken to my trading account plus 23 lakh 20,000. All pointers clear? Yes or no? So this was all the question. Now we will just have to close the account. See, opening stock was entered, purchases, net we have taken, cash purchase, credit purchase minus returns. Then sales, we have taken total sales minus any returns. Then closing stock was given. So we will find out the gross profit. Take the balance to the profit and loss account. We have entered all the expenses and income. This discount allowed to debtors, we found out how it has been arrived. So we get net profit as 61,600. This will be taken to our capital. Opening capital was found out by preparing the opening balance sheet. To this we will add net profit, capital introduced in the current year, and then subtract drawings. We get 14 lakh 55,200. Remaining all other values have been considered. The total of balance sheet what we get will be 19 lakh 64,400. So make sure you all guys solve this once, since you have now understood how the values are reflected here, and make sure that you're not going to miss on the working note. This question will definitely take your time, but with a good practice you can easily complete it, because once you close the question, the balance sheet automatically tallies and you will be in a safer position to score full 12 marks. Clear with this? Yes. So this completes this question. Next question. Mr. P was carrying on a business. On 1st April 2023, he admitted Q as a partner, giving him 1/4 profit. See, so there was only one person P. He was carrying on the business and then he admitted Q. It was agreed that the goodwill of the firm would be 24,000. So they are valuing the goodwill. On 1st July 2023, R was admitted as a partner and it was agreed that the goodwill of the firm be determined at 40,000. Now when Q was admitted, goodwill was 24. When R was admitted, the goodwill is 40,000. And the new profit sharing ratio of P, Q and R is now 3:1:1. Next, on 1st September 2023, S was also admitted as a partner, and at this time, goodwill was valued at 72,000. Now there are P, Q, R and S. So they agreed to share the profits in the ratio of 3:1:1:1. On 1st April 2024, R decided to retire and T was admitted as a partner. Goodwill at this time was 96,000 and the profit sharing ratio among P, Q, S and T was 5:4:3:4. All these agreements about goodwill have not been taken into account. On 1st April when R retires, T is admitted. The partners decided to account for the goodwill by making necessary entries in respect of goodwill in the books without keeping the goodwill account in the books. That means they are not ready to show this as a separate asset. You are required to show working of the goodwill and to pass the required journal entry. So what is the requirement here is, whenever there was rearrangement happening, that is one-on-one partner getting admitted, the firm has not at all passed the goodwill respective entries. Now they are asking you to prepare those entries. Along with that, they are also asking to find out the net impact, because there was one partner getting retired and one getting admitted. So how should we solve this? Just observe carefully, guys. This could be a new set of questions when you have seen this on the exam. But application of concepts is already what you know. Whenever there is admission happening, new partner is supposed to bring his share of goodwill. If not, we can find out using his proportionate giving the firm's goodwill. Yes or no? This is one point. And when there is admission happening, the new partner has to provide his compensation for the old partners in which ratio? Sacrificing ratio. Likewise, at the time of retirement, when the partner is going out of the business, whatever his share will be given back to the remaining partner. What is the ratio that we need to find out at that moment? It is called gain ratio. These points, I hope all of you are clear. That is what we have to just solve and just present one combined journal entry as per the requirement of the question and find the respective net amount. So let's understand with the ICAI solution itself how it is to be done. This is the final entry. First, we will understand how this is taken. See, on 1st April 2023, Q is admitted and Q is given 1/4 share in profit. Yes or no? So, the value of the goodwill, firm's goodwill at that point of time was 24,000. He has to bring his share of goodwill. So, 24,000 into 1/4, 6,000 will be their proportion of goodwill. New profit sharing ratio of P and Q was 3:1. Now, this 6,000 has to be provided to P in the sacrificing ratio. Understand one thing, the sacrificing ratio is 1 since entire sacrifice is made by P only. If the ratio is 3:1, that means Q is getting 1. From whom is Q getting? From P itself, because he was the only one person in the business. So here the entire amount of 6,000 will be provided to P. I hope this is clear. Next, on 1st July 23, R is admitted and the old ratio between P and Q is 3:1. New ratio, the question itself is giving as 3:1:1. Now R is admitted, that means he has to find out his share of goodwill. What was his share of goodwill? If you take it from this ratio, 1 divided by 5. 40,000 was his share, so 8,000 will be his amount of goodwill. We have to calculate sacrificing ratio. How do we calculate sacrificing ratio? Old ratio minus new ratio. If I have to calculate for P, what is the old ratio of P? 3/4, this one. Minus, what is the new ratio of P? 3/5. So 5 fours are 20, 4 fives are 5 threes are 15, minus 5 fours are 20, 4 threes are 12. So this will be 3/20. And then for Q, 1/4 minus 1/5. So this will be 20 again. 5 minus 4. So 1/20. Sacrificing share is 3/20, 1/20. Sacrificing ratio will be 3:1, which is what is given here. Clear with this? So this 8,000 will be apportioned in the ratio of 3:1. How to do that apportionment? We will have a separate working for that. So first let's find out these ratios. Then there is S getting admitted for the proportion of 1/6. So the goodwill at that point of time was 72,000. His share is 1/6, 12,000. Again, we need to find out the sacrificing ratio. We have to do the same thing, old ratio minus new ratio. We will get the sacrificing ratio as 3:1:1. So this 12,000 will be apportioned in 3:1:1. Then on 1st April 24, R is getting retired and T is getting admitted. So here we will also have to find out gain as well as sacrifice. So we will apply one structure. So if there is positive, it will be sacrifice. Negative, we will term it as gain ratio. For P, what is the old ratio? 3:1:1:1 is the old ratio. So 3/6 minus 5 plus 4 will be 9 plus 3, 12. 12 plus 4, 16. So 3/6 minus 5/16. If I have to take LCM between 6 and 16, we get 48. How are we getting that? 6, 16. If I take the common value, 2 3s are 6, 2 8s are 16. So then 8 3s are 24, 24 2s are 48. That is how we are getting 48. So 48 is the denominator. 3/6 into 48, that will be 24, and 5/16 into 48, that will be 15. So 9/48. The value is positive, so we term it as sacrifice ratio or share. And then likewise for Q, 6 and 16 we are getting 48. So 1/6 into 48 will be 8, and 16 48 will be 3 fours are again 12. 3 into 4, 12. So 8 minus 12, here we are getting a negative value. So the gain ratio will arrive. R is retiring. So whatever is there, we will term it as sacrificing ratio 1/6. Then S, 1/6 minus 3/16. Again, if we subtract, we get minus 1/8, which is again a negative. So it is a gain ratio. T, who is the new partner getting admitted, he's just gaining because he is not having any old ratio. 4/16. How are we getting 4/16? It is given in the new ratio. So 4/16 he will gain. Now from the notes, whatever we discussed so far, it is about the ratios arrived and the values which is taken from the share of the goodwill, the respective partner who need to compensate. But here we need to find out the net values in order to pass one single entry. Clear with this? Understand this carefully. It is simpler. Do not get feared by just looking at this table. There is also an alternate treatment. You can follow that if you are comfortable, but I feel that this structure is more easier to understand. Focus and carefully observe this. See, on admission of Q, P was only one person. So through the calculation, we understood Q's share of goodwill was 6,000. Only P was there, so entire amount should be given to P. When P is receiving the amount, his capital account will be credited, yes or no? And who is giving Q? So Q capital account will be debited. Henceforth, 6,000 credit for P and debit for Q. We have just made the respective partners column P, Q, R, S and T. Second case, R was admitted and his share of goodwill was how much? 8,000. So he has to give this to P and Q in the proportion of 3:1. So 8,000 into 3 by 4. 6,000 for P and 2,000 for Q. This is the amount. When these both are receiving, their capital accounts will be credited. Who is giving R? So P and Q. 6,000 credit, 2,000 credit, 8,000 debit. I hope all of you are comfortably clear till here. Then later on admission of S, 12,000 is their share. This has to be given to P, Q, R and S. So 12,000 into 3 by 5. This will be 7,000. Let me write it here so you guys will understand. 12,000 into 3 by 5. This will be 7,200. Q 12,000 into 1 by 5, 2,400 and R 12,000 into 1 by 5, again 2,400. These three partners are receiving, so their account will be credited. Who is giving? S. So entire 12,000 will be debited. Observe here. 7,200 credit, 2,400 credit, 2,400 credit and 12,000 debit. Clear? Next. On retirement, and T is admitted. Now, if you observe, what is the proportion of goodwill at the time of retirement and admission? Value of goodwill, I guess it was around 96,000. So, 96,000 is the value of goodwill. Now, this should be brought in by the new partner and we have to also compensate it for the old partner. Yes or no? Now, understand this carefully. On retirement of R, he is sacrificing 1/6. What is his share? 96,000 divided by 6. 16,000 is his share. So he has to receive that 16,000. How are we getting? 96,000 into 1 by 6. Clear with this, all of you? He has to receive this amount. Likewise, P has to bring in his share of goodwill. 96,000 into 4 by 16. How much is that? 24,000. So T has to bring in means T account should be debited by 24,000. Clear with this, all of you? 96,000 into 4 by 16. 4 by 16. Yes. Now, this 24,000 has to be provided to the remaining partners. Yes or no? So, how will we do this? 96,000 has to be given to P, Q and S. This 24 has to be provided. But observe one thing, P is sacrificing whereas Q and S is gaining. So what will be the entry? P will have to receive and Q and S will have to provide. P is sacrificing, he will have to receive. So when he receives, his account will be credited. So the total goodwill was 96 into 9 by 48. 96,000 into 9 by 48. I'm just emphasizing why is there a credit balance here. And likewise for Q, 96,000 into 4 by 48. This is into 4 by 48. Then there is less space. So just I'm writing into 4 by 48. I hope this is clear. And then likewise 96,000 into 1 by 48. Understood. So now we have the total of impacts for the respective partners. So we will just calculate C for P, 6,000 credit, 6,000 credit, 7,200 credit, and then 18,000 credit. Total 37,200 credit. That means P's capital account will be credited. This is what it indicates. Likewise, for Q, 6,000 debit. Then there is 2,000 credit. That means we will minus 2,400 plus 8,000. So this will be 9,600 debit. Q's capital account will be debited. R, 8,000 debit. 2,400 credit means minus 16,000. So 10,400 credit. It started with debit balance. So 10,400 credit. So R's capital account will be credited. Then S, 12,000 debit, 2,000 debit. So 14,000 again debit side. 24,000 debit. So the entry, combined journal entry will be R's capital account debit. This is S capital account debit, T's capital account debit to P's capital account and to Q's capital account. So this to R's capital account, sorry. This will be the combined journal entry. Now with respect to this question, examiner commented that most of the students failed to pass one combined entry and few students did the ratio calculations correctly, but majority of them failed to present this as a combined entry. Simple reason being, the one confusion point where we would have missed would be when there is retirement and admission. Commonly, what you can simply do is instead of taking the respective ratios, keep it in the same share. See, if you observe in the column, that's what I did here. I took 96,000 directly and applied the respective shares itself. I didn't combine that in the ratios. So that is where you get the combined structure, and this is how you can find out one statement that will become more easier to find out this exact common values net amount. Clear? This question, if you observe for the first time, you will feel it is complicated, but if you just break it down when the retirement admission happens with respect to concepts along, you might definitely get closer to it. If not correctly, but you can definitely attempt this with respect to your working notes calculation. Clear with this? Practice this really well, guys. One of the good question. Yes. This completes our question number 3 as well. Yes, let's begin the next question. Question number 4. P and Q have been carrying on the business in the name of Bharat Springs in partnership, sharing profits and losses in the ratio of 2:3. Their balance sheet as on 31st March 2024 has been as follows. They've given the balance sheet. On 1st April 24, they have decided to admit R into the partnership, giving him a 1/5 share in future profits on the following terms. So this is an admission question. They've given us old ratio and future share. R will bring 80,000 as a share of capital but is unable to bring in cash for his share of goodwill. It was decided to calculate goodwill of the firm based on R's share in the profits and the capital contribution made by him to the firm. First of all, what does it mean? They have not given partner share of goodwill, neither they have given the firm's goodwill. You are asked to calculate his goodwill. To first of all do that, we have to calculate the goodwill of the firm. They are giving us the terms on how to calculate goodwill of the firm based on R's share in the profits and capital contribution made by him. Here, in simple terms, what they are trying to tell is the goodwill is hidden. You will have to apply the steps to calculate goodwill, hidden goodwill, and then find out the firm's goodwill. So we can do that easily, keeping the new partner's capital as base, which is 80,000. Then, partners will not withdraw their share of goodwill, nor will the goodwill appear in the books of the accounts. Okay. Next, general reserve will be transferred to partners' capital account. Provision for doubtful debts is to be made on debtors at 2%. Liability of creditors of 1,440 is to be written back as no longer payable. Stock shall be written down by 10%. Building revalued at 1 lakh, plant 60, furniture at 24,000. Partners agreed that the values of the assets and liabilities will remain the same, an important consideration here, and as such there should be not be any change in their book value because of above mentioned adjustments. They also agreed that For the purpose of goodwill computation, any effect on revaluation shall be ignored. So what does this entire point in simple words means? The question is anyway mentioning us you are required to make memorandum revaluation, capital accounts of the partners and balance sheet of the new firm. So this clearly means that the partners does not want to change the values of assets and liabilities, and that needs to be reflected in memorandum revaluation account. So the question is pretty simple. Other than two important adjustments, one is about goodwill calculation and presenting memorandum revaluation account. So first, let's consider memorandum revaluation account. They have given us the details. Provision for doubtful debts is to be made at 20 debtors at 2%. Debtors is 48,000, 2% on this on the debit side in memorandum revaluation to provision for bad debts. 28,000 into 2%. So what was the amount of debtors? Sorry, it is 48,000 into 2%. So 48,000 into 2%. Then we have liability of creditors 1,440 written bank as no longer payable. Observe one thing, there is a creditor of 57,800. Out of that, 1,440 is to be written back as it is no longer payable. What does this mean? So they are need not be paid. They creditors what you have having as a liability, they need not be paid. That means you are saving, gaining on this. So that will appear on the credit side of memorandum revaluation by liability of creditor 1,440. Clear with this? Then stock shall be written down by 10%. Reduction in the value of stock. So this will appear on the debit side. To stock 5,480. 54,800 was the value of stock. Building is revalued at 1 lakh. The value of building is 85,000. So there is increase in the building. So on the credit side of memorandum revaluation by building 15,000. So that is 1 lakh minus 85,000. Then plant at 60,000. Value of plant is 55. So there is increase in the value of plant by 5,000. So by plant 5,000. Clear? Then we have furniture at 24,000. Furniture was shown in the balance sheet at 26,700. So there is decrease in the value of furniture. So two furniture in the revaluation account 2,700. Clear with this? So we have entered all the values. Observe one thing. First part will be normally as revaluation account. So we will apportion the revaluation profit or loss in the old profit sharing ratio. What is the old profit sharing ratio? 2:3. So we have taken all the values. So there is profit on revaluation 12,300 will be apportioned in the ratio of 2:3. Clear with this? Since they have asked us to prepare memorandum revaluation, whatever entered will automatically be reversed. One important thing here is when we are reversing, we will have a loss since we had got profit on revaluation. This loss will be apportioned to all partners in new profit sharing ratio. This point most of the students have missed is as per the examiner's comment. So make sure we are not losing marks here. So this needs to be apportioned in new profit sharing ratio. So see, provision for bad debts 960, stock 5480, furniture 2700 likewise written, liability of creditors, building and plant written. So again your loss will be 12,300. Only difference is it will be shared to all partners in new profit sharing ratio. In the question, they are not given us the new profit sharing ratio, but they have given us the old ratio and the future share. So can we calculate new profit sharing ratio? Yes or no? So there is a working note. Our share is 1/5. So remaining share, if I have to calculate, if I take the whole share as 1, remaining share will be 1 minus 1 by 5. So this will be 5 minus 1, which is 4 by 5. So old ratio into remaining share. For P, old ratio was 2 by 5. Remaining share is 4 by 5. So this will give us 8 by 25. Q share, old ratio was 3 by 5 into remaining share 4 by 5. This will give us 12 by 25. So the denominator here is 25. Future share of R was 5. So in order to proportion it to 25, 5 by 25. So your new profit sharing ratio will be 8:12:5. This is one working note which is required to close our memorandum revaluation. will be distributed in 8 is to 12 is to 5 ratio. Clear with this? First, we have prepared memorandum revaluation. Second, open partners capital and then balance sheet. Partners capital, first we will bring down the balance by balance brought down. 80, 160, there was only two partners. Then there was general reserve, which will be apportioned in the old ratio again. What was the general reserve amount? 50,000. 50,000 will be apportioned in the ratio of 2 is to 3. So 50,000 into 2 by 5, 20 and 30. 2 is to 3. So this is done. Then there is new partner's introduction. He is bringing 80,000 as capital. What will be the journal entry? Bank account debit to R's capital account. So that is what is reflected here. So this is understood. This is understood. And then this is done. Clear with this? Now, as soon as we do this, we had anyway prepared memorandum revaluation. We had got profit and loss. We will transfer that to the capital account. Memorandum revaluation. By memorandum revaluation, you will transfer the profit, and then to memorandum revaluation wherein you will transfer the loss. This point is clear. Until here, all of you should be comfortable. The next entry would be to find out the firm's goodwill. There, the question is clearly specifying you can use the new partner's share along with his future profits. What is the capital brought in by the new partner? 80,000. His future share is 1/5. Observe one thing carefully here. We have to take all the adjustments before the admission. So if I have to take here the total capital of the firm, how do I calculate? Take the reciprocal of the new partner share into 1/5 is nothing but into 5 by 1. So total capital will be 4 lakh. Now find out the existing capital as available in the firm. So P, Q and R has respective balances. Observe in the question, P had 80,000, Q had 1,60,000. So 80,000, 1,60,000. Q is additionally bringing 80,000. Remember one thing carefully here. This is where most of the students have lost their marks and have missed this also. General reserve also belongs to the partner itself. General reserve is getting transferred because of admission. That means this balance was already existing before admission, which purely belongs to the partners itself. So that should also be taken into consideration. Plus 50. So the entire thing will be called as the total capital existing, including general reserve. So that is 3,70,000. So this difference is nothing but our goodwill. So this 30,000 will be the firm's goodwill. But what I literally want here, the partner share. The future partner share is 1/5. So 30,000 into 1 by 5 is 6,000. This 6,000 will have to be apportioned to old partners in what ratio? In sacrificing ratio. Sacrificing ratio, how do we calculate? Old ratio minus new ratio. Yes or no? We anyway have old ratio. We also have new ratio also. So let's roughly calculate here for P and Q only. Old ratio is 2 by 5, 3 by 5. New ratio for P, 8 by 25 and 12 by 25. So LCM between 5 and 25 is still 25. 5 5s are 25, 5 2s are 10, minus 8. This is 2 by 25 and 25 here. 5 3s are 15, minus 12 is again 3 by 25. So the sacrificing ratio will again be 2 is to 3. That is what is given. So this 6,000 will be apportioned between the partners in the proportion as 2 is to 3. So what will be the journal entry? Who is the receiving partners? P and Q, and R will have to provide. So the journal entry here will be R's capital account debit to P's capital account to Q's capital account. He has to bring 6,000. 6,000 into 2 by 5, 2,400 and 3,600. Clear with this? Now this will be reflected in your ledger. R's capital to P and Q, 2,400 and 3,600 in R's column, and then by R's capital in P and Q's column, 2,400, 3,600. This was the entry. Now we have reflected all of the amount. So we will find out the closing capital balance. So this will be your closing capital balance, which will have to be taken into the balance sheet. Remember one important thing. The question is clearly emphasizing that partners are not required or do not wish the value of the assets and liabilities remain the same. So when we are preparing the balance sheet, and also the question is clearly indicating about memorandum revaluation, you will have the exact same values and not the revised or revalued values. This is where most of the students have committed the mistake. Clearly remember one thing, guys. When the question is asking or clearly specifying the partner's wish is to not change the value of assets and liabilities, you will remain the same values as it is. And if the question is also specifying to prepare memorandum revaluation, it also means the same thing. They want to carry over the same existing values. So your only change will be with respect to capital account. This is what you are getting: 1 lakh 3,384, 195.76 and 71,540. That is the change. Apart from that, you will have the impact in your bank account. How? Observe in the existing balance sheet, your bank account balance was 83,200. In the admission, the partner who's incoming, he will also add his capital balance. So what will be the journal entry? Bank account debit to ours capital. So bank balance will increase by 80,000. That is what is added here. 80,000 increased. I hope this is clear. After you consider, you will get 4,44,300 as your total of balance sheet. As I told you initially itself, the question was simpler. You have to just cope up with the two adjustments. One with respect to hidden goodwill, wherein the students can miss out to take general reserve, and then with respect to the balance sheet. Most of the students have committed the mistakes of taking the revalued figures. Remember carefully, when there is memorandum revaluation, we will take the exact details apart from whatever balances get revised due to capital account and introduction of new partners capital. I hope this is clear. Yes. Next question. Following is the receipts and payments account of Smart Club for the year ended on 31st March. They have given us the receipts and payments account. And then what is the requirement? Prepare income and expenditure from the above particulars and balance sheet as on that date. See, this is a not-for-profit organization question. Whenever you observe the question as a working note, there is subscription details anyway given, so we will have to make this as a working note. Along with that, also observe whether there is any capital fund balances given. If not, for that also we have to prepare the opening balance sheet. That will become your working notes. So now let's open income and expenditure account and then closing balance sheet. For working note, opening balance sheet, and then as and when we run through the question, we will analyze what other things are required. Right. So first there is two balance brought down given. This is nothing but your cash balance. It will appear in the opening balance sheet, 2,50,000. Let's enter it there. See, balance sheet as on 1st April, cash at bank 2,50,000. Then we have subscription received 4,20,000. So since we have the subscription account touch, let's also complete the adjustments. Subscription received is given. We have to take the current year income 4,20,000. So 4,20,000. Subscription include 40,000 received for the year ended on 31st March 2024. Which year are we preparing the accounts for? 31st March 2025. So here they are including 40,000 related to 31st March 2024. Does it belong to current year? No. That means we have to subtract minus 40,000. Then on 31st March 2025, subscriptions due but not received were 25,000. For the current year, this amount belongs to the current year. It is due. So we will have to add 25,000. Advance subscription received for the year ending on 31st March 25 but pertaining to the year 25-26. So there is an advance subscription which does not belong to the current year related to the future period. So this does not include in the current year income. So we will subtract minus 35. The subscription received in advance for the year ended 31st March includes 14,000 pertaining to the year 24-25. You had received subscription for the last year, but that subscription amount belonged to the current year. So what should we do? We need to add it to the current year. So after considering all these adjustments, we get the current year subscription income. 4,20,000 minus 40,000 plus 25,000 minus 35 plus 14,000. So this will be your subscription income. See in the income and expenditure account, 3,84,000. So for this, we will have to write the working note. There I roughly showed you how we are getting this value by taking add subtract, but this need to be presented in the working note. I will just show you how the working note is written. See, either you can write this statement, or if you're comfortable with the subscription ledger, you can also go ahead with that too. Anyway, you get the same values. See, subscription as per receipts and payments, subscription outstanding for 2025 belong to the current year, so we will add this. Likewise, we'll also understand the alternate treatment of this. This is your closing outstanding, so this is in the nature of receivable, so it will appear in your balance sheet. See here in the closing balance sheet, 25,000. Subscription outstanding 25. Likewise, subscription outstanding 2024 will be again your opening asset, so 40,000, that will also be reflected. Subscription received in advance for 2024 belongs to the future year, is your liability. Sorry, subscription received in advance for 2024, that means current year income was received in the previous year, so we will have to add 14,000. So in the opening balance sheet, when you receive this as an advance, this would have been your liability. So subscription received in advance 14,000. Then subscription outstanding again in the nature of receivable. So we will not consider this in the current year because this was outstanding for the previous year. So minus, and this also again we will be reflecting this in the opening balance sheet. Likewise, subscription received in advance for 2025 in the closing balance sheet, we will take this as a liability. Add, subtract, why we have done accordingly. I hope you have understood while we discuss this in the top itself. So that will give us 3,84,000, which is taken to the income and expenditure. This will be one of the important working note for subscription. So do it neatly, guys. Reading further. Opening, then we had donation for match fund. See here, there is match fund opening balance given. That means there is a separate fund maintained for it altogether. Here we have to simply apply fund accounting. So opening balance of match fund given 30,000. This is as good as is your liability. So in the opening balance sheet, we will first record this 30,000. See, match fund 30,000. So since they are giving us the details, we will also present this as the working note. So this is discussed. Working note 3, match fund expense to be shown. Because match fund excess anything, we will do the treatments in the balance sheet itself. If there is any excess balance is coming, that will have to be reflected in income and expenditure. So we will first understand what values are given. Match fund opening balances was given to us. So that was 50,000, I guess. Yes. So sorry, that is 30,000. So this match fund opening balance 30,000 is written. Then in the account, we had donation for match fund. This is your receipts. So for match fund, we are receiving donation. That means fund balance will increase. 55,000 we will add. Donation for match fund. Donation for match fund, we are adding 55. Clear with this? So now we have just started with the working note. Whenever we come across such items, we will record. Then sale of match tickets. Anyway, we are coming across with the match tickets itself, where we are making match fund. So this is also connected to this 20,000. This is again your receipts. It will be added. See, proceeds from sale of tickets 20,000. Clear? Then entrance fee. Entrance fee, we will also have to cross check whether there is any adjustment given as such. Entrance fee, see, capitalize 50% of the entrance fee, means 50% will go to balance sheet liabilities and then 50% to the income and expenditure. This is your receipts. So 85,000, 42,500 in the closing balance sheet and 42,500 in the income and expenditure. Observe here, by entrance fee 42,500 and entrance fee 42,500. Clear with this? Both simultaneously covered. Then salaries and wages 1,65,000. So likewise, we will check whether there is any adjustment. There is outstanding salaries and wages, which is 40,000 for the year ended on 31st March 2025. So 1,65,000 plus 40,000 will appear in your income and expenditure account because it is a current year expense. See, 1,65,000 plus 40,000, 5,000. So this is your outstanding expense liability appearing in the closing balance sheet. Outstanding salaries 40,000. Then we have taken this and this. Then there is office expenses 35. For this, there is no other adjustments. There is only one more, which is depreciation on sports equipment. Right. So we can directly enter all of these. Office expense 35, telephone charges 28, 35 and 28. Office expense 35, telephone charges 28. Then we have match expenses. Remember, we had maintained one match fund, so we will net off it there. 1,10,000 subtract from these balances. 1,10,000. So match expenses adjusted 1,10,000. Now let's take the total 30,000 plus 55 plus 20 minus 1,10,000. There is 5,000 negative. Now understand one interpretation here. In the fund accounting, we will first consider all the receipts, all the payments in the same fund balance itself. Observe one thing carefully. We are observing the treatments for both balance sheet as well as the income and expenditure. The amount available, all receipts we have considered minus the expense. We will take the complete expenses which has been incurred because that will be impacted in our current year income and expenditure. But in the balance sheet, when there is no balance at all, you cannot show anything in negative. So here the balance will turn out zero for the match fund. I hope you understood this treatment. Now let's observe how this will be reflected in the books of the accounts. Observe here, match fund, they are writing but showing it as nil because we know why it has turned out zero. Now, in the income and expenditure, we will write two match expenses, which is only 5,000. Observe carefully. We are only writing the excess and not the complete treatments, whatever we have done it in the working note. This point should be very, very clear by all of you. Yes, I hope understood. Reading further. By electricity charges 32,000. Then there is traveling and conveyance 65. We'll come to sports equipment because there is depreciation on that. 32,000 and 65,000. Electricity charges 32, traveling and conveyance 65. Then on the sports equipment, there is depreciation of 25%. So we will charge depreciation 2,15,000 to 25%. So this will also appear in the balance sheet, less depreciation. Clear? Then sports, this is done, this is done. And then we have the closing balance. So this will be taken to your closing balance sheet, 1,45,000. 1,45,000. So all other values entered. So first job here is to close the income and expenditure, find out whether there is surplus or a deficit. In this question, there is deficit. So we will subtract it from the capital. For the capital, first we need to find out the opening capital fund balance. We've entered all of the values. Capital fund will be a balancing figure, that is 2,46,000. So 2,46,000 minus 6,000, your value will again now be 2,40,000 reflected. Clear with this? Understood the question? So this is how we will total the balance sheet. As you observed, in this case, the question was pretty simpler for not-for-profit organization because the adjustments was also simpler enough. If you had a good practice, this was a must-do question. This completes our question number 4. Both was easy to take up. Yes, let's discuss question number 5. Now, this question will have one as internal choice as well. So, in that there is first BRS and then there is Bills of Exchange chapter question. So, let's first understand the BRS. From the following information supplied by Mr. D, prepare a bank reconciliation statement as on 31st March 25 after amending cash on that date. So the question is clearly specifying that we need to first amend the cash book balance and then take the revised one to prepare BRS. So that means in this question, we need to prepare adjusted cash book and then BRS. Clear with this? Yes. So they have given us bank overdraft as per bank statement. As soon as they give you two things, that is to prepare adjusted cash book and bank reconciliation statement, first make a bifurcation. which transactions will come in adjusted cash book, and then bank reconciliation statement. In this one question, what you have to observe is, for doing adjusted cash book, we first need the existing cash book balance. That is when we can come across the revised cash book balance. But observe one different thing here. The question is giving us bank overdraft as per bank statement. They are not giving us the cash book balance itself. Fine. Reading further, checks issued but not presented for payment. This is the timing difference. We would have made the entry in the cash book, so this we will take it in the PRS. Then, checks recorded in the bank column of the cash book but not sent to the bank for collection. Remember, we are doing this as on 31st March 25. You have recorded this in the bank column, but if you are not sending to the bank for the collection itself, there's no point of having that entry present there. So we need to reverse it. So therefore, this will go in the adjusted cash book. Then, payment received from customers directly by the bank. So bank has already made the entry. No entry is present in the cash book. So we will have to record this in the cash book. Next, bank charges debited in the statement. So again, the entry is made in the passbook, but no entry in the cash book. So this will appear in the cash book. Checks deposited with the bank but not collected. So you have made the entry for the checks deposited. This is again resulting due to timing difference. So therefore, this will appear in bank reconciliation statement. Then, a bill for 5,000 discounted with the bank in February, dishonored on 31st March, and noting charges is paid by the bank. There is a bill dishonor along with the noting charges, which is given as 20. The entry is made in the bank statement but not in the cash book. So this will appear in the cash book. Next, premium of life policy of D paid by the bank on his standing advice. So payment entry is made in the bank statement because of the advice given. This is not reflected in the cash book, so we will have to record this in the cash book. Later, overdraft balance credit on 15th March of 14,000 was carried over as a debit balance on the next day in cash book. Observe one thing, it was actually a credit balance which is standing at 14, but you have carried it as debit balance 14, which is not correct. This is due to error. So first of all, this needs to be corrected in the cash book. Now, when you are correcting, remember there is 14,000 debit, but we actually want 14,000 credit. How do we bring that to 14 credit? First 14,000 cancellation for debit, and then actual 14,000 on the credit side. The total revised amount, what you take is 14 plus 14, 28. I hope all of you understood how we are getting this 28. First, we need to cancel on the debit side 14,000 and then recredit 14,000 extra. So total will be 28,000. All these entries, we will observe how this will be presented in the cash book as well as in BRS. See, as I mentioned in this question, they are not giving us the cash book balance at all. They are giving us the bank overdraft, which is as per bank statement. So, in the adjusted cash book, we don't have any opening balance. So, we will just record the entries as such. So first, checks issued but not presented for payment. We will have to first find out the revised value. So let's keep that on hold. Checks recorded in the bank column of the cash book but not sent to the bank for collection. When it is for collection, that means you would have recorded on the receipt side in the cash book. Now, this is not at all present in the business. So we need to cancel this. So where will I reflect? We need to reverse the entry on the payment side, that is on the credit side. So you will enter by checks recorded in the bank column of the cash book 3,000. Clear with this? Next. Payment received from customers directly by the bank. So payment is received from the customers. You have not recorded it in the cash book. So this is your receipts. We will record it on the receipt side 6,000 customers account. Direct deposit. Clear? Next. Bank charges debited in the statement. So this is the expense. So bank charges debit 40 rupees by bank on the payment side. By bank charges. Then we have checks deposited as a BRS. We will address that later. A bill for 5,000 discounted with the bank in February, dishonored on 31st March, and noting charges is paid by the bank. The entry is already done in the bank, but you have to record this in the cash book. The bill is dishonored. When the bill was drawn, the entry would have been bills receivable to debtors. Now it will be reversed, customer or debtors account. So customer's account debit to bank because we have discounted this bill with the bank. So bank will have to be receiving this payment. What will be the total amount? 5,000 of the bill value and 20 rupees. So this will be recorded on your payment side. by customer for the bill dishonor 5020. How are we getting this? 5000 of the bill value plus 20 rupees as the noting charges. I hope this is understood. Next, then we have premium of life policy of D paid by the bank on his standing advice. So this is in the nature of your expense. It is already recorded in the bank statement but not in the cash book. Coming on the payment side, premium of life insurance policy 350. Clear? Then there was an error, overdraft balance credit, which was taken as debit balance on the next day in the cash book. This needs to be revised. See, this is an overdraft balance, therefore we will reflect it on the payment side, but when we are reflecting, we will have to consider the double amount. By error, overdraft balance carried over as a debit balance 28,000. Clear? After considering all of these entries without opening balance, we will have one closing figure 30,410. This we will take it in the BRS. Overdraft as per cash book. There were two more entries which we decided to appear in the bank reconciliation statement. One, checks issued but not presented for payment. Checks issued means if this is my cash book, if this is my passbook, as soon as the check issued, I would have reduced the balance in cash book. So which book are we supposed to alter? Only cash book, because if they are asking adjusted cash book, that means we can have base book as cash book. So in order to match, I will have to certainly add, since there is overdraft balance here, I will subtract. See here, minus 11,000. Checks issued but not presented. Likewise, next, checks deposited with the bank but not collected. As soon as the check is deposited, you will increase the cash book balance. No entry in the passbook. If I have to match, I will have to bring down the balance. Since this is overdraft, I will reverse. So I will add 9,000. So add checks deposited but not collected. So after considering this, we get 28,410. We started with overdraft balance as per cash book. So we will have to get the balance as per other book. So this is turning into again debit balance. So 30,410 plus 9,000 minus 11,000. So it is 28,410. We will have to get which balance as per passbook? Debit balance as per passbook. Debit balance as per passbook will again mean this is an overdraft balance. If you observe, the same balance was also given in the question. See here, bank overdraft as per bank statement, 20,000. Identically, if I have to see, both balances should have to match. Since the question here is not giving us the cash book balance, since there will be a difference, for which ICAI has also given us the note. See here, they're telling due to missing information in the question. The missing information is all about the cash book balance, which is not given. Because of this, there is a difference. The overdraft balance as per the passbook does not align with the overdraft balance as per the bank statement given in the question. That is why the difference is reflecting. If they had given the cash book balance, hopefully the amount what you are getting after preparing BRS and the given value should have to match. I hope you understood what we are trying to discuss in this particular point. Yes. Moving on to the next part of the question. P owed 2 lakh to Q. On 1st October, P accepted a bill drawn by Q for the due amount for 3 months. Q got the bill discounted with his bank for 1,98,000 on 3rd October. On 31st December, before the due date, P approached Q for renewal of the bill. Q agreed on the conditions that 1 lakh along with interest at 12% per annum for 3 months on the amount of 1 lakh will be paid, and P would accept a new bill for 3 months for the balance amount. These arrangements were carried out on 2nd January. However, on 2nd April, before the due date, P became insolvent and only 40% of the amount of the bill could be recovered from his estate. Pass the necessary journal entries with narration in the books of Q. So you are supposed to pass the entries in the books of Q. Let's begin the question. P owed 2 lakh to Q. That means Q will have a receivable. So therefore on 1st October, P accepted a bill drawn by Q for the due amount for 3 months. So what will be the entry for this bill's receivable account debit to P on 1st October? See here, on 1st October, bills receivable to P, the amount will be 2 lakh. Then Q got the bill discounted with his bank for 1,98,000 on 3rd October 2024. So the bill was drawn on 1st October. Immediately on 3rd October, Q got the bill discounted with the bank. So we will first receive the money. Bank account debit, discounting charges account debit to bills receivable. So this will be the entry on 3rd October. Bank account discount to bills receivable. 1,98,000 you're receiving means discount will be 2,000. Then later what happened? On 31st December, before the due date, P approached Q for renewal of the bill. That means here he is approaching for early retirement. Q agreed on the condition that 1 lakh along with interest at 12% per annum for 3 months on the amount of 1 lakh will be paid, and P would accept a new bill for 3 months for the balance amount. So on 1st October bill drawn, the actual due date was falling when, if it is for 3 months, October to November, November to December, December to Jan. So on 1st October, 3 days of extra, it would have been 4th of Jan. So on 31st December, P is walking to Q for asking extension. So as per the extension terms, 1 lakh along with interest for 12% for 3 months should be paid immediately, and the balance P would accept a new bill for 3 months for the balance amount. This would be the terms and conditions. These arrangements entirely was carried out on 2nd January. 31st December he asked for renewal, and this arrangements taking over on 2nd January. First we will reflect the entries for this. On 31st December, when P asked for renewal, there was an immediate settlement of 1 lakh along with interest. So what will be the entry first? For the renewal, we have to cancel the existing bill because that is going to mature on 4th of January. 31st of December, P account debit to bank account. So this will be the entry 2 lakh and 2 lakh because the now bill is discounted with the bank. P account debit to bank account. That is why the bank is getting credited here. Being the bill cancelled up to due to P's inability to pay. Then on 2nd January, P is paying interest along with the amount, the balance amount of the bill. So first we will make it due. 1 lakh is the bill amount. 12% is the rate of interest for 3 months into 3 by 12. So this will be 1 lakh into 12% into 3 by 12. So we are first making it due. Interest, you are writing the entries in the books of Q. Interest for you is an income. So we will have to pay P. So what is the due entry? P account debit to interest account for 3,000. Then on the same date, he is paying it along with 1 lakh. So what will be the entry? You are receiving the money. Bank account debit to P 1 lakh plus 3,000. Previously we made it due. Now we are receiving. So this was the entry. Then on the same date, he's accepting the bill for the balance amount. So then you're again drawing a new bill. So the entry for that will be bills receivable account debit to P. What is the balance amount? 1 lakh. Because the total amount due was 2 lakh. In that you're already receiving 1 lakh plus interest. I hope this is clear. 1 lakh is the balance. Later, what is happening? On 2nd April, before the due date, P became insolvent and only 40% of the bill which could be recovered from his estate. Now, first of all, whenever there is insolvency, we have to first reverse the entry because there was bill generated. So, what will be the reverse entry? P account debit to bills receivable. The same thing getting reversed. Then 40% of this we will recover. So, the entry will be bank account debit 40, remaining is your bad debt. Bad debt account debit to P account 1 lakh. So this is the ultimate conclusion entry. The entry structure was simpler. Just be careful with respect to making the interest entry due. Clear with this? Yes. Next. Mr. Sahil runs a factory which produces sugar. Following details are available in respect of his manufacturing activities for the year ended on 31st March. Opening work in progress is given, closing work in progress, then raw materials consumed, closing inventory of raw materials, higher charges, direct wages, factory rent, repairs and maintenance, sugar, sale of scrap, all this is given, and they're asking you to prepare manufacturing account for the year ended 31st March. So prepare a manufacturing account format. It will have particulars, units column and then amount column. Likewise, particulars, units, amount. In this question, it is represented in tons, so we are writing it in tons. So, to opening work in progress, 15 tons is given 4 lakh 50, and then closing work in progress 3 lakh 60. Will accordingly enter this values. To opening work in progress 4 lakh 50, closing work in progress 3 lakh 50. Then there was raw materials consumed that will appear on the debit side. If you are aware of the manufacturing account format, this is pretty simple, 32 lakh. Then we had closing inventory of raw materials. This would have anyway impacted in my raw material consumed. So again, you will not separately make any entry. Higher charges of machine at 200 per ton produced. First, how much we produced? 500 tons were produced. 200 per ton is taken. So 200 into 500 will be your higher charges. Higher charges on machine 200 into 500. Then we have factory rent. Okay, we have direct wages contracted at 400 per ton manufactured and 200 per ton of closing WIP. So we had manufactured 500 tons, 500 into 400. Then we have 200 closing WIP here is 12 tons. So 500 into 400 and 200 into 12. See here 500 into 400, 200 into 12. So this will be 2,02,400, which will be entered as direct wages. Clear? Next will be factory rent, repairs and maintenance of plant 2 lakh 40, 1 lakh 50. Then write sale of scrap on the credit side. See here factory rent 2 lakh 40, and then we have repairs and maintenance, sale of scrap on the credit side. After entering all of these values, you have to just close the trading account. The balancing figure will go to trading account in the name of cost of finished goods. So that is 38,98,400. The question was pretty simpler if you are aware of the manufacturing account format. Next, Alpha Limited has an authorized equity share capital of 20 lakhs divided into equity shares of 100 each and 10% redeemable cumulative preference shares of 5 lakh divided into 100 per share. The paid up equity capital. See, authorized capital is anyway not so important. The paid up equity capital is of 13 lakh 50 and 10% redeemable cumulative preference shares of 100 each of 3 lakh. Paid up values are given. Balances in other accounts are securities premium as 35, P&L 80,000, general reserve 4 lakh. The company has investments of the face value 40,000 being carried in the books at a cost of 45,000. The company has decided to redeem the cumulative preference shares at 10% premium, partly by making an issue of equity shares of the face value of rupees 1,50,000 at a premium of 10%, and then investments are sold at 110% of their face value. Investments was there, they are giving two values, one was 40 and one was 45. This is getting sold at 110% of the face value. All preference shareholders have been paid off except two shareholders having 500 shares. You are required to pass the necessary journal entries for effecting the above transactions, and working note should form part of your answer. So this is about redemption of preference shares. So let's understand the entries. The redemption is happening first partly by making issue of equity shares. This equity shares are issued at a premium of 10%. And then by selling the investments 110% of the face value. So 40,000, if I have to take 110%, 44,000, 4,000 profit is made. So first let's understand the entries for all of this. See, first of all, we are making the preference redemption due. The number of preference shares value was worth 3 lakh. So this is redeemed at 10% premium. So what will be the due entry? 10% cumulative redemption redeemable preference share capital, which is 3 lakh. Premium on redemption of preference shares, 10% on this will be 30,000. Preference shareholders, 3 lakh 30,000. We have first made it due. See, being the amount payable on redemption of 3,000 preference shares transferred to shareholders account. This premium, which needs to be written off at the end of the year, profit and loss to premium on redemption. You can also pass this entry at the end as well, 30,000. Clear with this? Now, this redemption is sourced through issue of equity shares and then by selling investments. Understand one thing, there is section 55 which does not allow any money to be utilized other than by issue of equity shares, and the balance should be done using creation of capital redemption reserve. For this, let's understand the working note. The amount which is required from capital redemption purpose is 3 lakh. Remember, we will only take it on the face value. 3 lakh is the amount required. Now, from the issue of equity shares, how much we are able to get? Here also understand one thing. From the issue of equity shares, since that is happening at premium, we cannot use the premium amount for redemption. We will also again only take the face value there. So 1,50,000 was what is received as on face value because 10% extra on this was premium. So 3 lakh was the amount required for redemption. 1,50,000 is from the issue of equity shares. Balance will be done by the balance transferring from capital redemption reserve. This should be clear. So for all of this, let's understand the working note. First, for issuing equity shares. Bank account debit to equity share application. How much money we are receiving? 1,50,000 is the face value. On that 10%, that is 1,65,000. So this will be 1,50,000 plus 1,50,000 into 10%. This is 1,65,000. Then transferring this to share capital, equity share capital to share, equity share application to equity share capital to securities premium. This will be transferred at face value and 10% 15,000 on that premium. Clear with this? This is at face value. Then we have the balance by creating capital redemption reserve. We have the balances available in general reserve, which was given to us in the question. So general reserve account debit, what was the general reserve balance? General reserve was anyway had 4 lakh. So we need only 1,50,000. So the entry would be general reserve account debit to capital redemption reserve, 1,50,000. Clear with this? Now we also sold the investment. Investment was present in the business at face value 40,000. You are getting 44,000 in return. So what will be the entry? Bank account debit 44. Investment was shown at 45 because you're recording it at 45. Profit and losses 1,000. Remember, the sale value is calculated on the face value proportion, but what is the actual price at which the investment is getting reflected? 45. So the entry will be bank account debit with the what amount you're receiving. Profit and loss account to investment. At the end, we have done all the entries. Now we will have to pay to the preference shareholders. Preference shareholders account debit to bank. How much you had made it due? 3,30,000. So that will be settled. 2,75,000, 2,75,000. 3,30,000 was due. That was representing how many shares? 3,000 shares. The question clearly told that they are not paying for 500 shares who was represented by 2 shareholders. So out of 3,000, if the face value was 10 rupees, they are not paying for 500 shareholders. Means the balance left is 2,500. For these 2,500 into 100 plus 10% premium. So that will be 2,75,000. So 2,500 into 11. If I have to be more specific, this will be 2,75,000. This will be 2,500 into 110 because the face value is 100 rupees and premium is 10 rupees. Just to be more specific, face value is rupees 100. Premium is rupees 10. Since they have not paid for 500 shareholders, only 2,500 shareholders would be paid. Hence, this will be the amount. I hope this is clear to all of you. Next. Last question. ABC Limited has issued 1,20,000 equity shares of 10 each at a premium of rupees 2 per share for public subscription payable as follows. On application 2 rupees, on allotment 5 including premium. If I have to break this, 2 rupees was the premium, so 3 plus 2. Then on first call 2 rupees and on second and final call 3 rupees per share. Application has been received for 1,80,000 shares. So what was the issue for 1,20,000 shares? But you have received excess application. Allotment has been made on pro rata to the applicants for 1,44,000 shares. The remaining applicants being refused. T to whom 4,800 shares has been allotted failed to pay the allotment and first call money and his shares have been forfeited. After the second and final call has been made, N to whom 6,000 shares were allotted has also failed to pay the two calls. There was first call and second call. His shares have also been forfeited. Subsequently, out of these forfeited shares, 7,800 shares, including all shares of T, were reissued to P as fully paid up at rupees 8 per share. Show the necessary journal entries and entries in cash book. So this is the catch. You have to show the normal entries along with the entries in cash book. So there is a transaction starting from issue and then there is forfeiture because of non-payment of one shareholder for allotment and call and for the other shareholders who's not paying two calls as well. Then there is reissue later on. So let's understand this entry. Observe such question comes for a good weightage for 15 marks. First of all, what is the entry? When the application money is received, bank account debit to equity share application. Yes or no? So bank account debit to equity share application. How many applications have we received? We have received 1,80,000 applications at rupees 2 per share. So they have asked us to prepare cash book. So what we have to record now is all the cash book entries will be presented in the cash book and those in the journal other than cash entries will be written in the normal journal. So we have written here cash book format and then the journal format. So here observe bank account debit to equity share application is your first entry. So this will be written as to equity share application 360. How much we are getting? How are we getting this? 1,80,000 is the number of application received at 2 rupees per share. Clear with this? Next entry is transferring this to share capital. Now, if you observe how much shares were issued, only 1,20,000. So that much only you can transfer to share capital. What is the entry? Equity share application account debit to equity share capital. 1,20,000 at 2 rupees, 2,40,000. I hope this entry is clear. But for the receipt of application money, we have got this at 3,60,000. We will understand the treatment for that as well. Yes, first entry, all of you would have understood. Equity share application money transferred to share capital. Now observe one thing. The company was only issuing 1,20,000 shares, but due to pro rata, they have started issuing, means they have allotted 1,44,000 shares. But you had received the excess application number worth 1,80,000 shares. So in this, first we will have to observe the question carefully. See here, the remaining applications is being refused. So first let's find out how much is the remaining application. Number of application received is 1,80,000. You have been allotted for 1,44,000. So the remaining application is nothing but 36,000. This is being refused. That means you are refunding the money. 2 rupees was the application money. What will be the entry? Equity share application account debit to bank account. So since we are preparing the cash book bank column, by equity share application, number of applications which are being refused is 36,000 at 2 rupees, so that will be 72,000. So how are we getting this 36? 1,80,000, which was the number of application received, minus 1,44,000 which was allotted. Clear with this? So this entry is done. So now extra amount what was there in the equity share application was how much? 3,60,000. I have transferred 2,40,000. So remaining was 1,20,000. I hope all of you are understanding this. In this 1,20,000, I've already redeemed. I've already refunded 72,000. So how much is remaining? 48,000. So this will be used towards allotment. Adjustment made towards allotment. Clear with this? So what will be the allotment due entry first? Equity share allotment account debit to equity share capital to securities premium because there is premium on allotment. So how many number of shares? 1,20,000 shares. So 1,20,000 shares into 5. Then this will go at face value 1,20,000 into 3 and 1,20,000 premium at rupees 2. Clear with this? Now we are supposed to receive the allotment money. What will be the entry for this? See here, they have just shown the entries, including non-bank transaction. Let me write the entry here. Bank account debit. Remember, you had some amount where you can, in the application, which we can adjust in the allotment. So equity share application account debit. Then there was a person who's not paying allotment, for which we will represent them as calls in arrears, debit. 2. Equity share allotment. Equity share allotment was 6 lakh. You still had 48,000 balance, so we will take it here 48,000. Calls in arrears. There was one shareholder who didn't pay the call money, T, to whom 400 shares has been allotted. Now understand this carefully. 400 shares has been allotted, failed to pay the allotment and first call money, and his shares have been forfeited. We cannot directly enter the values here, 4,800 shares at allotment money. Reason being, this is the number of shares allotted. Whereas we also have the picture of number of shares applied. We will clearly understand this in the working note. See, first we need to understand he has not been paying allotment money, but he has been paid the application money, yes or no? So, if he was allotted 4,800 shares, that means don't you think he had applied something extra? Because there is pro rata allotment done. So, when he had applied for extra, there was some excess application money involved in this portion as well. Yes or no? So now we are going to touch upon that figure. We have the details of 4,800 shares allotted. Now I want how many number of shares was applied for. How do I find this out? 1,20,000 was the number of shares which was allotted. 1,44,000 shares was applied for. So 4,800 if it is allotted, how much is applied for? How do I find this? 4,800 into 1,44,000 divided by 1,20,000. So if I solve this, I get 5,760 shares. So application money was 2 rupees per share. So the application money paid by T would have been 11,520. I hope you are understanding this step, what it is, correct? Now this T did not pay the allotment money. Anyway, he had paid an extra money. The number of shares which he applied for was 5,760. So 5,760 minus 4,800, 960 extra application money is what is paid. Yes or no? So 960 into 2, that is 1,920. I can set this off with his allotment proportion due. Yes or no? So first let's find out how much is his allotment due. 400 is the number of shares which he is allotted for. 5 rupees is the allotment money including premium. So this will be 24,000. In this, he has extra money how much? So he had applied for 5,760 shares, but he got 4,800 shares. So what is the extra? 5,760 minus 4,800, 960 shares. So 960 shares into 2 rupees, I can still set it off here. Yes or no towards the allotment? That's what I did. 1,920. So remaining is not what you are getting. So that becomes your calls in arrears, 22,080. I hope this entry all of you understood. So this is what will be reflected in our journal entry, 22,080. So the remaining amount goes to bank. This will be 6 lakh, 5 lakh 29,920. This will be reflected in the bank as 2 equity share allotment. Observe here all of you. 2 equity share allotment, 5,29,920. This is the working. Clear? So, since they are only bank entries reflected here, the balance will be reflected in the journal. These two will be reflected here. Equity share application debit, calls in arrears debit to equity share allotment with the total value 70,080. Clear with this? So, this 3 entries are done. Next, we have first call. So, all extra application money was received, adjusted towards allotment, refund. All those entries done. Next, we have to make first call due. What was the number of shares? 1,20,000 shares. What is the first call money? 2 rupees per share. So equity share first call account debit to share capital. That will be 1,20,000 shares at 2 rupees. That will be 2,40,000. What will be the next entry? Bank account debit. Let me write the next entry here. Bank account debit to equity share first call. But there is one shareholder who's not paying the call money, so that will be transferred to calls in arrears account debit to equity share first call. First call amount was 2,40,000. Shareholder holding how many shares? And to whom 6,000 shares were allotted. Also failed to pay the two calls. So again 6,000 shares were allotted. 2,40,000 was the share first call money. Remember, there was two shareholders. That was one which is N holding 6,000 shares, not paying two calls. But also there was T who did not pay from the allotment money itself. His part of the money is also involved here. So total number of shares who was not paying first call will be 10,800. How am I getting 6,000 for N and 4,800 coming from the T? So 10,800 into call money is 2 rupees. So that will be 21,600. So 2,40,000 minus 21,600. 2,18,400 will be reflected in the cash book. Observe here, to equity share first call 2,18,400. Yes, after this we have final call money to make it due and then receipt. But before that, observe one important thing in the question. See here, the question clearly specifies that T to whom 4,000 shares have been allotted, 4,800 shares have been allotted, failed to pay the allotment and first call and his shares have been forfeited. So what does this mean? Immediately after making the first call, his shares have been forfeited. So before we make the second call due, we have to first make the forfeiture of this 4,800 shares. So what will be the forfeiture entry? Equity share capital account debit. Securities premium will also be debited. Why? Because there was no premium money collected on the allotment since he didn't pay the allotment money. So securities premium account debit, and then to calls in arrears with respect to the amount being transferred from the allotment and then first call to share forfeiture account. So equity share capital, you had 2 rupees of application money and then 3 rupees of allotment and then 2 rupees of first call. So totally 7 rupees per share capital. Securities premium was 2 rupees. So 4,000 share 800 shares into 2 to calls in arrears to share for feature. Now understand carefully how are we getting that value. 22,080 is coming from the allotment and there was call included for which that was also not paid. So that is, how are we getting this? 22,080 plus 4,800 shares into 2 rupees. So that is nothing but 31,680. 4,800 into 2 plus 22,080 will give me 31,680. And then the balance will go to share forfeiture. I hope all of you understood this entry. Now after this, we will make the final call due. Observe one thing, 1,20,000 was the total number of shares which was issued. In that, 4,800 shares have been already cancelled. So we will receive or make final call due only on the remaining share. How much is the remaining share? 1,20,000 minus 4,800. So that will be 1,15,200 shares. We will make it due only on this shares. Observe, and this is very important to consider. So what will be the due entry? Equity share final call to equity share capital 1,15,200 at 3 rupees per share because the final call money was 3. Now this amount has to be received. In this 6,000 worth shareholder is not paying the amount. So 6,000 into 3 rupees will be your calls in arrears. What will be the entry for that? Bank account debit, calls in arrears account debit to equity share final call account. Equity share final call will be 3,45,600. 6,000 shares did not pay the call money. So 6,000 into 3 will be transferred to your calls in arrears, 18,000. So balance will go to bank. 327,600. So this will be reflected in the cash book. Bank To equity share final call 327,600. Observe here all of you. To equity share final call 327,600. I hope this is understood. Next. So this entry will be passed. Calls in arrears account debit to equity share final call. This is the entry for this. Now after this share is again getting forfeited. So the entry will be equity share capital. All money is being called. So 6,000 at 10 rupees. Calls and arrears were transferred 18,000. So remember there was also a call money included here. 6,000 into 2 and then 6,000 into 18. That is how we are getting 30,000. This one 6,000 into 2 plus 6,000 into 3. This is how we are getting 30,000. First call and final call. That will be transferred to share forfeiture. After this, there is an reissue. The reissue number of shares is 7,800 at 2 rupees. That means the entry for this would be for reissue bank account debit, share forfeiture account debit to share capital account. This will be the reissue entry. 7,800 shares have been reissued. 7,800 into 10, 78,000. You are reissuing it at 8 rupees. So this will be 62,400. And the balance will go to share forfeiture. So this will be reflected again in the cash book to share capital 62,400. See here, to equity share capital 62,400. This completes all our entries, so we can close the cash book and find out the balancing figure. Closing balance 14,26,320. So this is done. So the remaining entry share forfeiture to share capital, that is 15,600. Last one entry is the amount to be transferred to capital reserve. Here again there is a consideration which needs to be made clearly. See here, out of this 7,800 shares include all of the shares of T. T was holding how much? 4,800 shares. So for this again we will also observe the important calculation. Simple reason being, here we have number of shares allotted, but we also have to do it as per the basis on number of shares applied for. See, forfeited amount on 4,800 shares is 11,520. How are we getting that? Which is nothing but your 5,760 shares at 2 rupees. This is lying in the forfeited balance, correct? Next, forfeited amount on 3,000 shares, because 7,000 share and 800 shares was reissued. We are completely using 4,800 shares represented by T and the balance is 3,000. Now this 3,000 is from total number of shares, which is 6,000. 6,000 was his number of shares. In that I am only using 3,000. How much is the balance lying in the forfeiture amount? Remember, from the calls in arrears, we had 30,000. So that will go reflected in the balance in share forfeiture. So we are taking it on the proportionate basis. Out of 6,000, how much is it for 3,000? So 15,000. 26,520 is the balance available. So from the reissue 7,800 into 2, I am issuing this at discount. So that is the loss to be set off. 15,600. The balance will be 10,920, which is nothing but the amount to be transferred to capital reserve. Now, if you analyze this, why should we do such a calculation instead of not reflecting like we normally do with the per share value? In this question, as we have observed, we are taking this on the pro rata working. We are taking the number of shares allotted based on the money available from the excess application money. So that is why we have to follow this particular structure of solving. So I hope you understood how we are getting 10,920. So this is being transferred to capital reserve at the end. Forfeited shares account debit to capital reserve. So if you observe, this was one good question which definitely requires a practice before you observe this in the final paper. There is one similar question like this in your study material. Make sure you practice all of them in order to not miss. Where students can go wrong majoritarily here is, before making the final call, they might completely miss out on passing the forfeiture entry. This is again a new set of question being framed. So this becomes a must do for practice before you appear for your respective attempts, guys. Done. So there is one more last question. Let's quickly complete that. Next, at the time of valuing inventory as on 31st March, a sum of 7,500 was written off on a particular item. Okay, before that, there are some more points. From the following particulars, ascertain the value of inventories as on 31st March 2025. Inventory as on 1st April 2024 is given. Purchases, manufacturing expenses, selling expense, administrative, financial expense, sales, all these are available. At the time of valuing inventory as on 31st March, a sum of 7,500 was written off on a particular item, remaining in the balance which was originally purchased for 70 and was sold during the year for 65,000. Barring the transaction relating to this item, the gross profit earned during the year was 20% on sales. So this is just an extra item. Previous year's balance was written off. The previous year's balance was 70,000, from which 7,500 was written off. Now if we roughly calculate 7,000 minus 7,500, 62,500 is the actual value which is getting sold for 65,000. So what is the profit on this? This will be 2,500. Clear with this? Now, excluding all of these transactions, every other sale was generating a profit of 20%. Done. Next, on 15th March 2025, the goods of the sale value of 20,000 included in the above sales were sent on sale or return basis to a customer. The period of approval being 4 weeks. He returned 40% of the goods on 10th April 2025, approving the rest. Now, first of all, when the goods are sent on sale or return basis, it is not at all a concluded sale. This is sent on 15th March and you are calculating the value of inventory as on 31st March. So, this what we are telling, goods of this sale value 20,000 is included in the above sales. Now, the question here is it an actual sale? No. Since we discussed that goods sent on sale or written basis is not a concluded sale. So this should not be part of your sale. So what is the treatment? You will have to subtract this from your sales. Next, he returned 40% of the goods on 10th April. This is irrelevant for me because I am finding out the value of closing stock as on 31st of March. And what is happening beyond that, the calculation will not at all be impacted. So only simple treatment from this is we have to reduce 20,000. Clear? So this question we can solve using a format of cost of goods sold and then cost of goods available for sale. So let's structure wise what is the cost of goods available for sale. So here only let me do the working. Available for sale. So this will include all of your items, inventory, that is opening stock, plus purchases, plus your direct expenses, which includes your manufacturing expenses here. So this will be 176,900 plus 964 plus 1,90,000, 13,30,900. All other things will not be part of your direct expense. So this will not come, this will not come, and even this will not come. Sales is 15,37,000. So in 15,37,000, I have to make two bifurcation because the value of 65,000 which is getting sold is not at generating profit of 20%. So I will take out this 65,000 and then what is remaining? 1537 minus 65, 14,72,000. In this 14,72,000, 20,000 should also be not included because this is not part of your sale. We already understood this. So minus 20,000 if I do, 14,52,000 is my normal sales where the gross profit is 20%. Yes, cost of goods available for sale is arrived. So cost of goods sold. This is nothing but sales minus gross profit. On 65,000 sales, my profit was 2,500 So this will be 62,500. Then on remaining at 20%, that was 14,52,000 minus 20%. 14 lakh 52 minus 20% will be 11 lakh 61,600. Add up both 62,500. So this will be 12 lakh 24,100. 13,30,900 minus 12,24,100. 1 lakh 6,800. This will be my closing stock. Now just for your reference, let's check the ICAI solution. Yes, 1,06,800 is my closing stock. See here, Institute has considered here itself the abnormal item. You can also do this way, not a problem at all. So they have taken this as in the cost of abnormal item as well. So this format is also working. We have also solved in the same format, but we have just bifurcated into cost of goods available for sale and cost of goods sold. Let me bring that solution below this. So while I share, it will be easier for your references. So you can simultaneously cross-check and observe how this is being solved by the institute. Both gives us the same answer. Whichever format you have understood, you can stick on to that. Clear with this? So this completes our solving of September 2025 question paper, guys. A good set of questions for practice. I am sure those of you who have seen it for the first time would have definitely felt it difficult since there were many tricky points involved in different set of questions spread over. This definitely required a good set of practice. I am sure the upcoming aspirants will look at this and mold carefully for the next papers which would have been set up in the next level. So let's give our best effort in every time you spend with your books or with the lectures, guys. Stay or maintain that consistency, that will definitely build you with lot of confidence, which is what is ultimately required to face any exam, guys. You are doing your best. Keep rocking and all the best. Until I see you in the next video, take care. Bye. Hello champs, hope you all are doing amazing. In this video, let's discuss May 2025 CA Foundation Accounting exam paper along with ICAI suggested answers. Meanwhile, I've also gone through the examiner's comment to give you an insight about what did the examiner actually expect from the student's answer and what are the common mistakes committed, so that will definitely give you an angle where you should not commit the same what it is done by the earlier attemptees. So with the strong committed mindset, let's begin this discussion, guys. So question number 1, part A will be a true or false, wherein your marks will be awarded for denoting whether the statement is true or false along with the relevant supporting reasons. So let's discuss this one by one. So first one, trade discount is recorded in the discount column in triple column cash book. Cash book maintained on triple column basis will have three columns: cash, bank and discount. Now the question here is, what type of discount will be recorded in cash book? In cash book only cash discount will be recorded, so the given statement here will be false. And an add-on point here is, trade discount will not be recorded in the books of account itself, because we take the transaction net of trade discount while we make any entry with respect to the monetary terms. Next, money measurement concept means transactions are to be recorded at a uniform monetary units. The given statement is true. As per money measurement concept, the transactions will be recorded in the books of accounts provided they are expressed in monetary terms. Also, it precises that the measurement basis should be uniform. Like for example, if I have to denote any currency, it becomes easier if I prescribe everything in rupees or dollars, depending upon in what terms I'm maintaining my books of accounts. I hope you got this point. Next, If a society that is non-profit organization has a separate trading activity, the profit or loss from the trading account shall be transferred to income and expenditure at the time of consolidation. Yes, the given statement is true. If an organization engaged in the service oriented activities, that is, their objective is not to make any profit, and if in case they are engaged in any separate trading activity from which they are maintaining trading account and generating profit or loss, at the time of final presentation, it can be consolidated. So this, therefore, the given statement is true. Next, partners in a partnership firm will share the profits of business according to their capital contribution in the absence of any agreement. The given statement here is false. The question is clearly emphasizing it is in the absence of any agreement. We had a specific rule, rule number 6, when there is no agreement between the partners and partnership firm, profits and losses will be shared equally and not in the capital contribution. Hence, the given statement is false. Next, LLP should have two designated partners who are resident in India. The given statement here is again false. The reason being, LLP, yes, should have two designated partners, but when it comes to who should be, how many of them should be resident, at least one among the two designated partners should be resident. Either two should not be. The resident is not a mandatory point here. Clear? Next, a non-profit organization registered under Section 8 of Companies Act 2013 can distribute its surplus among its members. The given statement is again false. First of all, the objective of not-for-profit organization is towards serving some societal benefits or societal purpose. So in this course, any surplus what they generate, it cannot be distributed among its members. That surplus will be directly taken to the general fund of the organization. So these were your true or false. Let's look at the suggested solutions. See, first statement was about trade discount. The given statement is false. The trade discount is not shown in the cash book, or it can also not be shown in any books of accounts. Next, it was true. As per money measurement concept, only those transactions which can be measured in terms of money will be recorded. And additionally, monetary units should also be uniform, which was also prescribed in the statement. Next, the third one is again true, where in case of trading activities, the profit or loss from such activity should be transferred to income and expenditure in case of consolidated accounts. Consolidated means they merge everything, that is from not for profit and from trading activity presented together. Next statement was again false. In the absence of partnership agreement, profits and losses has to be shared equally. Last, as per Section 7 of the LLP Act, every limited liability partnership should have at least two designated partners. That is, when it comes to designated partners, there should be two who are individuals and at least one of them should be resident in India. The next was false again. A non-profit organization registered under Section 8 cannot distribute its surpluses to members. As I explained, it must be credited to general fund for furtherance of its charitable objectives. I hope this segment was much easier if you are aware of few points where the answer was completely dependent why the given statement was true or either false. Moving to the next part of the question, explain the following. What are the objectives of accounting standards and what is the difference between liability and contingent liability? Straightforward theory questions. Here you are expected to write the points what is prescribed under the specific heading. Like if I am taking the first part, objectives of accounting standards, they are looking at where is the service per objective purpose of rendering accounting standards. So if I look at the first part, objectives of accounting standards is again a straightforward topic. You are expected to write the specific answers as to what is the objective of the accounting standards. We can look at the points what is given. See here, accounting standards, diverse accounting policies with an objective too. There are two objectives: eliminate the non-comparability of financial statements and thereby improving the reliability of financial statements, and provide a set of standard accounting policies, valuation norms, and disclosure requirements. So, in short, you can just consider that elimination of non-comparability of financial statements, because application of respective accounting standards helps in avoiding confusions to have the same basis to compare. So second point is it provides a set of standard accounting policies, valuation norms and disclosure requirements which actually support presentation of financial statements to make it on a comparable basis. So these are two objectives of accounting standards. Examiners comment on this point here is many of the students have just given random explanations, but the question was very specific to provide what is the objective of accounting standards. So be aware of this point. Next was to differentiate between liability and contingent liability. So this is again a straightforward theory question. So you have to just explain first about liability, then about a contingent liability and one other key differences. See, what does the point say here is a liability is defined as the present financial obligation of an enterprise which arises from past events. This is the standard definition of a liability. The settlement of a liability results in an outflow from an enterprise rest of the resources embodying economic benefits, because in assets we see that there is inflow connected, so as it is a liability which is an obligation which requires any outflow of economic resources. And on the other hand, contingent liability, either outflow of resources to settle the obligation is not probable, or the amount expected to be paid to settle cannot be measured with sufficient reliability. That is why it is categorized as a contingent liability. Example for contingent liability would be claims against the enterprise not acknowledged as debts, guarantees given in respect of third parties, liability in respect of bills discounted, and other statutory liabilities under dispute. See here, for example, to precise more on these examples given, against the enterprise, claims against the enterprise or acknowledged as debt. What it clearly means here is some companies will provide guarantees or warranties on the specific product depending upon the defectibility of the usage of product. So this claim is not probable. I mean to say, it is not for sure potentially turning out to be a claim. It might be or might not arise. So therefore such can be categorized as a contingent liability. And in addition to present obligations that are recognized in the balance sheet, liabilities will have a clear recognition in the balance sheet, whereas contingent liability requires a disclosure by way of notes. So, there were 2 points of difference. First, we will define what is the liability and contingent liability. You can also quote some examples, and then you can prescribe one more point about the recognition. For liability, it will be recognized in the balance sheet, whereas contingent liability will not be recognized. It will be disclosed in notes to accounts. I hope these points are clearly comfortable to each one of you. Yes, next question. A trader prepared his final accounts on 31st March each year. Due to some unavoidable reasons, no inventory taking could be possible till 15th April 2025, on which date total cost of goods in his store came to 1,50,000. The following facts were established between 31st March and 15th April. So there are sales given both on cash and credit basis, as well purchases given on cash and credit basis. On 25th March, goods of the sale value of 30,000 were sent on sale or return basis to a customer. The period of approval being 4 weeks, he returned 25% of the goods on 12th April, approving the rest. The customer was billed on 25th April. Then the trader had also received goods costing 10,000 in March for sale on consignment basis. 50% of the goods had been sold by 31st March and another 25% by 15th April. These sales are not included in above sales. Goods are sold by the trader at a profit of 20% on sales. You are required to ascertain the value of inventory as on 31st March 2025. So this is a testing done from inventory taking concept, wherein inventory taking was not possible to be completed as on 31st March. So therefore they are giving you the value of stock as on 15th April, which is 1,50,000. So meanwhile, they're also giving us the details which happened between 31st March till 15th of April. We will have to consider the impact it would have and arrive at the value of stock as on 31st of March. So let's discuss this one by one. 1,50,000 is the value of stock as on 15th of April. Sales would bring down your value of inventory. Remember, we are calculating the stock as on 31st of March. So this need not be reduced. So therefore, I will add them back. Now, whatever would be prescribed here would be at selling price. When we are considering our own value of inventory, we cannot consider the profit element. So we will have to show this as cost of goods sold. How will we get cost of goods sold? Sales minus gross profit. Gross profit margin is given to us. So we will deduct this from our sales and add it back. So add back total 70,000 plus 25,000, 95,000. Sales is 95 minus gross profit at 20%. So this will be 76,000. 95,000 at 20%, 19,000 will be my gross profit. So we are just roughly doing this. I will show you the ICAI's presentation, how it is done. This is for your explanation. I'm just writing it here. Next, we have purchases. Purchases at cash and credit basis. Now, this purchases would have been done between 31st March to 15th April. I'm only concerned about the value of stock as on 31st March. So, this need not be included. So, I will subtract this. Purchases, cash and credit. So, total 15 plus 25 will be 40,000 to be subtracted. Clear with this? Next. On 25th March, goods of the sale value 30,000 were sent on sale or written basis, the period of approval being 4 weeks. First of all, if the goods are sent on sale or written basis, it is not at all a concluded sale. This is the first point to focus on. He returned 25% of the goods on 12th April, approving the rest. The customer was billed on 25th April. Now, in this case, what has happened is the transaction which has an impact for ascertaining the values on 31st March is what we are considering. The goods were sent on sale or written basis. By 12th April, we are getting the confirmation clarity. What is that confirmation? 25% of the goods has been returned, approving the rest. Now, what does that mean? 75% is concluded as a sale. Yes or no? So, same treatment we will give it as what we did for sales. So, I will have to add back goods sent on approval. How much is the sale value here? Out of 30,000, 25% is returned means 75% is approved. So that is your sale value. 22,500 is my sale value. On this, there is a gross profit which needs to be considered at 20%. So this will bring me 18,000. Is this clear? Next, the trader had also received goods costing 10,000 in March for sale on consignment basis. 50% of the goods has been sold by 31st March and another 25% by 15th April. These sales are not included in above sales. First of all, you need not consider this as part of your sales as well, because here you are acting as what? Consignee. Now, how much of this goods is remaining as on 31st of March? If I have to look at it, another 25% is done by 15th April. So, we are anyway considering the impact till there. So, 50% was anyway sold by 31st March, 25% by 15th April. In 10,000, how much more is remaining? 2,500. So, this will be added back. Sorry, this will be subtracted because this is not at all part of your stock. So, goods received on consignment. 2,500. So 1,50,000 plus 76,000 minus 40 plus 18,000 minus 2,500. So your value of stock as on 31st of March will be 2,01,500. So what is the answer as per ICAI? 2,01,500. So you can present it in a table like this, taking value of stock and what to add. what to subtract, just write it neatly. So that gives you complete full marks. First question was pretty simpler. I hope you'll be able to manage it well. Moving on to the next question. Following errors were found in the books of XYZ. Give necessary entries to correct them. Meanwhile, if there is any additional point, let's check. Okay. So this question is asked for 10 marks. We will discuss this one by one. First, a purchase of goods from R amounting to 10,000 has been wrongly entered through the sales book. So this is a rectifying entry. Purchases of goods, what would be the journal entry? Purchases account debit to R. But what they have done, they've entered it in sales day book, means the entry would have been R account debit to sales. So we need to cancel the sales and credit R. So what will be the rectifying entry? Purchases account debit, sales account debit to R account. The transaction amount for purchases will be 10,000. Sales, which was credited by 10,000, will be cancelled by debiting, and total 20,000 will be impacted to R. See here, purchases account debit, sales account debit to R account. Clear with this? Purchases of R from R wrongly entered in sales book is now rectified. That will be your narration. Next, furniture purchase for office use amounting to 25,000 has been entered in the purchases day book. This is an asset purchase. So what they have done, they have entered in purchases book, means purchases account would have been debited. Actually, what should I debit? I have to debit furniture account. So what is the rectifying entry? Furniture account debit to purchases. So 25,000, 25,000. See, furniture account debit to purchases. Again, you will write the narration in the same pattern, wrong debit, rectify. Next, minor repairs to the furniture account amounting to 1,500 were debited to furniture account. This is normal routine repairs. It should be part of a revenue expenditure, but they have treated it as capital expenditure by debiting it to furniture account. So what should have been debited? Repairs account. What is debited? Furniture. So we will rectify it by crediting furniture account by 1,500. So the rectifying entry will be minor repairs or repairs account debit to furniture's account. See, repairs account debit to furniture account 1,500. Next, wages amounting to 3,000 paid to workmen for making office furniture has been charged to wages account. So again, this is part of a capital expenditure, but they've treated it as revenue expenditure. So what should have been debited? This is wages paid to workmen for making office furniture. This has been charged to wages account. It should have been actually debited to office furniture account. So the rectifying entry here is office furniture account debit to wages account 3,000, 3,000. So office furniture account debit to wages 3,000, 3,000. Next, tuition fee of proprietor's son 25,000 has been debited to audit fees account. So this is an item in the personal nature. So drawings account need to be debited, audit fees debited instead. That needs to be reversed. The rectifying entry here will be drawings account debit to audit fees account 25,000, 25,000. Clear? Next, an amount of 10,000 due from Mohan, which had been written off as bad debt in the previous year, was unexpectedly recovered and has been posted to the personal account of Mohan. So, first of all, an amount of 10,000 due from Mohan. Due from Mohan means Mohan will be a debtor. So, if he is not being paid, that will be recorded as a bad debt. So, bad debt account debit to Mohan would have been that entry. This has been unexpectedly recovered and it has been now posted to the personal account of Mohan. Actually, when the bad debt is recovered, there will be a separate account created called bad debts recovered account. Now, instead of crediting this bad debt recovered, what they have done is they have credited Mohan's account. So, Mohan's account should have been actually debited. So, what will be the rectifying entry? Mohan's account debit to bad debts recovered 10,000, 10,000. See here, Mohan's account debit to bad debts recovered. This is the account which will be separately created when we receive any bad debts recovery. Next, goods cost being 7,000, sales price 10,000, distributed as free samples among prospective customers were not recorded anywhere. So this is an error of omission and entry need to be recorded. Advertisement expense account debit to purchases will be the entry. Now the question is whether you should take the cost price or selling price. Remember, we are recording this at our own expenditure. So we cannot make profit from our own businesses. So therefore, we will record this at cost. So 7,000 and 7,000. Advertisement expense of free sample to purchases account. Clear with this? Yes. Next transaction. Goods amounting to 1,000 returned by a customer G and Co were entered in the sales day book and posted therefrom to the credit of his account. Now, goods returned by a customer means there is a sales return. The entry should have been sales return account debit to G and Co. But what they have done, they have entered it in the sales day book. That means sales account would have been credited. Further reading, this was posted therefrom to the credit of his account. G and Co account was anyway supposed to be credited. It is taken care. But what is additionally being reflected here in the sales book? So what would be the rectifying entry? Sales return account should have been debited. So we will debit that. Sales which have been credited needs to be cancelled. So we will again debit by eliminating. G and Co was supposed to be credited. That is already done properly. So in order to rectify, we will make use of this suspense account. So the entry here will be sales return or return inwards account debit, sales return to suspense account. I hope this is understood to all of you. Next. A bill of exchange received from SS and Co for 10,000 had been returned by the bank as dishonored and had been credited to the bank and debited to bills receivable. So first of all, bill of exchange is received from SS and Co. So what would be the nature of the bill? It will be bills receivable. It had been returned by the bank as dishonored and had been credited to the bank and debited to bills receivable. See, if it is dishonored by the bank, bank account will be credited, yes, but it should have been debited to bills receivable, no. So what will be your rectifying entry? Observe here, all of you. SS and Co is the debtor here. Bill dishonored means they become liable again here. So we will debit SS and Co and then to credit bills receivable. Bills of exchange dishonored and had been credited to bank is debited to bills receivable, now rectified. Meaning when the bill was dishonored, anyway bank is getting credited. So the bill amount is again now standing as due. So therefore the rectifying entry will be SS and Co account debit to bills receivable. I hope this is clear. Next. A bills receivable for 2,500 was passed through bills payable book. The bill was given by Jack. The entry should have been bills receivable account debited to Jack. But what they have done here is Jack account debit to bills payable. So we will have to cancel this bills payable. So the rectifying entry here will be bills receivable account debit, bills payable account debit to Jack account. Observe here, bills receivable account debit, bills payable account debit to Jack account. Reason of crediting 5,000 to Jack is it was also taken in bills payable. It should have been shown under bills receivable. It was not shown. Hence, the dual amount will get reflected. I hope this is understood. So this completes your first part of second question. Next, prepare the bank reconciliation statement of XYZ brothers on 31st of March from the particulars given below. So meanwhile, we will look whether there is any additional information given. No. Okay. The bank passbook had a debit balance of 62,500 on 31st of March. Bank passbook debit balance here means this is an overdraft balance. So they are giving us the base book balance as passbook. So this will be a starting point 62,500. Now let's analyze each transaction one by one. For our reference, this will be my cash book and this is my passbook. As per the given details, we can only alter passbook. Clear with this? Yes. A check worth 1,000 directly deposited into bank by customer, but no entry was made in the cash book. This is my cash book and this is my passbook. When the check was directly deposited by the bank, passbook already has the entry. Cash book, there is no entry. Which book I can alter? I can alter passbook. Now, since I have to match this, I will have to bring down the balance. Since this is overdraft, what will I do? I will add back. At 1,000. Next. Out of checks issued worth 85,000, checks amounting to 50,000 only were presented for payment till 31st of March. Checks issued 85,000. That means cash book would show a lesser balance. Passbook is only showing up to 50,000. The balance 25, 35 is not at all considered. So which book I can alter? Passbook. If I have to match, what will I do? I will have to reduce. Now, since this is overdraft balance, I will add back. How much will I add back? 35,000. Clear with this? Next. A check for 10,000 received and entered in the cash book, but it was not sent to the bank. Check was received. As soon as the check is received, cash book balance will increase. It was not sent to the bank, which is my base book passbook. If I have to match, what will I do? I will add. Since this is an overdraft balance, I will subtract. Next, checks worth 50,000 had been sent to bank for collection, but the collection was reported by the bank as under. Check worth 50,000 has been sent for collection means in the cash book immediately your balance would increase by 50. But now what happened? Checks collected before 31st March 35. So passbook is also matching until 35. Checks collected on 10th April 10,000, 12th April 5,000. Now these two will not at all be reflected because I'm doing this reconciliation as on 31st of March. So my passbook is showing a reduced balance of 15,000, which is my base book passbook. If I have to match both, what should I do? I will have to increase. Since this is overdraft balance, I will reduce both. That is 15,000. Next, the bank made a direct payment of 1,500 which was not recorded in the cash book. Bank made a direct payment means balance would have come down. So this is not reflected in cash book. If I have to match, I will have to increase the balance. Now since this is overdraft, I will reduce this. Next, interest on overdraft charges by the bank was not recorded in the cash book. Again, similarly, interest on overdraft is an expense. This is already entered in the passbook. It is not entered in the cash book. If I have to match, I will have to increase the balance. Since this is overdraft, I will subtract. Next, bank charges worth 200 have been entered twice in the book, whereas insurance charges were 175 directly paid by the bank was not at all entered in the cash book. Bank charges with 200 have been entered twice in the book. Which book? It will be in the cash book. So it is entered 400. But in passbook, it is only showing up to 200. If I have to match both books, I will have to bring down the passbook. Since this is overdraft, I will add. 200 will be added. Likewise, insurance charges 175 was directly paid by the bank. Passbook is having the lower entry. This was not entered in the cash book. If I have to match, I will have to add. Since this is overdraft, I will subtract. Next, the credit side of bank column was undercast by 5,000. Credit side of bank column of cash book means this is payment side. So, payment side, it was not showing 5,000, but passbook already had the entry. If I have to match, I will have to certainly add. Since this is an overdraft, I will subtract this. So, my starting point is 62,500 plus 1,000 plus 35,000 minus 10,000 minus 15,000 then minus 1,500 minus 4,000 plus 200 minus 175 minus 5,000. So what is the balance amount? 63,025. We started with bank overdraft as per passbook. The value is coming positive. So this will be overdraft balance as per cash book. I hope this is understood. So this can be presented as per the balance presentation or plus minus presentation. See, as per plus minus presentation, what you should take care is the balance which we start will be negative since this is overdraft. So whatever points were supposed to be added, we will show it in a negative and then add the remaining. So again, you will get the same answer. Whichever you are comfortable, either the balance presentation or plus minus, you can do it easily. I hope this was very much easier to secure 10 marks. Yes. Moving on to the next question. The receipts and payments account of ABC Club for the year ended 31st March 2025 was as follows. Remember carefully, observe while you are reading the questions. This is mentioned in thousands. So whatever value is given will have three more zeros side by side. So this becomes important if the adjustments is given the other way around. So here it is okay. Yes, cash in hand is given, balance at bank as per passbook. There is deposit account, current account, and then bank interest, donation, subscription, receipts, contributions, sale of equipment, net proceeds of variety entertainment, donation for the forthcoming tournament. Then on the payment side, groundman's fee, moving machine, rent, cost of teas, Fares, printing and office expense, repairs to equipment, honorarium to secretary and treasurer, balance at bank as per passbook, deposit account, current account is given, and then cash in hand is given. You are given the following additional information. So here also it is mentioned in thousands. Subscription due, opening closing balance, amount due for printing, checks unpresented being payment for repairs is given, and then estimated value of machinery and equipment, interest not yet entered in the passbook, bonus to groundmen outstanding. For the year ended 31st March 2025, the honorarium to the secretary and treasurer has to be increased by a total of 3 lakh rupees. Prepare the income and expenditure and balance sheet for the period ending 31st March 2025. Now we read the entire question. Nowhere we did find the capital fund balance. So additionally, we should also prepare the opening balance sheet in our working note. So this becomes a very important question for practice for NPO chapter, guys. So let's understand this in detail. First of all, let's open all account, income and expenditure, closing balance sheet, and then opening balance sheet as our working note. So let's begin with the adjustments first. So subscription due is given. So let's connect this to the balance available in the receipts and payments account. On the receipt side, we have donations and subscriptions, 3,900. Subscription due means it is a receivable for you. Opening balance. Was it the amount belonging to the current year? No. So 3,900 minus 225. Subscription receivable 150. Was it the income belonging to the current year? Yes. So this will be added. Plus 150. 3,900 minus 225 plus 150. So this will be our subscription amount. So in the income and expenditure, observe donation and subscription 3,900, add outstanding, closing outstanding, and minus opening outstanding 3,825. So that entry is done. So subscription due is the nature of receivable. Closing will appear in closing balance sheet and opening will appear in opening balance sheet. Receivable means it's your asset. So you observe here subscription due 150 and then subscription due 225. Clear with this? So this completes our subscription adjustment. So this becomes easier if you take up first adjustments. Next, amount due for printing. So we have to observe whether there is any printing and office expense here. 420. So this is outstanding amount. So 420, 150 is the opening outstanding. Was the expenses belonging to the current year? No. So we will subtract. 120 is the closing outstanding expenses belonging to the current year. Yes. So we will add this. 420 minus 150 plus 120. So in income and expenditure account, expenditure side 390. Observe here, printing and office expense 390. Clear? Now this opening outstanding is a liability. So opening outstanding was how much? Opening outstanding was 150, will appear in my opening balance sheet. See 150, and closing printing and stage office expense 120 will also be done. This is clear. Next, check unpresented being payment for repairs. If you observe these wordings, this is very much common where we see this transactions in bank reconciliation statement. So if you observe, in the details given, they are giving us balance at bank as per passbook. Deposit account is given, current account is given. So this impact should be considered with respect to check unpresented and take the revised balance. That is why this balances is given. So this is a treatment coming from BRS. So we will consider this impact and take the revised balance. For the opening current account, see deposit account we cannot alter. So we will take the current account balance 900. Checks unpresented being payment for repairs. So check unpresented means this is your cash book, this is your passbook. You've already written it in your cash book. No entry in the passbook. Now they have given us the passbook balance. If I have to match, what will I have to do? I will have to reduce the balance. So 450 will be reduced. Likewise, the same treatment 390. So now if you observe, opening current account balance 900 is given. Remember, I have to make an opening balance sheet. So when I show the cash balance as per current account, I will take this 900 minus 450. Observe here. See, cash with bank in current account. 900 minus 450 was check unpresented for repairs. That is being considered here. Clear? Likewise, my closing cash book balance in the receipts and payments account, my closing cash book balance was 225. So 225 minus 390. Now 225 minus 390 will give me a negative balance. Come on, this is a passbook balance. So I can write this as a bank overdraft. In my closing balance sheet, there will be a bank overdraft of 165 rupees. Just excuse me on this. Yes. Clear with this? And now this was connected to repair. It was not unpresented means don't you think it is in the nature of outstanding because it is not at all paid. Now observe there is repairs and equipment. This impact should also be considered. 750, 450 and 390. Observe in income and expenditure account. 750 closing outstanding belongs to current year, so I will add. 450 is the opening outstanding not belonging to current year, so we will subtract. 690. I hope this is clear. So I hope you understood how this 690 is been appearing. So this completes our treatment for repairs. Next, estimated value of machinery and equipment 1200 and 2625. Now with respect to machinery and equipment, we have two items given. One is sale of equipment and another one is moving machine. So when such details are present, it is better to present them in ledger. As per the institute suggested answer, they've directly made the working in the income and expenditure itself because the balancing figure will help us find out the depreciation. If you observe, that's why I read invested time for the complete question for just making note of these minute details. There is an asset, but no depreciation details is given. So we have to find that out anyway. So how do we do it? Such details will be presented either in the ledger. So I will show how the institute has considered. See, there is one sale of equipment and moving machine given, and opening and closing balance of the assets are available. So 1200 is the opening balance, 2625. Observe here, opening balance is 1200, closing balance is 2625. There was one on the payment side and the name moving machine that is taken as purchases 2250. Sale of equipment is given. So considering all of these, we will get a differentiating value which becomes your depreciation. Depreciation on machinery. In the closing balance sheet, we directly take the closing balance. See here, machinery and equipment 2625, and then here machinery 1200 as the opening balance. Clear with this? Yes. Next point, interest not yet entered in the passbook. Now this is with respect to your bank interest. There is a receipts bank interest 45. So what are they telling? Interest not yet entered in the passbook. So what does that mean? That it is outstanding, not yet credited. So first of all, for the purpose of current year income, 45 is received, 30 is also belonging to current year. So total 75 will be recorded in my income and expenditure. See here, bank interest 75 totally taken. 30 rupees is not yet entered in the passbook means that it is receivable outstanding. So this will be recorded in the balance sheet, interest due under the assets. Clear with this? There is no opening balance. So nothing will appear in my opening balance sheet. Next, bonus to groundmen outstanding 450. Bonus to groundmen. Was there any other item given with respect to groundmen? Donation, groundman's fee is given. Now this groundman's fee and groundman's bonus is different, so we will treat that differently as bonus to groundsman. They're telling it is outstanding. What does that mean? It is your current year expense not paid. So we will record this in the income and expenditure 450. Bonus to groundman 450, and this is my liability, so that will also be shown. Groundman bonus 450. Clear with this? Yes. So this is done. Last adjustment for the year ended 31st March 2025, the honorarium to the secretary and treasurer are to be increased by a total of 3 lakh. Now observe carefully, whatever details was given was in lakhs, that is thousands of these things. In the adjustment, they're directly giving this as 3 lakh. Now, first, let's observe what was the value of inventory, 600. So, if I take three zeros beside, so this is nothing but 6 lakh. So this, if you observe for a further detail, this is of 2024. We are preparing this as on 31st March 2025. What does the adjustment tell? They are proposing this to be increased by a total of 3 lakh. That means the current year expense should be total of 3 lakh plus 6 lakh, 9 lakh. So we will record that in the income and expenditure account. See, to honorarium, to secretary and treasurer, 9 lakh. I hope this point is understood. Now observe carefully. This honorarium of 2024 is paid in 31st March 2025. That means on the opening date, it was still outstanding. So I will record that in my opening balance sheet, 600. In the question, if you observe, they are not specifying whether it is paid or not. Which one? That is the total amount. So honorarium, total entire 900 is still assumed to be outstanding, hence recording this on the liability side. I hope this point is clearly understood to all of you. Now, meanwhile, I can complete my opening balance sheet. We will now take the receipts and payments, take the remaining balances. Cash in hand 150, opening balance, passbook deposit account 3345. We will enter that in the opening balance sheet. See here 150 and 3345. This completes our opening balance sheet. We can close the balance sheet and find out the balancing figure as the capital fund 4620. Take this to the closing balance sheet. Clear with this? Next. We have treated bank interest, donation, subscription done, receipts from teas. Now, whenever we have a common item appearing on receipt side as well as on the payment side, we will net this and show in the income and expenditure. Now, for respect to teas, we had something called as cost of teas. So, we can net this off cost of teas with receipt of teas. So, which is greater? 450 is greater. So, we will enter this on the income side. 450 minus 375. See, receipts from the 450 minus 375. Next, contribution to fair. Similarly, with fairs, we also had one more thing, 600. Payments is 600 and contribution is 150, which is more expenditure. So, we will record this on the expenditure side, 600 minus 150. To fair expenses. Clear with this? Next, printing and office done, repairs to equipment, honorarium also done. Then we had balance at bank as per passbook, deposit account 4635, current account we anyway discussed, and cash in hand. We will write this 4635 and 375 in the closing balance sheet. 4635 and 375. Then on the receipt side, there is sale of equipment, that is also considered. Net proceeds of variety entertainment. This is a normal income receipt. So 1170, we will enter it on the income side. Proceeds of variety entertainment 1170. Next, donation for forthcoming tournament. So this indicates that there is a maintenance of tournament fund. So we cannot write this in income and expenditure. We will directly show it in the balance sheet, 1500. See here, tournament fund 1500. Clear? Next. We have completed on receipt side. Payment side, groundman's fees there 1125. Then ground rent 375. This is only pending. So we will enter this on the expenditure side, groundsman's fee and ground rent. All points considered. So after entering all of these, you can just find out the excess balance. So in this question, we will get surplus 60 rupees added to the capital fund and then find out the total of closing balance sheet. As I mentioned, this is a very good question for your practice. You have to look at the time and maintain to solve the complete question in order to secure the complete marks. Yes. Moving on to the next part of the question. A, B and C are partners sharing profits and losses in the ratio of 2:2:1. Their balance sheet as on 31st March is as follows. The partners have agreed to take D as a partner with effect from 1st April 2024 on the following terms. D shall bring 7,500 towards his capital and required sum of goodwill. The value of stock should be increased by 3750. Provision for bad and doubtful debts 10%. Furniture depreciated by 10%. Value of land and building should be enhanced by 20%. The value of the goodwill is fixed at 22,500. So they are giving us the firm's goodwill. General reserve will be transferred to partners' capital. The new profit sharing ratio of A, B, C, and D shall be 5 is to 5 is to 3 is to 2. The outstanding liabilities include 1,500 due to R, which has been paid by A. Necessary entry was not made in the books. You are required to prepare revaluation, capital accounts, and balance sheet as on 1st April. So, first of all, few points to understand, and rest all is easier here. D shall bring 7,500 to its capital and required sum of goodwill. That means here they're not specifying how much he should bring, but D is only bringing. In some cases, there will be partners who's not getting only capital and they are just valuing the firm's his share of goodwill. So that is a different scenario. In this case, they are clearly specifying that he is bringing his share of capital and also the required share of goodwill. Now they are giving us the firm's goodwill. They have not given any future share of profits, but they are mentioning in the form of new profit sharing ratio. We can easily find out the partner share of goodwill. See here 22,500 into new partner share is 2 by 15. So 22,500 into 2 by 15. So this will be 3,000. His share of goodwill will be 3,000. So totally he is bringing capital along with goodwill. So that will be 10,500. Clear with this? Now, first step is to complete your revaluation account. Value of stock increased by 3750 means on the credit side of revaluation, provision for bad and doubtful debts should be provided at 10% of debtors. Debtors is 8,250, so 825 on the debit side. Furniture should be depreciated by 10%, 975 on the debit side. Value of land and building enhanced by 20%, 37,500 on that 20% is 7,500 on the credit side. Then general reserve will be reflected in the partner's capital. The outstanding liabilities include 1,500 due to R has been paid by A. So this R is an outside party, A is our partner. There was one liability of the firm which is paid by Mr. A itself. So necessary entry was not made in the books. So we will have to record the entry for this. Liability will have a credit balance. When it is paid, the balance will come down. So when it comes down, what will be the entry? Outstanding liabilities account debit. Now if it is settled, we would generally credit bank. Since this is paid by partner A, what will be the entry? To A's capital account. So in capital account, we can reflect this under A's column. Understood this? Yes. So after all this, this becomes just simpler to record the details. Now this share of goodwill will have to be distributed among the partners. In which ratio? Sacrificing ratio. For that also one working note needs to be done. So revaluation account, as we discussed, see observe buy stock because there was increase, and then land and building, provision for doubtful debts, furniture and fittings, and then at the final you will transfer the profit or loss on revaluation to old partners in the old ratio. So then in the partners capital, since we have 4 partners, the institute has presented the solution in the inverted form. So we can just observe this. By balance brought down. Just a minute. So you can likewise consider this as equivalent value. By balance brought down 18, 18 and 7,500. There was a general reserve of 9750 distributed in 2 is to 2 is to 1 ratio. So that is done here. By general reserve, then remember one thing, outstanding liabilities to A's capital, that is what is shown here. There was a revaluation profit that is also transferred to all 3 partners. Then there was new partners capital introduction. Along with that, there is share of goodwill. So I totally written there at 10,500. That is what is written. By cash So you can also write it as by cash or bank to partner's capital, that is to D's capital 10,500. See, as per the examiner's comment, this is what majority of the students have missed. Students have only taken the share of his capital and not goodwill. The question is clearly writing he's bringing a share of capital along with goodwill. So we have to add both the figures here. Clear with this? Now, the last point to adjust here is about the goodwill treatment. So let's understand this. So old profit sharing ratio was 2 is to 2 is to 1. A, B, C. Old ratio minus new ratio. 2 by 5 minus new profit sharing ratio was 5 is to 5 is to some 3 is to 2. So 5 by 15. LCM between 5 and 15 will again be 15. 5 3s are 15, 3 2s are 6, minus 5, 1 by 15. For B, 2 by 5 minus 5 by 15. So this will again be same, 1 by 15. For C, 1 by 5 minus 3 by 15. 15. 5 3s are 15. 3 minus 3. So 0. So there will only be two partners who will be sharing the proportion of goodwill. So 3,000 will be distributed equally as 1,500 and 1,500. What will be the journal entry? D is the new partner. He will be providing to old partners. So D's capital account debit 3,000 to A's capital account to B's capital account. So this will be 1,500 each. This will what be reflected in your partner's capital account. D's capital to A's capital and to B's capital 1,500, 1,500. And then by D's capital in A's and B's column 1,500, 1,500. This completes your capital account. And then take this closing capital balances to your balance sheet. Consider all the revaluation impacts, and then in the bank balance, make sure you will add up the share of partners capital and goodwill. To just show you, see in the question, bank balance was given as 1650. Total 10,500 is what is bought. So your revised bank balance in order to appear in the balance sheet will be 1650 plus 10,500. This is 12,150 plus 10,500. How am I getting 10,500? 7,500 was a share of capital. 3,000 was his proportion of goodwill. So as I'm stressing, this is what the examiner has highlighted, that most of the students have forgotten to take 3,000 as the share of goodwill here, to the share of which is getting credited to bank or cash balance. And one more case is many students have committed mistakes in calculating sacrificing ratio. The objective is simple, guys. Sacrificing ratio, just use the formula old ratio minus new ratio. Old ratio is available to us in the question. New ratio is also provided to us in the question. Simple calculation you can do. You can either solve it if you have understood like this, or you can also follow this as per the institute approach, and then just find out the proportion and enter that in the partner's capital account. Relatively, this question was simpler if you are easily able to crack such points. That's it. So for the balance, cash and bank balance, Institute has also given a separate working note. You can also observe this to understand it better. Right. Moving on to the next question. Question number 4. Amal, Bimal and Kamal were in partnership, sharing profits in the proportion of 3 is to 2 is to 1. The balance sheet of the firm as on 31st of March was as under. So capital account balance, other liabilities and assets is given. Fine. Amal had been suffering from ill health and gave notice that he wished to retire. So Amal is getting retired. An agreement was therefore entered into as on 31st of March, the terms of which were as follows. The profit and loss account for the year ended 31st March 2024. This was which year? 31st March 2024. They are talking about the current year itself, which showed a net profit of 1,50,000, was to be reopened. Bimal was to be credited with 30,000 as bonus in consideration of the extra work which had dealt upon him during the year. The profit sharing ratio was to be revised to enable partners to share profits and losses equally with effect from 1st April 2023. Now understand this point carefully, guys. They are trying to adjust, reopen the profit and loss account closed as on 31st March 2024. Now this showed a net profit of 150. What is the revision they want to make? They have to give an additional bonus to another partner named Bimal by 30,000. Now after this distribution, the remaining profits will be shared to partners equally. So this is the impact which will result to the partners' capital. Done. Next, goodwill was to be valued at 3 years purchase of the average profits of the preceding 4 years. The following were the amounts for past 4 years given. So they are giving us the details. We have to find out the firm's goodwill. Next, fixtures were revalued at 1 lakh. Building was to be appreciated by 10%. Inventories were to be written down by 25,000. Provision of 2.5% was to be made for doubtful debts, and the remaining assets were to be taken at their book values. Bimal and Kamal agreed as between themselves to continue the business, sharing profits in the ratio of 3:2. The amount due to Amal is to be transferred to his loan account to be settled later. So this is the new profit sharing ratio after retirement. Now you are asked to prepare revaluation account and then partners capital account. So revaluation account, this complete point helps us to prepare. See, fixtures were revalued at 1 lakh. So fixtures were showing at 1 lakh 25. So you are write this 25,000 on debit side. Building is appreciated by 10%. Building is 3 lakh. 10% means 3,000 on the credit side. Then inventory is written down by 25,000 on the debit side. Provision of 2.5% was to be made for doubtful debts. So debtors are 1,90,000. On that, 2.5% means 4,750 on the debit side. So there are 3 debits and 1 credit. So let me show you the revaluation account. See, 3 debits and 1 credit. 1 credit. So there is a loss which is transferred to partners. Now observe one thing very, very carefully. We are doing this as on 31st of March 2025, right? Now, as per the agreement after retirement, what does the question say? The profit sharing ratio was to be revised to enable the partners to share profits and losses equally. Now, after they reopen this profit, they are deciding on the profit sharing ratio to be equal. Be very, very careful here. Examiner has emphasized this point that most of the students have failed to notice this, and they have shared the loss on revaluation in this ratio, which is not at all correct. So since the partners have come to consensus on the agreement, the new profit sharing ratio will be an equal ratio. Therefore, your loss will be apportioned equally. So 24,750 is the loss which will be shared equally among all 3 partners. This is one important point to take care in this question. Now they are also asking us a partners capital account. So since there are 3 partners, the firm is again, institute is again presented in this format. So we will first open by balance brought down, bring down all the balances. Then in this question, there was no any reserves. So there is one point. First point is very, very important. What does it say is profit 1,50,000 when it had happened, they would have shared it between the partners. Yes or no? Now, first of all, this has been called back. So for calling back, what is the entry? This was an entry belonging to last year. So we are doing it in the current year. We cannot reopen again profit and loss account. So we will bring a separate account called as profit and loss adjustment. When the profit was distributed, you would have credited the partner's capital. Now we are calling it back. So what will be the impact? You will debit all the partners' capital account. So there are Amal, Bimal and Kamal. So what will be the entry? Amal's account debit, Kamal's account debit, Bimal's account debit. So first is Bimal and then Kamal. So we are calling it back. So this will be 2 profit and loss adjustment account. So what is the total profit? 1,50,000. Now when they are calling back, they are still shared the profit in this ratio, that is 3 is to 2 is to 1, yes or no. So we will call back in the same ratio. What was the profit? 1,50,000. 1,50,000 into 3 by 5, 3 is to 2 is to 1. So this will be 3 by 6. 1,50,000 into 3 by 6, this is 75,000. 1,50,000 into 2 by 6, 50,000. 1,50,000 into 1 by 6, 25,000. So this will be first called back. So that entry you would observe here in the partner's capital. See, all partners capital to profit and loss adjustment means to profit and loss adjustment. You can see the same value 75, 75, 50 and 25. Now, why did they reopen? They want to give the bonus amount to Bimal. So, when they are declaring the bonus, what will be the entry? Bimal is receiving, so his partner's capital account will be credited. So, the entry here will be profit and loss adjustment account debit to Bimal's capital. They are giving 30,000 rupees as bonus, so that will be entered here. So in, if you have to reflect this in the partner's capital by profit and loss adjustment. So do you observe this? Yes. Now after distributing, the balance profit will be shared equally. This is what is written in the question. 1,50,000 was the total profit. We have given 30,000. Bonus is an expense to the firm, so this profit will come down. So we'll reduce 30,000. Remaining is 1,20,000. If I have to share this equally among all three partners, 40, 40, 40 will be divided. So what is the transfer entry? Profit and loss adjustment account debit to Amal's capital, Bimal's capital and Kamal's capital. So that is what the entry you will find here. By profit and loss adjustment, 40, 40 and 40,000. Is this clear? In this question, this was the one of the important adjustment. Next one is your goodwill. So this is done. Now, in this question, goodwill, we will have to calculate. They are giving us the details of profit. So, this year's profit is fine, this is fine, this is fine. Remember, 1,50,000 is not the actual profit. We now just now revise. What is the total profit corrected one now? It is 1,20,000. We will have to take that one to our calculation. So, 1,15,000. So, no other details are given and there is no trend also observed here. 1,25,000. So we will do it on a simple average basis. 1,40,000 plus 1,20,000. Why there is no trend? Because after 140 it is again becoming 1,20,000 divided by 4 years. 1,15,000 plus 1,25,000 plus 1,40,000 plus 1,20,000 divided by 4 years. This will be 1,25,000. Multiply with number of years of purchase is 3 years into 3. This will be 3,75,000. This is your firm's goodwill. We want the partner's share. 3,75,000 into what is his share? What is the revised profit sharing ratio? Careful here. This is 1 by 3. So 1,25,000 will be his share of goodwill, which will be apportioned in gain ratio. See here, 3,75,000. This is the firm's goodwill and Amal's share is 1,25,000. So we need to calculate which ratio? Gain ratio. How will I calculate gain ratio? New ratio minus old ratio. New ratio is given to us in the question. The partners have agreed that they will share the further proportion. In what proportion? 3 is to 2. So this is our new ratio. Old ratio is equal. 1 is to 1 is to 1. So we will have to calculate the gain ratio for Bimal and Kamal. New ratio is 3 by 5 minus 1 by 3, 2 by 5 minus 1 by 3. So 5 and 3, 15. 5 3s are 15, 3 3s are 9, minus 3 5s are 15. So this will be 4 by 15 and 15 here. 5 3s are 15, 3 2s are 6, minus 3 5s are 15, 5, 1 by 15. So gain ratio will be 4 is to 1. So this 1,25,000 will be apportioned in 4 is to 1 ratio. So what will be the journal entry? This is the retirement. So gaining partners capital account debit to retiring partners capital. Who is gaining? Bimal and Kamal. Bimal's capital account debit. Kamal's capital account debit to Amal's capital account. This will be your entry. So this will be reflected in your partner's capital account. So Bimal Amal to Kamal's capital. That is what you can observe here. By Bimal to Amal, 4 is to 1 ratio, and to Amal in the Bimal and Kamal's column. So after doing this, they have told that the amount which is liable to Amal will have to be transferred to his loan account. So we will consider all of the values and transfer the existing due to his loan account. And this completes your question. The question is clearly asked only for revaluation account and partners capital. To revise, make sure of the two important points. One is about calling back the profit, declaring the bonus, and then sharing again. Then taking the revised profit balance for your calculation of goodwill. So that is one thing important, and then it will be calculation of gain ratio. I hope this question was comfortably understood to all of you. Practice once carefully, completely from your end as well. Next question in the same subpart. The balance sheet of ABC as on 1st April 2024 was as follows. So there are details of assets and liabilities. During 24-25, his profit and loss account revealed a net profit of 8,37,500. This was after allowing for the following. Commission paid to selling agent, discount received from creditors, purchased a vehicle of 62,500, depreciation on furniture and fixtures at 10% and on vehicle 20%, provision for doubtful debts at 3% of trade receivables as at 31st March, but while preparing the profit and loss account, he had forgotten to provide for. So there is a detail of given profit and loss account which revealed a net profit, but they have not considered these two values, prepaid expenses and outstanding commission. His current assets and liabilities were inventories, trade receivables, cash at bank and trade payables. During the year, he introduced further capital of 3,75,000. You are required to prepare the balance sheet as of 31st March. To be precise, this is the very easiest question. They're just asking us to prepare a balance sheet considering the relevant adjustments. So first we can record the details as it is given. So balance sheet as on 1st April is provided, and here there are closing details. So we will take up all of these inventories, trade receivables, 1 lakh, 16 lakh 25. This should be taken after provision of 3%. See here balance sheet as on 31st March. Furniture and fixtures detail is given. Opening, see where is it given? In the opening balance sheet here, 8,12,500. So then there is vehicle 3,43,750. In the question, there is one more additional vehicle being purchased. Remember, this is purchased on 31st March. So depreciation is also given. Depreciation will not be considered on 62,500 because this vehicle is purchased as on 31st of March. For vehicle, we will add. So furniture depreciation is at 10%. So that is what is considered here. And vehicle additions is shown 62,500. Depreciation is at 20%. Now observe carefully. 3,43,750 on that 20% will only be your depreciation 68,750. Why not on 62,500? Understand logically, guys. This is purchased as on 31st March. So we are preparing this as also as on 31st of March. No depreciation will come. Examiner has clearly highlighted this that most of the students have also taken depreciation here without focusing on dates. So be careful about this point. Next, there was trade receivables and there was provision at 3% on this. Sorry, 2.5% on this. No, how much percentage? So trade receivables 3%. So on 16 lakh 25,000, 3% will be 48,750. This is at 3%. Then there is inventories details given. Two items were not at all considered. This will have an impact in my profit. CC 8,37,500. Prepaid expenses is a receivable. So I will first of all show this on the asset side. This expense was not belonging to the current year, so I will have to reduce 18,750. Outstanding commission expense belonging to the current year but not received, so I will have to add this 43,750. This is my liability expense not paid, shown on the liability side. So my revised profit will be 837,500 minus 18,750 plus 43,750, 8,62,500. This will be considered 8,62,500. So we have considered provision at 3%. Now there is a profit balance given, net profit of 8,37,500. Two items were missed to take. So we will have to consider this impact as well. 8,37,500. Now observe carefully. Now the confusion here would be, should we consider this as the opening balance or closing balance? If you read the question carefully, there are other details, current assets and liabilities details as on 31st March, separate categories given. So here they are not mentioning any date. So we will consider this to be as the opening balances and accordingly make the relevant treatment. So opening prepaid expense. This was belonging to the current year. So I will have to add this to my current year profit. Likewise, opening outstanding commission. This was not belonging to the current year. So I will have to subtract 43,750. Prepaid expense is a receivable. So I will show it on the asset side, and commission is my liability. I will show it on the liability side. So considering those, my revised net profit will be 8,12,500. For this, they have also prepared the working note. Accordingly, you can refer this too. So as I mentioned, prepaid expense shown in the balance sheet, outstanding commission 43,750. Assuming this is still outstanding on the closing date as well, hence it is getting reflected in the balance sheet. I hope this is clear. Remaining all other entries entered, and then you can finally appear at the total of closing balance sheet. As I told while we read the question was pretty simpler. You have to just work on the points which we discussed. Careful and clearly solved. Next question. On 1st July 2022, Maritime Limited purchased second-hand machine for 1,20,000 and reconditioned the same by spending rupees 18,000. On 1st January, a new machine was purchased for 72,000. On 30th June 2024, the machine purchased on 1st Jan 2023 was sold for rupees 48,000 and another machine was installed at a cost of rupees 90,000. Rate of depreciation is 15% on original cost every year. Show the machinery account from 1st July 2022 to 31st March 2025. So this is just asking us to prepare the machinery account. So here there was on 1st July second-hand machine purchase. The cost was 1,20,000. Some reconditioning expense was also there, which will also be added to part of your cost, 18,000. And then on 1st January, new machine was purchased, 72,000. On 30th, the machine purchase was sold and another machine was installed at a cost of 90. Let's record all of these in the machinery account. See, first on 1st July, second-hand machinery when it is purchased, machinery account to bank would be the entry 1,20,000 plus 18,000. So to bank 1,80,000. Okay, they have written it separately. You can also show it together, not at all a problem. In the same year, another machine was purchased, but that was on 1st of January. So for that also, to bank 72,000. So we will have to record close this by depreciation for this particular year. 1,20,000 plus 18,000. The total cost is 1,38,000 on this 15%. But this was done as on 1st of July. So July, August, September, October, November, December, Jan, Feb and March into 9 by 12. So it will be 15,000. 15,525. This is on machine number 1. Then machinery 2, 72,000. It was purchased as on 1st Jan 2023. So Jan, Feb and March, 3 months, 72,000 into 15% into 3 by 12. This will be 2,700. So total will be 18 to 25. So this is the breakup. For this, there is also a working here. You can observe this likewise. This is where you are getting the total 18 to 25. This was for the first year. Second year, that is 31st March 2024, you had a closing balance of 162.75, total of two assets. So you will bring it down, and then in the current year, there is a machinery getting sold. This was about the machine which was purchased as on January. So for this, before the machine is getting sold, we have to charge the depreciation. Observe carefully, 72,000, 2,700 written down value as on 31st March 23 will be 69,300. But be careful, the method of depreciation here is original cost. So 72,000 into 15% will be the depreciation for that particular year, 10,800. Then your written down value is 58,500. This is getting sold in the month of June. So there is April, May, June. The asset is still present in the business for 3 months. So 72,000 into 15% into 3 by 12. So 2,700, because this is original cost method, into 15% into 3 by 12. So 55,800. The asset is generating a sale value of 48,000. It is lesser, so there will be loss. So your entire journal entry will be bank account debit, profit and loss account debit to machinery account. So depreciation is also considered. Depreciation on machinery sold, bank account, and then profit and loss account. Clear with this? Now in the same year, there was another machinery purchase for 90,000. So now there is original machinery and one more machine which is purchased. Remember, the cost of that machine is 1,18,000 plus 15%. So that is 20,700 plus. This machine is purchased at 90,000 into 15%. July, August, September, October, November, December, Jan, Feb, March. Again, 9 months, 9 by 12. So this will be 1,000, 10,125. 20,700 plus 10,125 will be 30,825. So after calculating this, we will have balance carried down. So you will just enter this. So they are asking us the value of machinery account for 2 years. That is what is done. I hope all the steps which is explained is clearly understood. You can also refer the working note for whatever we discuss. The same thing is provided. Next. Attempt any one of the two subparts. So there is internal choice available here. First, for mutual accommodation of himself and Gagan, Aman drew upon Gagan a bill of 7,500 at 3 months on 1st April 2024. Gagan accepted the bill and returned to Aman, who discounted it immediately at 8% per annum. Be very careful when such things, percentages are given, because bills is valid only for 3 months and they also mentioned this in the question. According to agreement, Aman and Gagan share the proceeds as 2:1. On the date of maturity, Aman remitted his share to Gagan, who honored the bill by payment. Show journal entries in the books of Aman and Gagan. The point is very simpler. There is a bill drawn for the purpose of accommodating one another. So we will have to record the entries in both. So first in the books of Aman and then in the books of Gagan. So in the books of Aman, the bill is drawn as on 1st of April. When Gagan is providing the acceptance, for Aman it will be bills receivable. So the entry will be bills receivable account debit to Gagan. As soon as the bill is accepted, that has been remitted to bank and he got it at a discount. Remember, they had given the percentage of discount at 8%. So this is on bill of 7,500 into 8% per annum. But we are only looking it for 3 months. So into 3 by 12. This will be 150. So here only they have given us the working. So this is what you will observe. 7,500 into 8% into 3 by 12. Clear with this? So this is done. So the entry for this will be bank account debit, discounting charges account debit to bills receivable account. So this is done in the books of Aman. Likewise, for these two entries, we can reflect in the books of Gagan as well. So for Gagan, it will be bills payable. So Aman's account debit to bills payable will be the first entry. Then after the bill is discounted, this is to be shared in the proportion of 2:1. So we are receiving how much? 7,350. Gagan is to be paid. So Gagan account debit to bank to discount. So 7,350 into 1 by 3. That will be 2,450. 7,350 into 1 by 3. Likewise, 150 into 1 by 3 will be 150. I hope this entry is understood. And last, they will remit their share. So the entry as on due date will be Gagan's account debit to bank with the amount due 5,000, 5,000. How are we getting this? Observe carefully. The bill value was 7,500. Anyway, we've already given 2,500. So how much is remaining? 5,000. So that is how we are getting this 5,000. Now this amount bank account. So likewise we receive bank account to discount to Aman. That is what is written. Bank account debit to Aman. So after the share is being received, the bill is outstanding from the Gagan's point of view. He will clear it by remitting the amount. So the entry for that will be bills payable account debit to bank. I hope you understood the entire chain. First for the acceptance of bill, then discounting, sharing between them, and then the remitting of his share. Likewise, these entries are reflected in both the parties' books. Clear with this? Yes. Then, next question. The following are some of the transactions of digital stores for the year 24-25 as per their rough book. Sold to Alpha Industries, 10 laptops at 77,000 per laptop, 5 laser jet printers at 21,000 per printer, less there is trade discount. So 10 laptops into 77,000 will be 7 lakh 70,000 and 5 laser printers at 21,000 each will be 1 lakh 5,000. Total of this will be 8 lakh 75. Upon this 15% trade discount will be 1 lakh 31,250. So your net amount will be 7 lakh 43,750. Then sold old furniture to Singh Consultants on credit. This entry will not come because this is their sales book and this is with respect to assets selling. This will appear in journal prop. Next, sold 20 desktops to Brown and Co. per desktop on credit. So 20 into 34,000, 6 lakh 80,000. You'll enter the respective party name in the format. I will just show you once we complete reading this. Sold 10 tablets to Goku Institute at 7,000 per tablet for cash. Cash entries will not appear. This is a subsidiary book. Only credit transactions will be considered. So this also will not come. Sold on credit to JAT Industries, 50 mobile phones at 25,000 per mobile phone. So 50 into 25, this will be 3,75,000. 10 external hard disk into 4,500 per hard disk. This is 45,000. Total 4,20,000 at 10% discount will be 42,000. 3,78,000. So 3,78,000 plus 6,80,000 plus 743,750. This one 18,17,50 will be total of your sales day book. You have to just give note 18,1750. Cash sale and sale of furniture is not entered in sales day book. Just present that details in the particulars column with the party's name and the description of the product. I hope this is clearly understood. This completes your fifth question. No, not yet. There is C. Following notes pertain to the balance sheet of PQR Company Limited as of 31st March 2024. So they've given the capital details and then on 30th April, the company has made final call at rupees 30 each on 1,50,000 equity shares. The call money was received by 31st of May. Thereafter, on 1st July, the company decided to issue bonus shares at the rate of 3 equity shares for every 5 equity shares held by way of capitalizing its reserves. It decided that there should be minimum usage of balance in profit and loss account. So they've given the profit and loss account balance. They want it to minimally used for the purpose of bonus issue. On 1st October, the company issued right shares at the rate of 1 equity share for every 5 shares held. Here the bonus ratio is 3:5. Right ratio is 1 share for every 5 shares held on that date at a premium of 10%. All the right shares were accepted by the existing shareholders and the money was duly received by 31st of October 2024. Show necessary journal entries in the books of the company for bonus issue and rights issue. Also prepare notes on share capital and reserves and surplus relevant to the balance sheet after the issue of bonus shares and right shares. So the entire topic one is for bonus issue and right issue, and along with that they're asking us the notes for balance sheet. A simpler questions if you know the concepts clearly for 10 marks, because this is given a good weightage. Now first of all, as per the bonus concept, only fully paid up shares can be provided with bonus issue. So there is still 30 to be paid up. The question is clearly telling the company has made the final call and the call money was also received before bonus issue. We have to make this entry. We have to first make it due. What is the due entry? Equity share final call account debit to equity share capital. 1,50,000 shares at 30 rupees each as on 30th April. So let's observe this entry. See here, as on 30th April, equity share final call to share capital. On 31st of May, all money was received. So bank account debit to equity share final call account. Clear with this? 45 lakh, 45 lakh. Now next, after making this, now all the shares are fully paid up. How many are the total number of shares? Only equity shares will get the bonus issue, 1,50,000 shares. So what is the bonus ratio? 1,50,000 shares into 3 by 5. So 1,50,000 into 3 by 5 will be 90,000 at rupees 100 per share. So what is the requirement of bonus? 90 lakh is required. So what all reserves can be utilized for the purpose of bonus issue? Revaluation reserve cannot be utilized. General reserve I can use. Capital redemption reserve can be utilized. Securities premium collected and in cash will matter only for a listed company. In this question, nothing is specified. We can anyway make use of the securities premium balance, and then the balance will go from profit and loss. 90 lakh is the total requirement. See, this is given in lakhs. So first I will make use of 25 lakhs, then capital redemption reserve, then securities premium account, and the remaining from profit and loss. So what will be the journal entry? General reserve account debit 25 lakh, capital redemption reserve account debit 25 lakh, securities premium account debit 30 lakh. So far we have covered 70 lakhs. Remaining 25 plus 25, 80 lakhs is covered. Remaining 10 lakh is taken from profit and loss account. 10 lakh to bonus to shareholders. Now this is done as on 1st of July. So observe the entry, all of you. On 1st July, capital redemption reserve 25, securities premium 30, general reserve 25, profit and loss 10 lakh to bonus to shareholders. Then we'll be issuing bonus shares. Bonus to shareholders account debit to equity share capital. Same 90 lakh. Understood this? Next, they are making a right issue. Now 1,50,000 was the existing shares. By bonus, we have given additionally 90,000. So what is the total number of existing shares? 2,40,000. 2,40,000 is the existing shareholders. So what is the bonus proportion? 1:5. So this will be 48,000 shares again at rupees 100 per share. But these shares are issued at a premium. So what will be the journal entry? Bank account debit to equity share capital to securities premium. Equity share capital will be 48,000 into 100. Securities premium at 11 rupees. So sorry, at 10 rupees again. So 48,000. So that will be 4,80,000, and the total will go to bank account. Observe this. October 31st, bank account debit to securities premium to equity share capital. We have understood how we got 48,000 shares. So this is 48,000 into 100. 48,000 into 10. This will be 48,000 into 110. Clear with this? Understood? This was about the journal entries. Along with this, they have asked us the notes to appear in the balance sheet. Authorized capital was 5 lakh shares. There was no breakup given how much was equity, how much was preference. Now, when we write up issued share capital, remember 1,50,000 was the existing shares. You gave plus 90,000 towards bonus issue and then 48,000 as right shares. So 1 lakh 50 plus 90 plus 48. Totally we have 2 lakh 88,000. That is what needs to be written. 2 lakh 88,000 equity shares at 100 each. You have to give a breakup how that has been coming. 90,000 equity shares at 10 each were issued by way of bonus shares and 48,000 issued at 110 per share. That is a right share proportion. Then we will show how the reserves balance are utilized towards the bonus shares. See, first revaluation reserve, same balance will get carry over because we are not utilizing any of it for the purpose of bonus issue. Then capital redemption, full complete amount taken. Securities premium, we utilize how much was there, but remember from right issue we additionally got 4.8 lakh, so that is revised. General reserve completely utilized and in profit 10 lakh was utilized. Balance of your reserves will be 20 lakh. For all of those shares, here the working note is being provided. I hope this question was easier and you all understood it in a simple manner. Yes, let's discuss the next question, question number 6. R Limited invited applications for issuing 1 lakh equity shares of rupees 10 each at a premium of rupees 2 per share. The amounts were payable as follows. On application allotment, 6 rupees per share. So this also includes your premium. Balance on the first and final call, that is 6 rupees is taken on application and allotment. 2 rupees premium is also included, means how much is the balance? Again 6 rupees. Then applications were received for 2,50,000 shares. The number of shares company issued was just 1 lakh, but in return we are receiving the applications for 2,50,000 shares. Applications for 1 lakh equity shares were rejected and pro rata allotment was made to the remaining applicants. So 1 lakh equity shares were rejected means 2 lakh 50 is the application received. Extra application here is anyway 1 lakh 50. See, requirement was 1 lakh. We have received 2 lakh 50. In that, applications for 1 lakh is being rejected. And the first and final call was made. The amount was duly received except on 3,000 shares applied by Miss Jane. So they have given the applied details. Her shares were forfeited. The forfeited shares were reissued as fully paid up at rupees 8 per share. Pass necessary journal entries to record the above transactions in the books of R Limited. So let's understand the entries from the issue. Then there is pro rata allotment, some refund amount, and then forfeiture and reissue. So first, bank account debit to equity share application and allotment. 1 lakh is the number of issue, but in return you are receiving 2,50,000 shares. So 2,50,000 into 6 rupees. Observe, bank to share application allotment 2,50,000 into 6. Next will be transferring the application money to share capital. Equity share application account debit to share capital to securities premium, because premium is also included here, and you also have the excess money. Remember, this excess money part is being refunded. So to bank, and it will be adjusted with the next installment. What is the next installment? Equity share first and final call. So to equity share first and final call. This will be the complete entry, a very important entry. First, equity share application allotment was credited by how much? 15 lakh. 15 lakh is taken. How much was the number of issue? Only that much will be transferred to share capital. 1 lakh was the number of shares at 4 rupees, because 2 rupees is the premium. So that is what is considered. 1 lakh into 4. And how much is going to securities premium? 1 lakh into 2. How much is refunded? We are telling on 1 lakh it is refunded. Application money was 6 rupees. 1 lakh into 6 will be the refund money. Clear? The balance will be adjusted towards the next installment, that is equity share first and final call money. Is this understood? All of you got this? Yes. So next, what is the next entry? We have to make the next call money due. Share first and final call account debit to share capital. How many number of shares? 1 lakh shares at 6 rupees. So that is what is done. 1 lakh into 6. Next, in this case, now the shares applied, that is 3,000 shares applied by Jane, she didn't pay the first and final call money, and hence it was later forfeited. So what will be the next entry? The receipt of call money. Bank account debit, calls in arrears account debit because some amount is not received, to equity share first and final call. This will be the entry, yes or no? So bank account debit to equity share first and final call, we anyway took 6 lakh, that will only appear here. But now be very careful. Equity share amount final call is 6 lakh, but observe carefully, 3 lakh is already adjusted in the previous installment. So how much is remaining? Only 3 lakh. That is how this 3 lakh is coming. Because 6 lakh due partial adjustment is already done with the excess money received on the application. I hope this is very clearly understood to all of you. Remaining 3 lakh. Now, in this 3,000 shares which was applied by Jane, we didn't receive the call money. Be very careful. Here we have to make one small working note in order to understand how much is actual number of shares being allotted, because based on that itself we can find out how much is due on calls. Observe this working carefully. We are now finding out the number of shares allotted. Number of shares which is issued and allotted by the company is 1 lakh. But the application in excess received is of 1,50,000. So here they have given the details of number of shares applied. So that is nothing but 3,000. If I have to find out the number of shares allotted, I can just cross multiply this and find out 3,000 into 1 lakh divided by 1,50,000. So I will get the details of number of shares allotted. So that is nothing but 2,000 shares. Now, why am I doing this working? Understand this carefully, guys, because in the previous entry, we already adjusted the amount in excess received from application. So this shares will also be part of those. Yes or no? So the balance only can be considered as calls in arrears. For to find out that only we are doing this working. So final call due from Jane. She held how many shares? 2,000 shares which were allotted, not how many applied for. So 2,000 shares. What was the call money? 6 rupees. So this is the final call money due. So you get 12,000. Understood all of this? Now how much is adjusted with final call? How do we find this? We had the total amount 3 lakh rupees adjusted. So that 3 lakh rupees was adjusted towards 1 lakh shares. Yes or no? Now we are just finding this, how much is adjusted towards 2,000 shares. So 2,000 into 3 lakh divided by 1 lakh. So 2,000 into 3 lakh divided by 1 lakh will give me 6,000. Understood all of you this adjustment? So the balance is only my call money due, which is 6,000. So this amount will be taken in the entry 6,000. So the entry here will be bank account debit, calls in arrears account debit to equity share first and final call. So after this, then these shares are getting forfeited. So the company has made the entire call. So the entry will be equity share capital account debit, 2,000 shares which was allotted under complete 10 rupees is being called. So into 10, that will be 20,000 to share forfeiture account, to share to calls in arrears account, because the amount is transferred to calls in arrears. This 6,000 will come and the balance will go to share forfeiture. Now, in this case, this shares is again getting reissued at 8 rupees per share. That means the shares are issued at discount. So what will be the reissue entry? Bank account debit, share forfeiture account debit to share capital. So 2,000 shares being reissued at rupees 8 per share. To share capital will go at face value. So 2000 into 10. So the balance will go to share forfeiture. There was only one part of the share getting forfeited. So the balance amount in share forfeiture will be transferred to a separate account that is called capital reserve. So a transfer entry will be share forfeiture account debit to capital reserve. Share forfeiture had a balance of 14,000 and we have here set off for a discount of 4. So how much is remaining? 10,000 that will be transferred to capital reserve. How are we getting this? 14,000 minus 4,000. Simple. I hope all of you understood. So you can either follow what institute's working is mentioned, or I've just explained here the other way of also finding out the values. This can also be referred. So here the institute has alternately given the treatment wherein you can consider the excess amount which has been available, which is adjusted towards call as calls in advance. So if you do that, instead of crediting to equity share first and final call, you will credit a separate account called calls in advance, and then accordingly the entries calls in advance will here get reversed. So just the replacement of accounts there. Clear? A very good question and a simpler one as well if you've understood, for a good weightage of 15 marks. Next, Define measurement and valuation principles in brief. So this is again a straightforward theory question. Whenever the concepts of measurement and valuation comes, remember the four concepts strictly, but additionally here there are these 3 points also emphasized, and the examiner is also clearly communicated. Most of the students have failed to write about this. They have given the step marking for this as well. So what does these points say is measurement is a vital aspect of accounting, because without measurement we cannot quote any sort of values in the books of accounts. Primarily transactions and events are measured in terms of money. So this is the basic approach. Any measurement discipline deals with three basic elements of measurement. What are those? Identification of objects and events to be measured. What is the proportion or base to identify to measure the objects or events? Then selection of standard or scale to be used, and last, evaluation of dimension of measurement standard or scale. So these are the three basic measurement points: evaluation of dimension and selection of standard or scale, like per unit or kg liter. That is what the selection of standard or scale. And then evaluation of dimension, in what tons or quantity we will have to evaluate. These will be your basis for measurement. And then later on, four generally accepted measurement basis or valuation principles will be your historical cost, current cost, realizable value, and present value. We have to just explain this in detail. Historical cost, it basically means our purchase price or acquisition price. According to this concept, assets will be recorded at the amount of cash or cash equivalents paid. This will be for the assets. Likewise for the liabilities, which is to be proceeds received in exchange for the obligation. This is for historical cost. Then current cost, again we will rewrite it is in the form of assets and liabilities, but here there would be usage of words like that would have to be paid, and for the liabilities that would be required to be settled. This is the change of words which you should observe and incorporate in your answers. Then realizable value. Whenever any assets are expected to be sold, so as the amount what we expect to realize that could be currently obtained by selling the assets. Likewise, when it comes to liabilities, when we are expecting to settle the liabilities, what is that value? That is called as realizable value. At last, that is present value. For assets, we take the discounted cash inflows on the expected future returns. For the liabilities, we take it on the future net cash outflows. See, for the assets, it is future net cash inflows, and for the liabilities, future net cash outflows. This was the straightforward question, guys. So I know most of the students will definitely ignore theory, but such straightforward questions are simpler. Just invest minimal time as possible and know these points in order to not lose out on these simple lines. Yes or no? Yeah. So this completes our discussion of May 2025 question paper. As an overview, it was a pretty simpler paper. If you had a good set of practice, few points were just tricky enough, rest it was easily manageable. This again becomes a good paper for your practice. Make sure you utilize it well. And after you watch this video, I want you to literally solve each of the question. That is when you realize whether you have got it or clearly all the concepts or not. So until I see you in the next video, keep trying hard, keep putting the best efforts, guys. All the very best and take care. Hello champs, hope you are doing amazing. In this video, let's discuss January 2025 CA Foundation Accounting Exam question paper along with ICAI suggested answers. Meanwhile, as we run through the question, I'll also give you any respective presentation tips or notes which definitely fetch you that complete marks as you attempt the respective points or questions. So let's begin the session and make it most effective and impactful, guys. So first part of the first question, true or false. So we need to answer whether the given statement is true or false along with the respective reasons why you are telling it is either true or false. First one, matching concept is based on accrual concept. This matching concept and accrual concept is part of our accounting concepts. Yes, matching concept is based on accrual concept. The given statement is true. The reason being, in order to understand matching concept, we first obtain the understanding of accrual concept, which emphasizes also on occurrence of events or transactions, wherein matching concepts collides with recognition of or matching the respective expenses along with the current income or gains. So therefore, matching concept is based on accrual concept. Second one, customers of business should not be considered as users of accounts prepared by business. They're not interested in knowing the performance of the business. The given statement is false. As per the list of users of accounts, customers also become one of the core user of accounts. They are mainly influential in order to consider the stability or progress of profitability of the enterprise, because ultimately for any business, supply of goods or services for that matter being purely depends on the customers. Hence the users also includes customers, and they are interested, they should be considered in knowing the performance of business. Next question. Under inflationary conditions, FIFO will not show lowest value of cost of goods sold. The given statement here is false. There are different methods of maintaining inventories, like we have first in, first out, last in, first out, and weighted average, under which we have simple average and weighted average method. So, as per the inflationary conditions, LIFO and weighted average will not show the lowest value of cost of goods sold, because inflationary means price starts at its lowest and then it increases. First in, first out progresses on what goods are sent first, that will be. Next question. Under inflationary conditions, FIFO will not show lowest value of cost of goods sold. The given statement is false. Under inflationary conditions, the other two methods like last in first out and weighted average will not show the lowest value of cost of goods sold. To understand this better, see, inflationary conditions mean prices start from lowest to the highest. It keeps on increasing. Under first in first out, we provide importance for the price of goods which are bought first will be sent out first. So in this case, the lowest value of cost of goods sold cannot be observed under FIFO when there is inflationary conditions. Hence, the given statement here is false. Next statement. For redemption of preference shares, proceeds from fresh issue of equity shares and debentures can be utilized. The given statement is here again false. As per section 55 of the Companies Act 2013, for the purpose of redemption of preference shares, the company can use the sources like either make fresh issue of equity shares, or if there is any undistributed profits available, through which we have to create first capital redemption reserve that can be utilized for the purpose of redemption of preference shares. In the given statement, they have anyway mentioned about fresh issue of equity shares, but along with that, they've also given debentures, where debentures cannot be utilized. Hence, the given statement is false. Next point. Bookkeeping and accounting are not synonymous terms. They are different from each other. Yes, the given statement is true. Bookkeeping and accounting are not same. They are definitely different from each other, because bookkeeping mainly focuses on recording of transactions, whereas accounting precises on summarizing of the entire transaction. There is also a statement in the material which we can observe this: accounting starts after bookkeeping ends. So that is why it is not same. Hence, the given statement is true. Next, a ledger is also known as the principal books of accounts. Yes, the given statement is again true, because ledger helps us to identify or classify the respective accounts. So this becomes a principal or primary book to go ahead with preparation of final accounts. Hence, this is the principal books of accounts. Therefore, the given statement is true. So let's observe what is the answers given as per the institute. See, first one, true. Matching concept is based on accrual concept, as it considers the occurrence of expenses and income and do not concentrate on actual inflow or outflow of cash. That's what I expressed about occurrence of expenses. Next, customers are concerned with stability and profitability because their functioning is dependent on the supply of goods. This is what we discussed. Hence, customers are users of accounts which is prepared by business. Third, it was under inflationary conditions, LIFO and weighted average will not show lowest value of cost of goods sold, whereas FIFO would. So therefore, it was false. And next, redemption of preference shares can be done either from the proceeds of fresh issue of shares or by capitalization of undistributed profits, that is by creating capital redemption reserve, or it can also be through combination of both. But the proceeds from issue of debentures cannot be utilized for the purpose of redemption of preference shares. Next, bookkeeping and accounting are different from each other. They are not same. This is bookkeeping is on mainly focused on recording phase, whereas accounting is concerned with summarizing phase. As I explained, accounting starts where bookkeeping ends. Clear? Next, ledger is a principal books of account. Yes, it is true since it classifies all the amounts related to particular account and then it is used as the base for preparing the trial balance. Therefore, it is known as principal books of accounts. I hope this was all comfortable with true or false. Next question. Explain four main functions of accounting. Again, a straightforward theory question. They are asking functions of accounting. Probably most of the students would be aware of the pointers. You have to just take care of how you explain about this. Functions of accounting includes measurement, decision making, comparison, evaluation, control, forecasting. All these points will become your functions of accounting. Now you can observe there are few explanations also required. We will understand that here. The main functions of accounting includes measurement. This measures past performance of the business entity and depicts its current financial position, because that is how we estimate. Then forecasting, it helps in forecasting future performance and financial position using again past data and analyzing the trends. This is nothing but predicting about what could be the probable sales or probable expenses. I'm just giving you some examples to take care of this point. Next, decision making. Accounting provides relevant information to the users of accounts to aid rational decision making, because this is where the users of account consider looking at the books of accounts or how it is being presented. Next could be comparison and evaluation. Accounting assess performance as achieved in relation to targets and discloses information regarding accounting policies and contingent liabilities, again which play an important role for making a wise decisions with respect to prediction, comparing and evaluation of your financial results for an user of financial statement. Then control. Accounting also identifies weaknesses of the operational system and provides feedback regarding effectiveness of measures adopted to check such weakness. What does this point mean here is, by observing the functions here, how can a business control or take measures could be, it provides us the sufficient information about the conditioning or functioning of a particular system. So this judge us control. So control. Accounting also identifies weaknesses of the operational system and provides feedback regarding effectiveness of measures and adopted to check such weaknesses. So this point emphasizes on this, also helps us in looking at where are the weak points running and what are the measures which we can adopt to improvise the same. That is how it can be controlled. Next would be government regulation and taxation. Accounting provides necessary information to the government to exercise control on the entity as well as in collection of tax revenues. This is how it helps the government to understand what is the revenue structure of the particular business. So these were the points to be written for the purpose of functions of accounting. Next, from the following transactions, prepare the sales return book of K & Co, a ready-made garments dealer. So there are list of transactions given. So first, on 6th December, written receipt from our store 30 shirts at 300 and 15 trousers at 500 each, less trade discount at 10%. So you will prepare this in the format of date, particulars or particulars, details and that amount column. So under particulars, we will write our store. Under that, we will have 30 shirts at 300 per shirt. 15 trousers at rupees 500. So this will be 30 into 300, 9,000. 15 into 500, 7,500. Upon this total, we will have trade discount minus trade discount at 8%. So this will be 1,320. So 15,180 from the first transaction which happened on 6th December. Next, modern tailors returned 10 frocks which were sold for cash at rupees 200 each. Observe this, which were sold for cash. Automatically, when we look at this they are asking us to prepare sales return book. Only credit transactions will be considered. So this transaction will not be entered in the sales return book. Next, on 16th December, written receipt from Tulip store, 12 t-shirts at 100 each. So this will be 12 into 100, 1,200 minus 10% discount will be 120. So this will be 1,180. This is 1,080. So 1,080 plus 15,180. Total of sales returns book will be 16,260. This is how you will present. So as per the respective dates and particulars. We didn't mention one transaction because it was done on cash basis. We will give that as a note. Return of goods sold from modern tailors will not be included in written inward book as the sales were made in cash. I hope this point is understood to all of you. So this completes our question number 1. Let's move to next question. A firm purchased a second-hand machinery on 1st April 2021 for 15 lakh, subsequent to which 2 lakh was spent on its repairs and installation. So since it is together bought and we are spending 2 lakhs additionally on repairs and installation, if I have to look at the cost, so for the purpose of this machinery, the total cost will still be 17 lakh. On October 1st, another machinery was purchased for rupees 9 lakh, that is in the same year, and cost of installing the machine in a new plant is rupees 20,000. Again, this will also be included for the purpose of cost of the asset, 9 lakh 20. The firm also shifted the machinery purchased on 1st April to the new plant and incurred freight of rupees 10,000. See here, there is just a shifting which is happening. Any freight included will not be included as part of the cost because the asset is anyway already bought and installed. So this will normally treated as revenue expenditure and not capital expenditure. They adopted a policy of charging depreciation at 12% per annum on diminishing balance method. First point to consider about the method. Next, on 1st April 2023, it was decided to change the method and rate of depreciation to straight line basis. On this date, the remaining useful life was assessed as 5 years for both the machines. There were two machines which were bought, purchased with no scrap value. On 1st October 23, the first machine became outdated and sold for 2 lakh 50. On the same date, another machinery was purchased for 8 lakh 50,000. The estimated useful life of the machine is 10 years and residual value is rupees 30,000. You are required to prepare the machinery account for the year ending 31st March 2024. So they are asking us for the year ending 31st March 2024. The transaction began from 1st April 2021. So we will have to make the relevant working notes and accordingly present this in the lecture. Fine. So on 1st April 21, 15 lakh plus 2 lakh, and then on 1st October, another machine was purchased. So you have to prepare the machinery account means where will these two transactions comes? On 1st April 2021, machinery to bank 9 lakh and 20,000. Yes. So here they're just giving us the details of 1st April 2023. Let me help you understand this in the working note. Observe here, machinery 1 on 1st April 2021, 15 lakh plus 2 lakh, this will be 17 lakh. So for the year ending 31st March 2022, we will have depreciation at 12% on diminishing balance method. So on 17 lakh at 12% will be 2 lakh and 4,000. Your written down value as on 31st March 2022 will be 14 lakh 96. Now on this at 12%, because the asset revision, the depreciation method revision is happening on 1st April 23. So 14 lakh 96 into 12% will be 179,520. This is clear. So 179,520 out from 14 lakh 96, my WDV will be as on 31st March 2023, 13 lakh 16,480. Now there is revision in the depreciation method. They are changing from written down value to the straight line method, and they are reassessing the number of useful life to be 5 years. So now 1316,480 divided by 5, because there is a change in the method. Now this will be 13,16,480 divided by 5 years should have been done, correct? On 1st April 2023, the change is happening, but there was one transaction. 1st April 2023, they decided to change this. We have understood. On October 1st, the first machine become outdated and sold for 2 lakh 50. That means in between the year, the asset is getting sold. So for this particular thing, we will have to charge depreciation only for until 30th September, yes or no. So now, if I do observe here, divided by 5 years, I will get the depreciation for whole of that particular year. But this asset is getting sold. So how many months the asset is present in the business? April, May, June, July, August. 1st October is where the sale is happening. So September. So there was totally 6 months. So this will be into 6 by 12. This will give me 31 lakh 31,648. I hope all of you understood this. So after I take this out, 16,480, my value of the asset as on which date, 1st October 2023, will be 11 lakh 84,832. I'm getting 2 lakh 50,000 from sale of the asset. So here there is a loss of 9 lakh 34,832. I hope this treatment all of you understood. Yes. Okay, this was about machine number 1. So we will observe what entries are to be understood in with respect to this machine. See, as on 1st April 2023, the WDV from this working note, we can understand 13 lakh 16,480. That will be two balance brought down. I hope this is understanding. For this, there is a depreciation to be taken for 6 months. We just understood the calculation. So that is 1,31,648. When the asset is sold, what is the journal entry? Bank account debit to machinery. The machinery value was 13 lakh 16,480. On this, I've also charged depreciation. So depreciation will be debited. There is a loss on sale. So that will also be recorded. See, by profit and loss account, loss on sale of machinery with the amount of loss, with the amount I got from the sale of the machinery, 2,50,000. I hope this is understood. Next, there was also machine number 2. Now we will observe the entries for machine number 2. Machine number 2 was bought on 1st October 2021. 9 lakh on that they are also spent 20,000. So your cost will be 9 lakh 20,000. On 9 lakh 20,000, 12% is on diminishing balance. Remember, this is on 1st October. So to October to March, October, November, December, Jan, Feb and March. 6 months into 6 by 12, that will be 55,200. I hope this is understood to all of us. So 55,200 from 9,20,000, I'll have a WDV of 8,64,800. The revision is happening as on 1st April 23. On this, 12% for the full year, 1,03,776. So after I take out, my written down value will be 761,024. Now the asset method is changed from WDV to straight line method. And for this asset also, the revision of useful life is 5 years. So this divided by 5. This will be 1,52,205. I hope this is clear. Now after I remove this asset, will have a written down value of 6,08,819.2 you get. We have just taken it as a round of decimal. So let's observe the working for this. So to machine number 2, 7,61,024. We understood how we are getting. This is the written down value as on 31st March 2023. That is on 1st April 2023. So on this, the respective depreciation we are observing. By depreciation, see here machine number 2, 1,52,205. I hope all of you understood how we are getting all of these. Then there was, on the same date, another machine was purchased for 8,50,000. For this, we need to pass the entry. First of all, when the asset is purchased, what is the journal entry? Machinery account debit to bank. So that is done here. 8,50,000. So on this, we have to charge depreciation. Now, when this new asset was purchased, the method of depreciation is already changed. Correct? So see for this 8,50,000, the estimated useful life is 10 years and residual value is 30,000. So what would be the depreciation for this 8,50,000 minus 30,000 divided by 10 years into 6 by 12. Why into 6 by 12? Because the asset is purchased on 1st October. So 8,50,000 minus 30 divided by 10 into 6 by 12. So your depreciation on machine number 3 will be 41,000. So after considering all of these, you will have some balance left out, balance carried down. This is the total of your machine number 2 and machine number 3. This is what all the calculations being done in the working notes as well. So you can either show it here or you can also write it in the working note. That becomes more clear presentation. Also help evaluator to understand the values properly on what basis you have calculated. Now, as we discussed while explaining the question, the treatment about freight, see, they've also mentioned the note. It also becomes important for you to write a note on this. Freight incurred on machinery purchased on 1st April is to be excluded from the cost of the machinery, since this cost is incurred only for the shifting to the new plant and does not increase the operating capacity of the machinery. Those costs which increases the operating capacity will be considered as a capital expenditure. This is a clear understanding or pointers what we have discussed for the purpose of treating capital expenditure or revenue expenditure. Hence, they have given the proper reasoning why freight is not considered as part of the cost of the asset. I hope this question was simpler and easier to understand. Yes. Next part of the question. From the following information, prepare a bank reconciliation statement as on June 30th, 2024 for XYZ Limited. So they are asking us to prepare BRS. Bank column of cash book was overdrawn to the extent of 24,768. So there is an overdraft balance given of the cash book. Let's look whether there is any additional requirement given. No. They have given the list of transactions. So now we can present this either as per balance presentation or plus minus presentation. And there can also be some adjustments you can assume of. If you're thinking that the books of accounts are getting closed on 30th June, you can also prepare adjusted cash book and then present BRS. So this can be solved in different alternative ways. You can do it as per your own comfort. So we will do it as a normal BRS statement considering plus or minus of the respective transaction as per balance method. Okay. So the bank column of cash book is given. That means your base book or starting balance here is cash book balance. Fine. Bank charges amounting to rupees 350 had not been entered in the cash book. Now, if I consider this as my cash book and this book as my passbook, cash book is a book where you can alter. Now, what has happened? Bank charges had not been entered in the cash book. So the entry is already made in passbook. That means the passbook would show a lower balance. If I have to match, I will certainly have to subtract. But since this is overdraft balance, what will I do? I will add back. Clear with this? Next, check amounting to 88,678 issued before June 30th but not yet presented to bank. This is your cash book, passbook. When the checks are issued, you'll automatically make the entry in cash book. The entry is presented in cash book, but it is not presented to bank means no entry reflected in passbook. So if I have to match both the books, I will certainly add the cash book balance because that is my base book. Since here it is overdraft balance, what will I do? I will subtract. Next, one payment of 4,590 was recorded in the cash book as if there is no bank column. Now, some students would feel difficult to first interpret this transaction. What does this actually indicate? One payment. This is your catch point. So this is a payment entry which needs to be recorded. They have not recorded in the cash book is what you certainly understand, because here it is confusing by telling was recorded in the cash book as if there is no bank column. So you will understand this as There was no entry made in the cash book. Now payment means your passbook balance would have come down. Your cash book balance is still standing. If I have to match, what will I do? I will have to subtract. Since this is an overdraft balance, what will I do? I will add. I hope all of you understood this scenario. Next, the company paid 15,500 to a creditor and received a cash discount at 2%. The cashier erroneously entered the gross amount in the bank column of the cash book. See, actually, they had to enter this net of discount. So 15,500 upon 2% means they have to certainly enter 15,190. But what has the cashier done? He has directly entered the gross amount itself. So what is the difference? Difference is 310 rupees. Now the company paid and received a cash discount here means in cash book and passbook both sides the entry has been done. But cash book they have included 15,500 whereas in passbook it is 15,190. So cash book has reduced its balance with the difference of discount amount. In order to match both the book, I will certainly have to add for 310 rupees. Since this is overdrawn, I will subtract 310. I hope all of you understood this. Next, a debit of 5,700 appeared in the bank statement for an unpaid check which had been returned marked out of date. The check had been redated by the customer and paid into the bank again on July 8th. Remember, this transaction is affecting on July 8th, but we are here preparing BRS as on 30th June. So we will understand what is the impact until 30th June. A debit of 5,700 appeared in the bank statement for an unpaid check. That means this check is now out of date. Debit has been happened in the bank statement means the bank passbook is showing a lower balance, whereas there is no entry in the cash book. If I have to match, I will certainly have to reduce. But here, since this is overdraft balance, I will add. There is no entry made in the cash book because this check was returned out of date. If I am the cashier, I will come across this transaction only after looking at the passbook or bank statement. I hope these points are able to understand to all of you. Next, checks deposited in bank but not yet cleared amount to 45,789. When the check is deposited, your cash book balance would be increased. Whereas in passbook, I still have no impact because the entries are not yet reflected because it is not yet cleared. So if I have to match both, I will bring down the balance in cash book. Since this is overdrawn, I will add. Next, dividends of 1,980 collected by the bank was not recorded in the cash book. When the dividends is directly collected by the bank, passbook could show higher balance. There's no entry in the cash book. If I have to match both the book, I will have to certainly add. Since this is overdraft balance, I will subtract. Clear? Next, amount of 2,340 wrongly credited by the bank to company account for which no details are available. Just understand that there is a wrong credit by the bank. When there is wrong credit by the bank means passbook would show a higher balance. There's no entry in the cash book. If I have to match, I will certainly add. Since this is an overdraft balance, I will subtract. Next, on June 25th, 2024, the credit side of the bank column of the cash book was overcast by 6,789. Credit side here means payment side. So credit side of the bank column of the cash book was overcast by 6789. First of all, there is a payment. So overcast means payment is done more by 6789. There's only one 6789 in the passbook. If I have to certainly match both the books, I will have to increase, add cash book. Since this is overdraft, I will subtract. All points understood to all of you? I hope yes. So let's find out the balance as per other book. 24,768 plus 350 minus 88,678 plus 4590 minus 310 plus 5,700 plus 45,789 minus 1,980 minus 2,340 minus 6,789. So your revised book balance will be 18,900. See here, 18,900. We started with the overdraft balance as per cash book. The amount what we are getting is in negative. So this will be credit balance as per passbook. See, we are getting the balance in negative. So this will be balance as per the passbook credit. As I explained you at the beginning of the question itself, you can pass or prepare this bank reconciliation statement in different alternative treatment. I have explained you as per the balance approach, which is the first presentation given by the institute. See here, there is also an alternate options given again by the institute. You can follow whichever you are comfortable with. Alternatively, if the books are to be closed on 30th June, then adjusted cash book will be prepared. In that case, solution will be first you will prepare cash book and then the BRS after taking the revised cash book balance. So accordingly, the respective transaction should be first bifurcated, what comes in cash book and then in BRS. See here, and then alternatively in point 5, it is assumed that the amount paid 15,500 is a net amount. Then the discount will be 316. So if you consider whatever value given is net amount, then you will have to find out what is the proportion on that basis. So then it will be 316. In our question, we got 310. Here there will be an impact of 6 rupees. Accordingly, your solution, that is balance C, it will change, plus 6 rupees gets added, because here if I take 316. And if the books are to be closed on 30th June, again by taking the revised book, that is 316, accordingly there will be a difference coming up. So these are the different treatments how we can solve the bank reconciliation statement. The institute has given the various alternative treatments for this particular question. You can just have a look at how it is being done. I've explained you how it has been considered as well. Clear? Next. Question number 3. From the following schedule of balances extracted from the books of Mr. Piyush, prepare a trading and profit and loss account for the year ended 31st March 2024 and the balance sheet as on that date after making the necessary adjustments. So they are asking us to prepare trading and profit and loss and balance sheet. So when you are solving this question, first open all of the accounts, trading, profit and loss, and then balance sheet. As in when we run through the transactions, it becomes easier to reflect the entries in the respective accounts. So list of all details is given. Then we have adjustments. So this is where your requirement should be first and foremost. We have understood what is asked in the question. Then first look at the adjustment. So then it becomes easier for you to jot down the other points in the question. First, the value of stock as on 31st March 2024 is 7,65,000. What is this? Value of stock as on 31st March 2024 is nothing but our closing stock. Okay. This includes goods returned by customers on 31st March 2024. Goods returned by customers means what? Sales return. Yes, if the goods are returned by customers, it should be part of my closing stock. It is included. There's no problem. To the value of 25,000 for which no entry has been passed in the books. Now understand what is the point here is. 7,65,000 is the closing stock. This already includes the value of goods returned by customers. But for that separate return, that is sales return, entry is not being passed in the books. Now first you have to consider these entries and accordingly take the revised sales respective balances. Closing stock will still be 7,65,000. I hope this point is clear. Now let me open the document side by side and show you how this needs to be presented. Just give me a minute. So here I'm just opening the solution so it becomes easier for you to understand side by side along with the question. I hope this is visible to all of you. Yes. Now for this 25,000 we have to pass the entry. What will be the impact? There is sales return. So sales return account debit to debtors. This will be the journal entry. This entry has not been passed. Correct? Now sales return will come where we have to first deduct from sales. Yes. So the worth of returned goods is 25,000. So sales return minus from sales, and then one more reflection will be from debtors, because the journal entry sales return account debit to debtors. Debtors balance will also come down. Yes or no? So this will also be impacted to my debtors. Now observe. So let's take return inwards here. Return inwards is 1,10,000. Return inwards is nothing but my sales return. Yes or no? So 1,10,000 is the sales return. Additionally, 25,000 is to be considered. So your total sales return will be 1,35,000. I hope all of you are able to understand this. Yes or no? 1,35,000. Now, one more impact was in my debtors. How much is my sundry debtors? Sundry debtors here is 2,35,000 minus 25,000. There is also working here. Let me show that to you. See, calculation of debtors at the end. Sundry debtors 2,35,000 minus sales return not recorded 25,000. I hope this is clear. Now, what was the entry for this? Sales returns debit to debtors. So this was the entry for which we have considered the respective impact. Clear? Next, purchases include one furniture item purchased on 1st Jan for 10,000. Depreciation at 10% per annum is to be provided on furniture. Purchases also include an asset which needs to be first reduced because it is not part of your purchases. This being furniture, depreciation should also be considered. So this was purchased on 1st January. We are starting this from 1st April 23 to 31st March 24. So accordingly from Jan to March, we will have to charge depreciation. So coming to trading account purchases, we will reduce this furniture which is being included. See here, transfer to furniture 10,000, that is being reduced. On this 10,000, we will have to charge depreciation at 10%. So 10,000 into 10% into 3 by 12 by 3 by 12, Jan, Feb and March. So the depreciation on this will be 250. While I will show you that furniture account, you will clearly understand how the total is coming up. So next, 1 month's rent is outstanding and 12,000 is payable towards salary. First, 1 month's rent is outstanding. Now, what does this mean? Whatever rent is given here in the question will be for only for 11 months because 1 month's rent is outstanding. Yes or no? So if I have to find out the per month's rent, 66,000 divided by 11 will give me per month's rent. So 1 month rent is 6,000. This is current year's expense. So that will also be added to my rental expenses, and since this is outstanding, it will also be appearing in my balance sheet. So let's observe the dual treatment. CR in rent to rent 66,000, add outstanding 6,000. Then in the balance sheet, we have outstanding rent 6,000. I hope all of you understood what we are discussing. Next, in the same point, there was also 12,000 payable towards salary. We have salaries given 1,50,000. Payable means it is still outstanding, but is it a current year expense? Yes, it should be recorded in the profit and loss account. See here, two salaries, 1,15,000 from the trial balance plus outstanding 12,000. So total will be 1,27,000. So since this is payable, this will also be your liability outstanding salary 12,000. I hope this is clear. Next adjustment. Interest paid includes 9,000 paid against bank loan and interest received pertains to investments and deposits. Okay, first we will discuss about interest payment. Interest paid includes 9,000 against bank loan. In the trial balance, there is interest paid details. It includes 12,500. What does the question say? In this, 9,000 is towards your bank loan. This is towards bank loan. Now we have to first understand whether there is bank loan details given. Yes, observe here. Bank loan at 12% as on 1st October 2023. So the bank loan is borrowed as on 1st October 2023. Now we have to find out what is the interest due on the bank loan. 2 lakh into 12% into October to March. October, November, December, Jan, Feb and March into 6 by 12. So 12,000 is the actual interest. So if I have to just write 2 lakh into 12% into 3 by 12. So this will be how much? 12,000. But interest paid includes only 9,000 towards the bank loan. That means current year expense is 12,000, for which you have just paid 9,000. 3,000 will be what? It is still outstanding. So this is part of your current year expense. You will record this in the profit and loss, as well as, since this is your liability, it will be shown in the balance sheet. So let's observe the entries here. See, interest accrued on bank loan 3,000, because 9,000 is anyway given for interest payment. This is your balance sheet that is shown as your liability. Now in the profit and loss account, so to interest 12,500 plus 3,000, which is outstanding. I hope all of you understood this point clearly. So in the same line, we also had about interest received pertains to investments and deposits. Now there are two things involved here, investments and deposits. So first we have to understand what is the respective interest on these two items. Investments at 9% on 1st April 2023 means beginning of the year. So what is the interest amount? That should be 50,000 into 9%, that is 4,500. Then on deposits, 3 lakh into 10% again from the beginning. So full year, 30,000. So total interest, if I have to look at, it should be 34,500. That much I should have received. But observe here how much I have received. Interest received is 28,500. So actual amount to be received from both investments and deposits is 34,500, but I've just received 28. That means still some amount is receivable. So this will be recorded in the profit and loss account. See, by interest, total 34,500 will be recorded. In the balance sheet, 34,500 minus 28 is still receivable. So this will be shown on my asset side. Interest accrued on investments and deposits, 6,000. That is 34,500 minus 28,500 will give me 6,000. I hope all of you understood this. You can just mention it there. So this completes our interest and deposits. This is done. This is done. This is done. Provide for interest payable on bank loan and interest receivable on investments and deposits. Same point we have already covered. Next, make provision for doubtful debts at 5% on the balance under sundry debtors. So on the balance is clearly emphasized here. Remember, there was one revision in the value of debtors. So we have also considered that. Coming to the working. See, after considering the sales return, the adjusted balance is 2 lakh 10. On this, we will take 5%. So where and all this will be impacted? To provision for doubtful debts in the profit and loss account. See here, provision for doubtful debts 10,500. If there is bad debts, you can also show it according with that. If there is old provision and new provision, if not, you can also show it separately. Both gives you the correct presentation. And then from your balance sheet of debtors, net will be taken. So this 1,99,500 is what they are getting, which is being reflected. Clear with this? Yes. So this is done. Next, insurance premium includes 18,000 paid towards proprietor's life insurance policy. So if this is paid towards proprietor's life insurance policy in the nature of drawings. So first we will reduce this from the insurance premium. See, in the profit and loss account, insurance premium to insurance premium total value. From that, I will reduce less to drawings. Now, this should be added to your total drawings. We will show that in the balance sheet. See, less insurance premium here, 18,000, because it will anyway be deducted from the capital balance. I hope each point is clearly understood. Now, this completes all of our adjustments. Now, all of those values remaining, we will record. Capital account will appear in the balance sheet. See, 8,85,000 that is being taken in the balance sheet. The next, opening stock 3,86,000 in my trading account. To opening stock 386. Next, cash in hand, cash it back 18,500, 73,500 in the balance sheet, 18,500, 73,500. Investments shown as an asset 50,000 and deposits 3 lakh. Drawings is 78, written less drawings 78,000. Next, it is purchases 2495. In the trading account, we will enter two purchases 2495. Then sales 2986 by sales return inwards means sales return considered here. So 1,10,000 plus 25,000, which was the breakup. Next, we had written outwards 1,35,000 means purchases return that has been taken here 1,38,000. Then we have carriage inwards, which is your direct expenses. To carriage inwards 1,26,000. Rent, salary, debtors all considered. Sundry creditors in the liabilities 1,37,500. Sundry creditors 137,500. Then we have bank loan 2 lakh. Furniture as on 1st April 2023, 25,000. Now understand one thing. You had included furniture worth 10,000 in the purchases for which depreciation was for 3 months 250 rupees. Now there is a furniture of 25,000 on which the depreciation amount is 10%. Yes or no? Now in this case, 10% depreciation will be 2,500. 2,500 on the existing balance and 250 rupees on that asset purchase. That is how we are getting 2750. I hope all of you understood this. So this is about furniture. Next, interest paid, interest received considered. Advertisement in the profit and loss account 40,300. Advertisement 4,300. Then printing and stationery 32,200. Electricity charges 57,700. Then we have discount allowed 55,200. Discount received 24,600. Then bad debts 18,500. General expenses 36,800. Then we have motor car expense 8,500. Insurance premium 30,000. Insurance premium, we already understood the treatment. Then traveling expenses 21,800. Postage and courier 8,100. Depreciation on furniture, we already understood how to calculate it. And this completes all the entries. First, you will close the trading account, find out the gross profit, then carry it forward to the profit and loss. Consider all of the items, you will get net profit. Take that net profit, transfer to capital account, and accordingly close your balance sheet. If you are able to understand all of the adjustments, the question is pretty simple. It might take some time because of its lengthy structure. Yes, you can easily score full complete 15 marks provided you legibly write and assign the values accordingly. Clear all of you? Yes. For the purpose of working, here the institute has presented one for the sundry debtors, one for the interest calculation, paid received, and one for the depreciation. You can also do it likewise. Clear with this? Fine. Next question. X and Y are partners sharing profits and losses in the ratio of their effective capital. As on 1st April 2023, they had 2,80,000 and 1,60,000 respectively in their capital accounts. X introduced a further capital of 20 on 1st June and another 15 on 1st October. On 31st Jan, X withdrew 25,000. On 1st August 2023, Y introduced further capital of 30,000. During the financial year, the partners drew the following amounts in anticipation of profits. Now here you should be able to clearly distinguish this withdrawal and this withdrawal. When there is drawings with respect to anticipation of profits, it will be called drawings against profit. Drawings against capital will bring down your capital balance, whereas drawings against profit will act as a liability from the partner's side. Next, X drew 5,000 at the beginning of each quarter and Y drew 1,500 per month at the end of each month beginning from 1st April. As per partnership agreement, the profits were to be shared in the capital ratio. The interest on capital at 12% per annum is allowable and interest on drawings at 10% is chargeable. You are required to calculate profit sharing ratio, interest on capital and interest on drawings. So, this capital structure is linked to a concept called as effective capital method, wherein you can easily find out the effective capital, then calculate their profit sharing ratio and also their interest on capital. Let's understand this with the working. Now let's first find out the effective capital that helps us to find out the profit sharing ratio and as well as calculate interest on capital. X and Y. First, X has a capital balance of 2,80,000 and Y 1,60,000. X introduced a further capital of 20,000 on 1st June 2023. That means 2,80,000 is present in the business for how many months? April, May, because the next introduction is happening on 1st June itself. So this will be for 2 months. Next, this 2 lakh 80 is added with 20,000 more. So your capital balance will now be 3 lakh. This is present in the business until 1st October. That means June, July, August, September. 4 months. So there is further introduction of 15,000. So this will be 3 lakh 15,000 on 1st October. So this is the balance for how many months? October, November, December and Jan, because the next introduction is happening, next treatment is happening on 31st Jan. So this will be for 4 months. So then there is withdrawal of capital 3 lakh 15 minus 25, 2 lakh 90,000. This is for how many months? February and March. 2 months. I hope all of you understood how did we actually calculate. Likewise for Y. Y had this balance from 1st April until 1st August. Next introduction is happening on August. So April, May, June, July. This next introduction is happening on 1st August as well. So this is for 4 months. Then it is further introduced 30,000. So the revised capital balance will be 1,90,000. Further, there is no different details given. So we will assume this will be for the rest of the months. So August, September, October, November, December, Jan, Feb and March. So this will be for 8 months. Clear? Now we will find out the revised effective capital. 2 lakh 80 into 2. This will be 5 lakh 60. 3 lakh into 4. 12 lakh. 3 lakh 15 into 4. 12 lakh 60. 2 lakh 90 into 2. This will be 5 lakh 80. So your effective capital of X will be 36 lakh, and for Y 1 lakh 60 into 4. This will be 6 lakh 40. 1 lakh 60 into 4. Then 1 lakh 90 into 8. 15 lakh 20,000. 6 lakh 40 plus 15 lakh 20. This will be 21 lakh 60 for Y. So these are their effective capital. What is the first requirement? They want profit sharing ratio. Now we will have to find out the common values here. If I cancel out all the zeros, 360 and 216. If I just cancel out with 3, this will be 120 and 72. Then simplifying further, 10 is to 6. Further simplified, 2 5s are, 2 3s are. 5 is to 3 will be our profit sharing ratio. Then they're asking us interest on capital. When there is effective capital found out, it becomes very simpler. For X, 36 lakh into, what is the rate? 12%. 12 by 100 into 1 by 12. So 36 lakh. So this will be 36,000. For Y, 21 lakh 60,000 into 12% into 1 by 12. This will be 21,600. This will be your interest on capital. Yes, next calculating interest on drawings for X. So X is drawing 5,000 at the beginning of each quarter. First, total drawings. They have not given any method for this. So we will simply calculate on average basis. 5,000 at the beginning of each quarter. That means in a year there will be totally 4 quarters. So total drawings will be 5,000 into 4, that is 20,000, into rate of interest on drawings here is 10%. So 10 by 100 into average period divided by 12. Now there is 5,000 draws at the beginning of each quarter. So first number of months wise I will take 12 plus number of months remaining after the first drawing. So here it is quarterly done. So how many more quarters remaining? 3 quarters. So average period will be 12 plus 3 divided by 2. So that is 7.5 divided by 12. So 20,000 into 10% into 7.5 divided by 12. So your interest on drawings for X will be 1,250. Why? Amount of drawings is 1,500 per month at the end of each month. So 1,500 total drawings will be, number of months is 12, 18,000 into 10 by 100. End of each month, so n minus 1 by 2. 12 minus 1 by 2 will be 11 by 2. That will be 5.5 divided by 12. So 18,000 into 10% into 5.5 divided by 12. That will be 825 rupees. So this is your interest on drawings. We can find out the solution as per the institute. See, effective capital, they've just made a table. You can do it as per your understanding. So they have also gone 36 lakh, 2160. So the capital ratio, profit sharing ratio is 5:3. Interest on capital, we also got 36 and 21,600. Interest on drawings, 1,250 and 825. Interest on drawings, yes, 1,250 and 825. I hope all of you understood the respective solution. Clear with this? Yes. Moving on to the next question. Question number 4. A, B and C are partners sharing profits and losses in the ratio of 3:2:1. The following is the balance sheet of the firm ABC Trading Corporation as on 31st March 2024. Balance sheet is given. Land and building, machinery, furniture and fixtures, trade receivable, all. One unique point is joint life policy is given. Next. C died on 30th June 2024. As per partnership deed, the following arrangement was to be put into effect. So C died. So this date becomes important for our calculation. Goodwill of the firm was to be valued at 2 years purchase of average profit of 4 years to 31st March preceding the death of a partner. So preceding the death of a partner means the partner died in the year 2024. So we are considering the profit calculation yearly itself. So 31st March 2024 will be the preceding year death of the partner. The profits were as under. So they are giving us the profit details as on 31st March itself. Goodwill account will not be opened in the books of accounts and C is to be credited with a share. The new profit sharing ratio of A and B will be 5:3. This becomes easier for us to calculate gain ratio. Next, profit till the date of death to be ascertained on the basis of average profit of previous 4 years, and share of C was to be credited to his capital account. So again here itself, profit till the date of death they've take for the previous 4 years. So all of these years details should be considered. Next, assets were to be revalued. Land and building was appreciated by 15%. Machinery depreciation by 5%. Furniture and fixtures revalued at 1 lakh. And the value of stock to be taken at 90,000. Provision for doubtful debts to be increased by 1,800. A sum of 2 lakh 40 was received from insurance company against joint life policy, because when the death happens, the policy will mature and receive the policy amount. Amount due to C was paid to the executors. Okay. You are required to prepare revaluation account, partners capital and then balance sheet as on 30th June along with necessary workings. So there are revaluation, partners capital and balance sheet required. First, we can complete off the revaluation account. Land and building was appreciated by 15%. So this will appear on the credit side. 2,40,000 into 15%, 36,000. Then machinery depreciated by 5%. Machinery is 1 lakh 50 into 5%, 7,500. Furniture and fixtures revalued at 1 lakh. So furniture and fixtures is 1 lakh 5. Again, the reduction 5,000 on the debit side. Value of stock to be taken at 90. Stock is 85,600 increase. So this on the credit side. Then provision of doubtful debts to be increased by 1,800. Doubtful debts is 5,700. It is to be increased. That means again on the debit side. So you can observe in revaluation, those values will be appearing. To machinery, land and building, to stock, because these two are increasing, furniture and fixtures, and then provision for doubtful debts. These were the simple revision in the value of assets and liabilities. After completing this, we will transfer the profit or loss to the partner's capital account in the old profit sharing ratio, that is 3 is to 2 is to 1. So after doing this, they are asked to prepare partner's capital and then balance sheet. In the partner's capital, first of all, we will open the partner's capital balances. By balance brought down 2 lakh 80, 1 lakh 90 and 1 lakh 50. After that, we will distribute the general reserve to all partners in their old ratio. 1 lakh 35 in 3 is to 2 is to 1. So you can observe the entries for this. See here, by balance brought down 2 lakh 80, 1 lakh 90 and 1 lakh 50. And then by general reserve in 3 is to 2 is to 1. So this entry is done. Then we had revaluation profit. You also make the entry for that as well. So this also completes. Clear with this? So then we just have three more transactions to be addressed. That completes your question. First, we will take up goodwill. So goodwill of 4 years is given 1 lakh 14,000, 1 lakh 22,000. There's no any trend observed. So simple average we will do 1 lakh 19,000 plus 1 lakh 25,000. So this is 4 lakh 80,000 divided by 4 years. 1 lakh 20,000 is my average profit. So now this is 1 lakh 20,000 into 2 years will give me firm's goodwill. 2 lakh 40,000. This is firm's goodwill. We need the partner share. Firm's goodwill, we need the partner share. 2 lakh 40,000 into what is the partner share? C died. So 3 is to 2 is to 1 was the proportion. This will be 1 by 6. 40,000 will be the partner's share of goodwill. This need to be apportioned in the gain ratio. For this, we have to calculate the gain ratio. 5 is to 3 is the new profit sharing ratio. 3 is to 2 is to 1. So let's understand what the ICAI is working itself. See, we also got 1 lakh 20,000 as my average profit and goodwill was 2 lakh 40. C share is 40,000. Now 3 is to 2 is the new ratio. It will only be coming for A and B. I'll also show you the working here. Gain ratio is new ratio minus old ratio. For A, 5 by 8 minus old ratio is 3 by 6. 3 by 8 minus 2 by 6. LCM between 8 and 6 will be 8 6 are 48. 8 6 are 48. 6 5 are 30. 6 8 are 8 3 are 24. So this will be 6 by 48. And then 48, 8 6 are 6 3 are 18, 6 8 are 8 2 are 16. So this will be 2 by 48. Sacrificing share will be 6 by 48, 2 by 48. Sacrificing ratio will be 6 is to 2. So this 40,000 goodwill need to be apportioned in 6 is to 2 proportion. So what will be the journal entry? Gaining partners capital account debit to deceased partners capital. So who are gaining partners? A's capital account debit, B's capital account debit to C's capital account. His share of goodwill was 40,000, which we calculated. 40,000 into 6 by 8, 30,000 for A and 10,000 for B. This will be reflected in your capital account. So A's capital, B's capital to C's capital 40,000. Observe here. To C's capital in A's column and B's column, and then by A and B's capital in C's column 40,000. I hope this is understood. Next entry is about the profit, share of profit. The question is clearly giving us to take the proportion for the previous 4 years. We calculated the average profit. We got 1,20,000. So this will be your average profit. 1,20,000 into the partner share in this will be 1/6 because this is whole firm's average profit till the date of death, that is April, May, June, for 3 months. So 3 by 12. 1,20,000 into 1 by 6 into 3 by 12. So profit will be 5,000. What will be the journal entry? Profit and loss suspense account debit to cease capital. That will be reflected in your capital account. Observe here, by profit and loss suspense account 5,000. I hope all of you understood this. One more point is there about the joint life policy. See, when the death happened, there is policy amount being received. What will be the journal entry? Joint life policy is treated as an asset. So when you are receiving the amount, this amount should be apportioned to partners to in their old profit sharing ratio. So the entry will be joint life policy account debit to A's capital, B's capital, C's capital, 2,40,000 in their old profit sharing ratio, 3:2:1. That is what is reflected here in your capital account by joint life policy, 2,40,000 in this ratio. Now, how are we getting those values? 2,40,000 is what we received minus 90,000. So this will be 1,50,000 for A, B, and C. 1,50,000 into 3 by 6. 1,50,000 into 2 by 6. And 1,50,000 into 1 by 6. This is how it will be apportioned, which you will be observed here. 75, 50 and 25 as joint life policy. Now, in the question is clearly telling what was the amount due to C has been paid to C's executor. So C's balance, anything reflecting, will be paid as two banks, C's executor's account, and then the other two partners will have balances carried down. In the balance sheet, we will take the revised values after revaluation. Accordingly, you will enter all the details. And one important thing to observe is for cash and bank. See, what is the cash and bank balance given in the question? 32,300. What are the treatments which needs to be considered? See here, let me explain this with a working note. So how are we getting this cash and bank balance? From the balance sheet, the cash book balance was 32,300. 32,300 is the opening balance. From the joint life policy, I got 2,40,000 cash because while we receive bank account debit to joint life policy would be the entry. Then in this, I have paid to C's executor. How much is the amount? 2,46,850 minus 246,850. So 32,300 plus 2,40,000 minus 246,850 will give me 25,450. This is how we get the cash balance. For this, you can also prepare using the ledger. See, bank to balance brought down 32,300 by C's executed while we pay this, while we receive the amount 2,40,000. This will not be bank to bank. This will be bank to joint life policy. This is the correction you need to consider here. And then to balance carried down, by balance carried down 25,450. You can either find this out like this or this also would be sufficient enough. Make sure that you show this working in the answer. And one more important thing where most of the students forget is about recording profit and loss suspense in the balance sheet. That should also be written because that will have a debit balance. Since we are preparing this balance sheet as on 30th June, this will appear on your asset side. I hope the complete question was clearly understood. If you just break down the points, it becomes very simpler. Clear with this, all of you? Yes. Next question. Following are the details of assets and liabilities of Mr. Sarthak for the year ended 31st March 23 and 24. They've given the list of assets and liabilities. it was decided to depreciate building by 5% and furniture by 10%. On 1st June, an additional capital of 40,000 was brought in the business. Proprietor has withdrawn 2,500 per month for meeting the family expenses. Prepare statement of affairs as on 31st March 23 and 24. Find the profit or loss earned by Sarthak for the year ended 31st March 24. Now, when they are asking you to prepare statement of affairs for two different dates, it is always better to present it as two different columns in the balance sheet format itself, because that will save a lot of your time. If you're not comfortable with, you can make a separate one. See, statement of affairs is on 31st March 23-24. This is how they have presented. Okay, for the previous question, the institute has also given the alternative treatment. See, what they are giving in the alternate treatment is joint life policy can be routed through revaluation, because since it is treated as an asset, whatever money we are getting, they are considering it as if there is increase in the revaluation. So therefore, the increased balance is shown in revaluation account. Accordingly, your revaluation profit will change. Here you will have no entries in the joint life policy. So that is the impact what you can consider. Accordingly, the other adjustments will automatically come over. Here they have also shown the joint life policy, bank to joint life policy. Here also you need to make a change. This will be to joint life policy. See, here there is correct treatment given. This is what the link is here. Okay. So statement of affairs as on 31st March 23-24. As I mentioned, they have just given two dates column here itself. So let me open an alternate document so it becomes easier for you to refer. Yes, observe here statement of affairs. So first, building details is given. Building value is 2 lakh. We are writing it as on 31st March 23. 2 lakh. Closing is not given. How can we find? There is a depreciation details given at 5% per annum. So on 2 lakh, if I take out 5% depreciation, the closing will be 1 lakh 90. Next, as well for furniture, 75 written. Furniture, we also have the depreciation value. So on 75,000 minus 10%, if we do 67,500. Then inventory, both the details will enter 1 lakh 5, 1 lakh 95. Debtors, 68,000 and 94,000. Cash at bank, 72,500, 86,800. Cash in hand, 2,400 and 3,800. Then we have loans details 150, 1 lakh 25, 58,400, 79,500. We will prepare statement of affairs in order to find out the capital fund balance. So both opening and closing, we will have capital balances as the balancing figure. Remember, there was drawings details. Now we will take this for considering the profit proportion. As per capital comparison method, this will be your structure to find out the profit. That is, we first take closing capital and then we will subtract the additional capital introduced. The question has given us the detail. See, 40,000 was brought in the business. So 40,000 will be reduced, and then there is drawings 2,500 per month. There are totally 12 months, or 2,500 into 12. Add drawings, then opening capital balance subtract. So that will help us find out the profit details. 1,08,100. Alternatively, we can also prepare a capital account. Opening will appear as by balance brought down. See here, by balance brought down. Drawings will bring down your capital balance, so we will debit two drawings. Any additional capital introduced, capital introduction will be capital bank account debit to capital. So by bank or additional capital, you can write wise like net profit will also be added. So that is also be considered. That is nothing but my balancing figure. Balance carried on is the closing value, which is already found out in the statement of affairs. If we enter that, we will get profit as the balancing figure. Either of the two approaches, whichever is comfortable for you, you can stick on accordingly. I hope this is clear. This completes our question number 4. Next, question number 5. From the following income and expenditure account of a club for the year ending 31st March, you are required to prepare receipts and payments account for the year ending 31st March 24 and balance sheet as on 1st April 23. So, we will first simultaneously open both receipts and payments account and balance sheet. As we run through the question, it becomes important for us to also observe whether the opening capital fund balance is given or not. So, income and expenditure, we have details of expenditure and income. Then there is additional information. Here also there is no details of capital fund. Stationery was depreciated by 25% and sports material by 50%. So, we will also have to prepare opening balance sheet as a working note in order to find out the capital fund. Clear with this? So let's simultaneously refer so that becomes easier for you to understand. First, we will take from the additional information itself. Cash at bank opening balance is given. They have asked us to prepare receipts and payments account. So two balance brought down 60,000. Stock of sports material 30,000. So this will appear in my opening balance sheet. If I've prepared the opening balance sheet, anyway, the question is asking us to prepare the balance sheet as on 1st April 23 itself, which is nothing but the opening balance sheet. Okay. So this will be stock of sports material 30,000 entered. Next, tournament fund after deducting tournament expenses of 14,000. So tournament fund means it would have been prepared as per fund basis of accounting. Opening balance is not given, so that will not be reflected in the balance sheet. But this indicates one thing, there is a tournament expenses of 14, which means it should appear on the payment side. So we will record that by tournament expenses 14,000. I hope all of you are able to get this. Next, donations for club building 1,40,000. So this is again donation for club building would be your receipts. So this will be on appearing on your receipt side to donation for building 1,40,000. Then subscription due, opening balance, closing balance is given. Subscription due will be receivable. So first I will enter that in the balance sheet, subscription 10,000. So we will have to consider the receipts in the current year. So subscription income is given 1,05,000. So how can I calculate this? 1,05,000. Opening subscription due will have to be added 10,000 minus closing will have to be subtracted. So we will show the working for this. 1,05,000 plus 10,000 minus 15 will be your subscription income. Observe here. 1,05,000 outstanding taken. For this you will show the working. So we also consider what value will appear in the balance sheet as well. Next, stationery stock 4,000 is given. Remember on stationery they have given us the depreciation rate as well. Opening balance is given, so we will record this in the opening balance sheet. Stationery stock 4,000. Closing balance is not given. Sports material 50% is also given. So we have now addressed all of the items in the additional information. So sports material stock was anywhere there 30,000. So we will have to use this information in order to present this in the ledger. Or you can also do it directly. So first let's complete all other items in the receipts and payments. To lawn and maintenance will appear on your payment side. By lawn and maintenance 42,000. General expenses by general expenses 30. Then stationery depreciation is also given 1,500 and depreciation on sports material is given. Now observe one thing, they are giving us the depreciation details but they have also calculated it. Are you understanding something? There is some missing details which we need to find out. Now let's understand with stationery. Stationery is 30,000. As per the balance 4,000, sorry, stationery is 4,000. Depreciation on stationery is 25%. So what is the depreciation shown? In the income and expenditure, they are showing 1,500. See, my stock of stationery was 4,000. On that, if I apply 25%, my depreciation is 1,000. But they are recording 1,500 means there is additional stationery which has been also purchased in the current year. We need to first find out that value. Now, how do we calculate stationery stock opening balance is given? So, 4,000 minus 25% if I do, I get the closing value. See here, we can also refer this using the working note. They have prepared a stationery account. To balance brought down 4,000. By depreciation on this should have been 1,500, which is being recorded in the income and expenditure, but actual is 1,000 rupees. So there is something missing. What is that? How do we find out? We can first find out what is the closing value. Closing value, how can we do this? 1,500 is the depreciation. We don't know. There are additional assets also included, because from the my stock which is present at 4,000, the depreciation I'm getting is just 1,000 rupees. Are you all understanding what we are discussing here? So we will take this depreciation as the base and find out the closing value of stationery. So 1,000 rupees, on that if I apply 25%, so let me explain how this is referred. See, let me write it here itself. For stationery, 1,000 rupees is after charging 25% of X. If I take X as the value of closing stationery, X into 25% should have been 1,500. Correct? So I want to know what is the closing stock of stationery. How do I find this X now? 1,500 divided by 25%. So 1,500 divided by 25% will give me 6,000. Observe here, 1,500 divided by 25%, 6,000. Now in this 6,000, we already have the data for 4,000. Yes or no? So 4,000 worth is already shown as the opening stock. What is the extra purchase? 2,000. So that will be your cash purchases. I hope all of you understood this structure. Now this purchase you would have made by making the payment. That will appear in the receipts and payments account. See here, buy stationery 2,000. All of you understood this? Yes. Likewise for sports material. Now stock of sports material is 30,000. Depreciation on this is 50%, means 15,000 should have been depreciation. But observe here, they have already recorded 22,000. Same treatment. So there is some purchases included. How do I find out 22,000 divided by 50%? So that will be 44,000, which is my closing stock. I already have a data of 30,000. So how much is extra? 14,000. That is what I've recorded as buy sports material. For this, there is also a ledger presented in the same format what we understood for stationery. Clear with this? So these two were only the additional things to observe. Rest all is easier. Then we have two honorarium, which is your payments. By honorarium 10,400. Then this completes our expenditure. Income side, subscription done. Admission fees 12,000. So two admission fees 12,000. Sports material, sale of second hand material. So this 2,400 will be your income, sports material. So that is considered sale of sports material, 2,400. Then buy entertainment. So here two entertainment, 14,000. Then we have tournament fund. 14,000 was the expenses. This is your receipts and payments account. We have total tournament income which is received in the current year, 14,000 plus 6,000, which will be 20,000. I hope you understood all of the points which we discussed. So after entering all of these details, close the receipts and payments account by finding out the closing value. So balance sheet was anyway, detail was available. Cash at the bank was 60. Capital fund will be your balancing figure. This was the simpler question for 10 marks. I hope it was comfortable other than 2 points of stationery and sports material. Practice it well from your end again. Next, attempt any one of the two subparts, that is either 1 or 2. So there is an internal choice here. First part from that, Mr. A accepts two bills of exchange on 1st June 2024 for 1,50,000 and 60,000 drawn on him by Mr. B. First of all, let's read the requirement so that while reading, you become easier for you to calculations as well. You are required to give the journal entries in the books of B. Alright. So in the books of B, we will prepare or record the journal entries. Mr. A accepts two bills of exchange on June 1st for 1 lakh 50 and 60,000 drawn on him by B. Means what? B is drawing the bill. For B, it will be bills receivable. So we can record the entries simultaneously for this. So there are two bills. So we'll call this as bill number 1 and bill number 2. Bills receivable 1, bills receivable 2 account debit to A's account. So that will be your first entry on 1st of June. Observe here bills receivable number 1, bills receivable number 2 to A's account. Next, the bill of exchange for 1,50,000 is for 2 months, while the bill of exchange for 60,000 is for 3 months. This helps us to find out the due date of the bill. Mr. B got the first bill discounted with the bank for 1,49,000 on June 3rd, 2024. So on 3rd June, there will be one more entry. You're receiving money by discounting the bill. So what will be the journal entry? Bank account debit, discounting charges account debit to bills receivable number 1. Bill number 1 bill was 1,50,000. You're receiving 149 means discount will be 1,000. On August 2nd, Mr. A requested B to cancel both the bills and draw a new bill on him with the combined amount of both the bills along with interest at 12% per annum for a period of 2 months. Now, before the due date, Mr. A requested to cancel both the bills. Now, understand one thing, bill number 1 was due for 2 months and bill number 2 was due for 3 months. So, this is happening on 2nd of August. From 1st June, July, August. So 3 days of grace means 4th August, and then for the second bill, it is happening in the next month. So that will be for 4th of September. This were the respective due dates. But this person is coming on 2nd August itself. So first entry would be to cancel the bill. See, 2nd August, Mr. A will again become due. First bill has been discounted. So bill is not at all relevant. You will have to be liable to bank. So therefore, two bank for 1,50,000 itself and two bills receivable number 260. This is just as the cancellation. Being the reversal entry for cancellation of both the bills. I hope all of you understood the logic why I are bringing bank, because the bill is present with the bank now. Clear? Now, after this, along with interest at 12% per annum for a period of 2 months is given. So on the same date, we will draw a new bill along with interest. So bills receivable number 3, the party who accepts is again Mr. A. So 2A, there is interest element involved here for 2 months. So what is the total amount due? 1,50,000 plus 60,000. This is 2,10,000. Rate of interest given is 12% into 2 by 12. So this will be 4,200. 2,10,000 into 12 by 100 into 2 by 12. This is how we get 4,200. So here we are first making it due. Next, before the due date of the renewed bill on September 3rd, on August 2nd, if you are making the bill for 2 months, the next due date will be August, September, and then October. This is done on 2nd of August. So if you had 3 days of grace, 3rd, 4th, and 5th, it will be 5th of October. August and September. So then 5th of October. Now on 3rd September itself, A becomes insolvent and only 40 paisa in a rupee could be recovered from his estate. First of all, when the other party becomes insolvent, the relevance of bill should be cancelled. So what will be the entry? You receive 40% of the amount, bank account debit, bad debts for the remaining which is not being recovered, to bills receivable number 3, because earlier when it was receivable you will show this as an asset. Now since it is getting cancelled, we will reverse it. What was the total amount due? 2,10,000 plus interest you have still not paid. Interest amount was 4,200. So total is 2,14,200. In that 40 paisa in a rupees recovered means 40%. So 85,680 will be recovered and the balance will be your bad debt. I hope you understood the respective entries. For this, they've also given the alternative two separate entries in place of 3rd September. Mr. A to bills receivable. This is for dishonor of the bill. And then for the realization. As I told, first we need to cancel the bill. That is the breakup given for the alternate treatment here. Clear with this, all of you? Yes. So this completes our first part of the question. Yes. Let's move to the next part of the question. The following details are available of raw material of a manufacturing unit. Then they've given us, you are required to find out the value of inventory as on 31st May 2024 if the company follows weighted average method and then first in first out method. So if you read the requirement of the question, it becomes easier what you should do while you refer the question and what working notes should be preferable. So that also saves our time. So that's why we first looked at the requirement. They're giving us the details of opening inventory, purchases, and issues. The manufacturer also incurred the following expenses: freight of 300 and unloading charges of 150 at the time of every purchase, respectively. Warehouse rent of 2000 per month and administrative expenses of 1500 per month. So here they are asking us to prepare or find out the value of inventory. So this form of presentation can be done using a stores ledger. So in this case, if they are giving you such details of expenses, becomes very important to first understand what are in the nature of directly attributable expenses and indirectly attributable expenses. Why? So when there is directly attributable expenses, we will have to first add this to find out the actual cost of inventory. Now the question is clearly specified that these are incurred at the time of every purchase. So that means whenever there is purchase happening, there will be impact on our price while we revise it. I mean to say while we reissue it. So this needs to be considered because this will be in the nature of directly attributable expenses. This is one point to take care. Next, warehouse rent. So this is not directly attributable towards inventory. So this is indirect in nature. This need not be considered. Likewise, my administrative expenses as well. So this is the important point to take care. Now, we already know the format of stores ledger. First will be your date column. Observe here. First on the weighted average basis, date column. Then we have receipts. Under receipts, we'll have units, rate and amount. And then under issues, units, rate and amount, balance sale, units, rate and amount. First point, 1st May, there is an opening inventory. We will record that 100 units at 15 rupees, 1500. Next, there is purchases 300 units at 18 per unit. Now observe this carefully. 300 units has been purchased at rupees 18 per unit. But what is the rate which you actually have to consider? Remember, just now we understood the discussion of directly related expenses, indirectly related expense. That impact needs to be considered. So 300 units at 18 per units. If I consider 300 rupees of freight and 150, the revised price needs to be calculated. Observe here, there is a working note. Per unit of raw material cost purchased on May 2nd, 300 rupees at 18 per unit plus 300 rupees and 150 rupees divided by total number of units, which will be 300. We get the revised price as 19.5. So this you will take it here in the ledger. 300 at 19.5, that will be 5,850. So we got 300 into 19.5, 5,850. Now this is maintained as weighted average basis. We will have to calculate the weighted average rate. How do we get this? Total value of the purchases 5,850 plus the existing balance 1,500 divided by number of units which is remaining, it is 400. So that will give us 18.375. All of you observe 5,850 plus 1,500 divided by 400 units remaining, that will give us 18.375. Next, there is issued for consumption 250 units. So on 5th May, on issue side 250, the revised price is 18.375. We will issue at the same value. So out of 400, if I give away 250, how much is remaining? 150 at the same price. Clear with this? Next, there is purchases 500 units at 21 per unit. 500 units, here also we need to calculate the directly attributable cost along. So 500 into 21 plus 300 plus 150 divided by 500. So the revised price per unit will be 21.9. So that is what we have taken here. So 500 into 21.9 will be 10,950. So after purchases, the balance will be 650. So how do I calculate the average price? 10,950 plus 2756.25 divided by how many products units remaining? 650. So that will give us 21.086, that is rounded off as 21.09. So 650 units at 21.09. Then there is issued for consumption 100 units. From 650, we are issuing 100 at 21.09. I will be left out with 550 units at the same 21.09 price per unit. Then issued for consumption 450 units, 450 at 21.09. Out of 550, we are issuing 450, remaining is 100 at 21.09. So this will be your value of closing stock, 100 units at 21.09, 2109. This was as per weighted average method. Next, they've also asked as per first in, first out. I hope all of you understood the directly attributable cost. The same cost will be remaining. Just the presentation differs here. That's it. See, opening inventory is balance 100 at 15. Then there was purchases 300 units. We understood how we got 19.5. So this is done. 100 into 15, 300 at 19.5. So this is where the presentation gets differed. Now then there is an issue of 250 units. So first you will take it from 100, then 250, that is balance 150 from 300. So after doing this, you will be left out with 150 units at 19.5. Then there is purchases of 500 units at 21.9. So as it is, it will get carried forward 150, 19.5, then 500, 21.9. So then the next transaction is issued of 100. First you will issue from this 150, that is 100, 19.5. In that 50 is still remaining, 50 into 19.5. Then 500 into 21.9. Clear? Next, then there is still an issue of 450. 50 was remaining. We will first take that. And the remaining 400, we will take it from this. So 50 units for 500, we are taking 400. So 100 units remaining into 21.9. Again, the value of closing stock is 2190. Clear with this? So here there is also note which needs to be written. What we have considered for direct and indirect costs. Freight and unloading charges are directly attributable cost and are necessary to bring the inventory into present location and condition, and hence it is included in the cost of inventory. Whereas warehouse rent are indirectly attributable and are not considered as cost of inventory. Same explanation for administrative expenses as well. These both are indirectly attributed expenses. I hope all the points what we discussed is clearly understood. Next question. C had issued 20,000 8% partly convertible debentures of rupees 100 each on 1st April 2023. The debentures are due for redemption on June 1st, 2024. The terms of issue of debentures provided that 30% of the debentures will be converted into equity shares, nominal value of 10 rupees at a price of rupees 20 per share, and remaining will be redeemed at premium of 5%. So first calculate the number of equity shares to be allotted to the debenture holders at the time of conversion. See here, how many are the total number of debentures? 20,000 is the total number of debentures. Now, in this, 30% will be converted into equity shares. Now, if I have to find out 20,000 into 100, so 20,000 into 100, 30%. So, value of getting converted is 6 lakh. They are asking us number of equity shares. So the what is the issue price per share? 20 rupees per share. So divided by 20. So the number of equity shares which is getting allotted to debenture holders will be 30,000. So here's what you need to present. Number of convertible debentures issued, converted into equity shares how much, and value per debenture 30,000 shares. We have just directly taken first the redemption value and applying the percentage wished for conversion and then taking the issue price of equity shares. This is the first part of the question. Next, give the necessary journal entries related to the conversion and redemption of debentures, assuming that the company has created the debenture redemption reserve and also invested required amount for redemption of debentures at the time of issue. Debenture redemption reserve are sold at par value. Now understand this carefully. The question is clearly emphasizing that they had created debenture redemption reserve and debenture redemption reserve investment was also done. So we have to know some basic points about how much percentage should be debenture redemption reserve and how much percentage will be debenture redemption reserve investment. So as per the law, debenture redemption reserve will be 10% of the redemption value. So first in this question, 2 lakh into 100 was the value of debentures. Yes or no? In this 10% should have been debenture redemption reserve into 100 into 10%. Then debenture redemption reserve investment account should have been 15% of this. So 20,000 into 100 into 15%. This will be 3 lakh. This will be the requirement of what we discussed. Here there are also some points which we need to consider. Those proportion of debentures getting converted into equity shares, for that we need not create debenture redemption reserve. Now first we will observe the entries, how this has been done. See, on 1st June, the debentures are due for redemption. So first we will pass the due entry. 8% convertible debentures account debit, premium on redemption of debentures to debenture holders. This is the due entry. Now, 8% debentures is valued at 20,000 debentures is 100 each. Clear with this? Now, in this, 30% of the debenture holders are getting converted. That means how many debenture holders? 20,000 into 100 into 30%. 6 lakh is getting converted into equity shares. So, how many are remaining? 14 lakh. 14 lakh should be given a premium of 10%. Sorry, premium of 5%. So, what will be the premium amount for this? See, 20,000 minus 30%, 14,000 at 5% will be 700 into 100, 70,000. How are we getting this? Just 1 minute. So this will be 20 lakh divided by this will be 20 lakh. In this 6 lakh is getting converted into equity shares. Remaining is 14 lakh at 5% premium. That is how we are getting 70,000. Clear with this? So this was the due entry. Next entry, we are providing share capital for 30% of the shareholders. So what will be the entry? Remember, the debenture equity shares are issued at premium. 20 rupees were the price per share. That is 10 rupees nominal value, means 10 rupees is your premium. So what will be the entry? Debenture holders account debit to equity share capital to securities premium. So debenture holders to equity share capital to securities premium. We know the number of shares, 30,000 shares at 10 each, both for premium as well as capital. So that goes to debenture holders. Understood? Next. So this debenture holders are being paid with respect to the money. So the entry will be debenture holders account debit to bank, including premium on redemption. 14 lakh was remaining debentures plus 70,000. Clear with this? Now this we have to allocate the sources. The question is also clearly writing that debenture redemption reserve is sold at par value. So here you can also note this entries at the last as well. Here they are writing off the premium on redemption to profit and loss. This is the closing entry, 70,000. So see here, debenture redemption reserve will need to be created. So this debenture redemption reserve, after providing for debenture holders redemption, we will transfer it to general reserve. How much was required? Only 14 lakh worth was remaining to redeem. So that amount was created from debenture redemption reserve. We are transferring it back to general reserve. Bank account debit to debenture redemption reserve investment account. Now debenture redemption reserve investment, if you observe in our calculation, was 3 lakh. Now, as per the calculation here, debenture redemption reserve investment was supposed to be 3 lakh. Yes, but this 3 lakh is for how many percentage of debenture holders? Because 30% is getting equity shares. So this is only for remaining 70%. So 3 lakh into 70% will be 2 lakh 10. That is how we are getting 2 lakh 10. I hope all of you understood this. This completes our question. Alternatively, they can also give you can make a combined entry, that is by issuing equity shares and by making the payment to debenture holders, everything at one single entry is also done. See, in case of partly convertible debentures, debenture redemption reserve shall be created in respect of only non-convertible portion. So amount of debenture redemption reserve created at the time of issue is 10% of 14 lakh. So 1 lakh 40,000. And DRR investment should be 15% of this, that is 2 lakh 10,000. So you can also calculate it likewise. 14 lakh into 15%, that will also give me 2 lakh 10. I also helped you understand how we also get 2 lakh 10 here as well. I hope these points are clearly understood. So this completes our question number 5. Moving on to the next question. Question 6. Yes. Arpit Limited, with an authorized capital of rupees 20 lakh divided into equity shares of 10 each on 1st June 23, invited applications for issuing 3 lakh equity shares at a premium of rupees 5 per share. The amount was payable as follows. Application 2 rupees per share. Allotment on 1st July 7 rupees including premium. Premium was rupees 5 per share. So this will be 2 plus 5. Then on first call 3 per share. Final call 3 per share. They have given the respective dates. All the shares were applied for and allotted. So there is no over or under subscription. Mr. Naresh, who held 20,000 shares, paid the whole of the amount due on calls along with allotment money. So there were 2 calls. He's paying all of the amount due on calls with allotment money itself. The final call was fully paid except a shareholder having 5,000 shares who paid his due amount on 1st March. He's paying, but the actual due was 1st Jan. That is after 2 months along with interest on calls in arrears at 10% per annum. Company also paid 12% as calls in advance to Mr. Naresh on 1st Jan. See, 1st July is the allotment date. He's paying both the calls money on that date itself. So give journal entries with narrations to record all of these transactions in the books of Arpit Limited. So they're just asking us journal entries. Please read authorized capital as rupees 20 lakh. So here they have mentioned about this. So the question is simpler. Let's understand the entries carefully. So first, we are receiving the application money. So what will be the entry? Bank account debit to equity share application. Number of applications is 3 lakh into 2 rupees. So bank account debit to equity share application 3 lakh into 2. Now this will be transferred to share capital. Equity share application account debit to share capital will be the next entry. 6 lakh, 6 lakh. Be careful with the dates. Application money will be transferred to share capital when the allotment gets confirmed. So your date here will be on 1st of July. 1st July 23. Next, making allotment money due. So what will be the entry? There is premium included here. On 1st July 2023, equity share allotment account debit to share capital to securities premium. So what is the number of shares? 3 lakh shares into the allotment here 3 lakh into 7 rupees. Equity share capital at 2 rupees. 3 lakh into 2 and securities premium at 5 rupees. This was on 1st July. Next, 1st July, we are also receiving the allotment money. Bank account debit to equity share allotment. Now understand one thing. Naresh, who's holding 20,000 shares, paid whole of the amount due on calls with allotment money itself. So there will be calls in advance. As in when the company receives, for that day, it will be in the nature of liability. So we will credit calls in advance. So the entry for this will be bank account debit to equity share allotment to calls in advance. So 20,000 call money together put in will be 6 rupees. 20,000 into 6 will be calls in advance. So this will be your complete entry. Bank account debit, equity share allotment to calls in advance. Clear with this all of you? Next, we are making the first call money due. First call is happening on 1st November. What is the due entry? Equity share first call account debit to share capital. 3 lakh into 3 rupees. Then we are receiving the call money. Now Naresh had already paid it in advance. So the entry will be bank account debit, calls in advance account debit to equity share first call. Observe this, bank account debit, calls in advance to equity share first call. So on first call, what was the amount due received in advance? 20,000 into 3 rupees. So this will be 60,000. I hope you are all understanding the structured entry carefully here. Next, on 1st Jan, we are making the final call due. What is the due entry? Equity share final call account debit to equity share capital. 3 lakh into 3 rupees. This will be your due entry. Next, there was one shareholder having 5,000 shares who didn't pay the final call money. So what will be the entry? Naresh had already paid in advance. Observe the combined entry carefully. Bank account debit, calls in arrears for the person who's holding 5,000 shares not paying 5,000 into 3 rupees. Calls in advance. Now we had already got the amount. Now we are cancelling the liability. This is the calls in advance. 20,000 shares at 3 rupees. 5,000 shares at 3 rupees. The balance goes to bank to equity share final call account. Clear with this? Now reading further. The final call was duly paid having 5,000 shares who paid his due amount on 1st March after 2 months along with interest on calls in arrears. So first we will have to make the interest due. So interest on calls in advance and interest on calls in arrears both is there. Interest on calls in advance from the company's point of view it is an expense. So what will be the due entry? Interest on calls in advance account debit to shareholders. So this is happening on 1st Jan. So we will first make the due entry. Interest on calls in advance account debit to shareholders. How are we getting this value? Let's understand this with a working note. See, first call money was from 1st July. From 1st July 23 to 1st November 23. So how many months? July, August, September, October. So this was for 4 months. 60,000, that is 20,000 into 3 rupees on first call into 12% for 4 months. Then the second final call is happening on 1st Jan. That is from 1st July till December. July, August, September, October, November, December. So how many months? 6 months. So interest for this will be 3,600. Both put together will be 6,000. That is what is taken here. So once we made it due, then we make the payment. The payment entry will be shareholders account debit to bank 6,000. Clear with this? Later, we'll be making calls and arrears due. So interest on calls and arrears is an income to the company who should pay shareholder. So what is the due entry? Shareholders account debit to interest on calls and arrears. He didn't pay only the last call. How many shares held? 5,000. So how do we calculate the interest? 5,000 shares at 3 rupees into 10% for how many months? 2 months. 2 by 12. So this will be 250 rupees. For this also there is a working note given. You also better make it. Last will be he is paying the due amount. So what will be the entry? Remember earlier when we received the final call money, we had transferred the amount to calls in arrears. Now we need to cancel that. Bank account debit to calls in arrears for which we are receiving the call money, then to shareholders with respect to the interest. Complete entries were pretty simple, guys. Just go through the relevant practice entries and do a good set of practice, especially with respect to interest on calls in arrears and calls in advance, because there most of the students miss to pass the due entry. So first we have to make the due entry and then the payment or receipt entry. Clear with this? Yes. So this completes our first part of question number 6. Then last we have a theory question. What are the advantages of double entry system? Again, a simple straightforward theory question. What could be the advantages of double entry? You can write down the points like it gives us the accuracy in maintaining the proper books of accounts. Then it helps in comparison, obtaining complete financial information. And these are some advantages what you can refer. So just look at the answer given here as per the institute. See, according to the double entry, every transaction has twofold aspects, debit and credit. Both the aspects are to be recorded in the books of accounts. This is just a simpler explanation. The advantages includes by the use of the system, the accuracy can be established through the device called as trial balance. Profit earned or loss incurred can be ascertained together with details. The financial position of the entity can be ascertained through preparation of what? Financial statements. The system permits accounts to be kept in as much details as necessary. Therefore, it has been providing significant information. Result of 1 year may be compared with the another previous years for the reasons of the change may also be ascertained. So these are some fixed points where you can provide as advantages of double entry system. So this was your last part. So this completes our discussion of January 2025 question paper. It was again a good paper for the matter of practice, guys. It also had a pretty straightforward, simpler questions. Do give it a try. After you watch the video, make sure you're also solving it individually at once so that you get that complete accuracy from your end as well. So until I see you in the next video, keep giving the best effort, guys. Let's do our best to win or see that successful on our result day. All the very best to all of you. Take care. Hello champs, hope you are doing amazing. In this video, let's discuss September 2024 exam CA Foundation Accounting question paper along with ICAI suggested answers, guys. This was a pretty lengthier question paper, so let's understand how it is being framed, the concepts and the presentation, what needs to be done. Let's begin the session with a strong, powerful practice mindset, guys. Yes. So question number one, part A will be are true or false. So let's discuss them one by one. Nominal accounts are balanced at the end of the accounting year. The given statement here is false. Only personal accounts and real accounts will be balanced since nominal accounts are the yearly expense, income, gains or losses. There's no point of carrying it further ahead. So therefore, this will not be balanced. Next point. Overall expenses of a second-hand machinery purchased are revenue expenditure. So again, the given statement is false. Understand the statement carefully. There is an overall expenses incurred towards buying of second-hand machinery. First of all, the situation or condition of a second-hand machinery would require some basic reconditioning. So in this course, any overall expenses incurred would be to bring a proper conditioning of the asset or machinery. So therefore, this becomes part of the capital expenditure and not revenue expenditure. Hence, the given statement is false. Yes. Third point, valuation of inventory at cost or net realizable value is based on principle of conservatism. What is the principle of conservatism proposes here is provide for all possible losses and do not anticipate any profits. So as per principle of conservatism, treatment of current asset is mandate where it says value it either at cost or net realizable value and inventory being part of it. So it is based on the principle of conservatism. Hence the given statement here will be true. Next, a promissory note can be made payable to the bearer. The given statement here is false. It is talking about a promissory note. That means there should be a certain payee to whom it should be prescribed and it cannot be made payable to anyone who is holding the instrument. That is nothing but a bearer. Hence, the given statement here is false. Next, the receipts and payment account for a non-profit organization follows the accrual concept of accounting. The given statement is again false here. The receipts and payments account prescribes the recording of transaction on cash basis, whereas income and expenditure is done on accrual basis of accounting. Hence, the given statement is false. Next, legal heirs of a deceased partner are entitled to his capital account balance only. Again, here also the given statement is false. Legal heirs of a deceased partner is not entitled only for the capital dues. They are entitled to all the dues which the partner was supposed to receive. So hence the given statement is false. Now you can just have a look at what the ICI suggested answers are. See, the first statement was false. Nominal accounts are not balanced. These are transferred at the end to either trading or profit and loss account. Next, overall expenses are incurred to put second-hand machinery in working condition to derive the long-term advantage out of it. Hence, it should be capitalized. So, the given statement there was false. Next, conservatism concept states that one shall not account for anticipated profits but should provide for all prospective losses. Valuing inventory at cost or net realizable value, whichever is lower, is therefore based on the principle of conservatism. Hence, it was true. Next, a promissory note should not be made payable to the bearer. As I explained, it must be payable to a certain payee or a certain person. Hence, it is false. Next, it depicts the cash system of accounting rather than accrual, as the cash receipts and payments pertaining to any year are entered in receipts and payments account. The principle of accrual is not followed with regard to receipts and payments of a non-profit organization. So, in simple words, receipts and payments account is prescribed on cash basis of accounting, whereas income and expenditure follows accrual basis of accounting. Next, legal heirs of a deceased partner are entitled to all the dues of deceased partner. So, whatever a partner was supposed to receive, they are entitled to receive all the dues and not only capital balances. I hope these points are clear. Next part of the question, differentiate between bookkeeping and accounting. Again, a very straightforward and a simpler topic based question. So I will just point out the differences. Key differences are bookkeeping basically focuses on recording of transactions, whereas accounting includes your summarizing. Book Actually, there is a statement which prescribes that accounting starts after the bookkeeping ends. So here are the few points which we can observe. See, it is a process concerned with recording of transactions, and accounting is concerned with summarizing of the recorded transaction. Bookkeeping constitute as a base for accounting, because without recording the transactions, we cannot further build or proceed in the accounting process. Accounting is considered as a language of the business. Financial statements do not form part of this process because it is still in the recording stage, whereas financial statements is prepared in this process on the basis of bookkeeping records. Then managerial decisions cannot be taken with the help of these records because it is still a raw data presented in a structural information category. So you cannot have that data relevant to take up certain managerial decisions, whereas accounting management can take decision on the basis of these records. There's no subfield of bookkeeping, but accounting has several subfields. Examples could be your management accounting, financial accounting, cost accounting, etc. Then, financial position of the business cannot be ascertained through bookkeeping. Yes, financial position can be ascertained on the basis of accounting reports. So, these are few easiest key points of differences where you can make a note of if the straightforward questions like this come up. Next question. Pass the necessary journal entries to rectify the following errors using a suspense account. The question itself is prescribing by using a suspense account. So let's do the entries one by one. Goods of the value rupees 500 returned by Mr. A were entered in the sales day book and posted therefrom to the credit of his account. Now, first of all, what is the error happened? It was actually a sales return, but they have made an entry in the sales day book. First, that needs to be cancelled. When they have entered in the sales day book, sales account would have been credited. If we have to cancel, we will have to debit. Understood with this? Yes. And posted therefrom to the credit of his account. So actually, when there was a sales return, what was the normal entry we have to do? Sales returns account debit, and who is returning? Mr. A. So sales return to Mr. A would be the entry. Mr. A's account should have been credited, and there have been a posting done to the credit of his account. So what does this communicate? Sales return is not at all brought into this consideration. So sales return should be debited. Sales account which was credited needs to be cancelled, so we will debit it. A's account is rightly credited, we will not disturb. Through which account we will pass this rectifying entry by making use of suspense account. So your entry will be sales returns account debit, sales account debit to suspense account. I hope all of you understood this. Observe this. See, sales account debit, sales returns account debit to suspense account with the respective amount. 500 is the transaction amount and the total amount which goes to suspense would be 1000. So we'll provide the narration. Value of goods returned by A wrongly posted to sales and omission of sales return is now rectified. Next, goods 250 entered in the sales return book has been posted to the debit of R who returned the goods. 250 is entered in the sales return book. That means it was a sales return. They've already made the entry. If there is sales return, what is the normal entry? Sales returns account debit. In this, the question in this transaction, the party here is R, to R's account. But here, what they have done, posted to the debit of Mr. R. Mr. R's account should have been credited, but they have debited. Sales return is normally considered rightly. So which is the account we will use to rectify now? Suspense account. So the entry here will be suspense account debit to Mr. R. suspense account debit to Mr. R. Now, why is the transaction amount coming to 500? Remember, R was debited by 250. First, we will cancel. There, we will use 250. The right transaction amount is 250, which should be credited. So, therefore, the total sum ups to 500. I hope all of you understood this. Next transaction. A sale of rupees 700 made to Mr. Q was correctly entered in the sales day book but wrongly posted to the debit of Mr. S as rupees 70. A sale of 70 made to Mr. Q was correctly entered in the sales day book. That means sales happened with Mr. Q has been entered as Q account to sales but wrongly posted to the debit of Mr. S, who should have been debited Q, but they have posted it to S, and that too there is an amount difference. The transaction amount here was 700, but they have taken only 70 rupees. How much is the difference here? There is still a difference of 630. So whatever is debited of S, that needs to be cancelled first. Yes. How do we cancel? By crediting it back, correct? So say AS account will be now credited. This S by 70 rupees. Then Q account was not at all debited. So Q account will be debited by 700. The difference will go to suspense account, which is 630. Observe the entry here. Q account debit to S account to suspense. S, whatever was debited by 70, we are cancelling that. Then Q, which was not at all debited 700, we are debiting now. The difference will be routed through suspense account. The omission of debit to S and wrong credit to S for sale is now rectified. This will be your narration. Next, the total of discount allowed column in the cash book for September amounting to 350 was not posted. That means there is an error of omission here. Discount allowed should be debited. So this was not posted means there is no impact in the other account. So the entry, rectifying entry here will be discount allowed account debit to suspense account. Discount allowed account debit to suspense account. Being the total of discount allowed during September not posted from the cash book is error now rectified. First one was simpler question. It was full complete 12 marks for true or false, one theory, straightforward question and 4 rectifying entry. I hope all of you were comfortable to understand this. Moving to the second question. The cash book of Hari showed a debit balance as on 31st December which was in disagreement with balance as per passbook. Following discrepancies were noticed. This will be a bank reconciliation question. Prepare bank reconciliation statement on 31st December and ascertain the balance as per passbook. So here which book balance has been given? They are giving us the cash book balance, and is it a favorable? That means unfavorable. Favorable means debit balance, unfavorable means credit balance for a cash book. So here it is a favorable debit balance as per cash book. So your base book here is cash book. We will run through the transactions one by one. In this question, they have not specified anything to prepare adjusted cash book also. It purely becomes your choice. If you are making an assumption that adjusted cash book is required, you can prepare adjusted cash book and then present BRS, because the date here is 31st December. If you are assuming that the year is ending on 31st December, if not, you can simply present this in BRS either as per balance method or plus minus presentation. Here I will explain you as per the balance method. Any format if you take up, the answer will be same. I hope this is clear. Now, this is my cash book and the other hand represents my passbook. The base book here is cash book. I'm starting with 1,36,800. Yes, dividend of 18,000 was deposited in the bank of which Hari had no information. Dividend is your income. The entry is being made in passbook. That means book would have higher balance. There's no entry in the cash book. I can alter this book. If I have to alter, I will have to add in order to match both. So this will be added. Next, check was issued to Suresh of 14,780 on 18th December, which was recorded in the cash book as 14,870. Check is issued. That means as soon as the issue is done, entry would have been passed. The balance in cash book is lower. The same is also reflected in the passbook. The point here or the difference which could result here is because of the amount. 14,780, but it is entered in the cash book as 14,870. The difference here is 90 rupees. Now, In cash book 14,870, in passbook 14,780. So this is my base book. If I have to match both, I will have to add back how much? 90 rupees. I hope this is clear. Next, checks totaling 55,000 were deposited into bank on 30th December, which were not cleared until 31st December. Checks were deposited into bank. As soon as the check is deposited, you will make an entry in the cash book and it is showing a higher balance. But there's no entry reflected in the passbook because we are preparing this on 31st December and it is still not cleared until 31st December. In order to match both, I will have to subtract minus 55,000. Then Mediclaim premium of 14,160 was paid as per the standing instruction of Hari, which was not recorded in the cash book. Now this was done as per the standing instruction. That means the entry is already reflected in the passbook. It is an insurance premium which is an expense. So the balance in passbook would come down. There's no entry in the cash book. So what will I do in order to match both book? I will also subtract this. Next, goods amounting to 1,60,000 was sold to Ajay in November. He deposited check on 15th December after deducting 4% cash discount. This entry was missed while preparing cash book. So now what do we understand? Since he deposited the check, passbook would reflect the balance. So it is a deposit. So balance would have been increased. There's no entry in the cash book. If we have to match, we will have to add. Now this transaction is including cash discount. So we will take net of discount 1,60,000 minus 4%. So this will be 1,53,600. What will I do? I will add. I hope this is clear. Next, bank charges for issue of checkbook 150 was skipped while preparing cash book. So bank charges is an expense. Passbook would have an entry, balance is showing low. So there's no entry in the cash book. In order to match both books, what should I do? I will have to subtract. Next, Hari received a UPI of 1,000 on 29th December for sale of scrap which was not entered in the cash book. UPI means the amount would have been directly credited to passbook. So the balance is increased. There's no entry in the cash book. In order to match both book, I will have to add. Checks amounting to 1,80,000 were issued during the month, but checks of 1,44,000 were only presented during the month for payment. Checks issued means up to 1,80,000 the entry is reflected in cash book. Only up to 1,44,000 the entry is reflected in passbook. In order to match both books, I will have to add back. How much should I add? 1,80,000 minus 1,44,000, that is 36,000 need to be added. So these were the impacts to be done in bank reconciliation statement. Let's find out the balance as per passbook. 1,36,800 plus 18,000 plus 90 minus 55,000 minus 14,160 plus 153,600 minus 150 plus 1,000 plus 36,000. So your balance as per passbook will be 276,180. So this will be balance as per passbook. See, as I mentioned, you can either do this as per the balance method by writing down all the transactions, add less category, or there is also an alternative way to solve this question by preparing adjusted cash book. So we will first bifurcate the transactions which enters in cash book, which enters in BRS. In BRS, only timing differences transactions will come. Rest all will go to cash book. You will find the revised cash book balance. Take that as your base book and then adjust with the timing differences. You will still get the same answer. I hope all of you understood this. Clear? Yes. Yes, let's move to the next part of question number 2. Harry draws a bill on Sejal. So before we continue reading this question further, it is always better to understand the requirement. So while we read up every transaction, it becomes easier to relate. So give journal entries in the books of Sejal. Okay. Also prepare ledger accounts of Harry. All working should form part of the answer. So there are two parties, Sejal and Harry. They're asking us to present journal entries in the books of Sejal and ledger in the books of Harry. Now let's read the question. Harry draws a bill on Sejal for rupees 60,000 on 1st Jan 2023 for 3 months. Now let me open the document simultaneously, the answer solution part, so that as we run through the line by line transaction, let's understand the journal entries as well. So it becomes easier and simpler for you to also consider collation here. Yes, left hand side represents your question and right document your solution. So the first transaction was Harry draws a bill on Sejal for rupees 60,000 on 1st Jan 2023 for 3 months. Now we are preparing journal entries in the books of Sejal. If you if the other party is drawing a bill and you are sending the acceptance, means for you it will be bills payable, a liability. So what will be the journal entry on 1st Jan 2023? Harry's account debit to bills payable. So this will be the entry. Harry to bills payable 60,000, 60,000. They've also asked us to prepare ledger of Harry. So let's make the entry simultaneously there as well. Harry's account to bills payable 60,000. Clear with this? Yes. Next, Sejal accepts the bill and sends it back to Hari to get it discounted for 56,000. Now, Sejal acceptance done means the bill is being accepted. That is how the first entry we have passed. And this bill is now taken to the bank for getting it discounted. So, the bill amount was 60,000, but we are getting 56,000. When we are getting it discounted, what will be the entry? Bank account debit because you are receiving money, discounting charges account debit to Harry's account because the bill is now lying with Harry. So, on the same date, 1st Jan 2023, bank account debit, discounting charges account debit to Harry's account, being the amount received from Harry on the account of bills receivable. See, what would have happened is if you were preparing journal entries in the books of Harry, you would understand this in a better way. Now, Harry has got the acceptance of the bill. So, he holds a bill, he walks into the bank and gets it discounted. So after the discounting is done, now he is bringing that share and giving it to Sejal. I hope this how the entry is being reflected is clear to all of you. Yes. So bank account debit discounting charges to Harry. Now you are receiving how much money? 56,000. Reading further, see here, Harry remits 1/4 amount to Sejal. So 56,000 is the discounting amount. In that 1/4 will be 14,000. So that is how here we are getting 14,000. 56,000 into 1 by 4. Clear with this? Next. Discounting charges is 1,000. Now, how are we getting the discounting charges? Observe here, 4,000 was discount. So, 4,000 again shared in the ratio of benefit derived. So, this will again be 1,000. So, 4,000 into 1 by 4. Clear? To Harry. I hope all of you understood the entry till here. Further, on the due date, Harry was unable to remit his share to Sejal, rather accepts a bill of 80,000 for a period of 3 months. Now, what happened here is when the due date is nearing, Harry had to give away his share of amount so that Sejal, who's having that liability with the bank, has to make the payment to bank. But what happened here? Harry was unable to remit his share, rather accepts a bill of 80,000 for a period of 3 months. Now they are accommodating with another bill. So once this happens, first we will have to cancel the old bill because the due date would have emerged. Remember, the bill was drawn on 1st Jan. It was valid for 3 months. So Jan, Feb, March. And there will be 3 days of grace as well in the month of April. So it will be 4th of April. Observe here the entry, all of you, 4th of the April. Now, bills receivable account debit to Harry is the entry for the new bill accepted. See here, rather accepts a bill for 80,000. That is the entry what we are understanding here. Bills receivable to Harry. Now, before this new bill emerged, the old bill did not meet with respect to the discounting which was supposed to be remitted to bank. That needs to be passed with another cancellation entry. So what will be the entry for this? Whatever we have passed will now be reversed. Back, the bill will be standing due to Sejal. So we have reflected that in the ledger of Harry. Observe here. Now this was the entry for the bank and discounting charges being shared. Bills receivable to Harry's account. This will be the entry because it will again stand as a due. I hope all of you are understanding this. Next. This bill was discounted by Sejal for 74,600. Now, Sejal has the bill. She will walk down to the bank and gets it discounted. So, when she is receiving, what will be the entry? On 4th of April, bank account debit, discounting charges account debit to bills receivable. So what is the bill amount? 80,000. In return, we are getting 74,600. So the difference between these two, 5,400, will be discounting charges. Now this money, what you have got, you have to remit it to the Harry. His share should be given. See, Sejal, after making the payment of first bill, sent 3/4 of the amount remaining to Harry. So, remaining to Harry after making the payment of first bill. Now, you are getting 80,000. That is, you are actually getting 74,600. In that, how much was the due for first bill? See here, 60,000 was supposed to be paid on bill number 1, correct? So, this need to be paid first. So, what will be the payment entry? You're paying to whom? To bank. So, bills payable account debit to bank. So, this will get cancelled. 60 and 60. I hope all of you understood this entry. Next. Now, remaining amount, 3/4 was sent to Harry. Now, the bill amount was 80,000. It was used for paying 60,000. How much is still left? 20,000, and that 3/4 is sent to Harry. While we are sending, what is the entry? Harry's account debit to bank account to discount account. To bank account for the 3/4 amount. 15,000 will be the 3/4 amount. How are we getting this? 20,000 into 3 by 4. Clear with this? Then, in this, to bank, we are supposed to take out the discounting charges because anyway, the ratio of it should be shared in the benefit derived. So, observe the discount calculation here. 5,400 was the total discount. Now, this was for how much? 5,400 was the discount amount with respect to 80,000. In respect of how much we have remitted, 60,000. So the discount amount here will be 4,050 if you solve in this pattern. Clear? So this was with respect to the share given credited back to Harry. Later, on maturity of the bill, Harry became bankrupt and his estate paying 40 paisa in the rupee. Now here understand, the second bill was drawn from Sejal. That is, for Sejal, it was bills receivable. Later, Sejal got it discounted. Now, the bank has the due which was supposed to be paid from Harry, correct? Now, when other party becomes insolvent, you have to be careful here that first we need to cancel the bill entry as if showing it as a dishonor entry. Who was supposed to pay Harry? He was a creditor. Now he is no longer going to be creditor. So I will debit by cancelling. What was it representing? Bills. So the entry now here will be Harry's account debit to bank because it was ultimately with the bank. The bill was with the bank. To bank will be the entry. 80,000, 80,000. Now these two has Harry's account. So the same will be reflected in his ledger. See, to bank, to discount, to bank, 80,000. Clear? Then, now here the question says, his estate paying 40 paisa in the rupee. That means we are able to recover some amount. 40% is able to recover. So what will be the entry? Bank account debit, bad debts account debit to Harry's account. Now no longer you are going to recover any of the amount. How much was due? 60,000. In that 60,000, 40% I am able to recover. So that will be 24,000 and the balance will be your bad debt. I hope all of you understood this point. Yes, right. So this completes our second question. Moving on to question number 3. So let's read this further and then we will understand this with solution. The following trial balance is the trial balance of a proprietor as on 31st March. Prepare trading and profit and loss account for the year ending 31st March 2024 and a balance sheet as at that date. So they are giving various details of assets and liabilities. Additional information, closing stock on 31st March is 5,20,000. During the year, plant and machinery was purchased for 3 lakh, but it was debited to purchases account. 3 months factory rent is due but not paid, 3,000. Provide depreciation at 5% and 10% on plant and machinery. Further bad debts is 7,000. Provision for doubtful debts to be increased to 30,000 at year end. Provision for discount on debtors to be made at 2%. So these are the list of adjustments. More important is now, importance is given here for bad debts and provision. So let's first approach the question by using additional information at first. Open your trading account, profit and loss account, balance sheet format wise. So it becomes easier as you run through the transactions or adjustments to make the simultaneous entries. All right. There is closing stock on 31st March 2024, 5 lakh 20, where and all closing stock will appear first in trading account and then in closing balance sheet. So we can observe the entries here. I will just highlight so it becomes easier for you to get the interpretation. 5 lakh 20, and then in the balance sheet, closing stock in trade. 5 lakh 20. Understood? Yes. So this is done. Next, during the year, plant and machinery was purchased for 3 lakh, but it was debited to purchases account. So there is an error. So where is purchases placed in trading account? So first, let's understand the purchase value. 21 lakh 35,000 is the purchase value. So this is including the item of furniture. So in trading account, two purchases 2135. I will have to take this out. So minus 3 lakh. Less plant and machinery 3 lakh. This need to be added to your plant and machinery total. So plus plant and machinery 3 lakh. Clear? Then on this we need to also consider the depreciation, but now this treatment, second point treatment is done. 3 months factory rent is due but not paid, 3000. Factory rent is showing at 8000. Remember, this is a direct expense which appears in your trading account. 3 months factory rent is due but not paid is 3000. So they're directly giving us how much is the due amount, 8000 reflected in trading account. To this, I will also have to consider the outstanding amount because this is a current year expense. So plus 3000. See here, to factory rent 8000 plus 3000. Since this is not paid, this becomes your liability. So we will also reflect this in the balance sheet. Outstanding factory rent 3000. Clear? Next. Provide depreciation at 5% per annum on furniture and 10% on plant and machinery and motor van. So furniture all will appear in the balance sheet. Furniture 26,000 on this 5%. So 26,000 into 5% will be 1,300. So the same will appear in profit and loss account. To depreciation. So here they have totally taken all depreciations together. So we can just understand this with a working note. Office furniture we have done. Then there was plant and machinery 10%, motor van also 10%. So remember, in plant and machinery there is another addition which happened and they have not given any dates. So we'll also consider that was for whole year. Plant and machinery 5 lakh, to which I added 3 lakh. So total 8 lakh on that 10%, it will be 80,000. Clear? Then this all will appear in the balance sheet. Motor van 1 lakh 20, on that there was 10% of depreciation. So 1 lakh 20 into 10% will be 12,000. So motor van 12,000. Total depreciation is being taken to your profit and loss account. See here, respective depreciation, they are showing this in the balance sheet. Motor van less depreciation. In profit and loss account, to depreciation, total value is taken. Clear with this? Yes. Next, we have bad debts, provision for doubtful debts, and then provision for discount on debtors. Okay. So there is also an existing bad debt given, and additionally there are bad debts more. So we can just understand this with when working. So how much will go to profit and loss account? Bad debts which is already existing is 25,000. Add further bad debts which is 7,000. So this becomes 32,000. Here I will have to subtract old provision. Any old provision present in the question? Yes. See here, provision for doubtful debts 25,000. So this is nothing but my old provision. If there is any new provision, I can add this. So first, to new provision, how much is my sundry debtors? 4,57,000. 4,57,000. Remember, in the adjustments, we are having further bad debts that needs to be removed. 7,000. On this value, I will charge how much to be increased to 30,000. Okay. So new provision is 30,000, which is directly given. We need not think about this calculation. If they are given percentage on that value, I have to suppose to apply the percentage. So 32,000 minus 25,000 plus 30,000. So your amount to be debited to profit and loss account will be 37,000. Let's observe here. See, to provision for doubtful debts, 37,000. In your balance sheet, debtors will first be taken at 4,57,000 minus further bad debts, and then you will take the new provision, which is 30 in total. Be careful about these numbers. Then provision for debtors. So this is done. Provision for discount on debtors to be made at 2%. Now 4,57,000 was your debtors. How do we calculate? 4,57,000 was my debtors minus 7,000 further debtors. New provision is how much? 30,000. So 4,57,000 minus 7 minus 30. On this 4,20,000, you will charge 2% into 2%. So that will be how much? 8,400. See here, to provision for discount on debtors, 8,400. Understood all of you this? These were the important step marking adjustments where you have to make this presentation neatly. See, I can also show you this. See, in this question, Institute has presented provision for bad and doubtful debts in the ledger form. If you're comfortable with ledger, you can go ahead with it. If not, you can also prepare that in a statement form. See here, provision for discount on debtors, they have presented in statement form. They are taking first debtors minus further bad debts, then new provision. Debtors before discount, on that we will charge 2%. Clear with this? Yes. So this completes our adjustments. Now remaining all of the items we need to just place in. Plant and machinery done, office furniture, opening stock in trading account. To opening stock 4,80,000. Then motor van, sundry debtors all considered. Cash in hand 4,000. This appears in the balance sheet. Cash in hand 4,000. Cash at bank 65. Wages, direct expenses, trading account 15 lakh. To wages 15 lakh. And then salaries, indirect expense P&L 1 lakh 40. Purchases, trading impact already done. Bills receivable, current asset. So in the balance sheet, bills receivable 72,000. Return inwards means sales return. Deducted from sales minus 93 in trading account. We have still not come across sales, so minus 93 here. Drawings, balance sheet 70,000. See here, less drawings from the capital. Advertisements, indirect expense 60,000. Then we have factory rent already entered. Insurance 63,000. P&L. General expenses 10,000. Profit and loss. Discount allowed again. It is a loss, so appears in profit and loss account 65,000. Then we have capital. We have to take it to the balance sheet. Capital 4 lakh. Sundry creditors liability 5 lakh 20,000. Then sales, trading account, by sales. Bills payable liability 56,000. Bills payable. Then provision for doubtful debts treatment done. Written outwards means purchase returns. We will take it here to purchases. Discount received 37,000. Gain by discount received. So this is all the items. So consider all of these. After you enter, find out the net purchases, net sales value. You'll first find out gross profit. Take that gross profit to profit and loss. And then in this case, you have net profit, which will be transferred to capital account. So take that to capital, and accordingly your balance sheet will get tallied. The total here is 19,25,300. I've just explained you how the respective treatments are to be considered. You will get it only when you literally practice the question once, depending upon how much time you are investing and what is your speed. This will be evaluated only when you literally practice it, guys. Make sure you are doing it from your end. Yes. Moving on to the next question. The following is the balance sheet of Krish and Bala sharing profits and losses in the ratio of 3:2. So they are giving us the balance sheet details, assets and liabilities details. General reserve is there, workmen's compensation reserve is there, creditors, employees provident fund. Now these reserves you have to specifically observe because you cannot expect the treatment given to be given in the question, especially for general reserve. All right. So provision for doubtful debts is already having a balance. Okay. So on admission of Shobha for 1/6 share in the profits, it was decided that value of land and building to be increased by 5,000, stock 3,500, provision for doubtful debts again increased by 1,500. Liabilities of workmen's compensation reserve was to be determined to be 8,000. Shobha was to bring in cash for 25,000 as her capital, brought in her share of goodwill 12,000 in cash. You are asked to prepare the revaluation account, capital account, and the balance sheet of new firm. All right. So we will open all the accounts, revaluation, partners capital, and then balance sheet. In first we will complete off the revaluation, the most easiest one. Value of land and building to be increased by 5,000. So on the credit side of revaluation, buy land and building. Value of stock again to be increased by 3,500. Increase in an asset credit side by stock. Then provision for doubtful debts to be increased by 1,500. This is increase in towards your loss. So on the debit side, to provision for doubtful debts 1,500. So this take care of all revaluation impacts on assets and liabilities. So this is done. So we'll close the revaluation, find out the profit or loss. In this case, there is profit on revaluation transferred only to old partners. In the admission, we'll only transfer it to old partners. Now we have opened the capital account, buy balance brought down, bring down all the capital balances. Then transfer this revaluation profit. In the question there was general reserve. So if before any reconstitution happens, this needs to be shared amongst partners in their old profit sharing ratio. So 30,000 will be apportioned to old partners Krish and Bala in 3:2. So the entry for that will be by general reserve to Krish capital account to Bala's capital account. Now how are we getting that? See, general reserve was 30,000 into 3 by 5 for Krish 18. So the remaining 12 will be for Bala. Clear with this? Yes. Next, liabilities of workmen's compensation reserve was determined to be 8,000. Now let's observe how much balance is available. 10,000 is available. But the question is confirming that only 8,000 is the liability. So what is that 2,000 remaining in the reserve? This is again nothing but excess which will be transferred to old partners. So what will be the entry for that? Observe here, by workman compensation reserve. Again, how much is remaining? 2,000 in their old ratio. 2,000 into 3 by 5. That will be 1,200, and again 2,000 into 2 by 5 will be 800. I hope all of you understood this treatment. Clear? Next. Soba was to bring in cash for 25,000 as their capital. So bank account debit to Soba's capital will be the entry. Soba bought in her share of goodwill also in cash. So for this also the entry will be bank account debit again to Soba's capital. Total 25,000 plus 12, 37,000 will be considered as the entry. So for that, observe here, by bank capital plus goodwill 37,000. Now this share of goodwill brought in by the new partner should be apportioned to old partners. Now this will be done in which ratio? Sacrificing ratio. Is the question giving us sacrificing ratio? No. Can we find it out? Yes. So future share is given as 1/6. So what will be the remaining share? Remaining share will be 1 minus 1 by 6. So this will be 6 minus 1 by 6, which is nothing but 5 by 6. Krish, old ratio 3 by 5 into remaining share. So this will be 15 by 30. In other words, 1 by 2. For Bala, 2 by 5 into 5 by 6, 10 by 30. This is 1 by 3. Now, what did we actually find? We found out, we are finding out the new profit sharing ratio, because sacrificing ratio is about new ratio minus old ratio. So, what is the new ratio here? Let me show you the working. See, We got 1 by 2 for Krish, 1 by 3 for Bala. Now if I observe for Soba, it is 1 by 6. Denominators are not common. So what can we do in order to make Krish share having the denominator 6? I can multiply and divide by 3. So 3 by 6, then 2 by 6, 1 by 6. So new profit sharing ratio will be 3 is to 2 is to 1. See, observe the working here. They have taken new profit sharing ratio 3 is to 2 is to 1 and old ratio 3 by 5, 2 by 5. We need to find out the sacrificing ratio. What is the formula for sacrificing ratio? Old ratio minus new ratio. Now let me show you the working here. Krish 3 by 5 minus 3 by 6. 30. 6 5s are 30. 6 3s are 18. 6 5s are 5 3s are 15. So this will be 3 by 30 and Bala 2 by 5 minus 2 by 6, 30. 6 5s are 30, then 6 2s are 12, 6 5s are 5 2s are 10, 2 by 30. So sacrificing ratio will be 3 is to 2. 12,000 was the share into 3 by 5, 7,200 and the balance 4,800 will be for given for Bala. What will be the entry? Now the first entry was bank account debit to Soba's capital. Soba's capital account debit to Krish capital account to Bala's capital account. So that will be reflected in the capital. See here to Krish and Bala 12,000. Buy Soba in Krish column and 7,200 in Krish column, 4,800 in Bala's column. So these were all the entries. I hope all of you understood this. Next. One more thing, what you need to observe in the balance sheet is there is advertisement expenditure given on the asset side in the balance sheet. So this will be in the nature of a fictitious asset. Before any reconstitution happens, this also need to be apportioned to all partners who are present in the business before the admission happens. So 4,000 will be apportioned. So what will be the entry? It will have a debit balance. Now we are transferring it to partners capital. So partners capital account debit to advertisement expenses. So that is what the entry you will observe. 2,400, 1,600, which is nothing but 4,000 distributed in their old profit sharing ratio. So these are all the points which is done. So we will close the partners capital and then consider the revaluation impact in the balance sheet. Take the closing balances of Krish, Bala and Soba to your bank. Remember, to the existing balance. Let's observe here. See how much was the bank balance? 20,000 was bank balance. You're getting Soba's capital and share of goodwill. That was totally 37,000. So the bank balance will now be 57,000. So all these impacts to be considered, to be incorporated in your balance sheet. That is when it gets tallied. So total of balance sheet is coming at 1,38,000. I hope all of you understood this question. Meanwhile, also practice it from your end too. Done. So this completes our question, both parts. Moving on to question number 4. XYZ were in a firm sharing profit and losses as 3 is to 2 is to 1. Their balance sheet on 31st March 2024 was as follows. They are giving the balance sheet details. Again, in this case also observe investment fluctuation fund is given, workmen's compensation reserve is there, trade creditors and then employees provident fund. On the asset side, investments market value is given, goodwill is also there. See, observe this, goodwill is also present. Then debtors is there, provision for doubtful debts is there, cash at bank. Later, Z retired on the above date on the following terms. Goodwill of the firm was valued at 60. Now, if you observe, the goodwill is reflecting at 12, but as they are due to reconstitution, it is getting revalued at 60. Value of patent was to be reduced by 20 and that of machinery to 90. Provision for doubtful debts to be raised to 10%. Liability on account of provident fund was only 6,000. But you have the balance at 12. Okay. Liability for workman compensation to the extent of 6,000 is to be created. That means over and above this, they also require additionally 6,000. Z took over the investment at market value. Amount due to Z is to be settled on the following basis. 50% on retirement, 50% of the balance within 1 year, and the balance by a bill of exchange at 3 months. See here, this reading should be carefully done. 50% immediately on retirement, and then the other half is again divided into two. One will be returned within 1 year, and the other one should be done or settled by drawing or creating a bill. Understood the question? Now, in this, the requirement is they are asking you to show the entries for the treatment of goodwill. Reason being, there is goodwill appearing in the balance sheet, and then for the purpose of retirement, the goodwill treatment should be apportioned to the partners as well. Then prepare revaluation account, partners capital, and then balance sheet. So first let's understand the goodwill entry. See, when the goodwill is reflected in the balance sheet, that has no relevance since now there is reconstitution. So first treatment will be for that goodwill, we will write it off. So goodwill is having a debit balance. Now we are writing it off means we will credit. Who is receiving that? Partners. So how many partners are there? Three partners. So X capital, Y's capital, and Z's capital. Remember, this is retirement. So the all three will be called as old partners. So how much was there in the business? 12,000. So 12,000 in their old profit sharing ratio, that was 3 is to 2 is to 1. So what will be the entry? X capital account debit, X capital account debit, Y's capital account debit, and Z's capital account debit to goodwill. So this is nothing but first entry to write off the goodwill. I hope all of you understood this comfortably. Next will be apportioning the share of retiring partner in the case of retirement at gain ratio. For that, we need to calculate gain ratio. We require old ratio and new profit sharing ratio details. Have they given the details of new ratio? Nothing specified. If nothing is specified, what do we understand? New ratio is as equal to old ratio, and the same will be our gain ratio as well. Now observe the working here. See, what is the new ratio of the remaining partners? Now, earlier they were sharing in 3 is to 2 is to 1. Now, C, who was sharing, Z, who was sharing 1/6 is no longer continuing. So, how much is remaining? 3 is to 2. So, X will have 3 by 5 minus his old ratio 3 by 6. If we further calculate this, 3 by 30, 2 by 30 will be their gain share. 3 is to 2 is their gain ratio. So, what is the journal entry? Gaining partners capital account should be debited and retiring partners capital account should be credited. Who are gaining partners? X capital account and Y's capital. Retiring here is Z to Z's capital account. So our entry will be X capital account 6,000 debits, Y's capital debit to Z's capital. Clear with this? Now how are we getting 10,000? See, 60,000 is his total firm's share. Total firm's goodwill. 60,000 into 1 by 6 will be Z's share, that is 10,000. Understood this, all of you? These entries will also be reflected in the partner's capital. Now we will start by first preparing revaluation account. Value of patents is reduced by 20%, 30,000, 20% will be 6. So 2 patents on the debit side. Then machinery 90%, 60,000. They are bringing down at 10%. So 2 machinery 6,000. Then provision of dot roulette was to be raised to 10%. So 10% on 50,000 should be 5,000. But they have only created up to 4. So how much more is required? 1,000. So to provision for bad debts 1,000. Then liability on account of provident fund was only 6,000. How much is the balance shown? 12,000. So they are only needing how much? 6,000. So the balance is nothing but your excess. So this has again true treatment, same like your reserve. Either you can consider this as decrease in the value of liability, take it to revaluation, or directly provide the impact in the partner's capital. In this question, the institute has considered by considering it as a reduction in the value of liability, hence being shown on the liability side because they only required 6 but the available balance is 12. So remaining 6 is nothing but saving. So that is being taken in the revaluation on the credit side. I hope you understood both the treatments what I just explained. Okay. Next, liability for workmen compensation to the extent of 6,000 to be created. Now 12,000 was there. Additionally, they require 6 more. So totally they want it to be at 18,000. Now, this reserve is created from the profit balance. Ultimately, this should be from the share of partners itself. So where will this get reflected? See here, first they are showing this as an increase in liability. So two workmen's compensation 6,000 because 6,000 more was only what required. So this is considered here. Okay. Z took over the investment at market value. They are giving us the market value of investment 27,600. Investments will have debit balance. When it is taken out of the business, it will be credited. Who is taking it? Z account. So the entry will here be Z's capital account debit to investment. So observe in the partner's capital to investments 27,600. This is what is reflected. Clear? So these are all the list of adjustments, and the last point they are giving about settlement. So now first let's incorporate every point which is taken care here. So by balance brought down, X, this is Y, printing error I guess, Y's capital account, and then Z's capital account. We will write down the balances. Investment fluctuation fund is also again a specific reserve created. Since there is a reconstitution, we will first apportion this amongst the partners. So this is 6,000 which will be shared amongst all the partners by investment fluctuation fund in their old profit sharing ratio. Okay, then there is this goodwill entry by X, Y capital and here to Z's capital in X and Z, X and Y column. To goodwill, we had also understood this entry. This is nothing but first part which is writing off. Then there was a revaluation loss that has been transferred. Clear with all of these? After transferring all of these, we are majorly concerned about Z, who is the retiring partner. So use your calculator in order to understand these values now clearly, guys. 31,000 plus 1,000 minus 6,000 plus 4,000. 42,000 is the total of Z's column minus 2,000 minus 1733 minus 27,600. So this is the amount due to be payable to Z, that is 10,667. In this 50% is payable in 1 year, that will be transferred to his loan. So in this 50% if I take, that will be 5,333. I can round it off to 53434. Okay, this was immediately paid to bank 5334. In the balance, 50% was payable in a year. Earlier, I just missed out by telling 50,000 is settled immediately. For that, we are making to bank. Then 50,000 in a year. So that will be transferred to his loan, to Z's loan. 5334 is the balance. In that 50% is what we have taken. And the remaining by drawing a bill. Remember, this is from a partnership firm. For a partnership firm, it is a liability. Who should accept Z? So the entry here will be Z's capital to bills payable, so which is getting reflected here. Clear? Now, all of these will have to be incorporated in the balance sheet. First, we will take the revalued data of the assets and liabilities. So, two patents 30,000 minus 6,000, machinery 60 minus 654, closing stock 30,650. Sundry debtors is 50,000. They want it to be raised. Total will be 5. That is 45. Then cash and bank balance. How is it? 8350. 8350 minus you are paying 5334. That is how we are getting 3016. Then take the capital account of the partners. Z's loan we have created. There was also a bills payable for 2667. Don't forget all of this. Workman compensation fund they wanted to create for additional 6. Adding up both, it comes to 18. Then there is employee provident fund which is 6 because they only wanted 6. They have not told it is being used. It is still standing as a liability that has been written. This question had few points where most of the students can miss out taking, especially the treatment of goodwill for writing off the first entry, and then with respect to this value they can get confused with respect to reading how it needs to be set. So once after you understand the question, practice from your end too. That is when you gauge whether you have understood it completely or not. Clear? Yes. So this was our first part of the question. Next. From the following receipts and payments account of Delhi Club, prepare income and expenditure account for the year ended 31st December and its balance sheet as on that date. So the requirement here is to prepare income and expenditure and balance sheet. So we will open all of both the accounts. In this question, they are not anywhere mentioning the opening capital balance. So we, as a part of working note, we need to also prepare opening balance sheet. Okay. So subscription, we will run through the adjustments likewise and then go the details given. Subscription in arrear for 2023 is 1200. Subscription in advance for 2024 is 550. So in the question, as per receipts, how much is the subscription details given? 10,000. We need to know how much should be recorded as the current year income in the income and expenditure. So 10,000. Subscription arrear for 2023 means it is a current year expense. So it needs to be added plus 1200. Subscription in advance for 2024. You are receiving well in advance. It is not your current year income. So minus 550. 10,000 plus 1,200 minus 550. 10,650. You will show this in the income and expenditure income side, 10,650. So you will make a working note for this, what we are adding and what we are subtracting. Subscription in arrear means your income receivable. So in the closing balance sheet, this will be your asset. Subscription receivable 1,200. There is an alignment error here. So subscription receivable is 1,200. Subscription in advance becomes your liability. So that is reflected in the closing balance sheet. Understood? Yes. Next, insurance premium outstanding 80, miscellaneous expenses prepaid 90. So we have to look out for insurance premium. Look at the payment side. Insurance premium 300. So insurance premium is outstanding. That means we need to add. So in the income and expenditure, payment will be 380 to insurance premium 380 and 80 rupees is outstanding. So that will be reflected in the closing balance sheet. Insurance premium payable 80. Then miscellaneous expenses prepaid. Miscellaneous expenses, yes, miscellaneous expenses 500. It is prepaid, so not belonging to the current year. So we will subtract expenditure, miscellaneous expenses. See, here it is 500 minus 90 rupees, 410. Prepaid expense is your asset, so that will be shown in the balance sheet as 90 rupees. Clear? Next, 50% of donation is to be capitalized. 50% of donation, how much they are receiving? They are receiving 7,000. In that 50% should be capitalized means it should be taken to balance sheet and the remaining will go to income. Observe here, add donation 50%. 7,000 was total, in that 50% is 3,500 and the remaining donation 50% is shown on the income side. Okay. Then entrance fee are to be treated as revenue income. That means it will be taken to the income and expenditure account. Entrance fee 1,500 by entrance fee 1,500. Then 8% interest is accrued on investments for 5 months. So we have to first understand whether investment details is given to us. Yes, purchase of investments is given 6,000. So the question is telling interest rate is 8% and this is accrued for 5 months. That means it is due. It is still not received. So if I calculate it for 5 months, it should be 200 rupees. But here they have received 100 rupees worth of interest. How much is outstanding? 100 more. So total amount should be recorded in income and expenditure. So in income and expenditure, by interest on investments, 100 rupees plus the outstanding amount. So that will be 300. In the balance sheet, you will note the outstanding receivable interest accrued on investments 200 rupees. Clear with this? Understood the working, all of you? Yes. So just for your reference, how are we getting this? 6,000 into 8 by 100 into 5 by 12. This is how we are getting 200 rupees. Clear? Then Billiards table costing 30,000 was purchased during the last year and 20,000 were paid for it. So there was an asset 30,000 last year, means it will also appear in the opening balance sheet. Yes or no? See here, billiards table 30,000. So this will also appear in the closing balance sheet, billiards table at 30. But what is happening here? 20,000 were paid for it, means in the current year. Here under the receipts and payments account, they have not mentioned about these payments getting recorded. So therefore, we will record. Yes, I guess all of you understood the interest calculation. Next, billiards table costing rupees 30,000 were purchased during the last year and 20,000 were paid for it. Now, billiards table costing 30,000 purchased last year, means it will also appear in the opening balance sheet. Yes. So observe here, opening balance sheet, billiards table 30,000. 20,000 were paid for it. That means at the time of purchase, they only paid 20,000. What is that 10,000 balance? That will be your creditors. You still need to be settled that. So we will also have a liability, creditors for billiards table 10,000. I hope all of you understood this. Okay. So in the question in receipts and payments account also, if you observe, billiards table 10,000, it is being paid in the current year. So that is being reflected in the payments account. So in the balance sheet, closing balance sheet, creditors will again not come because that is being settled. Clear? So billiards table will anyway appear at 30,000. Understood the treatment, all of you here? Yes. Now, this completes our adjustment. Looking at the other items of receipts and payments. So cash in hand opening. So you will take it to the opening balance sheet, 8,100 and 15,000 closing. See, 8,100 cash at bank is your cash at bank balance and not closing. Okay, then donation, subscription we have already treated. Entrance fees already taken. Interest on investments done. Interest received from bank. So we will enter that on the income side. Interest received from bank 400. Sale of old newspaper 250. Sale of drama tickets 1,250. Here there is drama expense or as well. So we will net this and write. So sale of drama tickets 1,250 minus 500. That is what is shown here. Salary on the expenditure side. Repair expenses. Sorry. Repair expenses 500. Then purchase of furniture. This will be added to my asset. Furniture 7,000 in the closing balance sheet only. Then we have miscellaneous expenses treatment done, purchase of investments to be recorded in the closing balance sheet. Then we have paper ink 250. So paper ink 250 taken. Cash in hand closing balance sheet. Cash in hand 4,500. Cash at bank 11,050. So this is all done. So first we will close income and expenditure, find out whether there is surplus or deficit, then find out capital fund from the opening balance sheet. See, we have entered all, only this is remaining. Take this to the closing balance sheet, consider the surplus or deficit, and then find out the total of the balance sheet. In this case, it is 60,040. Clear, all of you? Please make note of the points where you can go wrong or what you have felt difficult to interpret, because those are the points which might fall for your marks to lose out. So therefore be careful about all this. It is always better to make a note out of those. So that acts as your guide to again not repeat the same mistakes. Clear? Okay. So this completes our fourth question. Yes. Now let's discuss question number 5. Physical verification of stock in a business was done on 23rd June. The value of the stock was 4,80,000. The following transactions took place between 23rd June and 30th June. So this is testing you the concept of stock taking. Out of the goods sent on consignment, goods at cost worth 24,000 were unsold. So here they are asking us to determine the value of stock as on 30th June. So as we run through the transaction, we can simultaneously understand the treatment. See, goods are being sent on the consignment, it is still not sold. Goods at cost worth 24,000 were unsold. That means it is still lying in your stock. It should be part of your inventory. So what do? We will add unsold goods, stock of the goods sent on consignment, 24,000. Observe here, unsold stock of the goods sent on consignment, 24,000. Clear? Done. Next, purchase of 40,000 were made, out of which goods worth 16,000 were delivered on 5th July. Now, purchases total is 40, but there are some goods still on transit. It doesn't matter. Now, we are just finding out what is your value of inventory and not the exact physical value of inventory, correct? So total 40,000 needs to be considered to our stock. So we will add this. Purchases will be taken. See here the institute has shown this as a two breakup. Purchases during the period 24,000 and 16 they are showing it as goods in transit. So anyway both needs to be added. Clear? Done. Next, sales were 1,36,000 which include goods worth 32,000 sent on approval. Half of these goods were returned before 30th June, but no information is available regarding the remaining goods. So, they had sent 32,000 worth goods, which is part of the sales. Actually speaking, goods sent on approval is not a concluded sale, so this should not have been part of your sales. Here they are telling the half story, that is half of the goods have been returned, the other half there is no confirmation. So now we will just consider the treatment of half part of the goods. 32,000, in that half will be 16,000. Now when they are considering it at sales, it will be reflected at selling price. But here we are finding out the value of inventory. We need to find out this at cost price. That means we need to subtract the gross margin from the selling price. In the next transaction, they are giving us the percentage. Goods are sold at cost plus 25%. However, goods costing 24,000 had been sold for 12,000. Now understand here, there are normal sales, there is abnormal sales. Now first on both we have to take out the gross margin and then calculate. Here there is a calculation done. Let me show this here itself for you. See, cost of calculation of normal sales, actual sales was 1,36,000. In that, I have to take out the return of goods sent on approval, also the abnormal sales. Abnormal sales value is 12,000, so that is what is taken. Return of goods sent on approval is 16, that is 32,000, 50%. So total is being considered. Then this is the normal part for which I have to subtract gross profit. Now observe here the question is giving me gross margin on cost and not on profit. Sorry, and not on sales. Can we find it on sales? Yes. 25% on cost. So just to explain how to find this. See, I hope mathematically all of you would be aware, but just to help you further, if I consider 100 rupees as cost, 25% on cost is taken. So plus 25, this is nothing but taken to find out the selling price. Cost plus profit. Profit percentage is now given on cost. So selling price will be 125. Now I want the percentage on sales. So 25 by 125. This will be how much? 20%. So this 20% should be considered. See here 20 by 100 on 1,08,000. So this will be 21,600. Later, loss on sale of abnormal goods. See here in the next part of the transaction, goods costing 24,000 had been sold for 12,000. That means there is abnormal loss that is also being considered here, minus 12,000. So your gross profit is 9,600. This needs to be subtracted in my sales. See, 1,36,000 total sales minus 16 which is given for approval. Total gross profit 9,600. Understand carefully. Here we are also considering the abnormal sale impact. So therefore, one particular working note is done. Accordingly, your value of stock will be 4,46,400. I hope all of you understood this. Yes. Next, attempt any one of the two subparts, that is either 1 or 2. So there is an internal choice here. First part in that, PQR Associates bought a computer set on 1st April 2020 for 2 lakh and they charge depreciation at 20% on diminishing balance. They made further additions on 1st April 21, 1 lakh 50, 1st April 23, 1 lakh. On 1st April 2023, it was decided to change the method to straight line basis and charge depreciation, assuming the expected life of all the computers to be 8 years from 1st April 2023. Prepare computers account for the year ending 31st March 2024. So they are just asking a yearly data of computers account. Let me explain this. So for the same question, Institute has also given an alternate treatment wherein you can find out the value of closing stock by preparing a trading account. You can just have a look at it as well. And then preparing statement of valuation stock in the same format again. See here first, they are making the working. So let's understand the working. In the ledger, they are asking us to prepare or to show for 1 year. Now here they have made the purchases column. So this also becomes a better presentation. So it also becomes easier for you to collate it directly. Cost is 2 lakh. Depreciation is 20% on 2 lakh. So that will be 40,000. WDV after charging depreciation for the year end will be 1 lakh 60. Then there is another asset purchased on 1st April 2021. So there is another column 1 lakh 50. On that also depreciation is 20%. So that will be 30,000. So WDV of machine number 1 is 1 lakh 60. On that 20% will be 32,000. So written down value of machine 1 is 1 lakh 28 and machine 2 is 1 lakh 20. Then on 1st April 2023, there is another machine purchased for 1 lakh. So here they are not giving the machine number 3 details. We can directly record it in the ledger. Now after this 1st April 2022, we are again charging depreciation at 20%. See 1,28,000 into 20%, that is 25,600, and 1,20,000 into 20%, 24,000. So this is the written down value before the method is getting changed. Clear? Now this was required to open the particular account as a opening balance. So in computers account, we will write as two balance brought down these values. 1,98,400. How am I getting 1,98,400? Combination of both the assets. 1,02,400 plus 96. If you're not comfortable this, you can also break it down. Machine 1, machine 2, computer 1, computer 2 and write this. Clear? Okay. On this year, in this particular year, the method is getting changed from written down value to straight line method. So we will charge now depreciation on straight line basis. What was the machine number 1's value, or the combined value we can take 1,98,400, because the question is telling that expected life of all the computers is now 8 years. So 1,98,400 divided by 8. That will be 24,800. Remember, in this year, there is one new asset purchase. So what is the entry for that? Computers to bank. The value of the asset was 1 lakh. That is being recorded. On this 1 lakh divided by 8 years. That will be 12,500. Clear? Now, after we record this, we get balance carried down. The same will be taken for the next year as well. Simpler question, just presentation matters in order to save your time. You can also follow the same. This will help you saving lot of time. Clear? Okay. Next part of the question. Following information relates to Mr. Prem, who maintains his books under single entry. He is not able to ascertain the amount of bad debts incurred by him and seeks your help. So they're giving the debtors details and credit sales details. Payment received during the year is 7,50,000, out of which checks of rupees 18,000 were dishonored. Bills of exchange is accepted by customers 2,90,000. Discount allowed is 1% of the credit sale. Now here they are wanting what? He's not able to ascertain the amount of bad debts. So we need to find bad debts by preparing a debtors account. That helps us to find it as a balancing figure. So let's prepare a debtors account. Debtors as on 1st April 2023, opening balance will be two balance brought down. So that has been entered 6 lakh 50. Then debtors as on 31st March 24, this will be your closing balance by balance carried down 8 lakh 50,000. Clear? Then sales for financial year is 16 lakh, out of which 80% is on credit. Remember, we are presenting the data in debtors account. Only credit sales need to be considered. So 16 lakh is my total sales. 80% is on credit. So In 16 lakh, 80% will be 12 lakh 80. What will be the entry? Debtors account debit to sales. So to sales, 12 lakh 80. Then payment received during there is 7 lakh 50, out of which checks of 18,000 were dishonored. That means in 7 lakh 50, you're getting 18 net 7 lakh 32,000. So the balance will be considered as bill dishonor. So first for the payment received, what will be the entry? Bank account debit to debtors account. So by bank 7 lakh 32. So 18,000 we are removing it. Next, bills of exchange accepted by customers 2 lakh 90,000. So you are drawing the bill, it has been accepted by the customer. So what will be the entry? Bills receivable account debit to debtors. So by bills receivable 2 lakh 90,000. Clear with this? Okay. Discount allowed is 1% of the credit sale. What will be the entry for discount? Discount allowed account debit to debtors. So 1% of the credit sales. 12 lakh 80 was my credit sale. So that will be 12,800 by discount allowed. Now we have entered all the details. Remaining is only bad debts. That is what the requirement of the question. We will find that as the balancing figure. Clear with this, all of you? I hope each one of you understood this. Right. Then next question. XYZ Limited is an unlisted company issued 6,000 12% debentures of 100 each at a discount of 5% on 1st April 2021. Interest is payable annually on 31st March every year. The debentures are redeemable at a premium of 10% in 3 equal annual installments beginning from 31st March 2022. The company invested in specified securities for the redemption of debentures. That means it is talking about debenture redemption reserve investment. Entire loss on issues to be booked in the first year. So that means this is the treatment they are talking about, the loss due to discount and on the premium. You are required to pass journal entries for all the 3 years. I hope all of you understood the question. First, we need to make the issue entry, and then for the redemption, it is happening in 3 annual installments. Debenture redemption reserve investments, all those needs to be considered. I hope all of you are aware. As per the provisions of Companies Act, 10% of the amount outstanding towards debenture need to be created or transferred to debenture redemption reserve, and then 15% of the face value of debenture has to be made as an investment in specified security, which we call as debenture redemption reserve investment account. Keeping this in mind, let's understand the entries. First, for the issue. So what will be the issue entry? You're receiving money. So bank account debit to 12% debentures. In this, you're issuing it at discount. So something will get debited here. Discount on issue of debentures. Likewise, redemption details is also given. Redemption is happening at 10% premium. So we can record this at the time of issue itself. Premium on redemption of debentures will also be debited. Since both are having been here, we will combine this as one entry and write as loss on issue of debentures. 2 12% debentures account, 2 premium on redemption of debentures. This will be your first entry. Now observe, this is happening on 1st April 21. Bank account debit 6,000 into 100. But here there is a discount of 5%. That will be 5,70,000. Loss on issue of debentures. How are we getting this? So here, first 5% discount. So that will be 30,000 as discount, plus 10% premium on redemption, 6,000 into 100 into 10% will be how much? 60,000. So this put together total 90,000 will be loss on issue of debentures. Clear with this? Then 12% debentures to premium on redemption. This is what the entry we discussed. 6 lakh at face value and 60,000, that is 10% premium. Clear? Then next, on 1st April 21, we are creating reserve. After the issue immediately, 10% of the amount should be transferred to reserve. So what will be the entry? Profit and loss account debit to debenture redemption reserve. 6 lakh is the total amount outstanding. 10% of it will be 60,000. So 60,000 and 60. Being debenture redemption reserve created at 10%. So this completes our first year. This completes creation of reserve. You have to also make an investment in specified securities. How much? 15% of the amount. So what will be the investment entry? debenture redemption reserve investment to bank. See, in this question, they are giving a specific treatment with respect to reserves. So 10% of the amount outstanding will be created as reserve. That is nothing but profit and loss account debit to debenture redemption reserve. Now, 15% of the amount outstanding should have to be invested in the specified securities. Remember, the investment will be made only for the purpose of redemption. And in the question, the redemption is happening in 3 annual installments. So, we will also make sure that the investment also works in the same fashion. So, first of all, what is the entry for making the investment? Debenture redemption reserve investment account debit to bank. Observe, this is the entry. But how much will be the amount? 6 lakh is the total requirement. Yes or no? So if we divide that for over the period of 3 years, 6 lakh divided by 3 into 15% is the requirement. So that will be your amount of investment. Clear with this? 6 lakh is the total outstanding amount. 15% is the minimum requirement as per the law, apportioned over the period of 3 years. Clear? Okay. So next will be the entire recognition of loss to be booked in the first year itself is given in the question. So at the year end, we will book it to profit and loss. The entry will be profit and loss account debit to loss on issue, entire 90,000. If this was not given, we would have written it off over the period of 3 years. I hope all of you are getting these points. Moving to the next year. First, you will have to make the treatment for interest. Then you will also make the redemption entry, sale of investments. All of these will come, and transfer of debenture redemption reserve back to general reserve. Observe the entry first for the interest. Debenture interest account debit to bank. You're passing the entries from the company's point of view. So interest for the company will be an expense. So the entry will be debenture interest account debit to bank. How do we calculate? 6 lakh into 100. Sorry, 6,000 debentures into 100 into 12%. Total will be 72,000. You are receiving on 6 lakh. So this will be 6 lakh into 12%. Clear? So we understood the debenture interest entry. Next would be, since the amount is getting redeemed, the amount representing in reserves should also be transferred back to general reserve. So what is the transfer entry? Debenture redemption reserve account debit to general reserve. Now how much should be transferred? 10% would have created it as reserves, correct? So the amount lying in the reserves is 60,000. In that, if you divide it by 3, 20 will be the amount which is to be transferred back to general reserve. Clear? Now we have made the investment in asset that needs to be sold. You're getting money. Bank account debit to debenture redemption reserve investment account. 30,000, 30,000. No specific dates given. So this will all happen at the year end. Now after we receive the money, we need to pay it back to debenture holders. First, 12% debentures account debit. Premium is there. Premium on redemption of debentures to bank. Or you can also write here debenture holders, then make another entry debenture holders to bank. Both are correct. I hope you understood what I mentioned. Now how much you are redeeming? 1/3 of it. So 6 lakh was the total liability. 1/3 will be 2 lakh. 10% premium on that. So 20,000. So total will go to the redemption account. Clear? Then next year, same debenture redemption reserve. Sorry. Debenture redemption reserve investment to bank. We are making the second installment. Then debenture interest to bank, where you're receiving the money. Here you should understand this carefully. 6 lakh was the total liability. In that I've already returned 2 lakh. How much is pending? 4 lakh. What is the rate of interest? 12%. So 48,000 is your interest. 4 lakh into 12%. Then debenture redemption reserve debit to general reserve, we are transferring a part of it. 40,000 is still remaining in the debenture redemption reserve account. 20,000 I am taking because 2 more installments are left. Then I'm selling the investment. Bank account debit to debenture redemption reserve investment. 30, 30. Clear? Then we have to make the payment. 12% debentures account debit. Premium on redemption of debentures to bank. Same value, 2 lakh 20. Then comes the next year. Again here also we have to first make the investment. Debenture redemption reserve investment to bank 30,000, 30,000. Then we have to receive the interest. Debenture interest to bank. Now how much is pending? 2 lakh. On that 12% will be 24,000. Debenture redemption reserve investment to general reserve 20,000 was remaining, that is transferred. Then we will sell the asset, bank account debit to debenture redemption reserve investment. You will get 30,000. Clear? Then at the last we will make the payment, 12% debentures account debit, premium on redemption of debentures to bank, 2 lakh plus 20, 2 lakh 20. So this is all of your entry. They've just made the working note here where I helped you directly calculate that. Just show this in the working note, so that will make you more clear on your values also where you have written it. As I mentioned, you can also pass this as a separate entry, but it is already advised to take the combined one. So they were debiting it as loss on issue of debentures. Likewise, we can also transfer it to debenture holders as I explained. So that is also the alternate ways of treatment. So if you observe, the entries are pretty simple. Just it becomes lengthier because they've asked it to pass it for all 3 years. Clear with this, guys? Practice it well because such questions are easy to score full 10 marks, but it is quite time taking since it is asking for 3 whole years. But calculation wise, it becomes very simpler. Clear with this? Yes. So this completes our question number 5. Yes, let's understand question number 6 now. Part A of it. P Limited issued 6 lakh equity shares of rupees 10 each at a premium of rupees 2 per share, payable 3 on application, 5 on allotment including premium. So if 2 rupees is the premium, what will be the breakup? 3 plus 2, and the balance in 2 calls of equal amount. So 10 rupees plus 2 will be 12. You're receiving 3 on application, 5 on allotment, so 8 covered. How much is there on 2 calls? 2 and 2. Understood this? Yes. Then applications were received for 8 lakh shares. Okay, there is over subscription and pro rata allotment was made to all the applicants. The excess application money was adjusted towards allotment. All right. Harish, to whom 1,600 shares were allotted, so they've directly given allotted, failed to pay both calls and his shares were subsequently forfeited after second call. So he failed to pay both the call. So after second call, the shares are getting forfeited. You are required to pass journal entries in the books of P Limited and prepare bank account. So this question is again an interesting and easier one, asked for 15 marks. So if you're conceptually strong, you can easily start passing on the entries. So in the books of the company, what will be the first entry? We have received an excess application. So bank account debit to equity share application, number of application received is 8 lakh, application money is 3 rupees. So 8 lakh into 3, 24 lakh, 24 lakh. Bank account debit to equity share application. Clear? Then next will be transferring to share capital account. What will be the transfer entry? Equity share application account debit to share capital. Here I can only transfer the application money for 6 lakh shares. But I still have 2 lakh in excess application money, which the question is specifying that you need to adjust it towards allotment. So what will be the next entry? Equity share application account debit to share capital to equity share allotment. So 24 lakh debit, equity share capital will go at 6 lakh rupees into 3 and the balance will go to equity share allotment. Clear with this? Then next we will make allotment money due. What is the due entry? Equity share allotment account debit. There is a premium here. So to share capital account to securities premium. How many shares? 6 lakh shares. What is the allotment money? 5 rupees here. 6 lakh into 5. Then equity share capital 6 lakh into 3. 6 lakh into 2 will be securities premium. I hope you're all easier to go with narration. So hence I'm just explaining you the entries. So what will be the next entry? Next entry will be receiving the allotment money. Bank account debit to equity share allotment. Remember we had already received an excess application money which was adjusted towards allotment. How much was adjusted towards allotment? 6 lakh rupees already adjusted. Here you are supposed to receive 30 lakh. So we will credit 30 lakh minus 6 lakh, 24 lakh alone because 6 lakh was anyway adjusted. I hope till here all of you got it. Next, we have to make the first call due. Equity share first call account debit to equity share capital 6 lakh into 2 rupees. So this will be your due entry. Then we have to receive the money. Remember here, there is one shareholder named Harish who's allotted 1600 shares, didn't pay both the calls money. So what will be the entry? Bank account debit, calls in arrears account debit to equity share first call. Calls in arrears will get debited by 1600 into 2 rupees. That is 3200, and the balance will go to bank, all 12 lakh to equity share first call. So this entry can also be passed directly as bank account debit to equity share first call. Okay. Next will be making final call due. What will be the entry? Equity share final call account debit to share capital 6 lakh into 2 rupees per share. Now here also the same shareholder is not paying the call money. The entry will be bank account debit, calls in arrears account debit to equity share final call. So after making the final call, they are going for share forfeiture. So what will be the forfeiture entry? Share capital account debit to calls in arrears account debit because amount is being transferred to calls in arrears to share forfeiture account. Share capital for how many shares? 1600 at 10 rupees. So this will be 16,000. Calls in arrears has 3200 plus 3200, 6400. The remaining will go to share forfeiture. They have not told anything about reissue. This is the final entry. Now, in this case, we have transferred the balance to calls in arrears. The alternate entry for share forfeiture can also be directly to equity share first call to equity share final call also. I hope you understood all of these. Now, in the question, they've also asked us to prepare a bank account. So, we will just reflect where and all we have credited the respective accounts on the debit side in the ledger, and the end balance will be taken as by balance carried down. I told you the question is pretty simpler. It just becomes time taking to just write each and every entry along with narration. Otherwise, the question is very easier one for 15 marks. Practice it well, guys. Last question. Differentiate between periodic inventory and perpetual inventory. So this is again a straightforward theory question. We need to just explain just about periodic inventory and perpetual inventory. Just look at the answer. Periodic inventory, this is based on physical verification, whereas perpetual is just based on book records. Next, this system provides information about inventory and cost of goods sold at a particular date, whereas under perpetual, it provides continuous information. That is, you can fetch the data whenever you require and you need not wait at the particular date when the actual inventory count happens. Then, this system determines inventory and take cost of goods sold as residual figure, whereas under perpetual, cost of goods sold will be determined, but you take closing stock or the closing inventory as the balancing figure. Under periodic inventory system, cost of goods sold will be the balancing figure. Under perpetual inventory system, closing stock will be the balancing figure. I hope this is clear. Then, cost of goods sold includes loss of goods as goods are in inventory are to be assumed to be sold. Since we took cost of goods sold as balancing figure, here you can easily guess closing inventory will include this loss details because that is inventory assumed to be part of inventory. Under this method, inventory control is not possible, whereas under perpetual, inventory control can be projected or can be exercised. This system is simple and less expensive, whereas it is a costlier method. Perpetual system becomes very costlier to implement. Periodic system require closure of business or counting of inventory because they have to pause to complete the counting. So that is not at all a problem under perpetual system. See, inventory can be determined without affecting the operations of the business. So if you are aware of the meaning of the inventory maintenance system, you can easily jot down the differences as it was a straightforward theory question. So this completes our discussion of September 2024 question paper, guys. As I told you in the beginning, some questions are very lengthier for 10 markers where it can take a lot of time, but it was an easier part. If you are just aware of few adjustment points, it was a go through past question paper. So I hope this gives you a good set of practice. Keep giving the best effort, guys, because this is only ultimately going to reflect on your results screen. So until I see you in the next video, take good care of yourself and all the very best. Hello champs, hope you are doing amazing. In this video, let's discuss June 2024 CA Foundation Exams Accounting Question Paper along with ICAI suggested answers. So, while we are running through the questions, practicing what all the important requisites points I will definitely highlight so that you can also get that point of view which will help you in your preparation and planning stage, guys. So, with this spirit, let's begin the session. So, question number one, part A will be true or false. So, let's discuss this one by one. First, if closing stock appears in the trial balance, then it does not enter in trading account. It is shown only in the balance sheet. The given statement is true. If the closing stock is appearing in the trial balance means whatever the purchases value will be reflected would be adjusted purchases. Hence, it will again not appear in trading account to avoid the double effect. So that will only appear in the balance sheet. Hence, the given statement is true. Next, if the amount is posted in the wrong account or it is written on the wrong side of the account, it is called error of principle. The given statement is false. Posting in wrong account or making it an entry on the wrong side of the account is called as error of commission and not error of principle. Hence, it is false. Next, accounting standards can override the statute. The given statement is again false. Accounting statements cannot override the statute. Statute here means law. So, if they are framing any accounting standards, they have to make sure it falls within the frameworks of law because it cannot be overridden. Clear. Next. Promissory note is different from bill of exchange because the amount is paid by maker in case of former and by the acceptor in the later. Yes, the given statement here is true. Promissory note makes an order to a certain person that whoever is promising to pay will be liable, whereas in bills of exchange, one who draws the bill receives the another party's acceptance who incidentally becomes liable to pay. So hence the given statement is true. Next, all errors are rectified by means of journal entries. The given statement is false, guys. All errors cannot be rectified by way of journal entries. Only those errors which does not affect the trial balance can be rectified by passing a rectifying entry. There could be an error which just affects one side of an account which can be rectified only by making a rectification statement. So henceforth all cannot be rectified by journal entries. Next, revaluation account is also known as profit and loss adjustment account. Yes, the given statement is true. Revaluation account otherwise is also called as profit and loss adjustment account. Yes, this was our true or false. Let's observe what is the suggested answer statements as per the institute. First statement, true, the closing stock appears in the trial balance and it is not entered in the trading account, but it is shown only in the balance sheet because it is already been adjusted in the purchases account. Next, the given statement was false. It was called as error of commission and not error of principle. Third, accounting standards cannot override the statute. The standards are required to be framed within the ambit of prevailing statute. This is the key point where you have to mention, wherein you can also simply frame it like the accounting standards which are in the formulation stage, it needs to be framed as per the requirements of law or within the ambit of law. Clear? Next. Next statement was true. Promissory note, it is generally the maker who makes the payment, but in case of bills of exchange, the person accepting the bill shall be liable to make the payment to the holder of the bill. Okay. The next statement is again false. Errors not affecting the trial balance can be rectified by passing rectification entry, as I explained this while going through the statement, while other errors that affect one account of trial balance cannot be rectified by passing journal entries. Totaling errors also cannot be rectified by passing journal entries. All this can be done by just making a rectification statement. Last, revaluation account is also called as profit and loss adjustment. It is used to record the gain or loss arising from either revaluation of assets or liabilities, and this happens at the time of reconstitution. All right. Next question. Define accounting policy. What are the conditions under which a company can change its accounting policy? Again, a straightforward theory question. Let's understand this with the given structure of answer. Accounting policy, first you need to define. It is nothing but specific accounting principles, and it also proposes the methods of applying these principles. See, it refers to specific accounting principles and method of applying these principles adopted by the enterprise for what? In the preparation and presentation of financial statements. Then they are asking the objectives of accounting policies. Policies are based on various accounting concepts, principles, and conventions. This is the first point. And conditions under which it changes can take place. You have 3 points in your study material. Here they have merged it and given us two. The first point here is it is required by some statute or for compliance with an accounting standard. So it is required by any of the statute. This was the first point, or to ensure to compliance with another accounting standard. Then last change would result in more appropriate presentation of financial statements. These are the conditions under which the changes of accounting policies can take place. This is a strict principled point where you cannot write your own answer. That is the static answer which you need to present. I hope this is clear. Next, explain the following: cash basis of accounting and going concern concept. Again, a direct theory question. Cash basis of accounting, you can easily write in your simpler words as well. See, cash basis of accounting is the method of recording financial transactions by which revenues and expenditure, assets and liabilities, because these are the structures which we use as in elements in accounts, reflected in the accounts in the period in which the receipts are actually effected or made, that is actually received or paid. Next was going concern concept. This is one of the accounting concept which proposes that it is prepared on the assumption that an enterprise is going to continue or will continue its operation for the foreseeable future. These are all the keywords which you have to use in your answers. Later, it is assumed that the enterprise has neither the intention nor it need to liquidate or curtail materially the scale of its operations. If such an intention or need exists, the financial statement may have to prepare on different basis, and when they are preparing in such form, there should be a proper disclosure. And if so, the basis used should also be disclosed. That's what I mentioned. The valuation of assets of a business entity is dependent on this assumption, because based on this only we can forecast. That's why this becomes one of the basic assumption as well. Traditionally, accountants follow historical cost in majority of the cases. So this is just another point or direction to present or prepare financial statements. I hope this were clear. Okay. Next part of the question. Pass journal entries for the following transaction in the books of Mr. Kapil. First, purchased goods from Sonu for rupees 1,50,000 at a trade discount of 10% plus CGST and SGST at 6% each. Now, whenever there is trade discount, first find out the transaction value here. 1,50,000, 10% discount here would be 15,000. So your transaction value will be 1,35,000. On this, we will charge GST. So what will be the journal entry? Purchases account debit, input CGST account debit, input SGST account debit to Sonu's account, because we are purchasing goods from Sonu. See, purchases account debit, input CGST account debit, input SGST account debit to Sonu's account. As I explained, 1,35,000 will be the transaction amount. On 1,35,000, 6% was the respective GST. We will write that. So this is 1,35,000 into 6%. And the total will be credited to Sonu. So you will give the narration accordingly. Being goods purchased subject to CGST and SGST at 6% each. Next entry, sold goods to Mohit for rupees 50,000 and charged CGST and SGST at 5% each. Out of the amount due, 40% is received by check immediately. So what will be the journal entry for this? First of all, we are selling the goods to Mohit. Mohit account debit to sales. GST is involved, so you will credit output CGST, output SGST. Some amount is received. 40% of the total due is being received. So bank account accordingly will also be debited. Now let me help you with the amounts, how it is reflected. See, this is the journal entry. Bank account debit, Mohit account debit to sales, output CGST, output SGST. Now from the question we were clear, sales was for 50,000. So we will first write that. GST was 5% each on 50,000, 5% each you will write. Now the total amount due will be 50,000 plus 5,000. Yes or no? So 55,000, in that 40% you are receiving through check. So that will be 22,000. So 55,000 into 40%. Remaining will be standing due. So this would be presented in the narration as well. Being goods sold to Mohit, charge CGST and SGST at 5% and receive 40% in check. All right. Next. Goods costing 25,000 withdrawn for personal use. Such goods were purchased by paying CGST and SGST at 6% each. Now, when goods are withdrawn for personal use, what is the normal entry we pass? Drawings account debit to purchases. Now, on this goods, it was subject to GST. So, we have to reverse this GST part. So, the final entry will be drawings account debit to purchases to input CGST to input SGST. So, the purchases will get credited by 25,000. GST will be charged. What was the GST percentage? GST at 6% each. So on 25,000, 6% each to input CGST, input SGST, and the total gets debited to drawings account. I hope this is clear. So narration should be clear here. Being goods withdrawn for personal use and the GST which was levied on such purchases are now reversed. Next. Machinery purchased from Bright Industries for rupees 2 lakh plus CGST and SGST at 9% each. Paid 1 lakh immediately by check and balance to be paid after 2 months. So you're purchasing machinery from Bright Industries. So first, what will be the purchase entry? Machinery account debit to Bright Industries. Since GST is involved, input CGST, input SGST will also get debited. Here there is 1 lakh paid immediately by check. So to bank will again get credited. So let's understand the amount here. See, the journal entry will be machinery account debit, input CGST account debit, input SGST to bank to Bright Industries. First of all, what was the value of machinery? Value of machinery was 2 lakh. GST rate is given at 9%. So on that we will charge 9% each. The question is clearly telling 1 lakh was paid immediately. So 2 lakh plus 18,000 plus 18 will be 2 lakh 36. If you settle 1 lakh immediately, how much is still pending? 1 lakh 36. So that gets credited to Bright Industries. I hope this is clear. Being machinery purchased and paid 1 lakh immediately. CGST and SGST at 9% each. So question number 1 was pretty simpler and easier to manage as well. I hope all of you understood true or false statement, the validation, why it was true or false, theory question, and then the journal entries. Moving on to the second one. The trial balance of Mr. Sarvesh Kumar as on 31st March did not tally and the difference was posted to suspense account. On a scrutiny of the books, the following errors were detected. So they're giving us the list of errors. Let's first understand the requirement. Yeah, you are required to pass necessary journal entries with narrations to rectify the above errors. So that's just asking us journal entries. So first, the total of sales return book for January has been casted short by rupees 1,000. So this is just a one-sided error. Sales return book will have a debit balance. If it is casted short, how would we increase it? By again debiting. So we can make use of suspense account. So what will be the rectifying entry? Sales return account debit to suspense account to 1,000, 1,000. See, sales return account debit to suspense account. Next, yes, second point. Freight paid for installation of a machine 6,500 was posted to the freight account as 5,600. Now, freight paid was for the installation of machine and this is being posted to freight account. When an expenditure is incurred with respect to installation of an asset, it should also be debited to the respective asset account included as part of cost. So, but here they have taken freight account and that too there is a difference in the amount. So what will be the rectification entry? Machinery account should have been debited with 6,500. So we will debit that. Freight account which is credited by 5,600 we will cancel by crediting it. The difference will go to suspense account, that is 900 rupees. So observe the entry. Machinery account debit to freight account to suspense account 6,500, 5,600 and 900. I hope this is clear. Then next, Goods of the value of 2500 returned by a customer were entered in the sales day book and posted therefrom to the credit of his account. Goods which were returned by a customer were entered in sales day book. When the goods are returned, it is nothing but sales return, but they have wrongly entered this in the sales book. So when it was entered in the sales book, it would have been credited. Now we need to cancel it. So what do? We will debit sales. Sales return account should have been debited. That is not at all done. So we will debit sales return account. This was done, posted therefrom to the credit of his account. See, the entry, normal journal entry would be sales return account debit to customer. With respect to customer, credit is rightly done. So the rectifying entry here will be sales return account debit, sales account debit to suspense account. Observe the entry here. Sales return account debit, sales account debit to suspense. 2500, 2500 and total 5000. I hope this is clear. Next, 18,000 paid for purchase of old motorcycle for personal use of Mr. Sarvesh Kumar was debited to conveyance account. This was purchase of old motorcycle for personal use means drawings account will come, but this has been routed through conveyance account. When this was done, conveyance account would have been debited. Now we need to eliminate it. So what will be the rectifying entry? Drawings account debit to conveyance account. 18,000, 18,000. Observe here, drawings account debit to conveyance account. Being the motorcycle purchase for Mr. Suresh, that is here Sarvesh Kumar, but here they have mentioned Suresh Kumar. Just make a correction. To his drawing instead of conveyance has been previously done by mistake. Okay. Next, a purchase of 6,700 had been posted to creditor's account as 6,000. So when it is credit purchase, what will be the journal entry? Purchases account debit to creditors. The amount here is 6,700, but it has been posted as 6,000. There is 700 short. So what will be the entry? It was being posted to creditors account as 6,000. Purchases, it is rightly done. So we have to increase the creditors more by 700. This will be routed through suspense account. So what will be the rectifying entry? Suspense account debit to creditors account. 700, 700. Being the mistake in crediting is less now corrected, or you can also use the word now rectify. Next, receipt of cash 5,000 from Mr. Avinash was posted to the debit of his account. When cash is received from Mr. Avinash, what will be the entry? Cash account debit to Mr. Avinash account. But here it was posted to debit of his account. Avinash account should have been credited. Now it is being debited. So we need to cancel that. To cancel 5,000 first. So we need to credit Avinash account. So credit Avinash account. So the entry here will be suspense account debit to Avinash, but the amount will be 10,000 because one cancellation of 5 on the numerator on the debit balance and then recrediting it back. So the entry will be suspense account debit to Avinash account 10,000, 10,000. Clear? Next. A check of 2,500 received from Mr. Alok had been dishonored and was posted to the debit of Mr. Ashok. First of all, check received from Alok had been dishonored means Alok could have been a debtor. So when we received the check, the entry would have been bank account debit to Alok. When it is dishonored, again Alok's account will be re-debited, standing it as outstanding due. So now, in this case, it has been posted to the debit of Mr. Ashok. That is, it is done through a wrong account. So what will be the rectifying entry? Alok's account should have been debited. So we will debit that. Ashok's account which is debited should not have been done. It should be credited. So we need to cancel that. To cancel, first 2,500 and then to Ashok will be credited. So observe the entry here. Mr. Alok's account debit to Ashok's account. Clear with this? Yes. Next. Sale of 8,500 to Mr. Deepak was recorded in the sales book correctly, but while posting in the ledger, credited to his account. Sales of 8,500 to Deepak was recorded in the sales book correctly. So what would be the entry? Deepak account debit to sales. It has been correctly recorded in sales book. But while posting in ledger, it is now credited to his account. So Deepak account should have been debited. So they have credited. So what will be the entry here? Deepak's account will be debited by 8,500. This will be routed through suspense account. So the rectification entry here will be Deepak's account debit to suspense account. The value was 8,500. As we discussed, Deepak's account, instead of debiting, they have credited. So that credit, when they cancel, 8,500 there, and additionally on the debit 8,500, total will become 17,000. Next, the total of discount allowed column in the cash for the month of December 2023 amounting to 3,800 was not posted. So this is an error of omission. Discount allowed entry should be passed. So this will be routed through again suspense account. So the rectifying entry will be discount allowed account debit to suspense account. 3,800, 3,800. Next, sale of old office table for 2,200 treated as sale of goods. So this is sale of an asset, but they are treated it as sale of goods. When they treated as sale of goods, what would have been the entry? Cash account debit to sales. But the actual entry should have been cash account debit to furniture account. So furniture account is not considered here. So sales need to be cancelled. The rectifying entry will be sales account debit to furniture account. Sales debit to furniture 2200, 2200 being the rectification of mistake by which sale of furniture was entered in the sales book and hence now corrected by debiting the sales account. I hope this is clear. So this completes our rectification question. Moving on to the next part of question number 2. On 1st April 2022, LMP Co., which depreciates its machinery at 10% per annum on diminishing balance method, had 9,72,000 to the debit of machinery account. On 1st October, part of machinery purchased on 1st April 2020 for 80,000 was sold for 45,000. Now first understand the wordings here. The machinery details opening balance is given to us, and in that part of it on 1st October 2022 is getting sold for 45,000. Next. Also, new machinery at a cost of 1,50,000 was purchased on 1st October 2022 and installed on the same date, and installation charges is being 80,000. So total cost will be 1,50,000 plus 80,000. Next, the company changed the method of depreciation from diminishing balance method to straight line with effect from 1st April 2020 and adjusted the difference on 31st March 2023. So here what they are doing is the method of depreciation is being changed retrospectively from 1st April 2020, and whatever the difference that has been adjusted as on 31st March 23. The rate of depreciation remains the same. So what was the rate earlier? 10%. So here also it will also be 10%. Show the machinery account and ascertain the amount chargeable to profit and loss account as depreciation in the year 22-23. Now for this particular answer, our institute has given 3 alternatives. That is, you can solve it as per any one, whichever you are comfortable. Let me just show that to you once. So I will open another file side by side so that we will have an easy comparison looking at the values. See, this is our question. And as I mentioned, there is alternative 1 given. Then there is alternative 2. Then there is alternative 3. Let me just give you an insight about what these specific alternatives are done. See here, as per alternative 1, the question is solved based on the information given by giving retrospective effect of depreciation only on the remaining machinery as on 31st March 23. That is by ignoring the retrospective impact of change in the method on the machinery disposed of, because the machinery which is getting disposed is happening in the year 2022-2023. Right. So this is the first alternative. Second alternative is this is solved based on the information given in the question by giving retrospective effect of depreciation on all the machinery, including the machinery disposed of. Then there is alternative 3. The change in the method of computing depreciation is treated as change in accounting estimate which may affect the current period or both the current and future periods. Accordingly, the question is solved by ignoring the retrospective effect of depreciation as mentioned in the question. See, this is very much similar to alternative 1 itself. First of all, they are applying the concept behind this. Change in the method of depreciation is nothing but change in an accounting estimate. For a change in accounting estimate, retrospective effect will not at all be considered. So it will only have an impact in the current or future periods. So therefore, any retrospective impacts will be ignored and only the respective change impact will be considered for the upcoming or the current year. Clear with this? So based on this, you can go with either alternative 1 or alternative 3. If we have to literally solve as per what is given in the question, that is they are applying it retrospectively, then you can follow alternative 2. I hope you understood the structure what I mentioned. So here let's understand this with alternative 3 because that seems more logical to apply the concept of accounting estimate. Clear with this? Okay. First, they are asking us what show the machinery account and ascertain the amount chargeable to P&L as depreciation in the year 22-23. So that particular year's account we need to prepare. So we will open the machinery account. There is an opening balance given on 1st April 2022 to balance brought down 9,72,000. Reading further, on 1st October, part of machinery purchased on 1st April was sold for 45,000. So here this 80,000 is nothing but the cost given. So this was cost when way back on 1st April 2020. We actually need the value of this particular item which is getting on the selling date, that is on 1st October 2022. For this we need to do the working. Observe here, calculation of depreciation, written down value and loss on part of the sale of machinery. Cost as on 1st April 2020 was 80,000. They are following diminishing balance method. Rate of depreciation is 10%. So depreciation at 10% on 80,000 will be 8,000. So written down value after considering this will be 72,000. So this was as on 1st April 2021. Then depreciation at 10% for the year 21 and 22, 7,200. WDV as on 1st April 22 will be 64,800. Now the asset is getting sold on 1st October 2022. So how many months? April, May, June, July, August, September. Because it is getting sold on the 1st October itself. So 6 months. So depreciation on this will be 3,240. Observe one thing here, there was a method change in the method of depreciation, and this they are changing with effect from 1st April 20. So now what should you consider for the depreciation will be 64,800 into 10% into 6 divided by 12, 3,240. This is how we are getting 3,240. Then there is written down value as on 1st October 2022, which is 61,560. Sale value is given to us, that is 45,000. So there is a loss on machinery sold, 16,560. See, this machinery is anyway not being continued further. So we are not considering the impact of change of method on this particular asset. So what will be the impacts of this entry? The asset is getting sold. First, you will record depreciation. This is on 1st October. By depreciation on machinery sold 3,240. Then you are receiving some money by bank account. So by bank 45,000. Then there is loss on sale. So you'll also record that by loss on sale, this will be transferred to profit and loss account. That is 16,560. I hope all of you understood this entry. Now this was about the sale. Then further transactions was resulted. So let's understand that. Also new machinery at a cost of 1,50,000 was purchased on 1st October and installed on the same date. Installation charges being 8,000. So what will be the entry for this machinery account? Debit to bank total 2,30,000. Sorry, total to 1,58,000. This is 8,000. I just mistaken it by 80,000. So 1,58,000. So on 1st October to bank 1,58,000. Clear with this? So there is still some assets remaining in the business. So we will have to find out the depreciation on that. Yes, let's understand the working of remaining assets. Computation of written down value of the remaining asset as on 1st April 2022. First, total WDV as on 1st April 2022 was given to us, that was 9,72,000. We understood what is the written down value of the machinery sold from the previous working. That was 64,800. So I will reduce that. So I will have now a remaining value of the assets present. Now we will calculate depreciation on them. Written down value of the remaining asset as on 1st April 2022. Be careful about the dates here. Is 9,07,200. Depreciation on that is at 10%. So that will be 90,720. Then we have taken the written down value after reducing depreciation. Some new machinery was purchased. The cost of it was 1,58,000. So 1,58,000 was the cost of the asset bought in the middle of the year. So how many days or how many months the machinery is present? For 6 months. So we will charge depreciation at 1,58,000 into 10% into 6 by 12. So that will be 7,900. So net of depreciation will be 1,50,100 for that particular respective year. So WTV of the machinery as on 31st March 23 will be 9,66,580. I hope all of you understood this. So what is the total depreciation which is charged? First 9,720 on the remaining assets, 7,900 on the newly bought assets. This is the total. Then there was some asset sold as well. So the total amount of depreciation which is being taken to P&L will be 1,01,680. So this will have to be reflected in the machinery account. See, by depreciation on remaining machinery will be 98,620 because we have already shown the machinery depreciation on the machinery sold separately. Clear with this? Okay. So after doing all of this, we will have balance carried down 9,66,580. Now, if you observe, the change had already emerged in the year 2020. So there was not at all any impact considered here. So therefore, it was all calculated on diminishing balance itself. As I told, you can follow whichever is comfortable with you. You can also just have a look at alternative 1 and alternative 2 answers as well. I hope this question was easy and simpler to understand. Moving to the next one. Yes. Observe the left hand side for question. The receipts and payments account of Vandana Sports Club for the year ended 31st March 2024 are as follows. So they are giving us receipts and payments. Then details of other assets and liabilities are given. The closing value of furniture and sports equipment are to be determined after charging depreciation at 10% and 15% respectively, inclusive of additions, if any, during the year. The question is clearly indicating after considering any addition, you need to charge depreciation. Fine. The club's library books are revalued at the end of every year, and the value at the end of 31st March 24 was 30,000. Okay. 60% of the entrance fee is to be capitalized. You are required to prepare income and expenditure account and then balance sheet as on 31st March 2024. We read the complete question. Nowhere there was opening capital fund available. So as a part of working note, we'll also prepare opening balance sheet. Now let's understand the question. First, we will address what is given in the additional adjustments. So closing value of furniture and equipment, depreciation details are available. Okay. So no other details are given. So we can begin with receipts and payments account. Let's open income and expenditure balance sheet, that is closing, and then as a working note, opening balance sheet. Now observe here income and expenditure. To balance brought down is nothing but cash balance, bank balance is given. So that will directly appear in our opening balance sheet. Observe here balance sheet as on 31st March 23. They are asking us to prepare as on 24. So this will become the opening balance sheet what I am showing. So we are just entering cash in hand 5,200, cash at bank 3,500, whatever is given. Next. Subscription receipts is given 2,95,000. This we need to record in income and expenditure. For this, you will have to make a working. You can either prepare in a statement form or you can prepare a subscription ledger. So here we will directly calculate the value. I'm just telling what you're supposed to use in your answers. So 2,95,000. Let me just write down here. 2,95,000 is the subscription receipt. In the adjustments, we have subscription details given here. Subscription receivable, subscription received in advance. Subscription receivable, opening balance and closing balance is given. So if there is subscription receivable opening balance, it is understood that it is not at all belonging to the current year. So what do? We will subtract minus 18,700. Closing subscription, that is subscription receivable, it means it belongs to the current year. So we will add this 20,600. Likewise, subscription received in advance. Opening subscription. This would have been received for the current year itself. So this belongs to the current year. Hence, we will add 7,000. Then 8,400. This is outstanding at the year end. This is subscription received in advance, means it was belonging to the next year, being received in the current year, which is not relevant for the current year's income. So we will subtract 8,400. So 2,95,000 minus 18,700 plus 2,600 plus 7,000 minus 8,400. This will be your income subscription to be taken in income and expenditure account. See, 2,95,500 is the value we are getting. For this, as I mentioned, you can prepare as a statement. Here they've just written what to be added, what to be subtracted. This is also fine. If you're not comfortable with this, you can also prepare a subscription account, that is a ledger. Now this is entered in income and expenditure. Subscription receivable will be in the nature of an asset. So we will enter this in the opening balance sheet and closing balance sheet. Subscription received in advance will be your liability. All these details will be entered. See here 18,700 asset side. Then subscription received in advance 7,000 on the liability side. Likewise here 20,600 and then subscription received in advance 8,400. I hope all of you understood this. So this completes our subscription transaction. Next, entrance fee. With respect to entrance fee, there was one line. 60% of the entrance fee is to be capitalized. That means balance 40% will be taken to income and expenditure. So total entrance fee received is 50,000. In that 40% will come in income and expenditure, income side. See here, by entrance fee 50,000 into 40% and the rest will go to closing balance sheet. See here, entrance fee 50%, 30,000. Clear with this? Then miscellaneous income. Miscellaneous income, just checking whether there is any other adjustments. No other adjustments given. So directly we will write it in the income and expenditure. By miscellaneous income 19,850. Then interest on investment, again nothing specified. So we will enter here by interest on investment. By salaries, there are some additional respective details given. So salaries outstanding is there 1,55,000. So opening outstanding means it was belonging to the last year. So this is not to be considered in the current year's expense. So 1,55,000 minus opening outstanding. Closing outstanding means this year's expense not paid. So we will have to add this plus 12,400. 1,57,200 will be the amount to be taken to income and expenditure. For this also you can either make a working note or directly show it here. Plus minus both would work. Clear? Next, rent and electricity 69,750 is given. For this also there is outstanding details. Same treatment again, 69,750 minus 6,500, then plus 7,600, 70,850. Clear with this all of you? So here they are given working note, so therefore they are giving the connection here, working note number 2. Like next, library books 10,500. See, if you observe, library books is an asset for this NPO. The club's library books are revalued at the end of every year and the value at the end of 31st March 2024 was 30,000. This is directly given to us. Now you can enter this 30,000 in the balance sheet. But it is better to show the breakup. Why? Because there is a detail given with respect to library books. It is nothing but, see here, in the details of other assets and liabilities, they are giving us the opening balance of library book. So library book 20,000 is the opening balance. By library book 10,500 is nothing but the additional purchase made during the year. So we will consider this. There was also depreciation given on books. There is no depreciation. We can just find it as a balancing figure because we know what is the closing balance. See here, 22,000 is the opening balance, plus additions will be 10,500, minus closing balance should be 30,000. So depreciation will be 2,500. This presentation can be done. See here, library books, opening balance, addition, less depreciation. Because the closing data was already given to us. Clear with this? Yes. Next, buy newspaper and magazines. So directly taken as an expense, magazines and newspaper 16,600. Then buy sports equipment. So this is again an asset. There is opening balance given 41,500. The question clearly emphasized that you need to charge depreciation after any additions during the year. So the addition details is here given. Sports equipment presented in the balance sheet opening 41,500. See here, this is the opening balance sheet, sports equipment. Likewise, library books also we covered. We will enter the opening balance. So in the closing balance sheet, observe the presentation. Opening balance 41,500 plus current year addition is how much? 28,500. So that is being taken here. So this gives us the total sports equipment value. On this, the depreciation is 10%. So this will be totally, sorry, depreciation here is 15%. 70,000 into 15%, that will be 10,500. So accordingly, this will appear in the balance sheet. This depreciation will be shown in income and expenditure account. So you will record this to depreciation sports equipment. Clear? Library books we also found out that also need to be considered. Yes. Next, sundry expenses 71,050 directly entered in income and expenditure. Balance carried down, closing details of cash in hand, cash at bank given. We will just record this. Cash in hand 8750, cash at bank 53,400. Understanding? Yes. So we completely covered the details given in receipts and payments account. Let's look at the other details of assets and liabilities. Salary outstanding, outstanding rent and electricity considered. Investments. This need to be recorded in the opening and closing balance sheet. Investments 1 lakh. Same values are there in the opening and closing as well. Next, interest accrued on bonds. This is again there as an opening and closing balance. So this will have no relevance elsewhere because the same was considered already. Then subscription receivable details was also taken. Then interest accrued on bonds. This is in the nature of receivable. So we will enter the details in the opening and closing balance sheet asset side. See here, interest accrued on bonds 2,000 in the closing balance sheet and interest accrued 2,000 in the opening balance sheet. Done. Next, subscription details already considered. Furniture opening balance is given. So we will record furniture 6,500. We didn't have any details of additions. So we will directly charge depreciation on the same. In the closing balance sheet, depreciation at 10%. See, furniture cost 6,500. Depreciation at 10%. You will show the net balance in the furniture outer column. So this completes all the details. This is also considered. So now first, you will find out the opening capital fund. We have entered all the details. Capital fund will be the balancing figure and take that in the closing balance sheet. Now close the income and expenditure. Find out whether you are getting surplus or deficit. In this question, we are getting surplus. Take that to closing balance sheet by making it add to your opening capital fund and then close the balance sheet. Your balance sheet total will be 3,33,200. See here, I just explained how the values are coming. You will obtain the practice only when you literally solve it. Make sure you practice this once from your end because this is a very good question. Lengthier one which covers few key points as well. So don't forget or don't miss to once do the writing practice. Fine. Next question. P, Q and R were partners sharing profits and losses in the ratio of 3:2:1. They decided to dissolve the business as on 31st March 2024 when their balance sheet was as follows. So there is a dissolution question given. Balance sheet is given. The following information is given to you. There was an unrecorded investment which was sold for 30,000. One of the creditors agreed to take over some of the items of furniture, book value of 25,000 at 24,000. The rest were paid at a discount of 5%. Out of the trade debtors, 9,000 proved bad. Remaining were fully realized. The other debtors were realized as under land and building, machinery, furniture, stock is given. Then there is expenses of dissolution. There was an outstanding bill for repairs which had to be paid for 3,500. You are required to prepare realization account, cash in bank, and then partners capital in the books of partnership firm. So first we will open all of the accounts, realization, partners capital, and then cash in bank. So your first step in dissolution question would be to clear the balance sheet. So first we will clear on the asset side. Assets, land and building. In realization, we are closing the assets account. So the entry will be realization account debit to all the assets. So realization to sundry assets. See here debtors, recording everything at book value itself, 1,56,000. Stock 55,800. Furniture 1,05,000. Plant and machinery at 1,88,000. Land and building 4,85,000. So list of all the assets taken. Here we'll not take cash and bank because there is a separate account open for this. So in cash and bank account, to balance brought down 44,200. Now moving on to liabilities. Partners capital will be opened in the partners capital account as by balance brought down the respective balances. There is general reserve. This should be apportioned amongst all the partners in their whole profit sharing ratio. 1,50,000 in 3 is to 2 is to 1. So that will be by general reserve to all partners capital account. Employees provident fund treated as a normal liability. So liability account debit to realization will be the closing entry. So by employee provident fund 60,000, then there is creditors 1,24,000. Now till now what we did, we just cleared the balance sheet. Now addressing the additional information. There was an unrecorded investment which was sold for 30,000. So here in the dissolution process, unrecorded part doesn't matter. So we are getting the money by selling the asset. So what will be the entry? Bank account debit to realization, because now there is no exclusive asset account. So bank account, by bank, there was an unrecorded investment at 30. We will record that. Next, one of the creditors agreed to take over some items of furniture of book value 25 for 24,000. The rest were paid at a discount of 5%. Now let's understand the working. What was the total creditors? 1,24,000. Now out of 1,24,000, they are taking the furniture worth 24,000. Book value is 25, but they are taking it at 24. How much is remaining? 1 lakh. Now this 1 lakh was paid at a discount of 5% of 1 lakh. So that will be 1 lakh minus 5%, 95,000. So two bank creditors for this, they are made up working note 95,000. Next, out of the trade debtors, 9,000 proved bad, remaining were fully realized. What was my total debtors? 1,56,000. So in this 1,56,000, 9,000 proved bad and rest were fine. So how much will be the remaining? 156 minus 9, 1,47,000. So that we will take here. Next, the other assets realized as under, they are giving the list. So we will also record it accordingly. Land and building is given 5,25,000. Machinery 1,70,000. Then furniture remaining taken over by P at 75. Furniture was 1,05,000. In that 25,000 was taken over. So remaining is taken over by P. Who is this P? One of the partners. So what will be the entry? Partners capital account debit to realization. See here, by P's capital at 75,000. Since we have opened, we have to make the simultaneous entry to realization in P's column. Clear with this? Next, stock 60,000. So stock 60,000. Then expenses of dissolution amounted to 18,700. What will be the entry? Realization account debit to dissolution expenses. So that is nothing but routed through bank. So to bank expenses 18,700. Then there was an outstanding bill for repairs which had to be paid for 3,500. Outstanding bill for repairs means this is your liability. Since we are now closing it down, we have to anyway settle it. So to bank again, to outstanding bill for repairs, that will be considered. Next, after we do this, before we close, we have to once cross check, because any liability which is not told the settlement terms, we will have to assume that it is settled at book value. See, in this question, there were creditors. Creditor settlement is done. Employee provident fund was there. There was no details given. So we will assume it is settled at book value. So that entry should be written to bank employee provident fund 60,000. So after all this, we will close the realization account, find out whether there is profit or loss. In this case, there is profit. We will apportion that profit in their old profit sharing ratio. Take this to the partner's capital as by realization profit. Now, wherever we have addressed bank, all of these entries will be reflected in our cash or bank account. At the end, partners' capital will not be closed because here we are not continuing the business to have balances carried forward. So that will be settled as two bank. This is as good as partners are to be paid. So this details will be recorded in the bank account and accordingly your bank or cash account would tally. So this is the structure of how to solve a dissolution question. I hope all of you understood this. Yes. So this completes our question number 3. Next question. Anu and Manu are carrying on business in partnership and sharing profits and losses in the ratio of 5:3. The firm's balance sheet as on 31st March 2024 was as follows. They decided to admit Ranu as a partner with effect from 1st April 2024 on the following terms. Ranu will be paid 1/5 share in the future profits and new profit sharing ratio would be 5:3:2. Ranu will bring 1 lakh as his capital. Goodwill of the firm is to be valued at 2 years purchase of average profit of past 3 years and Ranu will bring his share of goodwill in cash. The profit of past 3 years ending on 31st March were as under. So 3 years data is given. It was also agreed that the partners will not withdraw their share of goodwill nor will the goodwill appear in the books of accounts. That means this needs to be done through adjustment of partners' capital. It was also decided to value the assets. Revalue details are given. Okay, then provision for doubtful debts is to be created on debtors at 5%. You are required to prepare revaluation account, partners capital and balance sheet. So first we will open all of the accounts, revaluation, partners capital and then balance sheet and then start with the question. So first we will complete off the revaluation account. That becomes simpler. Only one point for all revaluation details is given. Building is appreciated. So by building, credit side on revaluation. Machinery is to be depreciated by 10%. What is the machinery value? 1,43,000. So 10% means 14,300. To machinery 14,300. Then furniture is to be revalued at 80,000. What is the value of furniture? 85. So that is downward revaluation to furniture 5,000. Investments at 16,000. Investments value is 15,200. It has been appraised by 800. So buy investments. Then inventories at 47,500. Inventories is 48,400. There is a downward revaluation to inventories 900. Provision is to be created on debtors. How much is my debtors? 1,64,000. Provision rate is 5%. So that will be 82,000. Provision for doubtful debts. So this completes our revaluation treatment. Find out the difference between debit and credit side. Here there is profit on revaluation. This will be credited to old partners in their old profit sharing ratio. What is the old profit sharing ratio? 5:3. So this completes our evaluation. We'll now open the partner's capital first by balance brought down. If there are any old reserves, that should also be taken here. In this question, there is nothing like that. So we have revaluation profit. So that will be credited by profit on revaluation. 2 entries done. Now next entry would be Ranu, that is new partner bringing capital. So what will be the journal entry? Bank account debit to Ranu's capital. So by bank with respect to capital. Then the next treatment would be for goodwill. They are asking us to find the firm's goodwill. 3 years data is given. So we can apply average profits method. 87,000 plus 1,06,000 plus 1,22,000 divided by 3. So my average profit is 1,05,000. This is just average profit. If I want goodwill, I have to multiply it with number of years of purchase, that is 2. So this will be 2,10,000. This is the firm's goodwill. We want only the partner share. What is the future share of profits? 1/5. So the share of new partner's goodwill will be 42,000. For this, you need to make a working. Observe here, 42,000 is the new share of, new partner's share of goodwill. Now this should be apportioned to the old partners in which ratio? Sacrificing ratio. That needs to be found out. They are giving us new ratio. There we have the details of old ratio. How can we calculate the sacrificing ratio? Old minus new. For Anu, 5 by 8 minus 5 by 10. LCM between 8 and 10 will be 40. See here, 40. 8 5s are 40. 5 5s are 25. Minus 10 4s are 4 5s are 20. So this will be 5 by 40. Then 8 and 10 again will be 40. 8 5s are 40, 5 3s are 15. Minus 10 4s are 4 3s are 12. So this will be 5 by 40 and 3 by 40, or 5 is to 3. 42,000 will be apportioned in the ratio of 5 is to 3. So this will be 26,250, 15,750. So what will be the journal entry? Anu's capital account, sorry, Ranu's capital account debit, 42,000, to Manu's capital, and then to, sorry, this is first Anu's capital to Manu's capital. So this will be the entry which will be reflected in the partner's capital. Let me write this here. Near the solution, so it becomes easier for you to understand. Yes, clear with this? So this will be reflected in the partner's capital. Partner's capital account. The entry was Manu's capital to Ranu's capital to Manu. So Ranu's capital by bank is only taken. This simple reason being he is bringing his share. So that's why directly written here by bank in Anu's column and in Manu's column. This can also be done. If not, you can just write bank account debit to Ranu's capital with total 1 lakh plus 42,000, and then Manu's capital to Anu's and to Manu's. Sorry, I'm again mistaking with Ranu. Ranu's capital to Anu and Manu. So then we will apportion the goodwill entry. Both ways are clear. Okay, after entering this, you will find out the closing values of the capital account and then take it to balance sheet. In balance sheet, one thing to observe is you will take the revalued data of all the assets and liabilities, and then there was one point which needs to be considered carefully. Cash and bank balance is given as 30,100. Now what will be the revised cash and bank balance? 30,100. 1 lakh was the new partner's capital plus 42,000 additionally as goodwill. Totally 1,72,100 will be the share. Be careful with this. This is the one point to take care. Remaining revalue data and all you can easily do. This was how much? What was the cash balance? 30,100 plus 1 lakh minus, plus 42,000. So for this, there is also a working given in the form of bank account. You can also go through that as well. I hope all of you understood this simpler questions. It takes some time, but it is easier if you are aware of the respective adjustments. Yes, next question. Harshit traders are carrying on the retail business of electrical goods. They keep their books of accounts under single entry. The balance sheet as on 31st March was as follows. Okay. The summary of cash and bank book for the year ended 31st March 2024 was given as below. They are giving us the cash book details itself. Then there is additional information. You are required to prepare trading and profit and loss and the balance sheet as on that date. So first we will open trading account, profit and loss, and then balance sheet. There would also be some additional working notes required. So we will do it as we run through the question. Okay, now we will read the additional information. Gross profit ratio of 12.5% on sales is maintained throughout the year. Okay. During the year, discount allowed to trade debtors was 62,500 and discount received from trade creditors amounted to 35,000. As on 31st March, closing balance to trade debtors and trade creditors were 22,500 and 1,05,600. See, these are the points hinting us to prepare debtors and creditors account as a working note as well, because some data would be missing. Okay. On 31st March 24, an amount of 14,500 was outstanding towards salary. Depreciation at 10% on motor vehicle and furniture. Okay, these were the additional details. So we have to also prepare in the working note additional debtors account and creditors account. Now we will run through the details and make an entry accordingly. Capital account balance is given, so we will directly take it in the balance sheet. Opening balance, capital 6,05,000. Then trade creditors was 75,200. This is the details as on 31st March 23. Observe this carefully, all of you. Details as on 31st March 23. Here they are giving us the details as on 31st March 24. What does this mean? There is opening balance and closing balance. So if you have opened creditors account, by balance brought down 75,200 and to balance carried down 1,05,600. This was taken. Then salary payable 9,000. Salary payable means it is still outstanding in the opening balance sheet also. So in the trading account, we have to record the current year expense 9,000 plus there is one salary outstanding closing also 14,800. So these two should be taken. Likewise, in the cash book, we have to also cross check whether there was any salary payment. Yes, there is salary payment 4,12,800. So 4,12,800 opening outstanding should be reduced minus 9,000 plus closing outstanding is 14,800. So your current year expense will be 4,18,600, which you can also show this as a working note. Next, motor vehicle 1,10,000. The question says charge depreciation 11,000. This will appear in our profit and loss account. To depreciation 10% on 1,10,000. Then on furniture also 73,500, 10% depreciation. So that should also be taken in the profit and loss. Stock in trade 1,70,800. So stock in trade, this will be our opening stock in the trading account 1,70,800. Then trade debtors, again same like creditors, this will be the opening balance. To balance brought down 1,45,400. There is a closing details given. 1 lakh trade debtors 2,20,500. So by balance carried down. In the adjustments also there was discount allowed given. So discount allowed, what would be the journal entry? Discount allowed account debit to debtors. So that will also be entered here by discount allowed. This discount allowed should also be appearing in your profit and loss account. See here, to discount allowed 62,500. Then there is discount received. Discount received is 35,000. Discount received is again, so this will also be recorded in P&L. Discount will be received from creditors. What will be the entry? Creditors account debit to discount received. So that will appear in the creditors account to discount received. Clear with this? Yes. Next. So like simultaneously we have also finished two adjustments. This is also done, salary outstanding. Depreciation is also done. Then 6% investment 60,000. So in the balance sheet, investment should appear 6% investment at 60,000. Then cash in hand at a bank, opening balance 1,29,500 is given. All right. So this is anyway available to us in the opening cash book balance. Cash sales is given. So this will appear in our trading account. We will show this as a breakup. Cash sales 10,22,400. Receipts from trade debtors. So what will be the entry? Cash or bank account debit to debtors. So we will record this in the debtors account by cash or bank 85,52,000. Then interest on investments 3,600. So this is received. So we will record this in the P&L account 3,600. Cash purchases is given. Trading account to cash purchase 948,400. Then payment to trade creditors. What will be the entry? Creditors account debit to cash or bank. So there is an account open. So we will enter that to cash or bank 75,45,000. Then salary is already done. Rent and taxes, normal expenses 2,51,600 in the profit and loss account. Then sundry expenses 138,400. So in the profit and loss account. Drawings in the balance sheet 2,40,000 less drawings. Then closing cash and bank balance is given, that we will directly take it to the balance sheet 1,71,300. All of you understood whatever we have done till here. Now we have opened the respective accounts, just closing is remaining, rest all details has been considered. See, from the presence of debtors and creditors, we understand that there is credit sales, credit purchases involved. So we have opened the debtors and creditors account. Always remember guys, when there is debtors or creditors account, always 4 entries are mandatory to be observed. Opening balance, closing balance, sales when it is debtors, and payment received from debtors. Likewise for creditors, opening balance, closing balance, credit purchases, and payment made to creditors. These four are the stagnant things. So in this question, there was additional one more thing, discount allowed receipt, we have anyway recorded. Basic things, what is present, 4 items, that is what I explained. Now, observe in debtors account. So we have entered all the things. So what is the closing balance? That is also was given to us in the question. So what is pending credit sales? So we will find that as a balancing figure. So two credit sales will come 86, 89, 600. This will be recorded in the trading account. See here 86, 89, 600. Likewise, we will close the creditors account. We will find purchases as the balancing figure 76, 10, 400. We will record this in the trading account. Credit purchases. Clear? Now for gross profit, the question is clearly telling what is the percentage. So 12.5%. If you observe in the question, closing stock details is not given. So here we will also find that as the balancing figure. Now what is my total sales? Cash plus credit 97 lakh 12,000 on this 12.5%. So that will be 12 lakh 14,000. Close the trading account, find out closing stock as the balancing figure. Take this to closing balance sheet 2 lakh 31,600. See here 2 lakh 31,600. Likewise, trade receivables was also there. Okay, we will take that as well. 2 lakh trade receivable, trade debtors detail was 1 lakh 45,400. Remember, closing balance was given to us in the question. That is what is written here. Likewise, trade creditors, outstanding salary detail is given. Now we will close the profit and loss account. In this question, there is net profit. We will take that to the capital balance and find out the capital plus profit balances. Ultimately, you will get the total of balance sheet tallied, which is 8,48,550. This question, if you solve literally, it is going to take some time for 8 markers. So make sure you practice from your end once, so you will also understand how much time is being allocated from your end depending upon your speed, and that will definitely help you the measures to speeden up with your solving. Clear with this? Yes. So this was our question number 4, both parts done. Next, question number 5. Manish closed his books of account on 31st March each year. Inventory taking for the year ended 31st March was completed by 10th April 24, on which date value of the stock available in godown was of 4,50,000 at cost. Following are the details of transactions that took place between 31st March 24 and 10th April 24. Goods sold to customer, sales return, purchases 85,000 including cash purchase, purchase returns is given, then goods costing 15,000 received in March for sale on consignment basis, out of which 60% of goods had been sold. These sales are not included in the above sales. Then after the stock was taken, it was found that there was certain very old slow moving items costing 14,850, which should be taken at 9,500 to ensure disposal to an interested customer. Goods are sold at a profit margin of 25% on cost. Ascertain the value of inventory for inclusion in the final accounts for the year ended 31st March 2024. Now, we are supposed to find out the value of closing stock as on 31st of March. In this details, there are course of transactions given from 31st March to 10th April. So we will understand this one by one. First, goods sold to customers 1 lakh 10. There is sales return of 10,000. Whenever such returns are there, we will always consider the net transaction amount. So 1 lakh 10,000 minus 10,000 return. Net sales is 1 lakh. Now we want the value of goods as on 31st of March. Sale has happened after 31st of March but before 10th April. So sales is happening in between that year means it should be part of my stock as on 31st of March. So what do? We will add this back. Remember, sales details will be given at sales price, but we only need cost price here. Check whether gross profit margin is given. It is given, but here it is 25% on cost. We want it on sales. 25% on cost means If I have to consider cost as 100 and profit margin is 25% on cost, my selling price will be 125. So how much is it on sales? 25 by 125. So this will be 20%. So 1 lakh on that 20%, if I take out gross profit, 80,000 will be added back. Understood with this? Next, purchases 85,000 including cash purchases. Again, we will take the net 85,000. Cash purchase or credit doesn't matter. Purchase return is 2,500. So 85,000 minus 2,500. So purchase would have added to your stock. But this should not be part of my stock as on 31st of March. What do? We will subtract. Minus 82,500. See here, less 82,500. Next, goods costing 15,000 received in March for sale on consignment basis, out of which 60% of the goods had been sold by 10th April. These sales are not included in above sales. First of all, you are acting here as a consignee. You have received the goods on consignment. Out of that, 60% have already been sold. Now we are just calculating how much is left with you, and this should be as per the details as on 31st of March. 60% of the goods has been sold. Now how much is remaining with us? 40%. That impact should be considered. In this case, you are supposed to include this or not. This is not at all part of your stock. Yes. So 60% is anyway not available with us. 40% should also not be part of our stock because this is not my goods. This is consignor's goods. Are you understanding? So how much should be subtracted? 15,000 into 40%. Clear with this? Next, after the stock was taken, it was found that there was a certain very old, slow moving items costing 14,850, which should be taken at 9,500. So this just is nothing but correct valuation of stock. So they are writing it down. Just check the difference which will not be included. 14,850 minus 9,500. So this will be written off. So you will subtract this. Considering all of these, see here 4,50,000 plus 80,000 minus 82,500 minus 6 minus 5,350 will give us 4,36,150. I hope all of you understood this. This was a simpler and an easiest question. There is an alternate presentation here wherein they have taken the written's details separately here, like reverse calculation. So this can also be done, but it is always easier to consider the net sales and net purchases. All right. Next question. Attempt any one of the two subparts, that is either 1 or 2. So there is an internal choice available here. Mr. Prakash runs a factory which produces pressure cookers. The following details were obtained about his manufacturing expenses for the year ended 31st March. So they are giving a list of manufacturing details. You are required to prepare manufacturing account for the year ended 31st March 2024. So we will prepare a manufacturing account format, and then simple sums, we have to just enter the details. Opening work in progress to opening WIP 6 lakh 25, closing WIP 7 lakh 15. Then there is opening inventory of raw material. So here we will have to record raw material consumed details in the manufacturing account. So how do we find that out? Raw material consumed, opening stock of raw materials, that is 5 lakh 85,000 plus purchases 18 lakh 74,000 minus closing stock of raw materials 4 lakh 70,000. So if there is any direct expenses, we'll also include this. In purchases here, in this question, there is purchases returns. We will take the net here. 1874 minus 95. So here it will be 1779,000 minus 95. So this will be 22 lakh 69,000. Then opening inventory of raw material, closing inventory of raw material, these details are given. As per manufacturing account, we need to record raw material consumed details. How can we find that? Raw material consumed. Raw material consumed will be opening stock of raw materials plus purchases if there is any direct expenses, and then minus closing stock of raw materials. Opening inventory of raw materials 5 lakh 85,000 plus purchases. In this question, there is also purchase return. So we will take the net value 18 lakh 74 minus 95,000. This will be 17 lakh 79,000 minus closing inventory 4 lakh 70,000. So 5 lakh 85 plus 1779 minus 4 lakh 70. So this will be 18 lakh 94. So here only they have shown the working. You can also do it likewise. Okay, so this details all considered. Then indirect material 1 lakh 88. In the presentation, we will show it in the later order. So two indirect material 1 lakh 88. Direct wages, two direct wages 3 lakh 97. Indirect wages again 82,000. Power and electricity 1 lakh 76. Repair and maintenance 2 lakh 65. Depreciation on factory shed 1 lakh 44, and then plant and machinery 1 lakh 62. Sale of scrap will be your casual income, so we'll record it on the credit side, sale of scrap. All details entered. So you will close the account. The difference will be transferred to trading account as cost of finished goods. So this will be taken to the trading account as the opening balance. Next question. From the following particulars, prepare the bank reconciliation statement of businessmen as on 31st March. Okay. Bank overdraft as per cash book is given. So your base book is cash book having a negative balance. Okay. So this is my cash book. This is my passbook. Check deposited as per bank statement but not recorded in cash book. Check deposited means the balance would have been increased. My base book is cash book. There is no entry here. In order to match, I will have to add. Since this is overdraft balance, I will subtract. Next, cash received from X was entered in the bank column of cash book. That means entry is made in the cash book. Cash received means balance would have been increased. There is no entry in the passbook. In order to match, I will have to bring down. Since this is overdraft, I will add. Debit side of the bank column casted short. Debit side of the bank column here represents receipt side. So bank column casted short means it is showing short by 1,000 rupees. There is proper entry in the passbook. Base book is cash book. In order to match, I will have to add. So since this is overdraft, I will subtract. Check of 9,000 deposited, but collection as per bank statement is 8,950. Check deposited 9,000, but in bank statement up to 8,950 is reflected. 50 rupees is a difference. I will have to subtract. Since this is overdraft balance, I will add back. How much? Only 50 rupees. Next, bills sent to the bank for collection, collected by the bank but not recorded in the cash book. Bills for collection means bank balance would have been increased. It is recorded, but it is not recorded in the cash book. So if I have to match, I will have to increase the balance. Since this is overdraft, I will subtract. Next, bank charges recorded twice in cash book. So this is cash book, passbook. Bank charges recorded twice means I'm showing 40 rupees, 40 rupees, total 80 rupees recorded. In passbook only 40 rupees. So the difference I will have to reconcile by adding back. Since this is overdraft balance, I will subtract. Same by 40 rupees. Noting charges debited in passbook for discounting bill dishonored. So it is charges. It is debited in passbook means entry is already done. No entry in the cash book. In order to match, I will have to reduce. Since this is overdraft balance, I will add. Then checks deposited on 25th March but collected by bank on 5th April. Checks deposited on 25th March means you would have already made the entry in cash book. There's no entry in the passbook because the collection is happening on 5th March. What to do in order to match? I will have to reduce. Since this is overdraft, I will add back. Checks issued on 26th March but presented for encashment on 6th April. Same. Checks issued means I would have already made the entry in cash book, balance showing less. No entry in the passbook. In order to match, I will add. Since this is overdraft balance, I will subtract. I hope all of you understood this. Now let's find out the balance as per the other book. 24,000 minus 4,000 plus 3,150 minus 1,000 plus 50 minus 4,200 minus 40 plus 60 plus 4,800 minus 3,000. So your balance will be 19,820. This is coming positive. So this will also be overdraft balance as per passbook. I hope this is understood. Next, the following is the abstract of balance sheet Happy Limited as on 31st March 2024. There is issued and paid up capital 90,000 equity shares of 10 each fully paid up. Then there is calls in arrears, 10,000 equity shares has not paid. 40,000 equity shares of 10 each, rupees 4 cash paid up. So there is partial payment. Reserves and surplus balances are given. Capital reserve is there, capital redemption reserve, securities premium, general reserve, P&L. On 1st April 24, the company makes final call at rupees 6 each on 40,000 equity shares. This was already taken at 4. Now they are calling the balance value. The call money is duly received by 30th April. All right. On 1st May, the board of directors of the company decided to forfeit the share on which final call of rupees 2 each is due. To reissue the forfeited shares at 11 each as fully paid up. Then to issue fully paid bonus shares in the ratio of 1 fully paid for every 2 fully paid shares held. And to use minimum balance of profit and loss. Pass necessary journal entries on the basis of the above decisions. So a simpler question, let's understand the entries one by one. First, we have to make the final call due. Now this is happening on 1st April. 1st April 2024, equity share final call account debit to equity share capital. How many shares? 40,000 shares at 6 rupees each. So this is how we get the balance. Next, you are receiving the money on 30th April. So on 30th April, bank account debit to equity share final call. Clear with this? Then what happened? To forfeit the share on which final call of rupees 2 each is due. Now understand one thing, in the balance sheet, there was some shareholders, 10,000 shareholders who did not pay the call money. So it is already sitting in calls and arrears account. That shares are now being forfeited. So what was the forfeiture entry? The balance is transferred in calls and arrears. So equity share capital account debit to calls and arrears account debit to share forfeiture account. How many number of shares? 10,000 shares at 10 each for equity share capital. Calls and arrears already amount worth 20,000 is being present. See here, 20,000 is already there. The balance go to forfeited shares account. Clear with this? Yes. So this is done. Then to reissue the forfeited shares at 11 each as fully paid up. So what will be the reissue entry? The shares has been reissued at premium. So bank account debit to equity share capital account to securities premium. How many shares are being reissued? 10,000 shares which were forfeited. 10,000 into 10 for share capital, 10,000 into 11 for bank, and 10,000 into 1 for securities premium. I hope all of you understood this. Next, to reissue fully paid bonus shares in the ratio of 1 fully paid shares for every 2 fully paid shares held. Now we have to find out how many shareholders are there and how many are receiving the bonus shares. Company started with 90,000 shares. In that, 10,000 was calls in arrears. Yes. So these 10,000 was cancelled. That is nothing but reflecting your forfeiture entry. 40,000 paid the money. So that is fully paid up. Correct? Later, again 10,000 shares were reissued. Yes or no? So there are totally how many shareholders? 1,30,000. So 1,30,000 shares. The ratio is 1 share for every 2 shares held. So this will be 65,000. So the amount required will be 65,000 into then 6,50,000. So this has to be done by utilizing respective reserves. Now observe carefully. The question is specifying that to use minimum balance of profit and loss. So we have capital reserve, capital redemption reserve, securities premium, general reserve, and then P&L. Here you should be very careful. Now we have stopped at the reissue entry. After reissue, balance in share forfeiture will be transferred to which account? Capital reserve. So that one entry should also be completed. Forfeited shares to capital reserve. Now understand things carefully. Capital reserve balance was already there 60. Now we are transferring this from share forfeiture. So your balance will increase from 60 plus 80 to 1,40,000. Can I use this for bonus issue? Yes. So I will make use of this. Then there was a share reissued at premium 10,000. This is also getting added to your existing securities premium balance, which was 1,10,000 more. So keeping this in mind, let's understand the due entry. Capital reserve account debit 1,40,000. I explained you how we got this 140. Then securities premium 1,10,000, 1,00,000 from the balance sheet, 10,000 from reissue. Then the remaining capital redemption reserve full 160. General reserve 120 and the balance will be taken from profit and loss account. The due entry will be to bonus to shareholders account. The requirement was 6,50,000. So then, while we issue the shares, bonus to shareholders account debit to equity share capital 6,50,000. So this will be your journal entries. As I told, the question was simpler. You have to just be careful with the points where we highlighted. Clear with this? Yes. So this completes our question number 5. Next, question number 6. The following balances appeared in the books of MAC Limited as on 31st December 2023. 80,000, 10% preference shares of 100 each, 75 is being paid up. 2 lakh equity shares of 100 each, fully paid up. Securities premium balance, capital redemption reserve balance, general reserve balance is given. Under the terms of their issue, the preference shares are redeemable on 31st March 2024. The redemption date becomes important at a premium of 5%. In order to finance the redemption, the company makes a right issue. 60,000 equity shares of 100 each at a premium of 10%. That means at 110 rupees. 25 payable on application, 45 including premium on allotment, and the balance on 1st August 2024. Remember, the redemption is happening as on 31st March. Balance, which is nothing but your call, is happening as on 1st August. The issue was fully subscribed and the allotment was made on 1st March. The amount due on allotment duly received by 25th March. So, you're receiving the allotment money before March. The preference shares were redeemed after fulfilling the necessary conditions of Section 55 of the Companies Act. What does Section 55 proposes? You can provide for redemption by issuing fresh issue of equity shares or by utilizing the undistributed profit balance, that is by creating capital redemption reserve. We need to consider these points. You are required to pass the journal entries including narration to give effect. Also prepare the notes to accounts on share capital, reserves and surplus relevant to the balance sheet. Immediately after redemption as on 31st March, ignore date column. So date column should be ignored. The question is specifically given. Now first let's understand the entries. See, first would be you're making the redemption due. So what will be the entry? Before doing the redemption due, observe one important thing carefully. Preference shares can be redeemed only when they are fully paid up. Here, the shares are partly paid up and the company has decided for redemption. So, it becomes our assumption that the first company shares are made fully paid up and then going for redemption. So, in order to make it fully paid up, first we have to make it due. What is the name of preference share? 10% preference share capital account debit. So, this is on your final call. So, the entry will be 10% preference share final call account debit to 10% preference share capital. 25 rupees at 80,000 shares. Then you're receiving that call money, bank account debit to 10% preference share final call. So these are the two entries we need to pass first. Clear with this? Yes. Next. After doing this, the company is going ahead making reissue. It is split up in application allotment. So first, receiving the application money. What will be the entry? Bank account debit to 10 equity share application. 60,000 shares into 25 each. Clear? Then you're transferring this application money to share capital. Equity share capital, equity share application account debit to share capital. 15 lakh, 15 lakh. Clear? Next, allotment includes premium. So what will be the due entry? Equity share allotment account debit to equity share capital account to securities premium account. How many shares? 60,000 shares. What is the breakup here? 10 rupees is the premium, means 35 rupees will be your allotment money. 60,000 into 35, that will be 21 lakh. And 60,000 into 10 rupees, 6 lakh will be for premium. Total for equity share allotment. So they have told allotment money is being received. So bank account debit to equity share allotment 27 lakh. All of you understood till here? Yes. Now we need to find out how much money is available through the issue of equity shares because redemption is happening as on 31st March. Remember, we have to consider face value here as per section 55. So if we have to do the working, what is the requirement? 80,000 into 100. 80 lakh is the requirement. Now from the issue of shares, this has happened till 25th March. How much money is already received? See, from share application 15 lakh, from share allotment 21 lakh. We have to only take face value. Be very clear with this. So 15 lakh plus 21 lakh. This amount is received already. So 80 lakh minus 36 lakh. Balance is 44 lakh. This is not yet collected from the issue of shares. That means this should be considered from creating capital redemption reserve. So first we need to make this working. We need to find out how much money is required by the creation of capital redemption reserve. So first we will transfer the money from general reserve. What is the entry for that? General reserve account debit to capital redemption reserve. This is how we are getting 44 lakh. Clear with this? Now we have got all the money. Now we will first make the redemption entry due. What is the redemption due entry? 10% preference share capital account debit. There is a premium on this. Premium on redemption of preference shares account debit to preference share holders. So 10% preference share capital, 80,000 shares at 100 rupees. Premium on redemption is 5% on 80 lakh, 5% to preference shareholders, total of this. Then at the end, you are making the payment, preference shareholders to bank 84 lakh, 84 lakh. Clear with this? At last, we had this premium which should be written off. This should be done by transferring it to general reserve. So general reserve account debit to premium on redemption of preference shares. These were all the journal entries. They've also asked it according with the narration. So you can go through with the narration. Now we will observe in the notes to account how it will get reflected in the share capital. See, 80,000 preference shares is now already redeemed. There is remaining, which is equity shares, 2 lakh equity shares. Remember, right shares are now being issued. So 60,000 until 60 rupees is collected. That is application and allotment. Only that will be reflected here. Be careful here. Then in reserves and surplus, securities premium already had a balance of 6 lakh 50. Now in this 6 lakh 50, we are additionally issuing shares at premium. So that will also be added. Capital redemption reserve already had a balance of 42 lakh. Additionally 44 we are creating. So that will also be added. In general reserve, there was a balance of 85 lakh. First, you created capital redemption reserve. So minus 44 lakh. Then you've also adjusted premium on this. So the revised balance will be 37 lakh. This entry should be properly done. Understood? Yes. So for this working, how we got 44 lakh, as I explained here, you have to also give a working note. This was simpler. I hope all of you understood this easily. Next question. What are the advantages of subsidiary books? Again, a very simpler theory question. What are some benefits or the plus points of subsidiary books? It helps in division of work, easy allocation of tasks, and you can easily compare. It will involve less time. So all these could be your advantages. Observe here, division of work. Since at the place of one journal, there will be so many subsidiary books. Let me show it in one document itself. Yes, first is division of work. Since in the place of one journal, there will be so many subsidiary books, the accounting work may be divided. Specialization and efficiency. Some same work is allotted to a particular person over a period of time. He will gain proficiency in that. So that helps in specialization and the work can also be done efficiently. Saving of the time because now the tasks have been allocated differently. Instead of one person doing all of the things, since it is being divided, it helps in saving time. Then availability of information, since a separate register is kept for each class of transaction, information relating to each class and transaction will be available at one single place. Next, facility in checking. When the trial balance does not agree, the location of errors is facilitated by the existence of separate books. Since the information is now broken into different set of books, it becomes easier to find it in a lesser time. So even the commission of errors and frauds will be checked by use of various subsidiary books. So these were the simplest points. Just take note of it and memorize accordingly because such if straightforward question comes, it becomes very easy to manage. This completes our discussion of June 2024 question paper, guys. It was again a good set of questions included for your practice. Make sure you literally solve it once from your end. That is when you know, or that is when you can evaluate where you are actually standing. All right. Give your best effort, guys, because everything, whatever you're doing now, will definitely be counted once you see that result successful on the result day. Wishing you all the very best in all of your preparations. Take care, guys.